Cosby trade. We don't have much tech here, so actually maybe on days like today, Tom, we benefit.
At least for today, that is the dynamic that you could point to, with gains in the futures. European futures looking to build on the upside of yesterday, pointing up by 0.3%. Yesterday, it was media at the top of the list in terms of your sectors. It was autos under pressure. Today, look at the basic resources. Look at energy, of course. Brent a little softer in the session. WTI, though, in positive territory the last time I checked. FTSE 100 futures pointing to gains of 47 points, up 0.5%. DAX futures looking to add around 74 points, up 0.3%, Anna.
Let's talk about some of the individual stocks in focus then, Tom, as we head towards the market open for this Tuesday morning. And we'll start with the banking sector. Standard Chartered is in focus. The CEO saying AI will replace, quote, lower value human capital, which sounds a bit ominous. But we'll watch that one at the start of trade to see where that takes us. There's been a briefing with media, it seems, over in Hong Kong, I think, certainly in Asia. Delivery Hero in focus as well. Uber Technologies has increased its stake in the German food delivery company Delivery Hero. They're trying to counter competition from DoorDash outside the United States. They don't want to buy as much as 30% of Delivery Hero, which would trigger a bid, of course. And Currys, we'll watch that one with the consumer in mind as they edge up their guidance for the full year. Guy.
Okay, which is good. Positive news out of the UK. We're in need of that. Let's talk about what these markets are delivering this morning. Let's start the Tuesday session, get it underway. We are expecting a positive picture to emerge out of Europe this morning. Less tech maybe helps. Yesterday, energy did well in the United States. Does that feed through to what we're seeing here in Europe? The FTSE 100... can't make up its mind yet. Which direction is it going to go in? Looks like it's going to be positive. The Stock 600 is up 0.1%. These aren't big gains, but consider the losses that we've seen overnight out of Asia, then actually holding the ground may be a good thing. So we're expecting that to maybe persist across most of the rest of Europe. We are expecting most markets to be in just positive territory, and that's what we're seeing. Clearly nothing happening in Germany this morning. We are open. We're up by 0.3%. Most markets up 0.3%. Doesn't look exciting, but in the context of what we're seeing elsewhere, it doesn't look bad, Tom.
On the sector-by-sector basis, top of the list right now is personal care. That sector up close to 1%, followed by media. Another decent day for that sector, which was the best performing sector yesterday, up 0.9%. On the downside, given the softness that we're seeing, particularly in silver prices today, but also gold a little weaker. Basic resources, the biggest losses coming through there on that sector, down 1.3%. Construction and materials also weaker by 0.4. Four sectors, just four sectors in negative territory so far, with the top gains coming through for media, at least for now, gains of more than 1%, Anna.
Yeah, it's a day where basic resources perhaps should have had a bit of a bigger mention, because that is by far and away the worst performing sector. There aren't many negative sectors, as you point out, Tom, but we're down 2% on Anglo-American, on Glencore and Antofagasta. So that's taking the edge off London, perhaps, which is kind of in the mix, isn't it? It's not really standing out today as looking very different. The CAC is up a 0.1% or 2%, so is the Xetra DAX, so is the FTSE 100. So modest gains then, Guy, across these European equity markets.
Looks like, yeah, steel is an interesting area to maybe watch out for this morning. In terms of what we are watching, is it a feed across? Is today the day when actually Europe's, can I say boringness? No tech? Actually shines a little bit. And maybe this is going to be the future, because potentially there is significant volatility. We're going to see maybe some of these trades rolling off. Are we going to see people looking for that diversification trade to deliver? I don't know. Let's try and find out. Okay, let's get another perspective, certainly on what's happening in the UK stock story right now. We'll get some analysis from Alexandra Jackson, Director of Equities at Rathbones Asset Management, with us on set this morning. Hi, Alexandra. Nice to see you. So I know that you have quite a lot of conviction around UK mid-caps, and it's the mid-caps area I think you focus on, and there were a number of
underpinnings for that? So today looks fairly quiet, so a good day to take a step back and talk about maybe some of the reasons that you have conviction around that UK narrative.
Yeah, absolutely. I mean, the UK does look kind of messy at a headline level, at a macro level. We've got the domestic politics, we've got rates, we've got the geopolitics. But actually, when you look underneath a little bit, you can see this divergence appearing. Valuations are low, you don't need me to tell you that. Balance sheets are very strong. And actually, M&A has really picked up. We're running at double the usual level in the UK. Premiums are actually higher and average deal size is higher. So that's interesting. Someone is buying these companies.
Somebody is buying these companies. How much do you worry about the macro effect then, certainly at that mid-cap level? Because if you look at the 250, it's underperformed. The FTSE 100 hasn't it of late, and part of that is, I guess, to do with concerns around the macro story. This morning we had numbers out from the UK, and the labour market story there. The number of payrolled employees dropping by 100,000, which was a lot more than expected. We're edging higher on unemployment. Is this something that threatens to take the edge off your investment thesis?
Well, I think it's kind of double-edged. It's both the gating and the unlock for me. So rates are really important to the mid-cap trade. The FTSE 250 is very correlated to yields. And actually that unemployment data this morning, it looks a bit softer, but it suggests maybe that companies and the companies that we talk to will get more of a steer on that later this week. But the companies maybe are choosing to lose workers rather than raise prices. So maybe that keeps a lid on inflation throughout the rest of the year, keeps a lid on yields as well. And again, that's the unlock for this 250 trade.
And you talked about 250 being sensitive, or those mid-caps being sensitive to high yields. Yeah. What assumptions then are you making about rates going forward from the BOE?
Well, the market is forecasting a kind of 80% chance of a hike before the end of the next two meetings. So that looks pretty aggressive to us. Sarah Breeden over the weekend was saying she didn't see a need to raise rates from here. I think she was indicating they're in a wait-and-see
Do you need
mode.
rates to be on hold for that, to continue to have that conviction in UK 250?
Yeah, I think the ideal scenario is for rates to be on hold and then to start to come down, and that's where you see the mid-250 really start to move.
At the moment, you've got a gilt yield 10-year, north of 5%. You've got a yield on the 250 of, 3.5%. Why am I buying the 250?
I think you've got some really interesting companies there. So we are looking at ways to play the AI trade in the UK, for example. As you said this morning, not a lot of tech in the UK. It's one of the reasons the UK is probably underperformed, but might give some protection now. For us, industrials are where the AI names are hiding. So even just this morning, we had Diploma out with numbers today, a nice beat, talking about high teens organic growth. And they are a play on the kind of build out of physical infrastructure, physical data centers. So they provide cabling and wiring and connectors into data centers. So that's one of those examples where you can access interesting structural growth. In the mid-250, they trade on a cheaper valuation than their sort of US-listed peers.
Why do you think people are missing them?
I think they probably have been overlooked because a lot of the macro keeps people out of this market. Probably they're not single plays. They might do a couple of different things.
Do you need? Okay, so they're not pure play.
They're not pure play.
Okay, so that dilutes maybe the argument a little bit, but I'm wondering what will it take for people to notice them? And is it important? Does the investment case need people to notice them? Because if they don't notice them, then it's great, we're going to do really well, we're going to kick out a decent return, but we're not going to get that kind of stratospheric performance that the rest of the AI trade is delivering. How do we get people to notice these stocks, other than you coming here and telling us about them?
We've got a graphic to put up next, as you answer. There you go, then people will notice.
A graphic sounds great. I think part of that will be other companies coming in and buying these names. We see strategic, we see trade buyers, we see PE all over these
Right, so this is
UK
just a takeout
companies.
trade. It's not an organic, it's a people are going to buy these companies for better multiples than they're trading on at the moment.
I would say the takeout trade is is there to prove out the valuation, and then we can move forward, because these businesses are generating incredible levels of organic growth. A lot of them will grow their margins. They're returning lots of cash to shareholders. They're becoming very shareholder friendly.
So we just put up a graphic. It had Renishaw and Halma, which I know are two companies that I think that you own,
yes.
Alexandra. So industrial tech, is that the way that you play it in the UK, to Guy's point? And what does that mean? What is it that these guys are doing? How does it feed into the data center story?
Yeah, so you could either play the kind of physical build-out, like a Diploma or something like that, a Hill & Smith, or you could play those names that provide kind of components into the semiconductor equipment manufacturing piece. So that's what Oxford Instruments and Renishaw both do broadly. You need to be able to measure the position when you're making semiconductor chips very, very carefully at the kind of nanometer level, and Renishaw provides some technology to do that.
Are these businesses seeing sort of step changes in their profits or their sales, or big pivots in their business lines to focus on this stuff, or are these sort of at the margin interesting dynamics?
A little bit of both, depending on the company that you're looking at. But certainly, when you look at the divisions of these businesses that are focused on the semi customers, you can see a step change certainly in levels of organic growth, in the investment that companies will put behind that, because they can see the duration of this demand really proving out that revenue visibility. But yeah, they're not 100% AI trades.
As we talk about the takeout trade and maybe the role of private equity and others in terms of looking at acquisitions in the UK, on the other side of the dynamic, in terms of the IPO pipeline, how closely do you monitor that? Is that pipeline, how healthy is that looking? Are we going to get more tech names that currently in the private sector? We have some strong tech, but in the public world, less so. Yeah,
we do have some strong tech in the private world. We have recently had meetings with, I would say, 7 or 8 UK private companies, most of them tech or tech adjacent, that are thinking about listing. They won't give me a timeline, but
in the UK.
In the UK, yeah, mainly in the kind of mid-cap space, not huge companies for sure. But that gives me a huge amount of confidence that we can, at some point, when that IPO market does sort of unlock, and we need a bit more confidence, we need that market to unlock for these companies to really want to come to market and get the right valuation. But they're very keen.
That's interesting, because in the States, well, in lots of parts of the world, they tend to skip the mid-cap phase, just list as giants. It seems that's the more recent trend.
Yeah, well, that will be a good differentiator, I think, for the UK.
Right, yeah, so some mid-cap tech names to play for.
If we get a change in government, how do the macro story is ever present in the UK? How does that put investors off? When you talk to international investors, how do they feel about the UK right now? Do they look at the politics and go, do you know what, I'll put that one to one side for now? How does what is happening domestically here change the international investors' perception? How is it changing the international perception?
Yeah, I think it's fair that global investors have been able to ignore the UK in recent years. What we see now is actually a bit more interest coming from my clients, coming from other global investors. Yeah. And when I go to conferences and things, I can see that there are more global investors there who are looking at interesting UK businesses, particularly those kind of global growth stories. We see the UK as kind of a hunting ground for global growth names that are mispriced just because of where they list.
But this is individual names. This isn't a wholesale, we're interested in the UK. There's some underpriced assets here that we think we can take advantage of.
I think that's probably mainly right. This isn't a market that you want necessarily passive level exposure to.
You don't know an index. This isn't an index market.
For me, I would prefer to be much more selective.
Okay, really nice to see you. Thank you very much indeed for stopping by. Alexandra Jackson, Director of Equities at Rathbones Asset Management. Call 6 looks a little bit like this right now. Let me just give you an idea of what is going on in terms of the main names that we watch. Tech is under a little bit of pressure. You can see that in ASML and Schneider. You are also looking at a fairly decent bid actually coming back into Nestle. That was a story yesterday maybe we saw coming out of the States as well. Some of the more consumer-facing stocks doing a little bit better. But let's get more detail on what is happening here. Charlie Wells is starting with Anna's stock of the morning, Currys.
Yes, I am, Guy. It's an interesting start, an optimistic start, I would say, for Currys. They raised their forward guidance, and basically the market is liking what it's seeing here. This really seems to speak to the consumer, right, of strength. Of Currys basically saying they're really not impacted, at least so far, by some of the uncertainty that we've been seeing across the globe. Consumers continuing to buy these electronic devices, so the market liking that, giving an optimistic tone that we haven't seen across the board, really. Let's flip and stay on a similar story with Doc Martens. Vans, right? That shoe company, they're up over 7% this morning. And again, they met expectations. And this really kind of brings to bear that tone on the consumer, given a lot of the uncertainty, given a lot of the negativity that we've seen, still holding up. So the market liking what it's seeing there. Different story with Vallourec. Let's bring this up. This is that French tube-making company. They are down almost 8% this morning. ArcelorMittal sold about 10% of outstanding share capital. The market really not liking that, despite the fact that ArcelorMittal said that really they continue to believe in, the strategy of this company, but a lot of negativity around there. Let's end this morning with Aixtron. That is one of the main European semiconductor companies. They're up just over 1.5% this morning. They reported some strong orders. So this is really going to be in focus, these semiconductor companies, because we're seeing jitters in Asia. This is some green on the screen here. We'd seen earlier, some red for a number of these other semiconductor companies across Asia. So how does it kind of spill out here in Europe? We're seeing positivity from these orders in Aixtron, and of course, a lot of focus on semis given those NVIDIA earnings tomorrow.
Charlie Wells, thank you very much indeed on some of the stocks on the move this Tuesday. Coming up, global memory stocks, as we've been talking about, taking a hit after comments from the Seagate CEO, sparks fears about the industry keeping up with demand. That is next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets.
So much corporate issuance.
Let's get the reaction and context.
With the smartest insights.
We're observing what's happening in the Middle East.
The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics.
Cross-border M&A is still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
That, of course, was NVIDIA CEO Jensen Huang speaking exclusively to Bloomberg's Ed Ludlow. Asian memory stocks, meanwhile, lower in today's trade, tracking losses from US peers after Seagate, the CEO, said building new factories would, quote, take too long, sparking fears it won't be able to keep up with soaring chip demand. Neil Campling, our senior market strategist, joins us now. So the blistering rally then in semiconductor stocks. It was interesting to see that software stocks actually performed quite well in the US session yesterday. Semis under pressure. Is this a blip? Does buy the dip come back in to rescue the chip makers, or does it point to over-exuberance in terms of the capital that's been piled in to the chip stocks, both in Asia and the US?
A great question. I think as far as whether it's a buy the dip or not, perhaps we'll rely on what Jensen says tomorrow night when NVIDIA report numbers.
Yeah.
In terms of exuberance, you could just look at some of the products that are created in the markets around some of these semiconductors. For example, there is a XXX levered semiconductor ETF. It went from the end of March until the end of last week up 350%. And it's down.
That's where Guy Johnson put his entire pension into.
Guy put his entire net wealth into this product, and he obviously got out at the end of last week before it fell 25%.
It's amazing, isn't it?
So, well done, Guy. I mean, I'm not sure why you're still sitting here. You should be a trader, clearly working at one of the big investment banks.
Yeah, it's my moonlighting job.
Well, I mean, I'm a man of many talents, but we've discussed before that some of the money that's flowing into this. We've got fund manager surveys, which we'll be bringing out some detailed analysis on in the next couple of hours. But again, it shows there's a massive drive in terms of asset allocation into semis, into AI, into the chip sector. Yeah. So on an institutional basis, it's very difficult to see where incremental money comes into. In the meantime, retail investors have been borrowing money to buy into a leveraged product. So momentum works both ways.
Double leverage. That would be triple. Yeah, no, but that's 3 times plus a bit of leverage on top. Yeah.
Plus the original investment vehicle it's invested into. Yeah. So it's momentum works both ways. It's great on the way up, and it can also hurt. You
can see it in factors. If you go to FTW on the Bloomberg, you can see factors to watch, and you look at kind of momentum has been at the top of that board for a long time. Last few days, not so much.
Absolutely. Last 2 days, last 2 sessions. And where are in the US? What sectors are performing well? Energy for obvious reasons, but also catch up from things like utilities, which is and some very defensive areas of pockets of the market. So it's going to be interesting to see how things play out in the next couple of sessions. Whether it's by the dip, as Tom mentioned, or whether it's more of the same in terms of a further sell-off.
Neil, I wonder what you thought of the comments by the Seagate CEO. We were discussing at the top of the programme. Should this have been positive or negative for those in that memory sector, the memory chip makers? Because the CEO says new factories would take too long. Does that give you comfort? He's not going to spend too much money and the bottom line is going to be damaged by that. Or does it make you think he's going to miss out? But that doesn't make sense because the whole sector sold off. So who's he missing out to? What explains the negativity around those comments, do you think?
The negativity, I think, is perhaps because of this momentum factor. As far as profitability is concerned, what he's doing is maximising profits for his company because he knows that this is a highly cyclical industry. It has been always. And even when you have the AI impetus, it's likely to remain a cyclical industry. So you maximise the profitability because, as he was saying, regarding building out new capacity, it takes between 3 and 5 years to build a new plant.
Is he saying that the time? Basically, he's saying in 3 to 5 years' time, I think this is going to be. Maybe this will be.
You could read into that. You could read into that the return on an 8-figure investment into a new facility, you won't get those returns in 5 years because the chips won't be commanding. We've seen some chip prices go up by 600% in 6 months. You can't sustain that for the next 5 years. So why would he look to be building out now in that increasing capacity? Because we've seen before, the margins in these parts of the market, when they are supernormally high, can also go to depressed levels. There are some memory companies, don't forget, that in previous cycle downturns get to negative margins. So we are at extremes on the other sense at the moment.
Yes, they may have some memory of that. Terrible joke. Meanwhile, Blackstone. That's awful, isn't it?
I'll be the trader, he'll be the comedian.
That even made Neil cringe. Meanwhile, Google and Blackstone, though, if they have that 3 to 4 year horizon, I mean, they're looking to spend pretty heavily with some leverage, 25 billion with leverage on data centers that will need to be filled with those chips.
So the announcement on our overnight, if we look at the capacity increase that they talked about, it's actually year-to-date deals that have been announced amount to 100 gigawatts of capacity being added over the next 15 years in data center gigawatt capacity alone. To give that some context, that is the entire output of Germany today, as far as installed capacity is concerned. And what they announced last night is less than 1% of data center capacity that's been announced of new capacity year to date. So it's a tiny piece of the ocean of a massive build-out spend. And obviously, as you mentioned, the memory cycles are very short-dated. The capacity built out for electricity, for power, for AI data centers, unless something happens from left field, then this is a 15-year kind of time horizon that we're talking about here.
Okay. Neil, thank you very much. Always something to talk to you about every morning. Neil Campling with thoughts on the tech beat this morning. Let's pivot to the banking sector. Standard Chartered CEO Bill Winters delivering a blunt message on the future of the bank's workforce, warning that a push into artificial intelligence will eliminate thousands of roles as the lender replaces what he calls lower value human capital with technology.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
Bill Winters there. Tom Metcalf, our managing editor of EMEA Finance, joins us now. Talk to us about these comments from the CEO. Tom, lower value human capital. Ooh. That sounds pretty bruising.
Do we call those people?
Somebody.
I think some bankers don't call them people, but
sorry.
It's lower value human capital. No, I do think those comments, he'll probably look back and think he could have maybe phrased them a bit better. I suspect that's probably going to be a lot of people's takeaway when they read the story is, wow, what a way of phrasing it. But obviously this speaks to, this huge trend going across banking, and I think it's, you've seen it with HSBC. We understand they're looking at, 20,000 jobs. For Standard Chartered, this would be about, in the order of about 8,000. Largely support staff. But, that is the interesting thing. It's kind of really looking to replace a lot of these jobs that are done by humans, obviously with the technology of AI.
Okay, people have got an interesting future in this sector. Just in terms of kind of what we're seeing across the industry, how does this tally?
I think 10-15% is sort of what executives are kind of thinking about. That seems to be the baseline in terms of where they're looking to get efficiencies. I think there is a distinction between the total number of jobs in finance, which may well actually increase, at least in the short term, just because you need different types of expertise. But certainly some kinds of jobs, data entry, anything more routine mechanical, you're going to see that become a much smaller part of the finance workforce.
Do we have any more clarity in terms of the investments that these banking executives are putting into AI? I mean, do we just assume that they're going to be investing more through 2026 into 2027? How much commitment is there? How much ability is there from their boards to back that kind of investment?
Yeah, I think that's exactly the right time frame for, where you'll see that CapEx increase and you're probably not going to see anything on the bottom line. But no, I think every bank you talk to, AI is, right at the top of their agenda. And I think just institutionally, they're all pushing for this. What's interesting is we're hearing, on the regulatory side, there's obviously plenty of concern and, perhaps the sense maybe the industry is getting ahead of itself, right? Like the technology, is it really there that they can, remove these jobs, remove that human element?
And are we all paying the proper cost of AI when it comes to what is going on here? Look at these companies that are losing money on that story. Tom, thank you very much indeed. What are we going to do next? The EU economy chief, Valdis Dombrovskis, is telling reporters at the G7 conference in Paris it's not time to ease up pressure on Russia. We'll talk about that next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Happy Tuesday. This is the opening trade. We're 30 minutes into today's session and you are seeing green on the screen. So a little bit of optimism coming through for European equities, building on the gains of yesterday as well, of course. Up 0.5% on the index, the main index, the Stocks 50, of course. When it comes to the UK, with all the political risk that we continue to factor in, the FTSE 100, despite that, is pushing hard by 0.5%. Some mixed data when it comes to the job story in the UK. The DAX is up strongly, outperforming so far across these indexes, up 0.8%. And this is a point that Guy's been making, is Europe today at least benefiting from the anti-AI trade. Guy?
On that front, I have good news and I have bad news. So let's start with the good news. 4-to-1, basically the ratio in terms of stock gainers versus losers. So the market is reasonably broad in terms of what we are seeing. The bad news is that actually volumes are a little light today, which maybe tells you there's less conviction in this narrative than maybe we would hope for. Let's talk about some winners and losers. Anna's been talking about Currys all morning. Let's get back in and see exactly how it is doing. It's up by 6.8, doing very nicely. Evolution confirming a buyback out of the Nordics, up 11%. SAP, to Tom's point, the software stocks bouncing back. SAP out of Germany, up by 4%. So there's some good news in this market. Downside, let's talk about where we are seeing some of that this morning. We are seeing ACS, I think it's making an offering. That stock is down on the back of that. Infineon had a good day yesterday. It is down by 2.14%. chip stocks generally have been a little bit lower around the world, and that is a story you need to fold in there. Glencore's also giving back a little bit of ground, 2.3, that sector under a little bit of pressure this morning, Anna.
Guy, let's get an update on some of the other news flow this morning. The Financial Times is reporting that China's Xi Jinping told Donald Trump that Russian President Vladimir Putin might end up regretting his invasion of Ukraine. According to sources, the comments to Trump came during the summit in Beijing last week. The US is stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the Democratic Republic of Congo. Washington has now imposed new travel restrictions, and the CDC is expanding its emergency response as concerns grow over the spread of a rare strain of the disease. And European Union officials are meeting today in an effort to finalise legislation for the bloc's trade deal with the United States. Failure to reach an agreement risks missing President Donald Trump's July 4th deadline and could trigger a fresh round of tariff escalation. Tom.
Meanwhile, G7 finance chiefs are meeting in Paris today. OECD Secretary General Matthias Cormann speaking to Bloomberg on the sidelines of the event, saying risks to the global economy have worsened as the conflict in the Middle East drags on.
Normally you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker. Across advanced economies, what we see is that core inflation remains, relatively okay. Yeah. But of course, that's precisely what we will be looking at.
Well, let's bring in Bloomberg chief Europe economist, correspondent, I should say, and part-time economist as well, Oliver Crook, standing by. Ollie, so you've been talking to leaders there, and notably, of course, the head of the OECD. Interesting talking about the second and third round effects of the impacts of the closure of the Straits of Hormuz. What are you hearing broadly about the concerns, the inflationary aspects and the inflationary concerns emanating from and around what is happening in Iran?
For the officials we're hearing from here, really it's a question of not panicking people, sort of impressing the severity of the crisis, while at the same time saying some things so far, so good. That's what we heard from the French finance minister yesterday when we were speaking yesterday morning. We hear it from Matthias Cormann that they're not quite seeing yet that contagion within the inflation complex back from the headline into the rest of the inflation complex. And that is, of course, the big question for everybody, Tom, is where inflation is going to go. It's not just the quantity of inflation, not just the headline rate, but the quality of inflation. Whether it goes into services, whether it goes into wages, food, all the other parts of the inflation complex. And that is really going to be the red alarm for the European central bank governors, many of whom are in attendance here and have been deliberating with the finance ministers to give their sort of appraisal. We should say, though, it is interesting what Matthias Cormann was saying there, that basically, there is a certain point here where the European Central Bank is going to have to face this issue of trading growth for inflation. Which of the two are they going to sort of put the fire out on? And he's saying that effectively you might have to raise rates despite the fact that we're seeing that growth weakening. And that's really going to be the center of the discussion we have a little bit later with two of the governing ECB council members, the Banque de France governor and the president of the Deutsche Bundesbank, who we'll be speaking to a little bit later, to give us a sort of breakdown. What is their read on this inflation? Is it going to remain segregated? And as a consequence, what is the rate path going to be?
Really looking forward to that conversation a little bit later, Ollie. Just give me a status update on the US-EU trade deal.
Yeah, so this is, as we've been talking about for about a year now, and that is, of course, the big frustration for the Trump administration, is that basically you had a handshake deal at Turnberry between Ursula von der Leyen and the United States, and the EU has not ratified the deal. We don't have to go through all the reasons why that is. Of course, it was the Greenland threat. There was the Supreme Court striking it down. But effectively, the Trump administration has now lost patience with the EU, and the fact that this trade deal is not in power yet, is not in force yet. There are deliberations today happening among the European officials and leaders trying to get the legislation sort of finalized. The deadline that the Trump administration has set is July the 4th, the 250th anniversary of the United States, to get this legislation going. And really the discussions today in Brussels among these leaders and among these policymakers is to see if we can get there in time to really make the progress that's required. The EU has added a few more clauses into the deal. The U.S. was not too happy about it, but it seems that they have sort of accepted it. And the question is, can the Europeans move quite fast enough? And that's an answer we'll have a little bit later today to see if they can nail that July 4th deadline.
Absolutely. We'll keep a firm eye on what is happening there. And as you say, Ollie, looking forward to the conversation a little bit later on. We've got an exclusive sit-down with the heads of the central bank from France and from Germany. That is a conversation you do not want to miss.
So they'll certainly be reflecting on higher energy prices. Coming up on the programme, with the global economy wrestling with those higher oil and other energy prices, we will talk to the CEO of Portugal's EDP, one of Europe's largest renewable companies. That's next. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. You're watching the opening trade. We are 40 minutes into the equity market session, and thus far it looks fairly good for Europe. We are looking at a picture that is, as you can see, largely green across the screen. You are seeing a bunch of single stocks actually doing fairly well, but there is this kind of anti-AI narrative that maybe is in the trade this morning. Cosby didn't have a good night overnight, and maybe people therefore look towards Europe. That said, some of the software stocks are having a fairly good day today, so maybe that trade coming back into the picture, Tom.
And of course, at the macro level, the global economy, of course, and global companies are still wrestling with higher energy prices. Right now, Brent is actually a little softer, down 1.4% at 110, still $110 a barrel. So the spotlight has shifted, at least to some extent, during this conflict and during what's been happening around the Straits of Hormuz, to what is happening in the renewable space as we look for additional sources of energy. For more on this conversation, let's bring in Miguel D'Andrade, CEO of Portugal's EDP, one of Europe's largest renewable companies. The stock is up about 35% in the last 12 months. Miguel, thank you for joining us.
Thank you.
Around the
Great to
desk
be
this
here.
Tuesday. How has that conflict impacted your business and demand for your energy?
So
So clearly the impact, well, of the war in Iran has been very felt on oil and gas in particular. I think in relation to power, what we've seen in some markets, that has obviously had a slight increase in the power prices, but still very, very different from what was the situation back, for example, in the Ukraine crisis back in 2022. So it's order of magnitude different. The TTF now is at around 50 euros per megawatt hour. It used to be sort of 200 plus a couple of years ago. So yes, it's having an impact, but not as much. I just highlight, though, that in markets like, for example, our core markets like Iberia, it's actually having almost no impact. And why? Because we have a lot of renewables. So a lot of wind, a lot of solar batteries. So actually gas is not setting the price, or it's only setting the price for 15% of the hours, which means we actually have not felt the impact, for example, in Portugal and Spain.
Are you hearing more from governments and others about the demand to build more renewable capacity? You've talked about how much there is in Iberia right now. Is there more? Does it change your strategic capex plans? Do you plan to invest more? Are you seeing more of an impulse?
Yes, I think, this is recognized by the President of the European Commission, Ursula von der Leyen, by the Commissioner of Energy, Dan Jurgensen. It's very clear they want Europe to be more energy independent. That means using our own internal resources, whether it's hydro, wind, or solar. So there's a renewed push to be more energy independent.
Fast-tracking licenses?
Fast-tracking licenses, investment in networks, investment in conventional generation. So really trying to push. The only thing I'd say, it's a little bit frustrating because it feels a little bit deja vu versus 2022. And a lot of the recommendations that came out of 2022 still have not been implemented. And now they're giving an additional push. It's like we should already have done that.
What are the things that should have happened that didn't?
Well, things like accelerated licensing times, one-stop shops, sort of specific areas where you already have pre-authorization for permitting. So there are some lessons and sort of recommendations that have still not been implemented in many of the member states, going all the way back to 2022. So I think that's been one of the big pushes we've been pushing for.
Meanwhile, the solar build-out in Europe has been quite impressive, and to such an extent that it seems other parts of the infrastructure, Miguel, can't necessarily cope. I was reading colleagues reporting about Spain leading the way in Europe's surge of negative power prices, as there's too much solar power for the grid to cope, for storage to cope. How is that impacting on your business? What can be done to stop that kind of wasted opportunity?
So obviously investment in batteries, I think that's one of the key issues. And so what we've been also advocating is to have more capacity payments and sort of making sure that you can actually build out of batteries. If you look at, for example, Iberia, it's got one of the highest penetration of renewables, but one of the lowest penetration of batteries. And so clearly you need to do more on that front. More investment on networks, so you don't have that curtailment. Sometimes you've got negative prices in some areas, but not in others. And so if you can get that energy to flow, that will also make a big difference.
And this is all your job to do in Portugal? Is this your job and other people's job in Spain? I mean, where's the bottleneck?
So there's a lot on the regulatory side, on the legislative side. I would just add one additional point, which is what we are beginning to see is a lot more demand also coming. And so I think over time, this will be like these cycles. You're having cheap energy now. You're seeing a lot of demand coming in, for example, from data centers and industry that is taking advantage of that. The power prices in Iberia are 20% below the European average. And so as that demand comes in, you'll sort of see that convergence also of supply and demand.
So are you an AI stock? Should I think about AI, you as being an AI stock?
So the AI is clear our largest customers. Amazon is our largest customer globally, Microsoft number 2. So all of these guys are the ones that are buying big amounts of power.
So corporate power purchase agreements, how big a part of your business going forward is that going to be?
So it's a huge part of our renewable business. 60% of our power of the projects that we are sort of building and selling are having these corporate power purchase agreements. And the remaining 40 is to utilities that are themselves then having sort of this increase in demand from data centers.
So the extra demand is coming from AI?
It's a huge amount of it. It's not the only thing. For example, in Iberia, you're also having increasing population, electrification, heat pumps, electrical vehicles. So all of that is driving demand. Portugal's had one of the highest demand growths in Europe over the last couple of years.
There was obviously the issue of the blackout. I'm assuming that when you sign these contracts, you are guaranteeing that there's enough. The flywheel effect in the system to keep you at 50 hertz is there. That you can can you guarantee that now?
Well, when you sign these contracts, you're signing it's pay as produced. So as long as you're producing, if there was some sort of.
But are we past that?
I think we're past that. I mean, that was clearly a very exceptional issue that happened in Spain. It was a over sort of voltage charge.
Yeah.
But I think people are managing the network in a much more prudent way now, and so I think the risk is obviously much reduced.
Okay. Just another on the data center demand. Where do you see that demand growth? How do you see that demand growth evolving in the years ahead? Are we getting close to peak demand? Where are we in that story, in that journey? And does the infrastructure, does the grid have capacity to meet that demand?
So in the U.S., undoubtedly, this is one of the best times. You know, we've been investing in the U.S. now for 20 years, and this is one of the best times to be investing there. I mean, we're seeing huge amount of demand driven by, as I say, these big tech just taking sort of all of our projects. In Europe, in particular in the markets like Iberia, Portugal, you're seeing a huge amount of demand also coming online. I normally mention one of these data points, but just one of the data centers that's being built south of Lisbon is going to represent 20% of Portugal's consumption. And so there are many others.
20%?
20%.
One data center?
One data center. And there's several others that have requested connections. So we're talking about structurally huge amount of demand.
Can the region build all the data centers that are being... that it could build at the moment? Are you turning business away because they cannot be built and connected to the grid?
The way we've positioned it, we want to be part of the solution. So investing in the networks, investing in the generation to make sure that we can incorporate all of that demand. But there is a huge amount of demand that wants to connect.
Is there pushback? Are you facing pushback? I mean, we've seen Portugal's government announce plans for a windfall tax on energy companies. Maybe that's not just oil and gas. Maybe that's renewables as well. And are you seeing pushback from communities affected by data centers? We've seen a bit of that in the US.
Yeah. On the windfall tax, we don't believe it's directed at the power sector. As I say, the power prices are well below the European average, and so I think it's more tailored to the oil and gas sector. In terms of pushback from the communities, I think that's one of the points. We need to make sure that we are bringing the communities along with us, that they see job creation, that they see cheap power prices.
Is there job creation? Because a lot of the AI story we've been covering this morning is about jobs going away. So that would be a positive.
I think if you think about it sort of in the, at least where those are located, you're going to have a lot of construction jobs. You're going to have, obviously, people working in the data centers. I think one of the Portuguese government's focus, and rightly so, has been it can't just be about building the warehouse for the data centers. Like, they have to bring additional value added to the local communities, whether it's in terms of high tech or, R&D centers. It has to add something to the local community.
Okay. Thanks very much, Miguel. Really good to see you.
Thank
you for stopping by. Miguel Stillwell-Andrade, the CEO of EDP. We've been talking there about oil prices, and earlier oil prices fell after President Trump said he'd called off a strike on Iran that apparently had been planned for today, following appeal from Gulf allies. For more, we're joined now by our Middle East energy reporter, Anthony De Paula. Good morning to you, Anthony. So how are oil traders viewing these comments from President Trump? We saw oil prices retreat, then they kind of came back to the flat line. I see they're retreating once again. It's been a volatile 24 hours.
Yeah, good morning. Of course, when there's comments like this, when Trump says he's averted an attack, that is going to cool off the oil prices as some of that risk, that immediate risk, goes out of the market. Of course, we're still around $110 a barrel, which is not the highs that we had earlier in the conflict, but it's not really low either. So there is some of that threat still in there. The main point is that we still have Hormuz shut. And so that's what's supporting the market, that we don't have the flows that we need of oil getting out of the market. Obviously, good news in the immediate that these attacks were diverted, but we have a long way to go in terms of the diplomacy around that. The sticking point at the moment is the opening of the Strait of Hormuz. Iran wants the U.S. to take its blockade off of the spot where it has it south of Hormuz. So they want to take that blockade off. The U.S. wants, for its part, to get Iran to open it up, have a free flow of crude and products out of the region, in order for the parties then to talk about what they might talk about in a future set of negotiations around the nuclear. So there's a lot of heavy lifting to do there before they do get Hormuz open again, and I think that's one of the things that the market is watching. If they can't reach an agreement around that, then does the U.S. return to the military threat? There are still a lot of military assets in the region. We did see over the weekend the USS Ford has returned to base in the U.S. in Virginia, but we've still got lots of assets, aircraft carriers, Marines in the region. So if Trump wants to act, he might see that as a tool, and as a tool that can't stay in the Gulf forever. So that's going to keep keep some of that support under oil prices, even though we do see that easing with those comments that Trump made earlier today, Anna.
And Anthony, in the meantime, the US has extended these sanction waivers for Russian oil. How much of a gift is that to Putin?
Yeah, well, that's certainly helpful to Putin. It is going to increase the income, and we are at the income where these prices are very high. The Secretary of Treasury, the last time that the U.S. eased those sanctions, tried to make the argument that by releasing those barrels into the market, by allowing them to be freely traded, that would bring the overall price down so that the Russians wouldn't be getting a higher price and a higher premium because prices in the market would be even more elevated than they were. So that's a little bit of a difficult argument to kind of get your head around. The point is that we are at $110 a barrel, and Russia will be able to sell those barrels for an extended period of time. That's probably going to be helping a big customer like India, which had been using a lot of Russian oil. They didn't really make much of an uptake of the Iranian oil when sanctions on those barrels were lifted, but they have been using the Russian, so they're used to that. They would be happy to get back in that. So that's going to help one of those big producers like India, which has really been suffering as well because of the cut off of Hormuz and the stop of the flow of crude and other products coming out of the Gulf, Tom.
Okay, Anthony DePaola, thank you very much indeed for that update. Here's what else we are going to be watching throughout the day. 9:10 UK time. So coming up, the Bank of England's Sarah Breeden will be speaking at City Week as traders price in more than 2 hikes from the BOE this year. G7 finance ministers, meanwhile, continue to meet in Paris. We're on the ground for you there. And Russia's president, Vladimir Putin, is travelling to Beijing. And after market, we're going to get Euronext earnings results, plus in the US, numbers out of Home Depot.
So European stocks this morning outperforming. Will it last? Let me ask that question to Adam Linton, sitting next to me. You're not convinced?
No, not massively convinced. I mean, if you look at kind of the broad equity setup that we're seeing today, we're seeing a bit of froth taken out of the markets in certain areas. You look at the Kospi, you look at the TAIEX and this broader kind of AI theme with, you know, these higher yields acting as kind of a bit of a catalyst. But there's no real kind of massive AI negative catalyst that we're seeing at the moment. I think, you know, Mark made the point, we may get this AI earnings rug pull at some point, but we're not really kind of there at the moment. So, you know, I've spoke about, you know, the lack of tech sector in Europe hamstring its performance relative to Asia, relative to the US. So today things look, you know, relatively better on a short-term basis. But, you know, the thing is relative and short-term. Ultimately, you know, what is the backdrop for Europe at the moment? ECB going to be tightening into a growth slowdown. And if you look at the pockets of, you know, strength which drew European equity performance last year, it was financials. Well, performance is flatlined. Yes, you could be in a higher rate environment, but lower, you know, credit quality, economic slowdown, and then industrials as well. They're burdened with the prospect of higher energy costs and supply chain disruptions.
I want to ask you about bond markets, Adam, and what's happening there. Because, of course, we tie this all back to Iran because they're an inability to get the energy that the world needs out of the Strait of Hormuz. But today, oil prices are weaker. But we have quite a disparate picture coming through on bond markets today, as if we're sort of pausing for breath after the sell-off that we've seen. JGB is telling us one story with higher yields. The European story is different with lower yields. And in the midst of that, the US yields are sort of edging a little higher. I mean, where are we in this story?
Yeah, I mean, big picture, obviously, it's all about Iran, right? And we saw, you know, that kind of bit of reprieve from that Trump not, you know, escalating things yesterday. But for me, that's kind of a bit of a non-development. We weren't really bracing for it, so the fact that it doesn't happen isn't, you know, a massive source of relief. The key story is we saw negotiations yesterday completely at a deadlock. The US is rejecting, you know, the overtures from Iran. The US isn't giving them any relief on oil. Meanwhile, the Strait of Hormuz remains blocked. And, you know, I've got Brent at 110. Risks still remain to the upside, in my view. And then, you know, the US rates space that's playing a bit of a catch-up. We've talked about this inflation angst is creeping in. But I think in terms of, you know, what to look out for the bond market, I think the most interesting thing I've seen in the last 24 hours is the RBA. You know, so they were, you know, quick out the gates when it came to tightening policy in the wake of the crisis. You know, they've hiked policy, I think it was like 3 times this year, and yet they're still concerned about inflation and expectations being de-anchored. So if, you know, they're, you know, the first out the gate, they're ahead of the curve and they're still concerned, then for those that are quote unquote behind the curve, that's a real source of concern, and that can make its way felt throughout, you know, the back end of the yield curve, which, you know, there's some idiosyncratic risk in Japan, in the UK, and I think that's what we should be watching out for now.
Okay. MLive's strategist, Adam Linton. Adam, thank you very much indeed on what to focus in on today. Tomorrow, of course, we have NVIDIA earnings as well, so that could prove to be a catalyst. Maybe that revives the semiconductor
Recent history suggests that it won't. Recent
because
history
expectations are so stretched.
It's early days a tough day for NVIDIA. Weirdly, you would have thought it would be amazing.
It doesn't tell you the story, does it? Necessarily,
precisely.
the way the share price reacts isn't necessarily where it ends up days later. I mean, we've already heard from Jensen Huang this week, haven't we?
Multiple times.
US futures have turned around moderately.
Yeah,
S&P
well, they
is
were
up
quite
at 10%.
negative, weren't they?
So there's a bit of a turnaround there with European markets up. Currently 9/10%, a decent day for European stocks. That's it, the opening trade. The Pulse is up next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final. The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
President Trump says he called off a strike on Iran planned for today after an appeal by the leaders of Persian Gulf allies who called for more time to pursue a diplomatic resolution. The head of the OECD tells us the global economy is at risk of further deterioration over the Middle East conflict. We're live in Paris for the meeting of G7 finance ministers. Plus, Standard Chartered plans to eliminate thousands of support roles over the next 4 years, joining the ranks of global lenders using AI to trim headcounts. Now, this hour, we'll hear from some of the top names in banking and finance. This hour, including the chief executive of Moelis. We'll talk about deal-making and market volatility. We'll talk to the EQT chief executive on winning the mandate for a new €5 billion tech fund, also on behalf of the European Union. Plus, we have the co-chief executives of Goldman Sachs International. Again, a good conversation coming up in about half an hour on market volatility and their plans for expansion in Europe. But first thing is first, let's check on the markets. U.S. stock futures holding pretty steady after a two-day pullback, while oil falling modestly. I guess traders still waiting for signs of progress towards this peace deal in the Middle East. We had a rally in stocks fueled by The build-out of AI, which seems to be cooling off after powering global equities to record highs in the face of higher bond yields and elevated crude prices, dollar resuming its climb. And then if you look at the European markets, look, they're kind of following what Asia has been doing, following on from the U.S. has been doing. We're seeing a little bit of gains across the board, nothing huge, but you can see, for example, the DAX gaining 1.2%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump says he's called off strikes on Iran scheduled for later today after Gulf allies asked for more time to seek a diplomatic breakthrough. Now, Trump says the U.S. remains prepared to attack if an acceptable deal is not reached, but did not give a deadline. Now, the Iran war, of course, continues to drive inflationary pressure and market volatility. Global investment bank Moelis has also been a key player in the region with a history of advising Gulf transactions, including the Aramco IPO. Now, beyond the Middle East, Moelis is expanding in Europe against a wider industry backdrop of consolidation by boutique banks. Well, I'm delighted to be joined by Navid Mahmood-Zadegan, the company's co-founder, stepping into the chief executive role in October, replacing Ken Moelis. And he joins us now. Navid, so great to speak to you. Thanks so much for having me with us here in London. Look, there's a lot going on in the Middle East. Yep. What does that mean for deal making in general? Are people nervous? Are they holding back? Or do you expect it to pick up?
Well, so we have about 50 people in the Middle East, and I'm really happy to say they're doing well and safe and sound given all the turmoil over the last few months. And what we're starting to see is really a return to normal, if you can believe that. Even though not all of the conflict has been resolved yet, life in the Middle East, life with our deal makers is getting back to normal. They're doing meetings, they're traveling, and there's a real resilience in that part of the world to try to get back to normalcy as quickly as possible. So I'm optimistic about deal making in the region.
So what are your clients saying in terms of the impact of the war?
Well, I think there's a real opportunity when we get on the other side of this to have a new Middle East and to have these incredible countries that are doing incredible development and building great companies. I think there's an amazing opportunity for the importance of that region and the countries in that region to be enhanced. We, as I said, have a major presence there, and we're big believers in the future of the Middle East.
Yeah, I mean, you have especially a big presence in Saudi Arabia. Yeah. When you look at the sectors, is it oil and gas, or is it other places?
Oil and gas, it's infrastructure, it's telecommunications, it's travel, hospitality, and leisure. It's many sectors that there's a lot of investment happening, and we're pleased to be there to advise companies and governments in the region.
Navid, I mean, I guess there's always a problem of timeline, right? Because we don't know what happens if there's a resolution, if it's a diplomatic resolution. Like, how do you live through the next couple of months?
Well, look, we're committed. As I said, the safety of our people is our first priority. We are committed to the region long term. We've been there for many years. We will be there for many more years to come. And we're going to continue to add senior talent and continue to serve our clients in the region. We're bullish on the importance of that part of the world, and there's a real opportunity if the war is successfully brought to a conclusion for that region to flourish in a major way.
Do you think it's had an impact on deal making in general?
In the short run, for sure, and clearly geopolitical conflict, rising oil prices, some of those things aren't helpful in the near term to deal making. Despite that, when you look at the overall, deal flows, especially on larger deals, both in the United States and in Europe, the numbers are actually pretty good this year, all things considered. Better than you would have expected if I told you there was a war in the Middle East.
That's true. Why do you think that is? Is it just a resilient economy or chief executive? There's been so many shocks, tariffs, it's COVID, that they've just gotten used to it a little bit more.
I think it's a few things. I think first, if you look at earnings growth and the numbers that the companies are putting out, it's still quite good, and there's still optimism about the economies in all over the world, essentially. And second, we're on the cusp of a major technological change with AI and the build out of infrastructure around AI, and companies feel that they absolutely cannot sit out the opportunity to scale their businesses on a global basis. And so I think all of those factors, have helped deal making, especially, again, with the larger deals.
So Moelis is also moving to a larger office in Marylebone. Yeah. How do you plan to continue investing in Europe?
We have about 200 people in Europe, and you're right. We moved to new space over the last couple weeks in Marylebone. I think it's a testament to our presence in the region. We're going to continue to invest and hire people here. We see great opportunity in Europe. Europe is a very important part of our global network and our global client base, and we're very, very optimistic and love our team here and looking to expand further.
Any specific sectors? Again, it does feel, being European, that sometimes Europe is just trying to play catch up, either with technology giants or AI or even energy and infrastructure.
I think most activity right now is happening in financial services, in defense, in infrastructure, in consumer. I think that's where you're likely to see a lot of elevated deal making here over the next, period of time, and I think those are some of the areas we're looking to continue to invest.
I mean, there's again a lot of question marks politically here in the UK. What happens with the Prime Minister? It can be in France and other countries as well that are going through elections in the next 18 months. Yeah. Does that weigh on chief executives' minds? Sure.
Look, political turmoil and change usually is not a confidence builder, but look, we have political turmoil in the United States too, and some of these forces that require M&A, again, technological change and innovation, the large amount of backlog of portfolio companies that are sitting in the hands of private equity that need to turn over. Some of these major structural forces require M&A to happen, and so we're, once we get through some of the geopolitical noise, once hopefully oil prices come down, interest rates subside, I think that could lead to a really great environment for enhanced deal making.
I mean, I was going to ask you if you thought that inflation, would lead to higher interest rates, and therefore that some of these deals had to be accelerated. Not the good type of M&A deals, but the ones that look a little bit desperate.
Look, generally higher interest rates is not a positive for deal making, and so, our hope again is that we'll get resolution and rates can come down, and some of the supply shocks we've seen on the energy side, which are creating some of these inflationary fears, subside. I think if that happens, again, when we came into the year, it looked like a banner year for deal making, maybe one of the all-time great years in terms of the environment. We've had a little bit of a setback. I think once we get through this, and hopefully we get through this in a positive way, I think we could be off to the races again.
So just delayed, no
just delayed. I think
changes.
That's our hope. That's our hope. Again, there's risks, but that's our hope.
Now, talk to me a little bit about your industry. So there's been a lot of M&A amongst boutique banks recently. Perella Weinberg, for example, buying Gleacher Shacklock, Robin Warshaw. Then what do you make of this consolidation?
Yeah. Well, look, we're in the business of serving as many clients as we can. So our own philosophy on growth has been internal talent development and hiring great world-class bankers from the outside. There is a third strategy, which is also to buy other boutiques. Right after the global financial crisis, there were many boutiques that were formed, including our firm. And some of those firms, 20 years later, are potentially looking to exit, and we're looking at some of those opportunities as well. So, but for the most part, our strategy is really revolved around internal talent development and hiring bankers as opposed to buying firms.
But if you were to buy a firm, is it a specific kind of firm? I don't know what you're doing, for example, private capital advisory.
Yeah, we're building our own private capital advisory franchise, and we're very excited about that. Look, whenever you look at a business like that, the question is, are the people additive to what you're doing? And is it additive to our culture? And can we do a deal that makes sense for both sides? If we found an opportunity that was additive to the culture, that would enhance our capabilities, and where we could do a deal that made sense for both sides, we would certainly look at it.
So would this be a regional play to get into somewhere else, or would it be more of
Could be regional, could be product capability, could be sector capability, could be any one of those three or a combination of those.
What makes a success of an M&A deal? Because you touch on culture, and this has been one of the most difficult things throughout decades, actually, in financial services.
I think that's one of the most underestimated parts of this, especially in a people-based business. We're in a people-based business, and so at the end of the day, what are we buying? If we were to do a transaction, we'd be buying a group of people. And what makes sense, the most important thing is, will those people thrive at our firm inside of our culture? I think we have a very distinct and unique and collaborative culture, and if we could bring on people through an M&A transaction where we would improve their capabilities. They would bring something to us in terms of a product or sector or client skill set, and we could work together in a collaborative way to grow our respective enterprises. That would make the most sense.
How will AI change your business? Or change
It's
your
already
industry?
starting to. Yeah, it's already starting to. So we're actively evaluating and deploying AI tools for our bankers. I think AI has the opportunity, a really incredible opportunity to enhance our business, to make bankers and all of our employees much more productive. Look, we're in the business of giving advice to clients and doing smart transactions with our clients. And AI can help us do that at an advanced pace and could help our bankers be more productive. And there's a set of tasks that our bankers sometimes do that can be automated, that could help their quality of life and could help us with our clients.
Does it change the culture of investment banking?
I don't think so. Look, we're on the precipice of a real sea change here. My hope is that it will improve morale and happiness in our industry for our bankers, again, lead to more productivity, and most importantly, enable us to provide even better advice to our clients.
How important are to be involved in large deals? I mean, it feels like it's in an era of, the large deal of like 10 billion plus is really what works. I mean, is your strategy to try and get some of those deals, and how do you go about it?
Yeah, you're right to point out the sweet spot of the market right now is 5 and 10 and up billion-dollar transactions, both in the United States and over here in Europe. Absolutely, we work on lots of large deals. It's very much part of our strategy, and those deals are important to demonstrate our client capabilities and our skill sets.
Is it different getting a big deal compared to a medium-sized deal? Do you pitch differently? Is it, do you have to know the founder from the start? I don't know what the magic sauce is.
Look, big cap coverage and big deals are really about long-term relationships. To earn the right to work on very, very large transactions, you have to be there giving very good quality advice for a long period of time. You have to be integrated with the management teams. You have to be known by the boards. And, to have the ability to win and work on those kinds of transactions, you have to have a long-term perspective.
Now, so you've been, you co-founded Moelis, but you've been in the top job for a little less than a year. What have you learned? What surprised you the most?
There's nothing that really surprised me. As you point out, I've been with the company since the beginning, and this has been more of an evolutionary change. But look, I could not be more excited about the quality of our people and our talent, the direction of our business. Yes, we are, as an industry right now, going through a geopolitical crisis and rapid technological change, but those are the things that excite me. Those are the dialogues we love to have with our clients, and I've never been more excited about the trajectory of the company and the quality of our people.
Navid, thank you so much for joining us.
Thank you.
That was, of course, the Chief Executive of Moelis, Navid Mahmoudzadegan. Now, coming up, the EU taps Swedish investment firm EQT for its latest move in the AI race. We'll speak to Per Franzen, the Chief Executive, next. And this is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Tune in Welcome to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, the conversations that matter, the insights you need. This is The Pulse. I'm Francis Nakwa here in London. Now, EQT has secured the mandate to run a new €5 billion EU fund investing in quantum computing, AI, and other deep tech companies. Now, it comes as companies and countries across the world are really racing to fund the AI build-out. Google and Blackstone only today announced plans to create an AI cloud business with data centers using Google's homegrown AI chips. Well, Per Fransen is the chief executive of EQT, which manages around €269 billion in assets. Per, thank you so much for joining us. First of all, congratulations on the mandate. Exactly how much will it work? So now you have to fundraise, and will you be putting any of your own EQT capital?
Yeah, we're very happy and excited about being given the opportunity and the responsibility to manage this fund for the European Commission. The initial fund size target is €5 billion. A substantial amount of that capital will be coming from anchor investors, the European Commission, but also from our own balance sheet. Yeah, I think the timing couldn't be better for this initiative. The world is moving fast. AI technology is advancing rapidly, and like the growth rates that we're seeing are really unprecedented also in AI and other areas where the fund will be focusing.
So, first of all, why is Europe struggling to hold on to homegrown champions?
So what we've seen when we looked at the numbers is that over the last 50 years or so, there's been approximately 250 startups in the US that have reached a market cap of $10 billion or more. But in Europe, there's actually only been 14 of those. EQT, the firm that I'm representing, we're one of those firms. So today we're still listed here in Europe, in Stockholm, and we have a market cap of approximately 40 billion euros, right? But the point is Europe needs more success stories like EQT. And so what we're doing with this initiative is giving startups, promising entrepreneurs access to the scale-up capital required to also reach their full potentials and become global champions.
So, I mean, I guess this is a problem, right? It's a capital problem. I mean, often it's a money problem. I don't know at what stage some of these European companies need that money to become European champions instead of moving to the US.
Exactly. So what this analysis shows is that Europe doesn't have a startup problem, it has a scale-up problem. And that is what this initiative is addressing.
So when you look at, the European tech ecosystem, where do you see that system needing money faster or more money? Yeah.
So I think the opportunities that we see where this fund will focus is across the early stage technology and healthcare ecosystem in areas such as AI, quantum computing, clean energy, but also life sciences and medtech. And of course, at EQT, we've been investing into those areas out of our early stage technology and life sciences funds for years, and we have a deep pipeline of opportunities. And yeah, with this initiative, we're even better set up to support those entrepreneurs and to invest into those startups.
Per, is this about national security? So we don't often think about the fact that you could see U.S. companies, and I don't know whether this is true, but we need to think about the fact that big U.S. companies could have a switch that actually says, well, now we're only mandated to do the U.S. I mean, is it that critical that Europe builds its ecosystem for tech?
So the way we think about it, as I said earlier, right, the world is not standing still. It's a competitive world. AI technology is advancing rapidly, and we're a global investor at EQT. But
we have European roots, and we have the largest part of our organization in Europe. So, of course, we support an agenda that drives, a more business-friendly and a higher growth agenda wherever we invest, and certainly also in Europe, and that's why we're so excited about this initiative.
Are there parts in Europe that they shouldn't focus on, for example, in the tech ecosystem? So if you look at LLM languages, is it too late? Does Europe need to think more about data centers or other parts of the value chain?
So what we're seeing is that when it comes to AI, that there are massive investments being made into AI infrastructure. And so I think that continues to be an opportunity for Europe. But we're also seeing an unprecedented number of native AI startups at the application layer. And I think here Europe also has a real right to win. If I look at some of the investments that we've made recently into companies such as Lovable, the vibe coding platform based out of Sweden, I mean, the growth rates that we're seeing here are unprecedented. They've gone from 0 to 400 million euros of annual recurring revenues in record time. So we really see opportunities across the AI ecosystem.
I mean, realistically, does Europe need a Google or an OpenAI? Would it ever have one? So, a company of that size and scale.
I'm not sure we'll be able to produce companies of that size. I mean, we have businesses such as Mistral, of course, when it comes to large language models. But I think what we're focused on is really investing into the opportunity set more broadly across the AI ecosystem. Yeah.
What do you think makes investing in Europe so attractive right now?
I think we have access to world-class talent. We have some of the best universities, academia in the world. And so the talent is there, the startups are there. We just have a scale-up challenge. Yeah.
What are you most excited about? And again, is it different investing in France than investing in Germany than investing in the UK? And how do you bring that together?
We really take a pan-European perspective to this. The pipeline that we have across those target subsectors is really across Europe, from the Nordics to Central Europe to Southern Europe. If I look at some of the subsectors, I think Europe has a right to win in all of those, right? Whether it's in quantum computing, whether it's in space, whether it's in AI or in life sciences.
I mean, and I've always been told that Europe doesn't have to choose between the US and China, but sometimes it feels like we're stuck in the middle a little bit. Do you think European companies, European tech companies, in the next couple of years will have to choose?
I'd say, there are a lot of external factors that we can't control in Europe. What we really need to focus on is just driving a competitive agenda ourselves across Europe to make sure that we drive a more innovation-friendly, a more business-friendly agenda. And this scale-up fund initiative is one of many, I think, promising actions that are being taken right now across Europe.
So the mandate is very fresh, because we found out about it only late last night. Yeah. So congratulations. Can you give me a sort of timeline of how much, so it's 5 billion, I guess, in all. How's fundraising going? When can we see the first kind of, cash being deployed?
So as I mentioned earlier, right, a substantial part of that 5 billion euro fund has already been raised. So I think, and the pipeline is there for us to invest into. So we want to get going as quickly as possible. And I'd say we expect to make the first investment at the very latest during the third quarter.
So, it's fast. I mean, things are moving so fast in quantum computing and AI and tech companies. So is that why you have to move, put the accelerator?
The opportunity is here right now in front of us. And the world is not standing still. So, and we're ready to make those investments. We have the infrastructure, we have the people on the ground, and we have the pipeline across those target subsectors to invest into.
Do you believe it's been harder for a lot of the companies that you've been talking to because of the war in Iran? Has that had a spillover effect, or is it fairly immune because the sector has still seen buoyancy even in Europe?
If you think about these subsectors and the opportunity set that we're looking at, is relatively speaking less impact by sort of the what's happening geopolitically in the world and where oil prices are. But of course, that does have an impact on overall economic environment and also risk sentiment. So from that perspective, it has an impact. But I think these businesses, these founders are more focused on executing on the opportunity ahead and getting access to that scale-up capital that they need.
So interesting, Per. Thank you so much for joining us. That was Per Franson.
Thanks for having me.
The EQT Chief Executive with us here in London. Now, coming up, we're joined by the Co-Chief Executives of Goldman Sachs International. We'll discuss inflation, we'll discuss market volatility, and of course, the deal-making outlook. That's coming up next, and this is Bloomberg.
phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London, and these are your top stories. President Trump says he called off a strike on Iran planned for today after an appeal by the leaders of Persian Gulf allies who called for more time to pursue a diplomatic solution. The head of the OECD tells Bloomberg the global economy is at risk of further deterioration over the Middle East conflict. We're live in Paris for the meeting of G7 finance chiefs. Plus, Standard Chartered plans to eliminate thousands of support roles over the next 4 years, joining the ranks of global lenders using AI to trim headcount. So if the conversations we've been having so far today have taught us anything, it's really now it is certainly not a boring time to be an executive in finance. That's true. Between navigating market volatility, negotiating cross-border M&A, supporting colleagues and clients in the Middle East, but also finding new talent to hire, every day brings new challenges and new excitement. Well, my next guests know this better than anyone, and I'm pleased to be joined by Anthony Goodman, co-chief executive of Goldman Sachs International and global co-head of investment banking at Goldman Sachs, and Kunal Shah, co-chief executive of Goldman Sachs International and global co-head of FIC at Goldman Sachs. So thank you both for joining us. So you've been in this job together as co-CEOs for a little over a year. I mean, everything's been thrown at you. There's there were Middle East war, there was Venezuela, there's a lot of, inflation, central bank. How's it been?
Yeah, well, look, firstly, thanks for having us. Great to be here. There's no question it's been a pretty turbulent environment. In these kind of environments, we see huge opportunity. It's a point in time where our clients need advice and they need support. We're obviously spending a lot of time trying to give them that and helping them navigate this environment, as complex as it is. And, and that's really key to us. As you know, everything in our business is about our client relationships and engaging with them. Look, I'd say the thing that's really critical in Europe, and I'm sure we'll talk about it, is we have to run a global business, but we have to run a local business. We want to be close to our clients. Right now we're operating in 29 offices across 23 cities, and really what Kunal and I have been focused on is making sure we get to all of those offices, see our people, and see our clients. And our clients want us to be there on the ground, close to them and near to them, to give them the advice and the support that they need. I would tell you that beyond investing in those relationships, there's 3 or 4 things that are really key for us, and that's what's been key in the last 12 months. Firstly, regulation. I'm sure we'll talk about that, but we want a pro-growth agenda. You've heard it from the earlier speakers today, and so we're spending a lot of time with European regulators and governments. We're leaning a lot into operational growth, by which I mean productivity gains and everything that can accrue from what we're doing on AI and collaboration within the firm across the divisions. We see enormous opportunity there. And then we're also very invested in our culture. This, Francine, the culture of the firm is really important to us. And so we're spending a lot of time with our people trying to engage in the collaboration that comes from the divisions working with each other. And so far, so good.
Kunal, if you look at global deal making, has there been a slowdown, or do you anticipate one because of the regional war?
Look, as Anthony said, times are uncertain, but even though our clients don't have clarity, I think the good thing here is that hasn't actually held up activity. Because although they may not necessarily know how the current war plays out, there are key structural themes they're focused on, whether that's resilience, whether that's diversifying supply chains, whether that is AI and technology. So actually, when you look at deal making at large in the region, there have actually been some real tailwinds there.
Yeah, and we'll talk about regulation in a second. We'll talk about the UK. But actually, when you look at, the feedback, I guess, from large sovereign wealth funds in the Middle East, will they continue to remain active amid the conflict?
Yeah, look, we're spending a lot of time in the Middle East. I was actually down there a couple of weeks ago. I think they are trying to operate in a fashion which is as consistent as can be with business as usual. The level of capital deployment, to us seems unchanged. There's no question they're maneuvering to adopt and adapt to a new environment. That's a thoughtful approach to it, and they're navigating it well. We're seeing a lot more focus, obviously, on technology, on AI. We're also seeing an enormous focus on infrastructure spending, both domestically and internationally, and we think that's a thoughtful place to be. We think it's a good opportunity for them and for us. I would just say, we remain highly committed to the region. We have over 100 people there. We have 5 offices. We're trying to do our best in this environment to support our clients and the sovereign wealth funds there. And I'd say, some of the things we've announced in the last few months have been consistent in that. I'm sure you saw this MOU that we signed with the Qatar Investment Authority for $25 billion. That's really about Goldman Sachs Asset Management working in partnership with the Qataris as they seek to invest globally across public and private strategies. We've done the same with PIF in Saudi. We're very excited about that. The other thing I would say, by the way, which is really critical to our business in the region, and we think critical to our clients in the region, is there is an enormous swathe of ultra-high net worth clients who really will benefit from our services, and we're trying to invest in that.
There does seem to be a difference between some of the private deals, private equity deals, and actually what we're seeing elsewhere. Do you see that difference?
I think on the deal-making environment overall, you're touching on an important point, which is if you step back and look at what's been going on in the investment banking business, we had a first quarter with just shy of $1.5 billion of advisory revenues. That's up about 90% year on year. We've seen M&A volumes up about 35-40% versus 5-year averages. But that activity is largely coming from big corporate M&A.
Right.
You know, deals in a size range of $5+ billion are up significantly. And that's really generally been about corporates trying to drive industrial leadership. What we're seeing in the market right now is that there is a real premium attached to being a market leader, having the scale and liquidity that comes from that. And the markets are rewarding you for doing those kind of deals. It's definitely been more muted on the private equity front, although we think that you'll see more activity there. Yeah, we think so.
Second half or sooner?
Well, look, in part it's going to be driven by what happens in the IPO market.
Yeah.
You know, the IPO market really is looking pretty healthy, particularly in the US, but we think there are signs of it building here in Europe. That's an important liquidity mechanism, as you know, for private equity. But I think they're also going to be leaning more and more into M&A activity. I mean, you know well, we all know well that there's a lot of pent-up inventory sitting in private equity hands. And I think that there's a degree of pragmatism both on the buy side and the sell side around finding appropriate asset pricing to get these deals done.
Kunal, the UK. I mean, there's a lot going on in the UK.
There is.
None of it is really that good. How are you expecting, first of all, client behavior to change given the political uncertainty?
Now, when you say it wasn't that good, actually Q1 growth was better than expected. So there were actually some tailwinds going into this. Of course, the war has had its effect, and whether it's the UK or Europe, just given the energy import requirements, of course, that's going to have a hit on growth. You're seeing this stagflationary impact on inflation. It's meant the Bank of England, as you know, went from expected rate cuts to now largely market pricing a couple of hikes. So that has led to pressures. I'd say it's also at a time when sovereign bond markets on a global scale have been facing pressures. You see this with treasuries, Japanese bonds, bunds, and the UK. And then, of course, you combine that now with the political uncertainty that's there. Look, we're not in the business of making political predictions. What I can tell you from our client base, when they look at the UK, it's a market which has actually served them very well. It's a great base to have for business and to be able to really transact and deal globally. But what our clients really need is certainty. And when it comes to the policy framework, which of course gets discussed as we think through what the next leadership may look like, what they really want is clarity, predictability, and something which hopefully is sustainable. So our clients can then go back to actually focusing on their businesses or their portfolios, which I think is really what's needed, because ultimately what this country needs is growth.
I mean, this is the one thing. Everybody wants stability. The UK Treasury recently announced new plans on ring fencing expected, in a couple of weeks. Does that make you rethink anything in terms of Goldman Sachs plans? Any impact, for example, for Marcus?
Yes, so look, when you look at the ring fencing regime, as you'll be aware, it's a particular quirk of the UK.
Yeah.
We think it's constructive that they're now following up this consultation, which for the ring fence banks should lead to some reduction of friction and costs. We're not a ring fence bank ourselves. We have capacity up to a headroom limit of £35 billion right now. So we have been, of course, growing our Marcus deposit product in the UK. Now, I think what's been especially productive in the recent announcements is the fact that that limit's now going to be reviewed on a 3-year basis, which is important. When you think about a global bank like ourselves, we've now got more clarity on the end zone for regulation, whether that's the implementation of Basel III, but also in the US, we now have clarity on the supplemental leverage ratio and various other rules, which means that we can now really project forward for growth and how we can really scale our business with our clients. And it's important that the UK remains within that. So now having more clarity that our ability to raise deposits and fund our business in the UK will have periodic review, of course, helps.
I want to talk about regulation in a second, but Wes Streeting has also put a Brexit reversal on the table. He's trying to challenge the Prime Minister, Keir Starmer. At this point, do you think the City of London would even want to rejoin the EU?
I think when you talk about Brexit reversals, of course, having a more open trade relationship with Europe would help. And there have already been discussions and some hints towards that direction already. There are clear lines to cooperate when it comes to defence. So I think that too is constructive. As for financial services, we can see what I can tell you is London still remains a vibrant centre. To Anthony's point, we've absolutely extended and expanded in the continent over recent years. For us, that's been very productive because it's really just meant that we've got closer to our clients in Europe.
Talk to me about regulation in Europe. I mean, it's kind of, there's a sweet spot, and it feels like we're not there yet in Europe, that maybe there's too much regulation.
Yeah.
Are regulators, understanding what's at stake?
Yeah, by the way, I think you're right. There is a sweet spot. Look, Europe continues to have huge opportunity. We feel very strongly about that. And we actually are optimistic about Europe. It represents 9 to 10% of the global population. It's 10, 15% of global GDP. But it requires Europe to operate in that capacity as Europe, not as 27 separate member states. And so what are we focused on? We're focused on that goal, and it's a simple goal. We really want Europe to operate in a cohesive fashion. What you just heard from your prior speaker around this technology fund, that's an enormous opportunity. I think they are leaning into two simple goals, which is consistent with our philosophy. Number one, we need to make it easier for business to operate pan-Europe. We can't have local jurisdiction, local regulations, and local
You really believe
admin.
it? 'Cause we've been talking about it for a while.
Yeah, we do believe it. We do believe it. Look, we think it's going to take some time.
Yeah.
We think you have to be patient. You think you have to be persistent. But I think European leaders and regulators get the need to make Europe an easier place for people to operate cross-border. And they also get the importance of having a deep, unified capital market so that actually when those corporates, when those startups scale up to a sensible place, they can access, a proper capital market that has the depth and liquidity of both the US and Asia.
Look, there's just a lot going on in markets, and it's AI. It could be the AI trade. How do you see the risks over the next 6 months in markets? It doesn't feel like the Middle East is getting any better, but I guess businesses have also a way to adapt and adjust.
Yes, so global stock indices, of course, have really been strong, many of them at now all-time highs. As you point out, AI has been a dominant theme. There is very narrow breadth when you really look at that outperformance. The US has really led this retracement post this conflict starting, but it is quite concentrated. And you're now starting to see some wobbles since Friday where the momentum trades are starting to turn, but it has really been a big structural trend. The market is, of course, looking at earnings coming out, like NVIDIA, et cetera, to really path forward. I'd say what we see from our own business and our own clients is real commitment to continue to scale. Now, some of that is just down to the insatiable demand for compute and really this race for capacity. But I'd also say from a corporate level, people are really starting to see the benefits from a productivity lens of this technology. So we do think that structural trend is there to continue. Of course, there'll be bumps along the road. We can have a debate on AI on whether the value is going to accrue at the chip layer, the infrastructure layer, the model layer, the enterprise layer, and a lot of that is going to remain to be seen over the cycle, but it's clearly a place that our clients are focused. Now, of course, one of the disconnects we get, though, is the fact that stock indices are at the high, but the price action in bond markets is obviously problematic on a global basis. Thus far, most of the sell-off we're seeing in bond markets is because of the inflationary impact of the current conflict. But there's a vicious cycle where the raising interest rates starts becoming a fiscal problem, and that's when things can sour and turn. I'd also say that right now the market's focused on inflation and those impacts from the war, less the growth impacts. Now that can bite too. We've survived thus far to May because inventories and commodities were higher. There's been some substitution, but at some point those stockpiles can run dry. So if we don't get resolution when opening up with the Strait, of course, that can start to have a real supply side impact. And that's when the confluence of these things can become more problematic for markets.
Yeah, and that's maybe it's something for the second half of the year, right?
Absolutely.
That's when it can become problematic. Thank you both for joining us. That was a great conversation. Anthony Gutman and Kunal Shah, co-chief executives of Goldman Sachs International. Now, coming up, oil prices decline as President Trump offers Iran a reprieve. We'll have plenty more on that next. We'll also go to Paris for the G7 finance chiefs. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bill Winters, the chief executive of Standard Chartered, says artificial intelligence will eliminate thousands of jobs at the bank as it replaces what he called lower value human capital. Now, the lender plans to cut more than 15% of support staff by 2030 as it expands its use of AI to streamline operations. Now, Standard Chartered employed about 52,000 people in those roles at the end of last year.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
Jensen Huang, the NVIDIA chief executive, says semiconductor demand in China is incredible, and he expects authorities there to eventually allow the import of AI chips from the U.S. Now, Huang was a last-minute addition to a delegation of business leaders who traveled to Beijing for President Trump's summit with Xi Jinping. Now, he spoke to us exclusively in Las Vegas alongside the Dell chief executive.
The president wants America to win everywhere. Right. The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and to explain very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jesse, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200. Right. I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place. But I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
Jensen Huang, the NVIDIA chief executive, and Michael Dell, the Dell chief executive, speaking exclusively to Bloomberg's Ed Ludlow. Now, President Trump says he's called off strikes on Iran scheduled for later today. That's after the Gulf allies asked for more time to seek a diplomatic resolution.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Well, joining us now is Jumana Bersetchi, Bloomberg's Horizons Middle East and Africa anchor. Jumana, thank you so much for being here. I mean, the President Trump's Iran threats are a little bit discombobulating because we thought they were looking for a diplomatic solution, that there were threats, but then he backed down.
Yep, escalate, de-escalate, escalate, de-escalate. We've been here many times. But I think if we rewind back 24 hours, remember President Trump also threatened that the clock was ticking for Iran to come to the negotiating table to make a deal or else. And now we know, in his own words, if we take it at face value, they actually did come very close to launching a second wave of attacks, if we believe what he said. And indeed, there was lots of media reporting yesterday suggesting that he had been briefed on various military options, but at the request of Gulf allies, and he specifically cited Saudi Arabia, Qatar, the UAE, he's decided to hold back, at least for a couple of days, with the view that maybe Iran this time around will come to the negotiating table. Now, at the same time, Francine, we are back where we were discussing the same issues that we've been discussing for the last couple of weeks. The fact that they have a different timeline vis-a-vis how they're going to reopen the strait. The Iranians are asking for the blockade to be lifted. The U.S. are saying that they're not going to do it until the Iranians lift their own blockade of the strait. The nuclear file, obviously very complicated, and the Iranians are saying that they have a right to continue with nuclear enrichment, but in order to get to that level of discussion, you have to pass through the other items sequentially. And of course, of top of mind for the U.S. administration right now is what they're going to do with the Strait of Hormuz.
Of course, and I mean, the U.S. also issuing a new Russian oil waiver to free up supplies. That feels significant.
It does feel significant, and also just a reflection of how much pressure energy markets are under. The U.S. administration is doing what they can to cap the move upwards in energy prices. We have Brent once again sitting at $110. There were some, again, media reports coming through from Iran yesterday suggesting that the U.S. might actually introduce a waiver or reintroduce a waiver on Iranian oil exports. That was not the case, but they did extend the waiver on the Russian one that expired a couple of days ago for Russian oil that's already on water. But the point is here, they are under a lot of pressure. The price of gasoline per gallon keeps the tick up in the U.S. We're heading into midterms. The war is increasingly unpopular, and this is one way, perhaps, to cap the upside that many energy analysts are expecting to come throughout the month of June.
Jumana, thank you so much. Terrific briefing there from Jumana Bersetchi, of course, on what's happening in the Middle East. Now, G7 finance chiefs are also meeting in Paris today with an inflation shock looking likely to endure. They must come to terms with the new economic reality. The OECD Secretary General, Matthias Cormann, spoke to Oliver Crook on the sidelines of the event.
Normally, you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker. Across advanced economies, what we see is that core inflation remains, relatively okay. Yeah. But of course, I mean that's precisely what we will be looking at.
Well, let's bring in Bloomberg Chief Europe Correspondent Oliver Crook. Ollie, good morning. So what more have we heard about the impact of the Iran war?
Yeah, so it's very interesting because obviously for central bankers and finance ministers here, everybody's focused on A, inflation, and B, the impact on growth. And of course, that stagflationary dynamic we've been talking about as a consequence of this war, particularly here in Europe. It seems so far from the conversations I've had and what we've heard from a number of finance ministers, and we'll be quizzing the chief of the Bundesbank and the Banque de France a little later on this, is that for the time being, obviously inflation is rising, but it's staying more or less segregated to the headline level. They're not seeing very explicitly the secondary effect, but you heard it there from Matthias Cormann, the OECD Secretary General, that this is a risk, and that even if you do get that, inflation spreading from energy to the headline to other parts of the economy, you may still need to sort of hike rates in the face of diminishing growth, and that is the very difficult conversation and scenario for many of these politicians and policymakers here in France meeting, and of course speaking to Scott Bessent in the search for sort of what the U.S. policy is going to be going forward, particularly since we get some conflicting reports. On the one hand, Bessent wants to see more sanction enforcement on on Iran. On the other, potentially they're putting out this idea that they may waive some of the sanctions on oil in order to keep the prices diminished. So those are some of the conversations that are happening here just behind us.
And Ollie, EU officials will meet to finalize a trade deal with the U.S. to avoid more tariffs.
Yeah, that's right. I mean, this is the other conversation that is being more centered around Brussels, trying to avoid that increase in tariffs from the Trump administration. You'll remember President Trump has set the deadline of July the 4th, the 250th birthday of the United States, for the EU to get this deal agreed to, ratified, and put into power. There's going to be a meeting a little bit later today to try to make a sort of meaningful step to get towards that deadline. The real question is, given how slow the EU move, can they hit that deadline? That's going to be absolutely crucial, because the last thing you want, Francine, in addition to a stagflationary shock, is another trade war.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, from the G7 finance chiefs meeting in Paris. Now we'll have an exclusive interview with the Banque de France governor and the president of the Bundesbank. Ollie Crook will be conducting that. It's at 1:30 p.m. London time. You don't miss it. It's probably one of the last ones by Monsieur François Villeroy de Galhau before he steps down. Now the picture for markets is one of, well, it's very tentative, actually. If you look at tech stocks, they're slipping. Traders really trying to find out what will happen in the Strait of Hormuz. Money managers increasing their exposure to stocks by the most on record last month. That's according to a survey by Bank of America. Up next, Bloomberg Brief. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Trading with caution. Stock futures slip as longer end Treasury yields in particular rise to flirt with levels last seen in 2007. Hold for now. President Trump refrains from scheduled attacks, he says, on Iran as Gulf allies ask for more time to form a deal. And job reshuffles and reductions hit industries from tech to financials as they push harder into AI. Let's get a check on markets around the world now. We'll start with Winnie Su in Hong Kong for the latest from Asia. Winnie.
Good morning, Bonnie. We're seeing today another risk-off day in Asia with the MSCI Asia here down for a third day. That is its longest of such streaks since March. Now, you are seeing oil prices easing a little bit, but still it's the concern around inflation given the lack of clarity around the Middle East situation, and that's keeping bond yields higher. Here, Kospi index is leading declines as you see chip makers actually tracking declines overnight in the U.S., given some concerns that Seagate technology might not be able to meet the soaring demand when it comes to memory chips. Now you flip the board and take a look at today's bright spot in Asia is actually in Japanese banks. You're seeing the bank index here up about 3%, driven by the higher bond yields and also stronger than expected GDP numbers coming through, raising the bets around Bank of Japan to raise rates earlier than later.
Winnie, thank you so much. That's Winnie Su there in Hong Kong. Now let's get to London for a look at Europe with Charlie Wells. Charlie.
Good morning, Vonnie. Well, it's a different story here in Europe compared to a lot of those indices in Asia, where we're seeing optimism across the board. That Euro Stoxx 600 up almost 0.8%, and similar optimism at a lot of these country-level indices as well. This seems to be something of that anti-AI trade that we get here in Europe, because there isn't that serious IT play, and also some potential optimism coming out of the Middle East. Let's flip and take a look at bond yields, a really crucial bond yield here in the UK, that 30-year. It is down some 6 basis points, potentially linked to some comments that we heard from Andy Burnham, the potential front runner to potentially replace the Prime Minister of the UK, talk about how he would stick to fiscal rules. So that getting a little bit of a relief this morning on that optimism narrative here.
Yeah, the bond market is certainly the narrative here in the United States as well. Charlie Wells, thank you so much. And that's where we begin. We have a curve steepening here with the 2-10 spread now at 53 basis points. The 2-year yield up 2.5 basis points. The 10-year yield almost at 4.61, and the 30-year yield now at 5.15 practically. This, of course, levels that we haven't seen since 2007. We're right about there. Now, this is partially the story. We have Brent crude still trading above 110, but it's down 1.5% on this idea that President Trump had scheduled attacks on Iran and then decided not to when some Gulf countries got in touch with him. That would all have happened today. So a little bit of relief in this market, but the potential for escalation or de-escalation is definitely something that could prompt this market to, destabilize, particularly the bond market. We have S&P futures down about 0.2%, and NASDAQ futures down a little more than that. Of course, the stocks sold off yesterday, semiconductors and memory chips in particular selling off. So we'll see if there are any dip buyers today or what, in fact, happens with equities, given where bond yields are at the moment. All right, let's get to some individual pre-market movers now. Back over to London and Chloe Melly. Chloe.
Good morning, Vonnie. Alphabet is up slightly this morning after Google agreed to build an AI cloud business with Blackstone. So this is part of a broader boom in spending in infrastructure, computing infrastructure. And the aim there is to be able to compete with companies like CoreWeave in this really increasingly competitive market. And so we're up about 1% for Alphabet this morning. Moving on to NVIDIA, which is on the move and seeing a little bit of weakness this morning ahead of the earnings expected tomorrow. We had the CEO, Jensen Huang, saying that China will eventually allow U.S. chips into its market, but the comments were not necessarily seen as that reassuring or that encouraging, it seems, and so we're seeing a little bit of weakness there. And finally, SanDisk is also in focus today. It's also seeing a bit of weakness this morning, part of this broader memory sell-off in memory, storage stocks, etc. And it is worth noting that the stock is still up about 460% year to date, but we have seen this massive rally start to cool a little bit, and so this is really what is in focus this morning for SanDisk.
For sure, those Seagate comments really injecting a little fear into this market. Chloe, thank you so much. Chloe Melly there in London. And coming up this hour, more on price concerns and the challenges ahead for central banks. We'll speak with Christopher Hodge of Natixis. But first, President Trump calls off apparently new strikes that had been intended for Iran.
Other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to.
Joining us now is Jumana Barsechi. Jumana, what do we make of the president's latest comments? How will they be received in Iran?
Yeah, well, Vani, 24 hours ago, remember, President Trump also put out a threat and said that the clock was ticking. Unless Iran returned back to the negotiation table, they know what will happen to them. And indeed, we found out throughout the course of what President Trump said yesterday, his Truth Social post, that the U.S. were actually planning on another round of kinetic actions. So that's not to be dismissed lightly, certainly from the perspective of people in the region. And President Trump also explicitly said that it was at the request of those three Gulf nations, Saudi Arabia, the UAE, and Qatar, that he decided, or the U.S. decided, to refrain from another round of those attacks, and then said that he's hopeful that a deal will be reached in the coming days, the next 2 to 3 days. So it's not completely eliminating the possibility of another round of hostilities. It's just a deferral at this point. But then the question becomes, how are we going to get this diplomatic breakthrough? And here, again, the stances and the respective stances are still extremely far apart on those key matters when it comes to the reopening of the Strait. Obviously, the U.S. are insisting that Iran unconditionally reopens the Strait. The Iranians are saying that they're not going to do it until the U.S. lifts their blockade. And then sequentially, the Iranians want to tie in the reopening of the Strait to a later discussion around the nuclear file. President Trump does not want to wedge the two issues. He wants them to be compiled together into the same round of discussions. And key here is enrichment. Once again, the Iranians saying that they have a right to low-level enrichment. The U.S. are saying that they have no right to enrichment, or if they do, only for civilian purposes, that 3.67% number over an extended time frame. So these are the same core issues that we have been discussing over the course of the last few weeks. And ultimately, Vani, there's going to have to be some form of compromise between the two sides. But ultimately, once again, we're in a situation where President Trump is threatening to go down the path of military action unless a deal is agreed to in the coming days. We'll see what happens. But I will say, from the chances of a diplomatic breakthrough, expectations are pretty low here. The best bet is that we may get a framework around how those negotiations are going to take place in the coming weeks, months as well.
Meantime, Brent's still above 110, and interestingly, WTI is around 107.50, which is pretty close to the highs of the war. Jumana, thank you so much. Jumana Resechi there. The Iran war giving Russia a chance to deepen its energy ties with China. President Vladimir Putin set to travel to Beijing to meet with President Xi for talks Wednesday. Joining us now from Singapore is Bloomberg's Roz Matheson. So the prompt reason for this, Roz, is to talk about a gas pipeline. Tell us a little bit more about sort of the headlines that will emerge just in terms of energy.
Well, that's right. So one of the key points of this meeting will be about this proposed pipeline, which runs from Siberia through Mongolia to China, or will rather. And Russia is obviously hoping that, given China's imperative right now around energy, because they have limited supplies coming from the Middle East, that they might be able to negotiate some kind of better deal, some kind of long-term contract price for this pipeline and get China to commit, because it's been going pretty slowly so far. And we know from officials that on the Russia side, at least, they're keen to speed this up and perhaps get some kind of commitment or even a timeline for pricing for this project while President Putin is in China. And so the sense is China's been taking their time. They're wanting to discuss it. They're willing to get a good price, because China has always had that leverage with Russia about generally getting a lower price for energy, because they are such a loyal buyer for Russia. And so we're going to have an interesting time, at least behind the scenes, on those conversations when it comes to energy. But there's also a lot of broader conversation that no doubt is going to go on around the relationship. He's coming there on the heels of President Donald Trump's visit to China very quickly, although this was apparently scheduled to be interesting. He'll want to know exactly what went on in some of those conversations. He'll want to know what was discussed about the Middle East, but also if the topic of Ukraine and Russia's war there came up at all. And so he'll want to get a readout of sorts from Xi Jinping about that. But certainly what he was primarily wanting to do is get some kind of assurances from China around that energy relationship.
Yeah, the Siberia 2 pipeline. Speaking of the interlocking trips, the FT is reporting that Xi Jinping actually told President Trump that Putin might end up regretting his invasion of Ukraine. Now, we have to say we haven't got any independent verification that this was actually said, and China itself, its foreign ministry spokesperson, is saying these things are not based on fact. But surely this will color in some way Putin's visit, or will it?
Well, it might be interesting again to see to know what they say behind closed doors. As you say, China's foreign ministry coming out and saying they have no sense of where that would have come from, and they feel that it was probably made up, or at least that's their accusation. But certainly you can imagine Donald Trump asking Xi Jinping for his perspective on Ukraine, because this is a conflict that Donald Trump came into office saying he was going to bring to an end very quickly, and yet after his time in office so far, the war is continuing in Ukraine. So he probably wanted to get Xi Jinping's sense is, of where he saw the war, because for China, obviously, that they don't want to get too involved in Ukraine, but I'm sure they don't want this war to be continuing necessarily. So what has Russia been saying to China about that? And the US has been trying to get China to use its leverage on Russia when it comes to Ukraine. So perhaps an arched eyebrow, maybe, from Vladimir Putin about that comment, and maybe he'll ask Xi Jinping, but he probably really knows already where Xi Jinping's thoughts are on this conflict.
Absolutely. Roz, thank you so much. That is Bloomberg's Roz Matheson. The impasse around the Strait of Hormuz keeping investors cautious. Stock futures staying lower after 2 days of losses, and 30-year Treasury yields flirting with levels last seen in 2007. Citi now warning that the 30-year yield may reach 5.5%. Let's get more with Bloomberg's Van Ram. Van, are these markets still stable, and at what point do we start to worry about instability?
Well, not at the moment, Vonnie. I think that, we will start to worry about instability if we get to the 550 levels that you mentioned from Citibank. But I think that, what is important is, even though oil prices have come off the boil at the moment, we have done $100+ a barrel for a long time now, and that is kind of giving the markets reason to worry about inflation. We got those inflation prints out of the US last week. Those were ugly and point to the direction of what the Fed is likely to do. The Fed's March dot plot is already blown out of the water. They need to revise up their macroeconomic projections, i.e. specifically inflation. And that means that, long-dated yields are going to be on the march higher. Although I think that, there are going to be pockets of opportunities for buying duration here. I think that, if you're talking about 515 on the 30-year yield, which is where we are at the moment, I think that you want to scale into duration at this point, because anything from here is probably not going to endure through the life of the bond. And I think that assume unless the whole world goes topsy-turvy, I think these represent bargain levels for long-dated treasuries.
Well, it's not out of the question that the world goes topsy-turvy, Van. I mean, we had Andy Burnham try to calm the bond markets today, and indeed he did, with gilt yields coming back by about 6 basis points or so. But then on the other hand, you've Japan, where the 30-year yield there is just rising to, not infinity, but like serious levels. And we have the yen beyond 159 once again. So how at risk are the UK and Japan, and how much in need of central bank action are they?
Well, in the case of the UK, Vonnie, I think that, long-dated yields, again, specifically referring to the 30-year yield, if you swap that out into whether you're talking about euros, whether you're talking about the US dollar, you are going to get a much higher pickup than you get on US treasuries, comparable US treasuries and bonds, German bonds. So I think that, there is a case for, compelling yields on long-dated gilts, but I don't think they're going to rally anytime soon because of the Burnham factor. If you're talking about Japan, I think the selling has got more to go, because the Bank of Japan is deeply in accommodative territory at a time when they need to be raising rates quickly. If you pass the Taylor rule, Vonnie, I think that suggests very conservatively a Taylor rule rate of 2.8%. They are not even at 1% at the moment. So I don't think, the sell-off in JGBs is going to abate anytime soon. And we got the GDP data this morning that showed the economy was pretty resilient heading into the Iran war. So I think that the concerns about growth aspect have been overplayed by the BOJ. I think they need to raise rates here to quell the riot in bonds.
Van, thank you so much for all the context this morning. Very interesting markets, and that is Van Ram of our MLive team. Now to other top stories trending on the terminal this morning. Sources say the SEC is expected to release a so-called innovation exemption for tokenized stocks this week, creating a new framework for betting on the fortunes of publicly traded companies. The move could reshape the landscape of the U.S. stock market as the Trump administration continues to loosen the rules for crypto markets. EU officials are meeting today in an attempt to finalize legislation for a trade deal with the U.S. They must reach an agreement by July 4th to avoid triggering tariff escalation from President Trump, as promised. NVIDIA CEO Jensen Huang sees China eventually opening its market to AI chips from the U.S. He spoke to Bloomberg from the Dell World Conference in Las Vegas.
The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
Jensen Huang there. Coming up, AI-driven staffing shakeups hitting industries from tech to financials. Standard Chartered and Meta, some of the latest companies restructuring their workforce. More next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bloomberg Brief, I'm Vonnie Quinn in New York. The push to utilize AI hitting jobs across industries. Meta is moving 7,000 workers into AI roles while cutting staff in other areas. Standard Chartered announcing a plan to eliminate thousands of support roles as they shift to AI to streamline processes. Standard Chartered CEO Bill Winter is saying, quote, "It's not cost cutting, it's replacing in some cases lower value human capital with the financial capital and the investment capital we're putting in. We don't have job losses, but we do have job role reductions in favor of the machines, and that will accelerate as we go forward into AI." Bloomberg's Tom McKenzie joins us now. Wow, Tom, lower value human capital, it's a bleak phrase. What is going on in the industry? I mean, Standard Chartered just the latest to announce the potential for many thousands of job cuts.
Yeah, there's quite the sting, isn't there, coming from that comment, and you can imagine rippling through, of course, the offices of Standard Chartered globally on the back of this announcement. It will be taking place over 4 years. It's about 15% of their 52,000 or so global employees, but it's a reminder that Standard Chartered is really leaning in to the AI efficiency theme. They're going to be scaling their investments around AI and implementing it pretty aggressively, and as a consequence, it seems trimming some of those back office roles, some of those support roles, as the CEO was saying. Others, though, in the financial space, of course, in the banking space, are looking at similar measures. We've heard from the CEO of HSBC talking and considering potential job cuts as they also invest around AI. Similar comments from Goldman Sachs' leadership as well. So you can imagine this won't be the last of this story. And at the same time that Meta is talking about realigning 7,000 jobs. So essentially phasing out 7,000 roles and replacing those or moving those current employees, 7,000, into different roles around apps and agents. And that's on a week when, on Wednesday of this week, employees at Meta are expected to find out that about 8,000 of their jobs will be cut. So there's 7,000 being reassigned, 8,000 job losses on Wednesday. That's been flagged already, the 8,000 number. So they're just waiting to find out where the axe lands on that. But again, it's a reminder that it's not just the hyperscalers, it's not just those building the AI solutions, but also those incorporating it that are increasingly trimming their headcount as they invest along these lines.
I'm sure it's not the last of these headlines we'll be receiving. Tom, thank you so much. Bloomberg Tech Europe anchor Tom McKenzie there. Coming up, staying with AI, the Wall Street Journal reporting the American rebellion against AI is gaining steam. We'll have a look at that and the rest of your headlines in your front page news. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, on the New York Times, the shooting at San Diego County's largest mosque. The Times reporting a mother of one of the shooters called police that morning to report her son, her car, and some guns gone. She said he might have a friend with him. By the time the police located the shooters, the teenagers had killed 3 people and shot themselves. Next up, the Washington Post reporting on President Trump's decision to drop his family's lawsuit against the IRS. The Post says it's part of a highly unusual agreement that established a nearly $1.8 billion fund to compensate those who claim they have been targets of a weaponized justice system. The Post says the fund could result in payouts to Trump allies and supporters. And the Wall Street Journal reporting the American rebellion against AI is gaining steam. The Journal says industry leaders are trying to address the negative sentiment by highlighting AI positives and finding solutions to problems such as energy costs and children's safety. Coming up, we're going to be speaking with Christopher Hodge of Natixis on price pressures as the Hormuz standoff drags on.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Trading with caution, stock futures slip as longer-end Treasury yields rise to flirt with levels last seen in 2007. Hold for now. President Trump refrains from scheduled attacks, he says, on Iran as Gulf allies ask for more time to form a deal. And job reshuffles and reductions hit industries from tech to financials as they push harder into AI. Let's take a look at the bond market first. It's going to be in focus all day today. Look at that 30-year yield at 5.15 and change now, up another 3 basis points. We're seeing it across the curve, particularly the 2-10 spread widening. We're at 53 basis points on that now, with the 2-year yield almost at 4.08 and the 10-year yield above 4.61. Lots of commentary. Goldman Sachs seeing some emerging measures of value. Barclays and Citi talking about the 5.5% mark being breached potentially on the 30-year. And the head of BlackRock's research unit is now recommending investors reduce their exposure to DM government bonds. We're also seeing it across the world. We're seeing it in Japan, where the yen is above 159 again. And then we're also seeing it in Europe, although less so in the UK today, with Andy Burnham making some comments that seems to calm the bond market there. Now, Brent crude is still trading above 110, but we're down about 1.5% after the president said he had threatened to bomb today, essentially, Iran, and that he withdrew that decision after some requests from Gulf countries. We do have futures pointed lower as well on the equity indices. This could be a slightly different story. I mean, obviously yields have something to do with it, but we also had a sell-off in stocks yesterday. The stocks index was down 2.5%, and memory chip makers, after Seagate's CEO said they wouldn't really be able to build factories fast enough to meet demand for memory chips. Let's get to some individual movers now. Here's Chloe Melly in London.
Good morning, Bonnie. Alphabet is up slightly this morning after Google agreed to build an AI cloud business with Blackstone. This is, of course, part of this broader move to invest a lot in computing infrastructure. And it seems that the market is reacting quite positively to this new partnership this morning. Moving on to Hyperliquid Strategies, which is in focus this morning and reacting to a report that the Trump administration will soon be rolling out a plan to trade the digital versions of securities. So this is a move that could reshape the American stock market and could potentially be a big boost for companies like Hyperliquid. And so we're up about 10% in pre-market trading this morning. And finally, SanDisk is also in focus and slightly weak this morning, part of this broader sell-off in memory stocks, and also reacting to those Seagate comments that you've just mentioned, Vonnie, about not being able to keep up with that demand for memory chips. And so there's a bit of investor fears around that and around that whole sector. And so we're down about 3% for SanDisk this morning.
All right, Chloe, thank you so much. Chloe Melly there in London. The 30-year U.S. Treasury yield hovering close now to its 2007 highs, while consumer prices don't show signs of slowing down. Christopher Hodge of Natixis weighing in, writing, quote, "We don't think that inflation will continue to trend upward, but instead stay in a range as consumer demand falters in the coming months." Joining us now is Christopher Hodge, Chief U.S. Economist at Natixis. Chris, we haven't seen demand fall off too much just yet. What will be the trigger for that demand to fall off? Will it be oil prices at a certain level for a certain amount of time, bond yields? What's going to do it?
Well, I think the longer that you see these higher oil prices and a combination of these tailwinds from the one big beautiful bill. So, you know, taxpayers have gotten about 20% more money back from the government than they had as of April 2025, and that's going to fade as well. And you're just looking at an overall weakening consumer as wage growth slows as well.
Yeah, I mean, I'm sort of surprised that the one big beautiful bill payoffs are still out there, right? I mean, are consumers really still using that money in order to keep up with inflation?
Yeah, we think April was the last month where you're going to get a tailwind and a boost to consumers for that. So we do think that that is really going to drop off when we get the numbers from May. And, you know, in combination with higher gas prices, lower consumer confidence, that's where we see the dampening consumer demand throughout the course of 2026.
You know, Chris, it's the long end, you know, yields rising, but around the world, I mean, Japan seems to have completely decoupled from the rest of the world at this point. It is just out on its own at this stage, but it's essentially the same problems: fiscal expansion, capex in the AI sphere, you know, increased issuance, another one. Where do we stop, particularly in the US? Are we at levels where we might actually pan out for a while here?
Yeah, well, I mean, I think from the administration's perspective, the bond market is really where you've seen a change in trajectory for certain policies, right? So, I do think I would watch out for something from U.S. policymaking, but ultimately, you have a fiscal trajectory that politicians have no appetite to bend down. You have the end of QE, or at least a slowing of QE in the future. And ultimately, bonds are not an inflation hedge. Stocks are. But as you get more and more inflationary pressures, or at least perceived pressures, you're going to get upward pressure for yields.
Chris, you say that you don't think that inflation is going to continue to trend upwards. What will cool it off, given that oil prices are going nowhere? In fact, WTI, the spread between WTI and Brent is only about $2 for the prompt month contract, at least.
Yeah, I think unless you see a spiraling upward price for oil, the price shocks that you see for core inflation are going to be, to use the dreaded word, transitory. So, those are going to push up prices once, but on a month-over-month basis, I do think that the weaker consumer is going to put lower pressure on products where consumers have a choice whether or not to spend. So, I think some of the bleed through from headline inflation to core is going to be offset by the lower consumer demand.
So we get some FOMC minutes this week. Are they going to be relevant, and will they teach us anything about this committee, given that it's already changed, essentially?
Yeah, I think they're less relevant than they have been in the past. And that's just primarily because Fed officials, particularly Fed voters, have been so vocal about how they view the economic trajectory. We don't really need the minutes from the meeting, to see where everybody stands. One thing that I would watch out for, though, is the Fed staff estimates. So does the Fed staff view the inflationary dynamics as being less transitory than they had previously? Do they think inflation is going to be stickier? That's something that I really think could shift Fed voters, especially on the board, throughout the course of the year.
What will we see in June? Are we going to see, a Fed chair that's more conservative, hawkish, or are we going to see a Fed chair that's willing to maybe consider that this economy would be able to take a rate decrease?
Well, I don't think, to be completely honest with you, I'm not sure that Kevin Warsh is going to have a huge impact on the near-term trajectory of Fed policy. Through no fault of his own, the process of him being picked and him being confirmed was very much politicized, and I would assume that some of his colleagues would think that he's got some preconceived biases about being dovish. So I think he's going to have a hard time convincing his colleagues, at least in 2026, to bring rates down very quickly. There's a genuine divide on the Fed right now, and I think it's going to take a little bit of time for him to be able to swing those voters on the Fed. So his appointment, I don't think really changes my calculus about the near-term policy trajectory.
Well, of course, the yields at these levels also will do a little bit of the Fed's job for it in taming some kind of inflation, I imagine. Chris, what is the Natixis view on what happens with rates between now and the end of the year?
Yeah, ultimately, we do think, because we think that core inflation is going to stay within a very narrow corridor, the Fed's going to look more on month-to-month inflation. Of course, year over year is going to be elevated because of the price increases, but month-to-month inflation, I think, is going to be cooler throughout Q3 and Q4. We have the Fed cutting twice, actually. We see a little bit more softness in the jobs market, and because inflation is still high but not accelerating, the Fed's going to be comfortable cutting.
When are we going to see that labor market weakness?
Well, it's not going to take much, right? So the unemployment rate ticked up about 8 bips to still rounded 4.3, but demand for labor is still pretty low. So you have a lot of people dropping out of the job force, and that artificially keeps the unemployment rate fairly low. So I think any sort of upward pressure, which we think we're going to see in the next few prints, is going to put additional pressure on the Fed to cut, which, as I mentioned, ultimately I do think we're going to get 2 cuts. Now, I don't have a whole lot of conviction about the timing of cuts, but I do have a lot of conviction about the directionality of Fed policy. So I think what's being priced in the market, which is hikes right now, is a little bit out there. I really can't see a path to the Fed hiking when wage growth is very slow and longer-term inflation expectations are still very well anchored.
It is going to be an interesting few months then, Chris. Thank you so much for joining us this morning, Christopher Hodge of Natixis. Now, to other top stories trending on the terminal this morning. New York City Mayor Zohran Mamdani is set to hold individual meetings with JP Morgan CEO Jamie Dimon and Goldman Sachs CEO David Solomon. The meetings are part of a string of conversations Mamdani's held with business leaders as he pushes for higher taxes on the wealthy. The spread of a bushfire in Southern California's Simi Valley is slowing. Fire activity has decreased significantly due to calmer winds and higher humidities. The fire nearly doubled in size over a 2-hour period Monday evening. Evacuation orders have been issued. The LIRR strike has ended. New York Governor Kathy Hochul says the MTA reached a tentative deal with 5 unions on wage increases. Some services will resume today at noon New York time. Coming up, President Trump calls off new strikes against Iran for now. More on that next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong U.S. tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to.
President Trump halting what he says were scheduled strikes on Iran after Saudi Arabia and other Persian Gulf allies wanted more time to pursue diplomacy. There was no immediate confirmation from Tehran of renewed talks. Bloomberg's Kasia Klimashinska is live from Washington. The president has repeatedly threatened going back to physical or kinetic warfare. Kasia, this is another example of it, but we haven't got there yet. Is there real optimism in D.C. that something is actually happening?
There is not much optimism here in Washington, D.C., and I think there isn't much in the markets either. I see Brent oil prices are stuck around $110. So the one thing we know is that the U.S. will not attack Iran today, but President Trump himself said that maybe he postponed this attack just for a little bit, for 2-3 days, or maybe forever. He said that there are talks going on. He also said that this particular delay came after a request from his Middle East allies, but we didn't get any more reports about exactly who is talking to whom and where there is progress. The one thing that came was this report that Iran floated that perhaps the U.S. is offering lifting sanctions on Iranian oil, but that I find it hard to believe. I find it hard to believe that the U.S. would agree to this. The one leverage that the U.S. seems to be having over Iran is cutting the flow of dollars or of funds to Iran because Iran is not able to get this oil out. So while we don't have any new military attacks, which I guess is good news, we also don't have any credible, reliable reports about whether there is any progress in negotiations.
So basically a stalemate. On the domestic front, the SEC apparently, Kasia, is going all in on crypto infrastructure. So it's apparently planning for more synthetic versions of stocks. So explain to us what's going on at the SEC.
We might hear more details about this week. The SEC is looking at what they call an innovation exemption, where they would allow basically much broader trading of tokenized versions of stocks, of real assets. That's like a big move in the crypto market this year, and we know that Trump and his family is very interested in those markets. The Trump administration has been supportive, cutting regulations for the crypto markets. So that's what the SEC is looking at now, whether to allow the trading of tokens of those assets, including the tokens that wouldn't have any backing or support of the companies that issue the stocks. So if that were to happen, it would be like this real-life, multi-year experiment of whether the trading in assets can move into the crypto markets.
Yeah, I mean, it's fascinating. It would likely be 24 hours. It would be a different way of discovering prices for stocks and so on. We'll see what happens. In terms of the drug pricing expansion, though, we did have the president making an announcement with Mark Cuban. Tell us what they both said.
Trump definitely wants to move the attention away from international issues, away from Iran and high gasoline prices, and he wants to talk about his affordability plans. One of them is these lower drug prices. All the presidents here at the White House are trying to cut the cost of healthcare and drug prices for Americans. This proposal unveiled at the White House yesterday by Trump and Mark Cuban, the billionaire, was about allowing Americans to buy more generic drugs directly from Trump RX website, so that would lower the prices for those generic drugs. This is new indeed, because previously what Trump has been doing was those deals with drug companies. So then that allowed Americans to buy some the original brand names via the Trump RX website. There are also some other efforts. Trump is, for example, trying to lower the gasoline prices by asking Congress to lift the federal tax on gasoline. We'll see whether Congress will go with that.
And Kasia, you know, as gas stays above $4.50, albeit pretty stable up there, we are seeing more state primaries. Give us the update on what we are looking at in terms of Georgia, Philadelphia, and some other states.
We have several primaries today. The most interesting one for me, anyway, today is in Kentucky, where Thomas Massie is up for re-election. This is a Republican lawmaker who has criticized and went against Trump several times, including on his signature tax proposal last year. Massie also sought the release of the Epstein files and is also a critic of the war in Iran. So he's up for re-election in a Republican primary today. President Trump has been actively supporting his opponent, and he has, in fact, sent his defense secretary yesterday to Kentucky to campaign against Massie.
All right, it's going to be fascinating. Kasia, thank you so much. Kasia Klimashinska there. Back to tech now. Firms are ramping up efforts to increase productivity and cut costs, they say, by utilizing artificial intelligence. So Meta is moving 7,000 workers into AI roles, but also cutting staff in other areas. Standard Chartered, meanwhile, announcing a plan to eliminate thousands of back office staff. Here's what Standard Chartered CEO Bill Winters said earlier, quote, "It's not cost cutting, it's replacing, in some cases, lower value human capital with the financial capital and the investment capital we're putting in. We don't have job losses, but we do have job role reductions in favor of the machines, and that will accelerate as we go forward into AI." Bloomberg's Neil Campling joins us now. I mean, that sends shivers down the spine, Neil. Not only are some humans lower value capital than just investment, I guess, but also, you know, it's going to turn in favor of the machines. Is that what we're seeing at Meta as well, or is it just Standard Chartered?
Morning, Bonnie. We are seeing this at a number of companies. Actually, we saw a few announcements last week as well. It's about efficiencies. It is really about the some of the tasks that you can do quicker, more efficiently, and more accurately with these AI tool sets than we can as humans. It's not necessarily going to lead to huge job losses. It's just in terms of job efficiency that you move some of those roles into more efficient processes. And to be honest, we've had that over decades in terms of where you've seen tech developments and advances. We just have more efficiencies in the actual systems in place. And in fact, if we are losing some of the lower intensity jobs, you can potentially retrain people to have more efficient roles, and perhaps even to code some of the future AI efficiencies that we need in this digital world.
Lower intensity might be a nicer way of saying it, though, than lower value, right? Let's get to the Google Blackstone deal. So what are they actually doing? They're creating some kind of an AI cloud firm with in-house chips?
Yeah, so this is about kind of competing with the neo clouds that are out there. Companies like CoreWeave, for example, that obviously was a very successful IPO last year. What this is basically an investment of $5 billion in cash, which actually then gets leveraged up. So it could be as much as $25 billion that Blackstone will invest in this. And this is all about generating that power that's required for data centers. The amount that we're talking about, the generation here, actually is very small relative to the overall capacity that's been announced so far this year. We are looking at over 100 gigawatts of capacity required over the next 15 years for data center power. So that's quite significant in terms of the amount of power that's coming on stream, huge increases. The amount announced so far this year is as big as the entire power output of the German economy.
Wow.
So it's very huge numbers. Yeah.
Gosh, that is great context for us, Neil. Thank you so much. Bloomberg Senior Market Strategist Neil Campling. Coming up, we have employment data and retail earnings on deck in your day ahead. That's next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazla Amin in Davos, Switzerland, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now let's take a look at what's ahead for today. First up, we get ADP employment data that's out at 8:15 New York time. We also get pending home sales coming out at 10 a.m. Plus some more earnings, Home Depot before the bell, and then Kava reporting after the market close. And then we'll be jumping on the Fed speak before the FOMC minutes this week. Philly Fed President Anna Paulson is going to be speaking. That's at 7 p.m. Eastern. Some movers before the bell now. That memory chip sell-off looking to continue today, down another 2.7%. I mean, relative to the gains, we're talking really small beer, but SanDisk definitely feeling the impact today. Blackstone a little higher on the news that it's creating an AI cloud firm with Google with in-house chips, as Neil Camping says, to compete with the Neo clouds. And then Hyperliquid Strategies moving this as the SEC is said to be readying a plan for more synthetic trading. That would benefit Hyperliquid or HER. Let's take a look at your macro environment as we head into the Tuesday session now. We have Brent crude still above $110 a barrel, and that is down. So we're down more than 1.5% at this point, but still above $110 a barrel. I think that tells you a lot about what you need to know about this market. That and the fact that yields are crawling higher once again. And NASDAQ 100 futures looking to continue yesterday's sell-off. The index was down 0.5%. That's it for Bloomberg Brief. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions.
a poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
We're seeing a bifurcated S&P 500 for sure.
The AI theme is best expressed right now in U.S. large cap growth stocks.
It's hard to know who's in a bubble.
We are seeing a weakening in the overall AI story.
If it is in fact a bubble, nobody knows when it will pop.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, whipsawed by verbal intervention.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever, because we've had very big discussions with Iran, and we'll see what they amount to.
The White House claiming it's delaying planned military strikes, helping to reduce the tension and putting a lid on crude's advance as the Treasury is opening the door for energy-starved nations to buy some Russian crude.
Which is so interesting because the Treasury Secretary is meeting with his counterparts right now with Paris, and his opening remarks was about making sure that they up the sanctions when it comes to Iran, when this administration is extending a waiver to let countries buy Russian crude for another 30 days. Says to me, Jonathan, that they are very concerned about potentially the premium we were going to see in the oil market that is going to drip into the gasoline market here in the United States.
The blockade phase, and we should call it that, has lasted longer than the so-called kinetic phase. The military strikes feel like a long, long time ago. The blockade phase comes with its own problems, so you need to do these tweaks here, there, and everywhere to make sure that everyone's got enough energy. That's going to get more problematic in the months to come.
Which is why it was so interesting yesterday with an Iranian news agency coming out and saying the administration, as part of negotiations, were saying we're going to give you some waivers, lift some sanctions to get Iranian crude moving. Why would you do that if you had the blockade? I go to what UBS's Paul Donovan had to say. He said equities failed to rally because no attack is the status quo. Why did the president come out with this truth, saying that he's holding off on a planned military strike when he didn't tell the world that he was actually going to make that military strike?
The status quo comes with its own problems. You'll notice this morning that crude is pulling back just a little bit. Look at what's not happening. No rally in the bond market. No rally in equities. Yields are higher across the curve. 2s, 10s, 30s look like this morning. 10s back through 460, up by 2 basis points on the session. This from Citi. I see markets underpricing the risk of a Fed rate hike starting the year. Jim McCormick.
It's incredibly worrisome for some of these banks. They're now going from potentially we're going to have rate cuts to now having to price in rate hikes. This is another top discussion happening right now at the G7. The French finance minister basically put it, yes, energy prices are higher. Yes, inflation is higher. We might as well worry about low growth, aka stagflation. But you know what? On optimistic, and they were all smiles yesterday in a selfie, we're not in a recession.
Feels difficult, still difficult to internalize the prospect of a rate hike at some point this year. And I know I'm not the only one. Check out this language coming from Standard Chartered. We need to talk about this story. They're planning job cuts, and this is how they're communicating them. Bill Winters over at Standard Chartered with this quote. It's not cost-cutting. It's replacing, in some cases, lower-value human capital with the financial capital and the investment capital we're putting in. They have got to come up with a better way of talking about this than lower-value human capital.
100%. This is not how you address your staff. This is not how you address the public. And if you are, say, a top-tier student coming out of university and you're getting offers across the banking sector, are you going to work for a company that regards you as low-value human capital that maybe you're going to be replaced in 6 months by a bot?
It's not a good look. Think about the commencement speech we saw over the weekend.
All the boos.
From the former Google boss and a host of other individuals as well getting booed by the graduate class of 2026.
So you have these luminaries stand up on the stage and say, look, the future is going to be bright. What's happening in technology is going to be amazing. This is like an industrial revolution time. And the students are sitting there and they're booing. Do you know why? They're worried about job prospects. They're seeing their job prospects basically be evaporated by Claude, Google, Gemini, and the like.
Speaking of technology, the JP Morgan Global Technology Conference taking place in Boston. That's where Bramo is this morning. We'll catch up with Lisa a little bit later this morning, 6:30 Eastern Time. Kevin Brunner, the Global Chair of Technology over at JP Morgan. Do not miss that conversation. Equity futures this morning on the S&P slightly lower. We're down by 0.4%. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth as tech stocks slide. Bloomberg's Tyler Kendall as President Trump calls off fresh attacks on Iran. And Jeff Curry of Abax Markets on the next commodity super cycle. We begin this hour with stocks struggling to rally following back-to-back losses. Cameron Dawson of New Edge Wealth writing equities became overbought and narrow with an upside driven by a small cohort of names. This was a recipe for a pause in the recent powerful moves. Cameron joins us now for more. Cam, good morning.
Good morning.
Is that what this is, just a pause or something more than that?
Well, it's perfectly normal and perfectly prudent to see markets pause after having what was a very parabolic advance in a narrow cohort of names that were driving the vast majority of the upside in the overall market because they became such a huge weight in the index. And we were seeing certain extremes in some of this trading. You saw flows into leveraged ETFs, option flows being very extreme, and you also saw this narrowness really not be consistent with an overall new high in market. So it made this fragile. We think it is a pause, but at the end of the day, when you have an over 18% weight in a cohort of names that went vertically up, a simple correction in those names back to trend could be damaging for the overall market cap weighted index.
Where do you think the bond market fits into this? New numbers again this morning. We're back to 460, 30s, pushing 520 now, getting closer at 515 and up 2 basis points today. Where does that fit into your outlook?
I think that equity markets were able to ignore the bond market and ignore oil as well for a period of time when it was effectively re-rating semiconductors after a huge upside move in those earnings, meaning that the earnings were moving up so much that you had the ability to look through everything else. Now you've effectively reset the earnings, you've reset the valuations on those semiconductor names. And so now the overall equity market has to look around and say, is this valuation consistent with a 10-year at 4.6%? And what does that 10-year tell us? Because it's not necessarily just because growth is coming in a little bit better than expected. It's also because inflation is coming in hotter. What does that mean for policy? What does that mean for financial conditions?
Well, let's get to the policy call. So I mentioned the name over at Citi, Jim McCormick. Of course, Andrew Hollenhorst will have his own view on things. I think they're still looking for 3 rate cuts. But from the market's perspective, do you think we're underpricing a rate hike, and a rate hike that might come this year?
Yeah, the WIRP screen shows a 62% chance of a rate hike by the end of the year. You have a 2-year yield that's now about 30 basis points above the Fed funds rate. So we've been saying it's not a very warm, warsh welcome because that's a really tough position to be in when you are expected to cut rates. Now, there has been a little bit of an easing in some of the commentary, we think, coming out of Trump about the urgency to cut rates, which just means that we had been talking about the potential that Warsh could be pushed to dissent at his first meeting, which would be absolutely wild, a bit unprecedented. It seems like he now has a bit more wiggle room to say, given the movement higher in inflation, given the ability for unemployment to remain stable around 4.3%, that we don't have that same urgency. It really depends on whether or not you see inflation metastasize throughout the overall economy, meaning that core measures start to pull up in a more meaningful way that could get them to hike rates. We think for now it's a hold.
And he's getting sworn in on Friday, so potentially maybe that's why the president is lowering the temperature in terms of the rhetoric. But at the same time, he's going to be there without a Steve Myron. Who would line up with him in terms of a dissent?
Yeah, it's a really good question because he's taking Myron's seat, so we effectively remove a dovish dot from the dot plot, assuming that the dot plot does stay around. But it does move the center of gravity of the Fed over into a more hawkish stance, which just puts him in a tougher position to be able to get everybody to coalesce around his views. You know, the question we have is whether the bond market believes in their willingness to defend the 2% inflation target. The thing that continues to catch our eye, look at 10-year break-evens. they're at the highest level they've been since 2022. They've moved up by about 30 basis points. That doesn't sound like a lot, but that is a lot for break even since the start of the war. So the bond market seems to have a lot more consternation that maybe this new Fed isn't as serious as getting inflation back to that 2% target.
If the war persists, are they going to be forced to hike and not just look through this?
It depends, again, on the metastasizing of this inflation. If we continue to see inflation really just be in that headline number where it remains contained in energy prices, we do expect it to move into food prices, but not show up in other portions of inflation measures, then they can have this potential to look through it. It really depends, I think, also on wage growth as well. That's really the ability for higher inflation to be passed on and into other areas. And what we're seeing now is that wage growth remains anemic because the job market isn't necessarily as robust for new jobs. But the problem you have for consumers in that environment is that real wage growth is now negative. And so as you think about the consumption outlook through the end of the year, you have effectively little upside for consumers simply because real wage growth is negative. You're seeing that in the way that markets are trading as well. Equal weight discretionary versus staples is rolling over, and you're seeing a concomitant cut in consumer household consumption forecast within GDP. They've gone from 2.1% to 1.8%. So the market is pricing in some of this consumer worry.
Do you think a lack of clarity around the incoming Fed chair and his personal view on his reaction function, so to speak, do you think that's complicating things as well?
I think it is to an extent. I mean, the old phrase is that the bond market always tests a new Fed chair, and potentially he was more dovish in the interviews and will be more hawkish going into it. But at the end, once he's in the seat, but this is a global phenomenon. Look at what you see, of course, with UK yields, Japanese yields. I thought that the Japanese GDP data was really interesting. It came in hot on real GDP. The GDP deflator came in hot. So you effectively have nominal GDP in Japan at 5.5% with a 2.8% 10-year Japanese yield. So as much as we're talking about what's going on with the Fed, the reality is this is a global bond market that has a lower and lower appetite for duration.
Japan, the UK, Germany, it's not just the US. Cam, it's good to see you. Cameron Dawson of New Edge Wealth is going to be sticking with us to respond to what's happening over in the Middle East in just a moment. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. President Donald Trump calling off what he says were planned strikes on Iran for today. Trump saying Gulf allies asked for more time to seek a diplomatic resolution, adding the U.S. remains prepared to attack if an acceptable deal is not reached. Home Depot shares are higher in the pre-market. The company did beat estimates on net sales in the first quarter. Sales at locations open at least a year, though, rising just 0.6%, and that missed estimates. Home Depot's core business has faced high housing prices and a pullback on customers taking on larger projects. Standard Chartered says it's replacing, quote, lower value human capital with technology. CEO Bill Winter is saying the bank will cut more than 15% of its back office roles over the next 4 years. And that is your Bloomberg Brief. John.
I don't think you need to call McKinsey to fix that one. Vonnie, thank you. Just get in a room and come up with a better name than that.
Yeah.
A better phrase.
That's not a good phrase. Whoever decided to give that advice to the CEO, I'm sorry to say it, that person should be fired. Maybe AI would have given him a better response
phrase than that,
honestly.
Yeah. That's not a good look. Up next on the program, holding fire against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever.
Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Kicking off earnings from the big retail players earlier on this morning, about 15 minutes ago. Slightly softer from Home Depot. Looking ahead, you'll get numbers from Target and Walmart. The big one, of course, coming up on Wednesday after the close. We'll have numbers from Nvidia. Heading into all of that, equity futures just a little bit softer, down by about 1/3 of 1% on the S&P, following a back-to-back slide on the S&P 500. Minor losses yesterday, very mild stuff, but still the first two-day losing streak we've seen so far through the month of May. In the bond market, yields still elevated. Up this morning by 2 basis points at the long end of the curve. 10s at 460, 30s around 514, getting closer and closer to 520. Even with this move in commodities this morning, pulling back on both Brent and WTI. Brent crude stood around 110 and down by close to 2%.
So oil potentially is leaning into the fact that clearly this administration does not want to go back to strikes, does not want to go back to kinetic war. Everyone else is sort of confused. Is this, the wolf, the boy who cried wolf once again? Because why did the president come out and say we're holding off on planned strikes when he didn't tell the American people he was going back to the said planned strike? So it felt like he was looking potentially maybe for something he gets usually with an Axios article.
Whipsawed by verbal intervention
once
again, and that's been the experience of the last 2 months. Under surveillance this morning, holding fire against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
So here's the latest this morning. The president pausing planned strikes on Iran. The decision giving Gulf allies more time to continue diplomatic efforts with Tehran. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, President Trump says that this planned attack is off for now as he credits these regional allies for pushing for a deal. Saudi Arabia, Qatar, the UAE have all repeatedly been targeted amid this conflict. But keep in mind, the president did keep the threat of escalation on the table, going on in that post on Truth Social to say that he advised his national security team to be ready at, quote, a moment's notice for a large-scale attack. At this point, the White House didn't provide any additional details to us on what this planned attack would have entailed, as the president has long maintained that there could be the threat of military escalation, while also maintaining that a diplomatic solution is still viable. I will point out that our own analysts at Bloomberg Economics say that their analysis is that the White House very likely could revert to short and intense strikes in a bid to change the status quo, amid reporting that the president has been advised in recent weeks that limited strikes could help push Iran to the negotiating table. Because the latest is, just yesterday, both sides did reject the freshest counter proposals, as Iran says that it is not interested in negotiating around curbs on its nuclear program, and the U.S. says its naval blockade isn't going anywhere. In fact, CENTCOM confirmed just yesterday that so far the U.S. has redirected 85 commercial ships in its efforts to secure the strait. John, we're hearing from these regional allies. We'll see if any other headlines come from other countries later today, as Russian President Vladimir Putin visits China, where he is expected to discuss the ongoing conflict in Iran with Chinese President Xi Jinping.
Tyler, price of gasoline up again today, $4.53 as we go into Memorial Day holiday weekend. What's the administration doing when it comes to gas prices?
Well, Anne-Marie, at this point, President Trump has proposed that we could see a temporary suspension of the federal gas tax. It is our understanding that lawmakers are set to unveil new legislation related to this in the coming days. But at this point, we don't really have a firm timeline on when that would pass. And there are some questions on just how big an impact that really could have. This is an issue that has been plaguing the administration. As we know, affordability remains the top concern as we head into the midterms. A very pertinent conversation for today as a flurry of states are holding their primaries, and we know that President Trump is facing the pressure when it comes to the cost of living. Still, many Trump-backed candidates are winning their primaries, and the president at this point is trying to urge patience with the American people, saying that this will only be a short-term disruption, as we know that those costs are still filtering down.
Tyler Kendall with the latest from the nation's capital. Tyler, thank you. We need to define what short-term disruption is now. We're 2 months into this, approaching 3 months, and maybe going through the summer. A lot of people at the beginning thought that 1 month was too long, 1 month too long, and now we're in multiple months. And at some point, you have to sit here and say this is not about the short term anymore. This is the status quo, and it continues.
You have to plan for the rest of the year, basically, and maybe as well into next year. When you talk to the administration about this, they quickly push back and rattle off the Iraq War, Vietnam, Afghanistan, et cetera, and they say, comparatively, this is very short. The issue is, when they presented this to the American people, they said it was going to be an incredibly short, just a few weeks. And now, to your point, we are months into this conflict.
So how does the consumer feel about things? We know the sentiment, if you look at you, Mitch, is rock bottom at record lows. We'll get corporations reporting throughout this week. We had Home Depot a moment ago, weaker than expected. You'll hear from Target and Walmart later this week. Cameron Dawson of New Edge Wealth is still with us. Cam, when you look at the data, what are you paying attention to and what are you ignoring with regards to how the consumer feels and what the consumer's doing?
Yeah, well, the mantra over the last 4 years has been watch what they do, not what they say, is that sentiment has been in the doldrums for quite some time, and yet they've continued to spend. I think the big question is now that we're back in this period where real wage growth is negative, do we see spending start to moderate? We go back to the last time we had negative real wage growth, it was back in 2022 during the last inflation spike. The difference with 2022 is that savings overall were higher and you had more room for the savings rate to drop. So effectively there was a cushion that consumers had to dip into in order to keep spending, even though real wage growth was negative. The big question is as we go into this summer, could we see them start to pull back on spending? Does that start to show up in things like economic surprises? Remember, there's a really tight relationship with economic surprises and the 10-year yield. So if you're looking for a bond rally, that could be the source of it.
What's the relationship between that and the stock market, weighted to something very, very different away from the U.S. consumer?
When we think as equity investors of when geopolitical events matter, it's when you have a prolonged increase in oil and retail gasoline prices that eventually weighs on GDP and eventually weighs on earnings. And that's been the disconnect this time around. We're cutting GDP estimates, but we're raising earnings estimates, not because the economy is necessarily holding up broadly on a better basis. It's because you have this one cohort of names, being the semiconductors, who are seeing massive earnings estimate upsides. You've seen the SOX increase its 2026 estimate by 42% this year. That masks a lot of weakness under the surface. And you see it within the GDP line as well. Look at household consumption forecasts going down, but private fixed investment going up. So were it not for AI, this would be a very, very different story for the economy as well as the overall equity market.
You mentioned, Cameron, what happened last time we saw higher inflation and consumers went into their savings. Aren't they getting tax refunds that are bigger than they normally would this time around? How is that helping them?
Well, it's effectively helping to offset some of the increase in oil prices. What effectively the math has been working out is that the increase in gas prices has effectively offset the benefit from the OBBB. The big question is how long do these gas prices persist? It is a duration question. So now that we're effectively offsetting those tax cuts, if we continue to see oil prices and gasoline prices remain elevated through the end of the year, we're watching the Brent December futures like a hawk, effectively saying that's the market finally coming around to the fact that this could be a more prolonged issue. And if you continue to see high gasoline prices, then that's where you'll start to see the pain. So it all comes down to duration.
At any point, will higher gas prices hurt the likes of a company like NVIDIA that are holding up the S&P 500?
Yeah, we'd like to think that we all do breathe the same economic air, but it's multiple steps away. I mean, the people who are paying for all of this CapEx are companies like Google and Meta, who are primarily advertising companies. Meta's 98% of its business is coming from advertising. That is a cyclical business that is, in fact, related to overall economic growth. Don't forget, Meta had negative revenue growth in a year like 2022. So if you were to see more pronounced economic weakness, then certainly it could filter through, because the reason they've been able to spend so much on NVIDIA chips is because their core business is so strong because the economy has been holding up.
Cameron Dawson of New Edge Wealth. Cam, it's good to see you. Thank you. Reminded me to look at the December futures contract on the Brent curve. Looking at the Brent futures curve, we're trading above 90 all the way out through December. December, that contract right now, as I'm looking at it, 91.55.
Markets starting to wake up that this might be a prolonged conflict, or at minimum, this might mean that structurally it has changed in the region, where Iran has a bigger control of the Strait of Hormuz, and it might not be smooth sailing as it once was, and you have to start to incorporate more geopolitical risk premium into the oil price.
Won't be smooth sailing for Kevin Walsh either over at the Federal Reserve. This is why things are slightly different compared to how they have been over the last 10, 15 years or so. The last few Fed chairs have come from the existing Federal Reserve Board. So they aren't unknown entities, so to speak. Neither's Kevin Walsh, but this is slightly different. He hasn't been on the board for a long, long time. We understand his views, but only really in media circles when he's sort of having a go at the balance sheet and QE and things like that. We don't really know what Kevin Walsh stands for coming into this Federal Reserve. Things are slightly different compared to what we knew about Powell and what we knew about Yellen.
That's why this first meeting is going to be fascinating. Is it the Kevin Walsh that we knew when he once was at the Fed, who was a hawk, or the individual that interviewed the President of the United States and gave testimony that sounded very dovish? Which Kevin Walsh is actually going to show up?
Yields slightly elevated across the curve again this morning. 2s just north of 4%, 10s back above 460, and 30s. 30s just feel unhinged worldwide at the moment. The long end of the curve feels very untethered. Yields up by 2 basis points, 514 on 30s. Up next, we'll catch up with Kevin Brunner of JP Morgan on the outlook for tech investments and M&A.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Pulling further back from all-time highs on the S&P this morning, negative by 0.4%. Back-to-back losses on the S&P, the first two-day losing streak of the month so far. Yesterday's losses very mild. A turnaround in the equity market as we got a bit of verbal intervention from the president about delaying planned attacks we didn't know were even happening. In the commodity market right now, crude pulling back, Brent and WTI. Brent down to 110, down by close to 2%. You take that screen and typically you can predict what's happening in the bond market. Not this time. In fixed income at the moment, 2s, 10s, 30s, yields creeping higher. At the front end of the curve again, up by 2 basis points. 10s still around 460, and 30s north of 5%. Your 30-year yield up by a basis point or two. More on the bond market a little bit later in the program. That's across asset price action. Let's get you some single names, some morning movers. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Well, let's start with a little read into the consumer, and particularly an interest rate sensitive area, right? So Home Depot out with earnings. It's actually higher now, but it did miss estimates in terms of comp store sales. They were up 0.6% as opposed to analyst estimates for 0.9% of a gain. Consumers just not buying those big houses or engaging in those massive projects in their houses, right? But they are doing a little gardening, and so things weren't all that bad. As I said, Home Depot holding on to its guidance for the full year, and basically it had said earlier, now that does miss estimates. We'll see what executives say on the conference call that's scheduled for 9 a.m. Eastern. Let's move on because we have another AI deal today, and in this sense, it is an AI infrastructure deal. So BlackRock, through its funds, investing $5 billion with Google in order to gain access to Google TPUs through an infrastructure project. It will be competition really for CoreWeave. So CoreWeave selling off just a little bit today, although CoreWeave has had a lovely run up, but positive for both of these players. Blackstone expects to see 500 megawatts coming online by next year. It's a massive amount of energy. And then let's take a look at the memory chip makers, because of course we saw the Seagate CEO's comments yesterday caused a little bit of a sell-off for that stock. It was down almost 7%. He basically said, look, we're not going to be building massive factories. It's probably not going to be worth it. It's going to take too long. It's going to be 5 years before they're online, and at that point, who knows what memory chips will cost, causing another little bit of a sell-off today. But I mean, in relation to the run-up in these prices, I mean, if you look at just SanDisk alone and Seagate, they've been up multiple hundreds of percent. Micron up 600%, 3,500% gain practically for SanDisk over the last year. So I think they can sell off a couple of percentage points. It won't break the bank, John.
Hey, Vonnie, thank you. Appreciate it. Massive run-up for those names. A bit of negative follow-through so far this morning. On our radar this morning, President Donald Trump calling off a planned strike on Iran after speaking with Gulf allies. Trump announcing a pause for, quote, 2 or 3 days, saying the countries are very close to reaching a deal.
If we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Tehran yet to confirm the latest round of discussions. Elsewhere, Standard Chartered set to cut its support staff by more than 15% as it builds up its use of AI. The CEO, Bill Winters, saying the bank is replacing, quote, lower value human capital with technology.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
The job cuts would take shape by the year 2030. And finally, the NVIDIA CEO, Jensen Huang, is saying he expects China to open up its markets to imports of American AI chips. The CEO speaking with Bloomberg's Ed Ludlow following his visit to Beijing with President Trump.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
China, notably, yet to sign off on accepting NVIDIA's H200 chips following the U.S. greenlighting access for some firms there.
They greenlit it, the United States, in January. Then once again in March, NVIDIA said that they did get some orders. But then those customers went to NVIDIA and said, actually, we're not allowed to go through with the purchasing orders. So now we wait and see if the summit produced potentially China and the CCP telling these firms they can buy it. For Jensen Huang, he's definitely hopeful because NVIDIA said that it's a $50 billion opportunity when it comes to China. The real question I have is China worried about national security risks within their own market? Do they want to make sure they can almost ring fence their own AI? Or do they feel like they don't even need the U.S. chips anymore? And if that's the case, how much leverage has the United States lost at the negotiating table?
NVIDIA, a difficult couple of days, down slightly again so far this morning. Let's talk about technology. JP Morgan holding its annual TMC conference over in Boston. Bramo's there at the event with a special guest. Good morning, Lisa.
Good morning, John. Thanks so much. I am here in Boston at the TMC conference held by JP Morgan with the Global Chair of Investment Banking and Mergers and Acquisitions, Kevin Brunner. Thank you so much for being here with us today.
Thanks, Lisa. I really appreciate it. So, thank you for being here, by the way.
Well, this is such an interesting moment because it seems like the AI cycle is driving everything right now. You've been working on tech M&A for 25 years. How is this moment different than previous ones?
It's completely different. It's impacting every client that we have. There's not a client that we talk to that's not actually thinking through where they are in the landscape, what's their long strategic narrative, and how they're going to adapt to a changing environment.
What's driving most of the tie-ups right now? Is it the idea of trying to get economies of scale? Is it to shore up cash to invest more efficiently? Or is it just sort of a quest for survival?
You know, I actually think the M&A market could be defined by selectivity, scale, and really creativity these days. And so we're obviously seeing strategic acquirers be highly selective in where they're putting their capital use. The deals they're doing are actually done with high conviction, and they're actually changing the long-term narrative for a lot of these companies, and that's probably the number one focus. At the same time, scale's very important. So cash flow to be able to reinvest in the business is very important. We've seen the equity markets really embrace what I would say is scale overall. And frankly, when you're going through business transformation, at the same time, scale's been very important to be able to fund that. And then creativity's been the most interesting part. We've seen deals of all type, minority investments, we're seeing collaboration, we're seeing consortiums do deals together, we're seeing partnerships, a lot of structure, and that creativity, I think, is something that's really very interesting to me as we look forward.
What are some of the barriers to these tie-ups? I mean, how high is the threshold? We've been talking all about how bond yields have been surging to the highest levels going back to 2007, at least in the 30-year in the U.S. Globally, you're seeing long-term yields rise. At what point does that stymie some of the activity in deals that we've seen so far?
You know, I think capital has not been putting a barrier on M&A whatsoever. Obviously, we have a constructive regulatory environment. And at the end of the day, I think while we're trying to balance all the geopolitical and all the macro issues that are out there, at the same time, it's so imperative that many of these companies change their long-term strategic narrative, that we're seeing people push forward, do deals of size, and making sure they're actually repositioning themselves on the chessboard for the path forward.
We've seen a lot of mega deals so far this year. That has been the driver, at least in the overall volumes. Is that the same in technology? Does it have a different flavor?
Yeah, it's a great question, because technology a little bit is a tale of two cities. AI is actually a catalyst within technology, and it's also a disruptor. So we're actually seeing those companies with AI tailwinds be very acquisitive, adding capabilities, adding different tools to their system, and making sure that they're continuing to reposition themselves to be the leaders that they are today. On the other side of the technology market, we've obviously seen a little bit of a pause. We've seen people assess their own business models. Where are they in this evolution? But I actually think that uncertainty as we go forward is going to actually turn into differentiation in the marketplace. And that differentiation is going to lead to continued consolidation, more traditional M&A activity, I think, in the second half. and we're really enthused about that.
Can you put some specifics around this in terms of what we're actually talking about? I mean, is it the hyperscalers versus the software guys that are all fighting for survival, that are all going to try to band together or else die?
Well, let me tell you where we think we'll see differentiation on the software side, right? So we're going to see, obviously, companies of scale. We'll see mission-critical platforms come through the other side. We'll see systems of action, right? Obviously, I think there's a lot of discussion around SaaS moving to an outcome-based platform. We'll also see what would be companies with data moats come out the other side. And that differentiation, obviously, we went through one earnings season. We're going to go through another one here in a couple months. And I think we're going to lead to those that are actually have reassessed their models. They put the moat around their business. And I think those are some of the characteristics we'll see.
Would you say in the next year, this is going to be a big shakeout period where some of these models get put to the test in the way that they haven't so far? Which are the ones that actually can be deployed in an effective way, and those that can't, and that ultimately go away?
100%. I think we're going to continue to see, and maybe see even a little bit more than we have today, the capital kind of focus into the winners. This is more on the hyperscalers, the large providers, really building out the infrastructure. On the other side of the market, we're going to see consolidation, right? As we hit that point of differentiation, we're going to see the winners. The winners are going to be acquisitive. The winners are going to add to their portfolio. They're going to apply the same techniques that they actually applied to their own business, and we'll start to see them build their scale along the way to have all the benefits that we were talking about previously.
How much pushback are you starting to see from investors, whether it's the private capital or whether it's public markets, in terms of financing some of these transactions, given how much risk is coming in and given the competition for capital elsewhere?
Yeah, investors have actually been very resilient. Investors obviously on the top of the market, right, where there's a lot of growth and there's a lot of AI tailwinds, everyone wants to participate. We've obviously seen a pause on the other side of the market where the transformation's taking place in the business models. But as that differentiation starts to happen, we're going to see investors be very focused. I mean, I expect, take private equity, for example, let me back up. Private equity actually has been very focused on being patient, assessing their own business models. They're part of the creativity I talked about. But as we move through to the second half and we see that differentiation, I think we're going to see capital for take privates. I think we're going to see capital for consolidation. And I think that'll come from both sides of strategic and financials.
Do you think that we're going to see also a lot of failures among some of the private equity firms that have had companies that have not gone public for a very long time because they couldn't reconcile the valuation that they were booking versus the valuation they could get in the markets, and they have to kind of do something with that in order to free up cash to be able to go out there and do something?
Well, a number of the private equity veterans are obviously very AI savvy, very focused on the transition. We're actually reading now, about some of the new announcements, partnerships, collaborations that are taking place. And I think we're clearly going to see some winners, but with all success, there's obviously some that'll be on the other side of it.
This is one of these annoying questions that help benchmark where we are. Where are we in this process? I hate using the innings kind of analogy, but I'm going to use the innings analogy. Where are we in this process of build out with respect to AI?
It's still early, but as I look at the conversations taking place here at the conference, we've really moved from it just being AI, agentic, infrastructure build out to actual execution and scaling as part of the plan. Every company here is very focused on what's their long-term strategic narrative and are in the early stages of doing so, but we've actually gone from hype to real execution and scaling.
This, to me, is a fantastic moment to be speaking to all of you. Kevin Brenner, thank you so much for being with us. Kevin Brenner there, the Chair of Investment Banking and Mergers and Acquisitions. John, I will send it back to you.
Lisa, thank you. Great work. Looking forward to Lisa's coverage throughout this morning from Boston. From New York City this morning, let's get you an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. 3 people were killed in a shooting outside an Islamic center outside San Diego. Authorities say 2 teenage suspects were also found in a car with apparent self-inflicted gunshot wounds. San Diego's mayor is saying there'll be extra police protection at local mosques. EU officials meeting today to try and finalize legislation for a trade deal with the United States. They must reach an agreement by July 4th to avoid triggering higher tariffs threatened by President Trump, who previously threatened to raise those levies on European auto imports because the EU hadn't moved quickly enough to implement the deal. Fund managers boosting their stock allocations by the most on record. The May Bank of America Fund Manager Survey shows managers are the most overweight equities since January of 2022, and they've made big cuts to their cash levels. The survey identifying inflation as the biggest tail risk. That is your Bloomberg Brief. John.
Hey, Vonnie, thanks for the update. More from Vonnie in about 13 minutes' time. Up next on the program, AI meets the physical world.
If we're getting to a point where we don't have enough supply, what that means is there's more duration to the good news. We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
Up next, we'll catch up with Jeff Curry of Abex Markets from New York City. You're watching Bloomberg TV.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
The losses resume. We're down by 0.5% on the S&P, on the Nasdaq 100 this morning, pulling back by some 0.8. On the Russell, small caps, negative by 0.7. Under surveillance this morning, AI meets the physical world.
Memory is one of the main areas of constraint right now because there's not enough physical clean room space to put the tools in place to build all the memory we need for AI. Months ago, the big concern was that we wouldn't have enough demand. Now, if we're getting to a point where we don't have enough supply, what that means is there's more duration to the good news. We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
So here's the latest this morning. The Seagate CEO, Dave Mosley, issuing a warning for the AI build-out. Mosley telling a JP Morgan conference that building new factories would take too long. The comments weighing on memory and hardware makers after plunging in Monday's session. Jeff Curry of Abax Markets writing, capital has chased the AI trade while ignoring the physical assets it requires to run. Assets that have quietly become the best performing asset class of the decade. Jeff joins us now for more. Jeff, welcome to the program. I've been excited to catch up with you, sir. I think we need to take a giant step back and think about the mining bust post-China boom. We need to think about the shale bust of a decade ago and why that set the stage for this period of what you call capex starvation. Just where are we and why?
Well, when you look at history, going back the entire post-war era, there's two sectors that lead the equity market. One is energy, the other is tech. If you can't turn on the lights, nothing happens. If you can't innovate, you never progress. And that's what you see. So we go back. Tech was a leadership in the 90s all the way up to 2002. Then we transitioned into energy. 2002 to 2014, 14 to now has been technology. And the way you think about it is in those periods when energy lead and commodities lead, you build overcapacity. That lowers the overall price. Inflation gets low and stable. Interest rates drop. And investors chase duration, which is growth stories, tech, and the rest of it. But eventually you run out of energy, run out of commodity capacity. And that's where we are today. With this geopolitical event, it just pulled forward. And Jonathan, we've been on here talking about the revenge of the old economy over and over and over, this rotation out of tech into hard assets. That was already underway before this happened. What this did is just accelerate it.
As you know, Jeff, discipline has really hardened at some of these C-suites. What will it actually take to break out of this capex starvation phase that we're currently in? And do you see us breaking out of it anytime soon?
Higher prices, higher returns. But ultimately, you ask, what creates that huge upward trend in prices that you saw in the 70s and you saw in the 2000s? It's once investors take capital out of tech, dump it into commodities, they begin to spend, and then you get cost inflation. The PPI that came out last week at 5.1% is telling you you're already seeing signs of it combined with the huge supply shock that you're seeing in the Middle East. So in terms of thinking about where we are on that, we are just in I'd say the bottom of the first inning of the super cycle, despite the fact commodities are the best performing asset class this decade. So you're already 6 years into it in terms of pricing. And when we think about the forward, you've probably got another decade to 12 years left, just looking at history.
Jeff, this is important. Let's just compare what's happening with tech then. So I imagine you think as capital intensity picks up, capex intensity picks up at the tech players, we get a re-rating. And then you get the rotation into the more energy-sensitive parts of the market, the mining sector, the energy sector. We're not seeing that equal and opposite move, though. In fact, Jeff, those particular parts of the market have lagged so far. That's interesting to me, that the energy names haven't done much at the moment. What gives?
I think right now there is no concern about the supply of energy and commodities. Even with the largest supply shock the world has ever seen, 2x what we saw in the 1970s. And I think there's three reasons why they're not concerned. One, we're in the middle of the shoulder months. This is the weakest demand that goes down and then back up. We're in that weakest demand part of the entire year right now, so there's no stress on the system. The second reason is right now we're in a deficit, meaning that demand's up here, supply's down here. We're drawing inventories. Once you exhaust inventories, boom, you have to push demand down in line with supply. That's when the shortage hits, that's when the pain hits, and that's when prices go nonlinear. The third point I want to talk about is that every policymaker, macro forecaster, central banker, tech promoter is telling you right now there is no problem. Every commodity CEO, commodity trader, anybody who gets their hands dirty is telling you you have a problem. You have seen this movie before back in 2020, 2021, when, remember, inflation is transitory. And then, a few months later, boom, you hit the wall and, we went to double-digit inflation. And I think you're seeing the same dynamic here. One last point, though. Carter in 1977 made a fatal mistake. It was the sweater speech. It was, February 1977. He was wearing a sweater kind of like this. Went out, was brr, and told everybody, turn your thermostats down, and then prices of commodities explode. And I think every policymaker has learned from that, you don't want to create fear. My job is, if I was advising the president, telling him to do the exact same thing, keep everybody calm, but my job is telling you how to make money. And at this point right now, this is really serious.
Yeah, Trump definitely doesn't want to come out, especially with the 95-degree weather, saying, don't put your air conditioners on. But Jeff, you say that at this moment, supply has never been more constrained, yet Brent can barely hold on to 110.
You have that seasonal weakness right now. You're not in a shortage. But another really important point here is because nobody is buying the energy companies. In the back end of that forward curve is anchored to the cost of capital of those companies. It is too low. And, I call this the biggest asymmetric trade in modern finance in historical terms. Why? When you look at the free cash flow yield of the oil companies, they're 15.5%. The hyperscalers are 0. Let me say that again. 15.5% free cash flow yield for the oil companies, 0% for the hyperscalers. We call those oil companies the Munificent Seven. What does munificent mean? Giving you lavish gifts. And at 15.5% free cash flow yield, I'd call that a lavish gift.
And just when it comes to supply and demand, you mentioned this, it's going to get rough when inventories are drawn down. When will we hit tank bottoms in your analysis?
It depends on where you are in the world and what products. Some products, you're already there, like motor oil in the U.S. And by the way, motor oil in the U.S. is critical because you couldn't even turn on your car without motor oil, even if you had gasoline. Items like sulfuric acid, you're out. What does that cause? That's why copper hit an all-time high last week, because you need the sulfuric acid to produce copper. But when we think about diesel, jet fuel, gasoline, those parts of the world, jet fuel, you're there. We would expect to see here in Europe, diesel and jet fuel run into very serious problems by the end of this month. The United States, gasoline by July. And at that point is when you start to get to that nonlinear part and see prices go higher. But I want to emphasize, when we look at the spread between spot prices and the back end, this spread has never been higher. And everybody goes, oh, we had, prices were at 122 in the Russian invasion. By the way, the back end of the curve was $10 lower. And then everybody goes, we saw 147 in 2008. By the way, the back end was at like 140. So 147, 140. What is mispriced here right now is the back end of the oil sitting somewhere around 70, 75. This is a long-term problem. The cost structure is going to go up. There is no spare capacity left. It's going to take a long time to reestablish it. We need to reprice that market. That's going to reprice the Munificent Seven. That's why I tend to think the trade here, just looking at pure economics, has the most upside to actually own these oil companies.
Jeff Curry, fired up. Jeff, when you're next in town, you need to co-host the program with us.
Yes.
Looking forward to that. Jeff Curry
Love
there
to.
of Abex Commodity Exchange over in London. Maybe bring Michael O'Leary into the program as well from Ryanair. Perfect lineup.
And I also think they have different views on jet fuel at the moment when it comes to Europe. So I'd actually would love to see them around the table together.
Up next on the program, we'll catch up with Steve Orth of Federated, Henrietta Trays of Veda Partners, Drew Redding of Bloomberg Intelligence, and Michelle Ma of the MasterCard Economics Institute. The second hour of Bloomberg Surveillance is just around the corner.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Verrett.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
The major macro indicators are actually pretty strong.
Begrudgingly, the consumer has held on to their spending trends.
The U.S. consumer is in a better position than most of the world.
The bond market is definitely, the narrative is driven by inflation right now.
I don't think that these interest rate levels are helpful, if anything.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. 2-day slide on the S&P 500, negative this morning on the S&P by another third of 1%. In the bond market, yields elevated through the curve. 2s around 4%, 10s around 460, 30 still north of 5% on a 30-year yield in America, a number we haven't seen for quite a while. You've got to go back to 2007 for yields that elevated at the very long end of the yield curve stateside. The problems in the bond market, not just a problem for the US, a problem for the UK, for Germany, for Japan as well. Japan, the one to watch through the week so far. In the commodity market, check out crude this morning, Brent and WTI. Brent crude is a little bit lower, WTI as well, but that's not unlocking gains in this equity market. That asset class whipsawed by the verbal intervention of the last 24 hours.
Once again, how many times have we been here from verbal intervention from this White House? The president coming out and saying that at the request of Arab partners and allies, that he is going to hold off on our planned military attack on the Islamic Republic of Iran, which was scheduled for tomorrow. What I find so interesting is no one knew about this scheduled attack, but the president decided to tell us he's holding off on an attack that no one was expecting. For the oil market, though, this obviously everyone is clinging to the fact that this White House wants to wrap up this conflict. On top of that, they're also extending a Russian sanctions waiver to allow more Russian crude to stay on the market.
And there's an important why to that. You have to keep massaging the story. Find little pools of crude and energy here, there, and everywhere. Unlock them while you can, just to make sure that this crude price, this move, doesn't get away from you. We heard from Jeff Curry, legend of the commodity market, about 10 minutes ago, talking about how much time we have left before this becomes an even bigger problem. It hasn't become an even bigger problem because we've been drawing down inventories aggressively, not just stateside, but worldwide over the last 2 months.
Yeah, we're living on inventories right now. We hit tank bottoms on these inventories. That is when the commodity complex is going to get incredibly challenging, and we can see parabolic moves. We could see, we don't see them yet. What is important to keep in mind is that depending on where we get into the inventory levels, how low we get, depends on where you live. And that's what Jeff Curry said. That's what we heard from Michael O'Leary yesterday. It's going to be much harder in Asia, as it has been, and then it's going to ripple through to Europe, and then potentially pockets of the United States.
Stock so far this morning, slightly softer, not a major move. Think about the run-up. The run-up's been absolutely massive. The losses have been muted, very mild yesterday, adding to the losses on Friday. Two-day losing streak could become day 3, down about 1/3 on the S&P 500. My port in the storm, my bullish port for a long, long time has been Steve Orth of Federated. And Steve has this to say: stocks can pass through and or manage inflation, especially when productivity is booming due to AI. We're raising our forward earnings and market targets despite persistent inflation worries. I'm pleased to say that Steve joins us around the table. Steve, good morning.
Good morning, John.
You're the guy I turn to and have done for the last decade or so to kind of get me out of this bearish mess or this hole I've dug myself into. Why can you still be optimistic in a moment like this one?
Well, you know, I was thinking this as Anne Marie was talking about hitting bottoms on tankers and things. We have an expression at Federated Hermes: if it can't happen, it won't happen. And sometimes you can outsmart yourself. You know, you're looking at everything and saying, you know, this looks really bad, but we're not the only ones who see that. And so I have to assume that some combination of Donald Trump, President Xi, the whole crowd, this is not good for anybody. And so I don't think we are going to run out of oil. I think they'll figure out a way to solve this one way or the other.
As you say that, I'm reminded of what happened yesterday, this Iranian report that part of the negotiations, this is what the Iranians were saying, the United States was willing to give waivers to Iranian crude. If the situation gets so bad, they're just going to let crude go freely from their enemy that they're in a conflict with?
Well, I think that they do whatever they have to do to have this not be an issue. And in the meantime, the other thing that I think people are sort of missing here is bond yields are up because inflation's up. But bonds are the asset class with a problem, not stocks. Stocks have always been an inflation hedge. It really doesn't matter what inflation is doing. If you look at the data and sort it, as long as growth in earnings is strong, stocks go up. Whether it's driven by inflation or driven by real growth, it doesn't really matter because stocks eat nominal earnings. And look what just happened, you know, in the last earnings season. 8 of 10 sectors had double-digit earnings growth. People talk about a narrow recovery, and it's one of these fallacies where people look at percentage moves off of lows. Absolutely off the lows, the AI stocks have driven the rally. However, year to date, I was kind of laughing during your last telecast, you're talking about how it's AI-led, and in the background, they're showing the returns on Exxon, up 33% year to date. Year to date, value stocks, small cap stocks, emerging market stocks have all performed double-digit ahead of the Mag 7, which is up 8%. So this is not simply an AI-driven rally. It's a broad rally. AI itself is spreading out. The AI theme keeps spreading from one thing to the next. It's all over the economy. This is one of the biggest technological changes in the history of man. And the trajectory of earnings right now, based on what we're seeing and what has been coming out of the street, as street estimates keep rising every day we go through earnings season, we found that our number, we had a number, we always use a 3-year out earnings number to project a 2-year forward market return, which at the time we were at 8,200. The number keeps going up. We had a $400 earnings estimate for 2028. We were way ahead of the street 6 months ago. You know, I woke up Monday morning and we're behind the street. How could that be? Street's now at 425, so we're at 450. If you look at the numbers, that's what's happening. Stocks are passing through, and productivity gains are helping them, you know, pass through, and their margins are going up, not going down.
Steve, this is the struggle people have, and I had this conversation with Alex Altman over at Barclays, that we seem to be putting more emphasis on how we've got here and not enough on where we are. And a good example of that is, say, look at the charts versus look at the numbers. If you look at the charts and look at the parabolic move, particularly in chips, coming off the March low, you can see why a technical strategist becomes a little bit unnerved about how detached we've come from the daily moving averages. Yeah. But if you look at the actual numbers, there's a source of comfort there. Do you have that struggle speaking to investors at the moment? They struggle to detach one from the other and just focus in isolation. Look at where we are, and where we are is okay.
Right. I try to focus our clients on where we're going, and that, I think, helps calm everybody down. For sure, as a technical strategist, and all the ones we work with are all telling us, you know, we're overdue for a pullback after a sharp run-up. Absolutely. Absolutely. And one reason we'll put out a bullish note like we're about to do here, you mentioned our new target on the S&P, 9,000, is we're almost anticipating a correction. And we want to get people ready for that. And actually, the situation in our mind is actually getting better, not worse. Technically, we're certainly overextended. Could be a pullback. But it's never as deep as you'd think it's going to be.
You've alluded to the challenge, though. You need to think about pricing this market for the economy we'll have 12 months, 18 months out, further down the line.
Yeah.
Not the one we've got. That's another struggle for a lot of investors. They look at the economy we've got. They look at the energy price move. They hear Anne-Marie and the prospect of things getting a little bit messy later this summer, and they struggle.
Much less Lisa's not here.
There you go. Could have been even worse. They struggle to think about where the economy will be 12 to 18 months on a rolling basis. Just walk us through your discipline with regards to that.
Yeah, well, we just look at the underlying, what's going on in the economy and in the companies, because we're talking, our analysts, we have 170 PMs and analysts in the equity group at Federated Hermes, so we're talking to companies every day all over the world, and what they're telling us is that the situation looks pretty good. They're all seeing their sales are expanding, their earnings, their margins are going up, and their earnings are going up. And it looks to us, as AI gets more and more adopted into the economy, that margin expansion trend is going to continue. This is one of the things that has made us more bullish than the average bear or the average market investor. Most people keep talking about peak margins. We've heard about peak margins for a decade. And yes, that has always been true. Every time someone has said that, we are at peak margins. And guess what? The margins keep going higher because the mix of companies in the economy is getting increasingly mixed towards higher margin businesses, and even the older companies are improving their margins, partly because they're using AI.
Do you think this story can continue in the way you're describing it if the Federal Reserve has to hike interest rates?
Yeah, I think, well, I don't think the Fed is going to hike interest rates, so that's a loaded question. But even if they did, yeah, the market would probably have a quick pullback.
What do you think they're going to cut?
But I said earlier, I think bonds have a problem, not stocks. Stocks are growing their earnings at double-digit rates. Bonds can't grow their revenue stream unless there's a rate hike. In fact, they need to get bond yields higher to compete with stocks. That's been the problem.
You keep talking about the E. If we've got a problem with the bond market, will we have a problem with the P in the equity market? The price that people are willing to pay for those earnings if yields start to continue backing up like this.
Yeah, it's fair enough. The discount rate could go up marginally. But look what's happened with the earnings growth rate over the last 3 years. It's way above the increase in the discount rate. So I think you can get overly focused on that. It will certainly cause a near-term correction. If the Fed turns around and hikes, which I doubt that they would do. If you think about it, Anne-Marie, it's like a bifurcated economy here, right? The low end right now is being protected by the One Big Beautiful Bill. That's offsetting the gasoline price hike by 6 to 8 months. The high end's being protected by the wealth effect. So that's why the economy is going along. The Fed, if it raises rates, what that is going to hurt is the interest rate sensitive part of the economy, which is not as big a hunk of the economy as it used to be. And it's the part of the economy that currently right now is sort of in a recession. Look at Home Depot's numbers this morning. So the housing market is the thing that's struggling. That employs a lot of people. That's the area that needs lower rates. And Warsh understands that. So I think it's really unlikely that he's going to hike. All he's going to do is further hurt the part of the economy, the one part that's not growing fast. And it's not going to have anything to do with AI. The investment there is being driven largely by cash flow, not by borrowing. So it's not going to have any impact on the AI boom.
Just to remind us, just to wrap it up, new price targets, what are they?
We've gone to 9,000 for the end of 27, and we're at, I want to say, 8,000 for the end of 26.
Pretty bullish stuff, Steve. It's good to see you.
Yeah, likewise.
Appreciate it, buddy. Thank you. Steve Author of Federated Hermes. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. We're getting new details about President Donald Trump's meeting with China's Xi Jinping last week. The Financial Times reporting Xi told Trump that Russian President Vladimir Putin may end up regretting invading Ukraine. Putin is in Beijing and scheduled to meet with Xi tomorrow.
A legal setback for Elon Musk. A California jury tossing out his lawsuit against OpenAI and its CEO, saying Musk should have sued sooner. The jury didn't rule on his core allegation that OpenAI abandoned its responsibilities by pivoting to maximize commercial profits. Musk says he'll appeal. The LIRR strike coming to an end after 4 days. Railroad workers agreeing to a potential agreement to get the country's largest commuter line back up and running. Now, the unions still need to ratify the accord, which delivers raises for workers while protecting riders and taxpayers. And that is your Bloomberg Brief. John.
Some good news going into the long weekend. Vonnie, thank you for that. More from Vonnie later this hour. Up next on the programme, delaying strikes against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever.
Up next, we'll catch up with Henrietta Trace of Vader Partners, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
A summer tease from New York City, getting into the 90s a little bit later. For the Brits out there, for the Europeans, that's 34 Celsius. Into the 90s.
It's unbelievable.
Sneak peek of the summer.
The Brits don't experience this ever, so come to New York. What's sad, though, is that it's not carrying through the weekend, which is a long weekend for Memorial Day. So.
Temperatures are going to come down pretty aggressively over the coming few days into the long weekend. That's the situation with the weather. This is the week ahead for the economic data and the earnings. Later on this week, the main event, of course, is NVIDIA after the close on Wednesday. You'll also get Target that morning. Look out for that. Walmart on Thursday. This is a new one on the calendar, the swearing in of Kevin Walsh as Fed chair. That's coming on Friday from the White House, I believe.
From the White House. And the last time a new Fed chair was sworn in at the White House was Alan Greenspan in 1987. Normally they're sworn in at the Federal Reserve building, and then there's some sort of celebration announcement at the White House. But Trump's going full hog on this one. It's the party and the swearing in. The first time since Greenspan.
People going to complain about the optics of that. Kevin Walsh at the White House alongside the president.
I was in the last cabinet meeting where the president said because of all the renovations that's happening when it comes to the Federal Reserve, maybe we're going to have to find a desk for Kevin Walsh here at the White House.
Yeah.
I immediately looked at Susie Wiles to see if her face was just kind of like, oh my God, no.
The building they're in right now, the Federal Reserve, is a beautiful building already. could have used that. But anyway, futures right now on the S&P 500. Yeah, we'll move on. We're down by about 0.4% on the S&P 500 this morning. Crude pulling back just a little bit. Let's focus on that. Under surveillance this morning, delaying strikes against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
Here's the latest this morning. President Donald Trump calling off attacks against Iran in an effort to give Gulf allies more time to push for diplomacy. Bloomberg's Tyler Kendall joins us now from Washington for more. Hey, Tyler.
Hey, John, good morning. Well, President Trump maintains that the risk of escalation is still very much on the table, as he went on in that post on True Social to say that he has told his national security team to be ready at, quote, a moment's notice for large-scale strikes. At this point, the White House has not detailed any of these plans, as President Trump has long threatened additional military action, while on the other hand has maintained that a diplomatic solution still remains viable. But I will point out that our analysts at Bloomberg Economics say that it is increasingly likely that the White House could revert to short and intense strikes in a bid to change the status quo, amid reporting that President Trump has been advised in recent weeks that limited strikes could help pressure Iran to reach a deal. Because the latest is both sides are rejecting the freshest counter proposals just yesterday, as Iran underscores that it doesn't want to discuss curbs on its nuclear program, and the U.S. says that the naval blockade isn't going anywhere. In fact, CENTCOM confirmed yesterday that it has so far redirected 85 commercial vessels in its attempts to secure the strait, which at this point remains effectively shut, and the administration is looking for ways to get more oil supply to the global market, moving just yesterday to issue this temporary waiver to allow for the sale of some Russian crude barrels already loaded onto tankers and at sea. John, in fact, a person familiar with the matter tells Bloomberg News that this 30-day general license could very likely be extended as the war in Iran drags on within the next month, considering that we saw the last general license lapse. It's something to watch here as the administration faces this increased pressure when it comes to rein in higher fuel costs.
Tyler, there was also a report yesterday from an Iranian semi-official news outlet saying that part of the negotiations, the United States was even willing to lift sanctions on Iranian crude. Is that potentially one of the tools in the toolbox?
Well, at this point, Anne-Marie, we did hear from a White House official who said that that report from Iranian state media was false and that that was not going to be something on the table. It was interesting because it did come, of course, the same day that we saw the U.S. Treasury Secretary Scott Bessent urge G7 allies to ratchet up their sanctions when it comes to Iran. In terms of any other sanctions that we could be watching, as you well know, we were just in Asia, President Trump telling reporters on his way back on Air Force One that maybe he would be looking at easing some of the sanctions on Chinese oil refiners who import Iranian crude, though at this point we haven't gotten any further update on that. It is very clear, though, that the administration is looking for some other ways that they could tamp down when it comes to rising fuel costs. But so far, we haven't really seen recent moves. I mentioned last hour on this program that the White House is looking at asking Congress for this temporary suspension when it comes to the federal gas tax. Anne-Marie, I will also quickly mention that yesterday we got some other reporting from Iranian state media, including that the U.S.'s latest proposal did not include payments when it comes to war damages. That is also something that at the moment is being disputed by the White House.
Tyler Kendall with the latest in Washington. Tyler, stay close. Thank you. Henry Trace of Vader Partners writing the U.S. and Iran could negotiate a narrow reopening of the strait while the thornier tax issues are sorted out. Military escalation remains distinctly possible. Henrietta joins us now for more. Henrietta, welcome to the program first. And secondly, I want to pick up on that last line. I think it's really important. In markets, overwhelmingly, the consensus is this administration is committed to a diplomatic effort to end this war and avoiding the resumption of hostilities. Do the events of that announcement in the last 24 hours reinforce that or highlight that maybe we were closer to a resumption of hostilities than many people believed?
I think there's actually a lot of confusion on the street. My inbox is constantly, what are your odds of military escalation? I don't think there's a lot of confidence in one direction or another about what the president is going to do here. And that's because he doesn't have any good options. The fact that Iran's neighboring countries are telling the president, per his own words, that this is not the time to escalate militarily is because they're the ones that are going to get retaliated against. And they don't want their energy outlets, their energy refiners to be the ones that are targeted, which President Trump understands because it'll drive inflation and gas prices even further. I thought your last guest was really interesting, and it's disturbing to hear that this is not a widespread problem when you're pointing to earnings from Exxon as a reason for good news. The Gulf is closed, the Strait is closed, and inflation continues to seep across the entire economy into wholesale data, into PPI data, and the Strait is the problem. So escalating and further incapacitating energy refiners in the entire region is only going to exacerbate the problem. So the president doesn't have a good choice here.
So Henry, why do you think that the Strait at some point could be reopened while they negotiate other issues? If this is the one piece of leverage the regime has, don't they want to hold on to this as long as possible?
Exactly. And so I think, Anne-Marie, the way I think about it is that this would have to be the United States allowing for the movement of freight and ships through the Ayatollah. It always comes back to this fifth and final point that Iran always includes on its ask list, which is, I want to have the ability to control flow through the Strait, which means collecting a tax. And in my opinion, if you really think about it, it's pretty easy and painful, obviously politically, for the president to allow some transit through the Strait, at least clear the backlog of ships that are in there, maybe get some of the oil out that's locked in, get those poor souls that have been stuck there for 80 days out of there, and get the flow through. But you'd have to allow for Iran to continue coordinating, which, by the way, the insurers want. And Iran is generating its entire own insurance policy to get those guys through. So in comparison to a military escalation, it's theoretically easier. Diplomatically and tax policy-wise, it's a disaster.
Well, Henry, are you saying that the Strait could open with Iranians collecting a toll, or potentially the United States using the Fifth Fleet and just having naval escorts?
Well, the naval escorts are extraordinarily expensive. They let 2 ships through. Each one costs $10 million, and that's going to escalate. And obviously, the president called that off after 36 hours or something because the manpower cost and the risk was presumably too high. If it was effective, we'd still be doing it. We're not. And that's the problem with the military sortie from the United States side. So the path of least resistance, if you're more worried about military, manpower, loss of life, is to create a formalized route to go through that goes through the tax policy angle. It's from a human cost, less problematic.
Henrietta, appreciate your take. Thank you. Henrietta Trace there of Ada Partners. On the options available to this White House right now, they're limited, which is why they've committed to the blockade. Because at the moment, that's the low-risk option for now, because you've got the inventories. But as you aggressively draw those inventories down and you start to get hiccups here, there, and everywhere, that becomes a higher risk option. And that's where things get more complicated.
It's why you see OFAC extending these waivers when it comes to Russian oil. They're willing to allow Russian crude hit the market because they don't have a lot of choices for some of their partners, especially in Asia and in Europe. It's going to be a very challenging environment. Right now, to Henrietta's point, the Strait of Hormuz, John, has an X account, so you can message them and pay them to get your vessel through.
That easy, right?
Yeah, with some
Bitcoin.
Yep.
Okay. All right. Brent crude this morning around 111. WTI around 108. Equity futures negative. We're down by about 1/3 of 1%. Up next, we'll get the latest on Home Depot with Drew Redding of Bloomberg Intelligence.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Hi from New York City, welcome back to the program. Bramo on tour today. She's up in Boston. She'll be catching up with everyone over at JP Morgan at their tech conference. Coming up a little bit later, look out for this conversation with the Liberty Media CEO. Coming up a little bit later with Derek Chang. That's happening in the next hour. Stacked hour. In about 60 minutes' time, we'll also catch up with the central bank governors of France and of Germany. So a read on the ECB. Ollie Krug on the ground at the G7, bringing you the latest from there a little bit later this morning. For the week ahead, this is how things are stacked up. We had Home Depot earnings a little bit earlier on this morning. Sales falling slightly short. Stock's not been hammered. That's interesting. Later in the week, we'll hear from Target. We'll hear from Walmart. We'll also hear from Nvidia. That is the big earnings report for the week, given its massive contribution to the S&P 500 and to the NASDAQ. And then later in the week, we mentioned this earlier in the program, Kevin Walsh, Fed Chair, sworn in on Friday, entering a really, really complex moment for any central bank anywhere, particularly for this Federal Reserve. Unclear what its reaction function is. Want some clarity on that. We do know the committee is incredibly divided at a time where inflation has picked up to multi-year highs, driven by this massive move we've seen in energy over the last few months.
Cameron Dawson was talking about, is this going to be potentially one of the first Fed chairs that comes to a meeting and dissents? Remember, he is taking Steve Myron's very dovish spot. So he might have to, assert himself in that way. I do think it is interesting, though. First, it was the Treasury Secretary, and then it was the president of this Fortune magazine. It wasn't a full-blown, I'm going to give Kevin as much space as he needs, but it was a sense that you might have to wait to see the figures to after the war is over. Basically, considering the fact that we are seeing a higher inflation environment with higher energy prices, potentially cannot come in and cut rates immediately.
I mentioned this quote from Jim McCormick over at Citi earlier on this morning. I see markets underpricing the risk of a Fed rate hike starting this year, not next year, but this year. And I think many of us, including myself, struggle to internalize that. I mentioned this yesterday. We heard from Neil Kashkari. He dissented against the language in the statement. And when he talked about why, he talked about the financial conditions tightening somewhat so they wouldn't have to do more further down the road. And my translation of that was ultimately, if you change the communication of the Fed, if you tighten financial conditions up somewhat, you get that done, you won't actually need to hike further down the road. So even the dissenters to the language on the easing bias in the statement right now, I don't see them as inclined to wanting to hike anytime soon.
No, but they want to set the bar and make sure that inflation doesn't run away from them. I mean, when you talk about an individual coming out and saying potential is going to be a hike, which some of the banks and analysts are starting to see this year, did you see Steve Auth, how he responded to when I said, can stocks continue to where you think they're going? That story persists if we have a rate hike. And he says, whoa, I don't even think there's going to be a rate hike. And that is a loaded question. It's so interesting right now. The debate is so different and robust. Citi yesterday, Veronica Clark is still expecting, her and the team, 3 cuts this year, while individuals are starting to price in a potential hike.
Let's start with the bond market then. 2s, 10s, 30s, and check out 2s first. Yields elevated by 3 basis points. You'll notice the yield here is still north of 4%, close to 4.1%. That is quite some way away from the policy rate on the Fed funds. Now, this is important because the gap has opened up, and this is why people are talking about the prospect or the risk of a rate hike in the year to come. On the 10-year, further out along the curve, north of 460, we've seen that over the last couple of days now, up another 2 basis points so far this morning, and on 30s, up about 2 basis points on the 30-year to around 5.15 yields at the long end of the curve at multi-decade highs. In Japan, at record highs on certain maturities. In the UK, numbers we haven't seen for almost 20 years.
It's not just a problem in the United States, although this would be a problem screen for the Treasury Secretary. Remember, he wanted 3% of the 10-year yield, Jonathan, when he came in. That was his hope and ambition. This is a global problem, and this is something that is actually going to be dominating the G7 finance ministers meeting happening right now in Paris. We already heard from the French finance minister who said, this is a problem. Energy costs going up, it's inflation. Potentially there's going to be a little bit of a drag on growth. This has a stagflationary fear.
That's the bond market move. Equities this morning down by about 1/3% on the S&P 500. Slightly lighter, negative across equity markets today on the S&P, on the Nasdaq, on the Russell. On the Russell this morning, we're down by 0.5. Just to round things out for you, to check out commodities, Brent and WTI. Brent's down by about 1%, but still holding on to 110. Call it 111. On WTI crude, 108. We're down about 1/3% on the session so far. On our radar this morning, President Donald Trump delaying strikes on Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, because we've had very big discussions with Iran, and we'll see what they amount to.
While there has been no immediate confirmation from Tehran of renewed talks, President Trump saying the countries are very close to reaching a deal.
But how many times have we heard that? I mean, I spoke to the president weeks ago when I called him and he said they're desperate to make a deal. Right now, when you get the readouts from the Iranians and the White House, they are still so far apart and on their red lines, and neither side is moving inwards, which is why the president talks about the fact that he could still go back to strikes. What I find so interesting about this truth yesterday is that no one was planning for a strike. And the president came out and said, I'm not doing one, which is why it feels like it's verbal intervention. And for the oil market, it's working. And Kit Juke says the market buys taco more than nacho. Taco, we know Trump always chickens out. Nacho, not a chance, Hormuz open.
Still trying to work out what came out of that meeting in China. You were in Beijing for it, trying to work out the details of what was agreed, if anything, with regards to what's happening in the Middle East. And, of course, the latest on NVIDIA, the CEO, Jensen Huang, saying he expects China to open up its markets to imports of American AI chips. The CEO speaking with Bloomberg's Ed Ludlow following that visit to Beijing.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
China, of course, has yet to sign off on accepting NVIDIA's H200 chips following the US green-lighting access, and that right now is the sticking point.
I spoke to sources about this. They're waiting on Beijing. The United States has allowed the H200s. Remember, this was a huge U-turn for the Trump administration when it comes to the H200s. First, they were banned. Then in January, they gave the green light. Then in March, there was a lot of talk about specific Chinese companies that went to NVIDIA and said, look, we want to buy these chips, and then went back and said, ooh, actually, we can't purchase them because the Chinese Communist Party, the government told us we're not allowed to. After this meeting, does potentially that open up? And that would be a big win for NVIDIA.
The marketing around this AI story is absolutely dreadful right now. It's something they all need to address. I'm sure you've seen some of the scenes from over the weekend with some of these commencement speeches at various colleges around the United States, and some of the individuals delivering those speeches getting booed every time they mentioned AI. Why? Because of language like this. Standard Chartered slashing more than 15% of its workforce, leaning into AI. The CEO, Bill Winters, saying the technology will replace, wait for it, lower value human capital.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
The job cuts would take shape by the year 2030. Interestingly, with this announcement, the stock is lower in London trade. It went down by 0.8%. I can't think of a clumsier way to talk about this. That is not the way to talk about this, and I hope the lesson is learned in the years to come.
Well, as I said in the last hour, maybe you should have asked AI. So I asked Google Gemini, what is a better way to phrase this? Google Gemini, first word, oof. That original phrase is a textbook example of corporate speak gone wrong. Calling human beings lower value human capital and comparing them directly to investment capital sounds incredibly cold, robotic, and devaluing. Maybe before the next time a CEO goes out, or they go out and give a commencement speech or speak to shareholders or their company and their employees about AI taking over people's jobs, they should ask AI how they should deliver that message.
I think it's fair to say this is why some of those commencement speakers right now are getting booed.
Absolutely.
Off some of these stages. Looking at some of the data we're getting for the consumer, big week for retailers. We heard from Home Depot a little bit earlier on, the company missing expectations, pointing to high borrowing costs and slower consumer spending. Home Depot CFO Richard McPhail telling us here at Bloomberg, shoppers continue to defer large projects, telling us they have a higher degree of uncertainty. Drew Renning of Bloomberg Intelligence joins us now for more. Drew, welcome to the program. It's not as if the bar was particularly high for these companies. We knew things were going to be difficult. How difficult were they in the last quarter?
Yes, it was a relatively neutral print for Home Depot. They had a slight miss on comparable store sales. But as you mentioned, coming into the quarter, expectations weren't all that high. The stock's down over 20% since mid-February. I think the more important thing and what investors will latch on to is the fact that they maintained their guidance for the full year despite these choppy macro conditions. Now, their guidance did assume that sales would be either flat to up 2%, so I think they did provide themselves with a little bit of wiggle room to kind of see how this macro ultimately shakes out. So I don't necessarily think we've seen the impact yet of the recent inflation and heightened consumer uncertainty. So we do think that there could be some risk through the remainder of the year.
Drew, that's the cyclical backdrop. There's also just this massive structural problem with interest rates because of what happened with the pandemic. Within the space of like 12 months, we had record low interest rates and then interest rates at multi-decade highs. So if you got that mortgage at the right time, you've still got it. And you certainly don't want to cycle out of that into what we get in the market right now, which is something closer to, say, 6%. Drew, do they have to think about this just being a longer-term structural problem that people just aren't going to be moving until that's addressed? And I don't see any solution for it at the moment.
Yeah, it's certainly one of the biggest headwinds to increased housing turnover. Somewhere around 70% of outstanding mortgages are below 5%. And without a whole lot of labor market stress, there's not a whole lot of incentive people being forced to move from their homes. Housing turnover right now is about 20% below normalized levels. We know that movers tend to spend more on home improvement spending. So we think that the existing home market continues to bounce along the bottom. We don't necessarily see it as a headwind to home improvement retailers at this point, but the catalyst just hasn't come yet.
Drew, what's going on with the tariff refunds? I know Home Depot signed up for them. Are they going to get some of this money back?
So I think they mentioned that they have signed up for them. They have got some of them back already, but I think the CFO had mentioned that it's not going to have a meaningful impact for them.
How challenging has it been for the C-suite? They dealt with tariff last year. They're dealing with high mortgage prices, a housing crisis really in this country, and now potentially consumers just on edge because of everything going on with higher inflation and conflicts around the world.
Yeah, it's really been a perfect storm against the home improvement retail industry. I think one of the main things you highlighted, and it's what we continue to hear across the housing landscape, is just the elevated uncertainty, which is causing consumers to scale back spending, particularly on big ticket projects, which was mentioned by Home Depot. The other thing to keep in mind, with rates where they are, you're tending to see less spending on those big ticket projects because they're typically financed. So think of things like large-scale kitchen remodels, bathroom remodels, flooring, window projects. Those are all things that really haven't come back, and that's what you need to see in order to get the next leg of growth.
It costs a lot of money, that's for sure. Drew, it's good to see you. Thank you, sir. Drew Renning of Bloomberg Intelligence. Stock slightly lower. Bar was pretty low for this company. Name was down by some 13% year to date. Following last year's losses, that stock was down something like 10-11%. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Meta is cutting jobs and reassigning 7,000 workers to new roles related to AI. According to an internal memo, the Facebook parent will announce staff cuts later in the week as part of an effort to improve efficiency and offset its investments in AI. SpaceX could make its trading debut as early as this week. Elon Musk saying the IPO is coming pretty soon as it seeks to raise as much as $75 billion on a valuation of more than $2 trillion. That would make it the largest IPO in the history of capital markets. New York City Mayor Zohran Mamdani is set to hold meetings with JP Morgan CEO Jamie Dimon and Goldman Sachs CEO David Solomon. This as wealthy New Yorkers and Wall Street push back on the mayor's proposals for higher taxes on the rich. And that is your Bloomberg Brief. John.
Vonnie, thank you. I wish we'd just say employers. I keep reading these stories about the billionaire class, just employers. The mayor today is meeting some of the biggest employers of people in this city. That's the headline.
Yes,
JP
Morgan alone.
The fact that's news is shocking.
Yes, because this was a mayor who didn't want to engage with the biggest employers of this city. JP Morgan alone has more than 24,000 employees who work in New York City. And more broadly, according to our statistics, Wall Street accounted for basically 20% of New York State's tax revenue. So meeting with the biggest employers and also the biggest revenue generators when you look at your budget.
The fact that's even a story is just ridiculous. Right?
It's sad, actually.
It's really sad.
All these meetings should have been going on. I think there was maybe one ahead of the election.
At least they're actually happening, unlike under de Blasio, where these kind of things didn't happen at all, which was also ridiculous. Up next on the program, testing consumer resilience.
Consumers are making difficult choices based on where prices are, but we haven't seen the consumer stop spending. Begrudgingly, the consumer has held on to their spending trends.
Up next, we'll catch up with Xiao Ma of MasterCard from New York City. You're watching Bloomberg TV.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
There is a weight to this tape this morning. We're down again by 0.4% on the S&P. We're down by 0.75% on the Nasdaq 100. We're still elevated in the bond market. Yields on 2s, 10s and 30s higher this morning by a few basis points, up 2 on 10s to 461. Is this a problem? Mike Wilson of Morgan Stanley is constructive on this equity market, but on the bond market, he said this: we may need to see a more durable resolution to the conflict in the Middle East before yields fall. If bond vol rises with rising back-end rates, we would expect the first meaningful correction in equity prices since markets bottomed at the end of March. Mike Wilson of Morgan Stanley to kick off this week.
And the problem right now is when you have the president coming out and saying he's holding off on strikes that no one knew were planned because of what the Gulf partners have said to him. Is that a durable solution? No. We've been here multiple times. This conflict continues. We're in paralysis. And that is why maybe the oil market is looking at this and taking it as a signal, but not so much the equity and bond market.
Crude still elevated, slight pullback, as Anne-Marie indicated, but still elevated around 111 on Brent, WTI around 108. What does it mean for this economy? Under surveillance this morning, testing consumer resilience.
Consumers are making difficult choices based on where prices are, but there hasn't been demand destruction. And you're continuing to see consumers spend on services. You're seeing things like durable goods slow down, but we haven't seen the consumer stop spending. Begrudgingly, the consumer has held on to their spending trends.
So here's the latest this morning. A busy week of retail earnings continues. Target tomorrow, ahead of Walmart on Thursday. Michelle Maher of the Mastercard Economics Institute writing consumer spending remains resilient. With some reallocation, inflation pressures remain concentrated in energy and in airfares. Michelle joins us now for more. Michelle, good morning.
Good morning.
Good to see you. You've seen these kind of energy shocks before. We've seen them recently a couple of times. How different are the spending patterns now compared to, say, then?
I mean, so one common theme is, of course, consumers are spending more at the pump. That's a given because energy prices are higher, and that's a necessity. So we're seeing spending on fuel and convenience run up about 20% positive on a year-over-year basis. Historically, when energy prices rise and remain elevated, you do see consumers start to reallocate their basket of spend, and durable goods will be more vulnerable, particularly things like autos that are directly related to gas prices, but even the larger appliances that are bigger ticket items. And then sometimes you'll see things like discretionary services start to slow down. What's interesting about today is that you are not seeing the shift in discretionary services. For example, restaurant spending is remaining very steady, very solid. And I think that says a lot about the consumer's desire to continue to engage.
Do you think we're running on fumes? What's this backed up by?
It's backed up by the labor market. I don't think it's fumes. If you see the last few jobs reports, it's obviously very volatile, but we are still seeing job creation. The unemployment rate is at 4.3%. That's a solid labor market, all things considered. So yes, we can debate how much labor supply there is out there, what the right break-even rate is for jobs. But when you look at an unemployment rate of 4.3% and very low unemployment insurance or jobless claims, it's supportive for the consumer.
We're about to have Memorial Day weekend. AAA is talking about highest gasoline prices in 4 years, but still record numbers are going to hit the road. Do you see consumers still having the money and the appetite to go travel?
Yeah, so we just published a big report called the Travel Equation, where we look through the 3 big forces that are driving travel. It's macro, it's machines, which is AI, and it's personal motivations, which is always a big factor that drives people's decision to travel. And it seems like, yes, travel is still happening. It's a reorientation of travel for sure. So depending on how much consumers can afford, they may decide to drive less, drive differently, go somewhere else, but they're going. And it's the same thing with air travel. So of course, there's the conflict in the Middle East, there's higher jet fuel prices, some of that is being passed on through higher airfare. And consumers are gonna take that into account. But they're going to look for places to go and ways to still find value in travel. So this reorientation is considerable, and we see it.
They're traveling, but are you basically saying the conflict in Iran is dictating potentially where they're going, their destination?
Well, it's an important factor from a safety perspective, from an availability of flights, from a connectivity perspective, and a cost. So one of the things that we found very clearly in our research is the influence of AI to help consumers find value and find those places to go. So we were able to look at two different cohorts of consumers, one that utilizes AI subscriptions and one that doesn't. And you see different travel trends based off of those cohorts.
In what way? What are they doing? What are they finding out?
So the first thing, those that use AI subscriptions have a greater share of wallet towards travel, which is interesting. It just shows that maybe it's a younger cohort, more inclined to utilize their purchasing power. But you also see these off the beaten path type of destinations, particularly throughout Europe, where it's a very high share of AI subscribers that are the tourists in the destination. So Leipzig, Germany, which is a big music city, a third of tourists from the US are AI subscribers.
Wow.
And that's because they were taken there, or that's just a correlation? Correlation or causation? I'm just trying to understand.
That's very hard. It's a good question. It's hard to know if it's correlation. Are those AI subscribers more likely to have gone there regardless, or are they finding those destinations? I think it's got to be part of the latter. You're identifying new places to go that have more value, that are a little bit unknown.
Asking for a friend, where else in Europe?
Read the report. There's a lot of good locations.
I've read the report. FX a big factor in all of this as well.
FX matters too, yeah, of course.
I've always wondered. In London, I was very sensitive to that. I'd check different places and maybe decide based on what the foreign exchange market was doing. Is that becoming a bigger thing stateside?
That's very savvy of you. But yes, I think it matters more for the emerging markets. Particularly, we see a lot of that FX volatility influencing where people travel in Latin America.
Michelle, it's good to see you. Thank you. Michelle Ma of MasterCard. Consumers are still spending. They're not running on fumes. It's backed up by a labour market that has cracks, let's put it that way, but still it's pretty decent.
But I do think it's interesting that because of jet fuel costs, because of other issues, potentially travelers are looking into peak travel season is going to be this summer, and maybe they're changing their destination. I didn't realize also AI was helping you find some great deals.
Didn't know that either. This, of course, is the big test for this Federal Reserve. Consumer price tolerance. Will they absorb these price hikes? And if they do, where does it leave this Federal Reserve?
It's going to be a challenging one, especially given Kevin Warsh is going to be sworn in this Friday, an individual that was looking pretty dovish coming in, and now potentially from Scott Bessent and the president himself, give me a little bit of cover. Potentially he's going to have to remain on hold for longer.
These particular ceremonies can get a little bit awkward. Do you remember the one with Yellen and President Obama? Do you remember that one? It was a little bit awkward because that wasn't really the person he wanted to be running the Federal Reserve. He wanted Larry Summers.
Yeah, he wanted someone else. Larry Summers wanted Larry Summers, too.
Yeah, and Summers wanted Summers. I think Summers always wants Summers, doesn't he?
But President Obama wanted Larry Summers, but he ended up with Janet Yellen. So I don't think this one's going to be awkward, though, because the president has known Kevin Warsh for years.
No, I don't. This is the guy he wanted, obviously.
Yes, and also has a family relationship there. I mean, he's friends with Kevin Warsh's father-in-law. So I think the president is going to be so excited at this ceremony.
I think Kevin Warsh is hopeful that the president doesn't say anything about where he thinks rates should be.
Yes.
And at least the volumes come down on that a touch.
I think Kevin Warsh is hoping it is going to be strictly a signing ceremony and not an event where journalists can come in and ask questions.
Best of luck to him. Looking forward to that signing ceremony. That oath that's going to be taken a little bit later this week. Coming up, Ajay Rajadaksha of Barclays, Liberty Media CEO Derek Chang, and we'll catch up with the central bank governors of both France and Germany. Look out for that a little bit later in the next hour on Bloomberg Surveillance.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We're seeing a bifurcated S&P 500 for sure.
The AI theme is best expressed right now in U.S. large-cap growth stocks.
It's hard to know who's in a bubble.
We are seeing a weakening in the overall AI story.
If it is in fact a bubble, nobody knows when it will pop.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action scores look like this, pulling further back from all-time highs on the S&P 500, down on Friday, down on Monday, down Tuesday morning so far by 0.5%, negative 0.8 on the NASDAQ. The bond market not helping. Yields higher across the curve, up by almost 4 basis points now at the front end, approaching 4.1% on 10s, back through 460 on 30s. Hello 515. Yields up by close to 3 basis points at the long end of the curve. Again, a number we haven't seen going back to 2007 on a closing basis. In the commodity market, crude is okay. Today it's well behaved, but it's not helping out bonds, and that's not helping out stocks. Crude around 111 on Brent, WTI around 108.
Crude may be taking on some of that verbal intervention from the White House. The president said he had planned a strike. He pulled back on it, calling it off at least for the next few days. And this was at the behest of Arab allies. And he says that negotiations are ongoing. But we've been here so many times. So some parts of the market are taking it that it's real, and some others are kind of brushing it off until they see something more tangible. On top of that, though, the oil market is probably going to be helped by an OFAC license. That Russian crude gets another 30 days, so you can continue to buy Russian oil that's at sea. Potentially, though, it does show that this administration is going to be looking for ways to try to add more barrels to the market because we are going to peak driving season and things may get tense domestically.
That move in energy is exposing weakness in fixed income, underlying weakness that hasn't been addressed for quite a while. You get a move in energy, which drives CPI to multi-year highs, which exposes limited fiscal space in certain governments across the West, which highlights leadership issues in places like the UK and elsewhere. And this is why the G7 has got language like this morning. Policy responses to the war should be fiscally responsible. I'm not sure they have any choice because this bond market is prepared to push back.
And especially for Europe, it's very challenging. So remember, they're off the heels of a different energy crisis when Russia invaded Ukraine. So this is why they've been here before, and it's very concerning for them. When you look at what's going on in the bond market, you say that where we are for 30-year yields, we haven't been since 2007. Barclays strategists are saying we could push 5.5%, where we haven't been since 2004. And BlackRock research is saying stay away from developed market government bonds and just go into equities.
Yields this morning up across the curve. Coming up this hour, Ajay Rajadakshar of Barclays with stocks looking to snap a two-day slide. Liberty Media CEO Derek Chang with the Formula One season in full swing. And Jay Goldberg of Seaport with a street low price target on NVIDIA. We begin this hour with stocks drifting lower and bond yields remaining near multi-decade highs. Ajay Rajadakshar of Barclays writing both stocks and bonds look unappealing at this point. We expect the risk rally to now take a step back. Ajay joins us now for more. Ajay, good morning. Good to see you.
Good morning.
I think we need to catch up on where we were. You were very constructive on the equity market. We caught up recently in the last couple of weeks, and you said it's not that we didn't think the situation in the Middle East mattered. We just didn't think it mattered yet. We have the yet now. We have that point right now.
Yes, we do. I think we are at that point. We are now getting to a point where every week the world is drawing down more rapidly on oil inventories. And the bond move in particular, remember when I was here 3 weeks ago, right? You pressed me for an answer on what I would buy. And I basically went hamana. You know, I couldn't have an answer. That's pretty much where I am still. I think the bond move is not something you get in the middle of. It's real and it will last, I worry.
Well, let's pick up on the curve right now. Let's go through these numbers. 460 on 10s, 5% on 30s. We've seen 460, these kind of levels, a few times in the last few years. Typically, it becomes self-limiting. You get to a point and then people worry about growth. People start buying bonds again. This time, I've seen a variety of research point to this belief that maybe this part of the market, long end of the curve, maybe pushing out to 30s, has become unhinged or untethered. Are you worried about the same thing?
I think at the very least, I'm worried about a drift higher in longer rates. And it's for the reasons you said, Jonathan. So first is we do have a catalyst in terms of an inflation shock coming from oil continuing to last high for longer. But second, these are the sins of years and years starting to pile up. I mean, it's not just the United States. Across the West, we've been spending money like a drunken sailor on shore leave for at least a decade, and that's coming back to haunt us now.
We've lost our anchors. It used to be the German debt market, it used to be JGBs. You could get away doing funny stuff because you had these two dominant markets just holding down global yields. They've gone away. What's the anchor now for fixed income?
I don't know. I think the US is an easier answer because there is going to be a clearing price at which private investors come in. We do have the privilege of being the reserve currency, weaker as it is in recent years. Believe it or not, I worry more about countries like France, like the United Kingdom, where there's a bad mix of both politics and economics. In both countries, in the United Kingdom, you're talking about 4 prime ministers in 4 years. You might get a 5th now. On the French side, you've had 5 prime ministers in the last 2.5 years. That is not coherent policy.
When it comes to this bond market, potentially we saw last year the bond market be the reason the president had an about face when it comes to tariffs. Do you think this is the bond market pushing back potentially on this conflict in Iran?
I think at the very least, the conflict in Iran is now starting to be a catalyst because one of the things that has happened, Anne-Marie, is everyone has pushed up their 2026 averages for oil. You know, as every week passes, people are just marking to market and saying, look, for example, when I came here last, I thought oil would average $85 to $90 a barrel. I think we'll now average $100 a barrel.
For all of 2026?
For all of 26. And remember, the first 2 months weigh against that argument, right? Because we ran at $70. So this is a pretty big problem. It is a pretty big energy shock, and the bond market is reacting to it.
And what does this mean for equities, higher energy prices?
So I have hesitated going short equities just because the power of earnings has scared me. And then you had momentum. But I think we are getting very, very close to the point. I mean, you asked me to pick a side right now, I would not own equities here.
Well, that's stocks versus bonds. You say you don't pick a side.
Cash.
You mean short versus long?
It's unfortunately a non-answer, Jonathan, but there's nothing that is attractive.
No, I understand. When was the last time you were in this position?
Not for a long time. Not for a long time.
Knowing you for a while, it feels like this has been a while. When was the last time? Can you think back to it? What were the conditions then that got you to this place? Does this feel unique?
At the absolute bottoms of COVID, where I was massively wrong, just because I didn't know where, whether the system was going to work, where the next policy reaction was coming from. This was not remotely like that in terms of magnitude. I don't mean to imply that, but I mean, the earnings story is so strong that it's very hard to go decisively in the other direction. The bond yield move is significant, but it's still not appealing enough. No one's making any progress on the fiscal side. There's no political will to do anything. And you're about to get an inflation shock. I just don't know where to go.
Well, let's stay with the bond side of things. This is where things are confusing for a lot of people for a whole host of reasons, and we can go through them. One is energy. The other is limited fiscal space. The other is weak leadership. Hello, UK. We talked about that. France as well. That's been a problem for a long, long time. There's another issue in the mix as well, which needs to be addressed. Let's isolate that and talk about it. And that's the reaction function at the Federal Reserve. And it's not clear right now what Kevin Walsh is going to decide to do, look to anchor. When you first saw this shock, Chairman Powell came out and tried to anchor inflation expectations, planted that flag almost straight away in the news conference. You could see that was where the emphasis was. Do you know what the emphasis will be next month at the next Fed meeting?
Well, I should start by saying the Fed, if you look at financial markets, has very clearly not lost inflation credibility. So if you look at five-year inflation break-evens, they are still pricing, and you look for the next 5 years to 5 years beyond, they are pricing in 2% on core inflation, literally. Okay, so the starting point on a credibility standpoint is good. But I don't for a minute see how the Fed can deliver rate cuts this year, genuinely, regardless of what the motivation might have been, behind the decision to nominate Chair Walsh. I'm not even saying that was the reason. I think they're just going to have to wait it out. Years ago, Governor Waller told me something that has struck in my mind. He said, look, base effects are a central banker's best friend. So when you get a supply shock, which is the shock that you're getting right now on the oil front, right? The Fed can't do anything by hiking interest rates to make oil flow more freely. It cannot do anything by cutting interest rates to, you're not supposed to cushion the shock through monetary policy. You just sit on the sidelines, and that's what they're going to do. So I don't think the Fed is going to be a driver of longer yields going even further here. But the starting point is just very poor. I mean, that's all there is to it.
You don't see a cut, but you don't see a hike either.
I do not see a hike.
Where will the next move be once the war is over?
I think the war over is actually not a catalyst for a move. Let's start with that. So for the rest of 2026, I think the Fed sits squarely on the sidelines. Say the war is over, they will take their cue from data. And one of the problems for both the front end and the bond market as a whole, Anne-Marie, has been that the US economy has held up. It has to, you saw retail sales last week, for example, right? The consumer savings rate is very low. We are not creating any net jobs to speak of. It doesn't matter. The consumer keeps spending. So one of the best things that could happen from a macro standpoint, near term, strange as it sounds, to prevent this one-way move in bonds, is for data to weaken. If that doesn't happen, I think the Fed stays on the sidelines. But more importantly, the bond move doesn't stop.
10s at 5, would I get you interested?
Yes. I think another 40-45 basis points would get me interested.
That's the number for you.
That is the number for me. And not because I think things magically improve, but there is a clearing price at which private investors come in. I don't know how to solve the equation for economies like France, for example, where last year inflation ran at 5%, the deficit ran at 5%, and nominal growth ran below 2%. That's the circle that I have a very, very hard time squaring. I don't think you had a bond crisis this year, Jonathan, because debt management offices still have something up their sleeve. They can keep issuing lower coupons in the long end, and they can stave it off. But every time you get a headline, it's going to be in the upward.
But this is the problem in places like the UK. I struggle with the same story. Yeah. You could shorten up duration as much as you like, but ultimately, if you're facing an inflation shock and your central bank might respond to it, you got problems.
I agree. I mean, do you remember last July where there was a lot of news in the UK press about how Chancellor Reeves was seen getting emotional in Parliament? The more significant part that week, if you remember, was that Labour, with a 160-seat majority in a 650-seat Parliament, wanted to pass a small cut to the winter fuel allowance and faced an open parliamentary revolt. There is no political will anywhere.
This is where I'm really struggling with places like the UK. And why I said yesterday on the programme, I'm not really too interested right now in who leads the government. because you're not going to see the changes required to get this country, this economy on a better trajectory unless you see massive pressure coming from fixed income. That spells out a very dreadful story for the future of the UK finances.
I think you might actually need to get a shock. Hopefully it doesn't require that, but
things have to get worse.
There is a chance that the only way that policy, and you know, it didn't used to be this way. I'm completely dating myself. In 2011, US Congress got so worked up, they established a bipartisan commission called Erskine-Bowles because they thought US debt to GDP was too high. You know what our debt to GDP was then? 60%. We are over 100 and going to 120 and no one cares.
I remember that.
It's gone very quiet in the US, hasn't it? But we've got that privileged stateside that the UK doesn't seem to have at the moment.
Yeah, but even so, you can't run 6.5% deficits indefinitely without the market.
With unemployment close to 4.
With unemployment close to 4.
I agree. Ajay, could talk to you all day. It's good to see you. Thank you, sir. Ajay Rajadaksha there of Barclays on this fixed income market. 10s at 5, it gets interesting. 10s right now, 460, not so much apparently. Yields higher by just 2 basis points on a session so far. Let's give an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump calling off planned strikes, he says, on Iran today. Trump saying Gulf allies asked for more time to seek a diplomatic resolution, adding the U.S. remains prepared to attack if an acceptable deal isn't reached. NVIDIA expects China will eventually allow AI chips to be imported from the U.S.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
NVIDIA CEO Jensen Huang telling Bloomberg he didn't discuss the company's H200 chips during his trip to China with President Trump. NVIDIA reports earnings after the bell tomorrow. And it's going to be a hot one here in New York City. The National Weather Service issuing a heat advisory for the city and New Jersey, with temperatures expected to soar well into the 90s. Late-day thunderstorms on Wednesday are expected to bring temperatures right down. And that is your Bloomberg brief. John.
Bonnie, thank you. I live for it. The winter's so long in the northeast.
I know, it's time for the beach.
The days are so dark. But the promise of summer just keeps you alive, doesn't it?
And you can blade there for $95.
Unlike the UK,
oh, no,
when the winter's
UK.
so dark and the winter's so long, and there is no promise of summer whatsoever apart from maybe a few weeks in August and July.
Basically 1 week. There's one always amazing
And then September, and it's amazing. And London, honestly, nowhere better when the sun is shining.
Yeah,
but it's just rare. And
it lasts like 5 days, and that's it.
Okay. Futures this morning, negative by 0.4%. Up next, we'll get you some morning calls, plus Liberty Media CEO Derek Chang on F1, MotoGP, and Live Nation.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
We were seeing certain extremes in some of this trading. And you also saw this narrowness really not be consistent with an overall new high-end market. So it made this fragile. We think it is a pause, but at the end of the day, when you have an over 18% weight in a cohort of names that went vertically up, a simple correction in those names back to trend could be damaging for the overall market cap weighted index.
That was Cameron Dawson of New Edge Wealth on this equity market a little bit earlier on this morning. Your equity market right now negative by some 0.4%. On the Nasdaq down by 0.75%, call it 0.8%. Going into the cash open 1 hour and 12 minutes away. That's the price action. Let's get you some morning calls. First up, Citi raising its price target on SanDisk to 2025, seeing persistently strong storage demand and a highly favorable pricing environment. That stock struggled in the last 24 hours. It's down this morning by 3%. Your second call from Mizuho raising its price target on Micron to 800, seeing positive impacts from AI data centers on memory chip makers. That name also lower down by 2.4% this morning. And your third and final call from HSBC, raising its price target on Nvidia to 325, expecting a beat and a raise in the company's earnings report tomorrow after the close. That name is down by some 1%. Let's head back over to JP Morgan's annual Technology, Media and Communications Conference underway in Boston. Lisa standing by with another special guest. Hey, Lisa.
Hey, John, thank you so much. I am here with Derek Chang. He is the CEO of Liberty Media, also sitting on the board of the Oversight, Liberty Media's subsidiary that oversees Live Nation. Derek, thank you so much for being here. Really appreciate it.
Lisa, thanks for having me.
So I want to start with the idea that everyone here is talking about scale, getting enough scale, merging up, particularly in the media space. You moved in the opposite direction last year, breaking up into a host of different entities. Can you talk about why you decided to do that?
Well, I think if you look at Liberty Media over its history, it's had a history of sort of expansion and contraction. You know, we kind of go with the flow a little bit, depending on what the circumstances are and what the market is you know, asking for and what we think that we should be doing for our shareholders. So I don't think in this particular moment it was a specific strategy of we're ultimately going on a trail of just sort of getting smaller. It was clarifying and simplifying the structures, and so delivering to shareholders sort of what assets they want in what places at this particular moment. But, you know, over time, we have had tracking stocks, we have spun out companies, and now we're sort of back to a more simplified structure. And it's really to provide that clarity for shareholders.
So you oversee your two main properties at Liberty Media are Formula One and MotoGP, which is relatively new in the U.S., very big in Europe and Southeast Asia. I'm just wondering how you're thinking about a media strategy. You just signed this 5-year deal with Apple in terms of streaming rights. Is it the same between streaming and legacy cable networks? Is it sort of all the same at this point when it comes to sports licensing?
Well, I think it still depends on what markets you're actually in. And so in a lot of markets like the U.S. at this point, the streamers have you just spoke about scale, a lot of scale. And I think that historically people have said, oh, you got to be on a broadcast network, otherwise you're not going to have the reach. I don't think that's true anymore. And I think the deal that we did with Apple basically has shown that is, for us, we've seen no real drop off in terms of viewership, and in fact, engagement overall is higher than it was before in the early sort of going here, the first 3 or 4 races that we've had this year. And I think what that speaks to is streaming platforms certainly in the U.S. have reached a level of maturity and even beyond, you'd say. And you see it right now with sort of what's gone on at the NFL, their recent deals that they're doing. So clearly it's part of sort of mainstream viewing habits. And this whole concept, I think, that people would, the knock on streaming was also you lose sort of the sampling effect. And I think what you see with our deal with Apple is that people sample in different ways. You go into an Apple store, or you watch other content that's on Apple TV or Apple Music, or what they do with Apple Maps, which they did in the Miami race, where they sort of created an app, integrated it into Apple Maps with stuff around the Miami race, and they had special content for that race. So you've got platforms now that, because of the technology they have, because of their sort of, in Apple's case, singular focus on Formula One, the ability to actually expand your audiences in different ways than you ever have.
Do you think that you're going to move to a Netflix type of model that you did with F1 when it comes to MotoGP in the US, where you have a TV series about it and you sort of broadcast it to popular consumption in a way to democratize exactly what it is?
Well, I think what you're going to see with MotoGP is a lot of what we did with Formula One. There will be similar applications of that. So the biggest thing for us with MotoGP is how do you take the sport, which at its core is a very pure sport and a huge, passionate fan base, and how do you expand that? How do you get more people engaged, whether it's in the U.S. or worldwide? And I think you do that by telling the story. And we haven't told, MotoGP has never really told that story. And you do that through riders, you do that through the action on the track, and you do that sort of in multiple ways, through content, through fan activation at races, through the licensing partners and the sponsorship partners that you have. But I do think the content piece of this is a very important part. Whether you do it as a show just like Drive to Survive, I don't know if that's necessarily going to happen, because it's a different sport, and you want to remain authentic to your fan base and to the fans that you're trying to attract. So we will figure out things that we can do in and around MotoGP that sort of creates the same impact and making it available and making it accessible to as broad a fan base as possible.
You also help to oversee Live Nation, the Live Nation investment through the Liberty Board. And I'm curious from your perspective, ticket prices are really expensive. Everyone talks about it. Everyone complains about it, that the inflation in ticket prices to go see events is incredibly high, and then they still go. How do you understand the inflation in ticket prices, whether it's World Cup and what's going on there, or whether it's basketball at Madison Square Garden, and understand what's the right pricing? How do you do that strategy?
Well, the reality is it is simple supply and demand. Right, and so I think what you're seeing is there's huge demand for live entertainment, live events. And, I see this through the Formula One lens, where our Paddock Club is, for the most part, sold out through the rest of the year here already.
The high-end club.
That's the high-end, tickets and hospitality that we offer. And I think there's just so much demand for these sorts of experiences that the reality is you could probably, create multiples of availability, and it's still going to sell. I don't know about, the specific ticket pricing strategy for those, but I think ultimately what you're speaking to is there's just this demand, this pent-up demand for live entertainment that you continue to see, despite the fact that there are a lot of different things that people can go to. But I think it's the allure of that and the appeal. And for different people, it's different reasons, right? Some people go specifically for the racing. Some people go for the racing and for the food. Some people go for the racing and for the celebrities. Whatever it is, there's this just attraction to it. And I think we're bringing that to the fans.
Derek Chang, thank you so much for being with us. Derek Chang, CEO of Liberty Media. See that, John? You're talking about how expensive the World Cup tickets are, and maybe it's just that the food is really, really good if you go to the right seats and you get to be part of a great experience.
I'm doubtful of that. Doubtful of that. Bramo, thank you. Appreciate it. Looking forward to 6 weeks of complaining about ticket prices at a World Cup. Coming up on the programme, a pair of central bank governors. Check this out. This is going to be fantastic. We will hear from the French central bank governor and the German central bank governor as well, from the G7 on the future of rate policy at the European Central Bank. That conversation just around the corner. Plus, Danny is going to have some morning movers for you. Memory stocks falling as the chip slump continues.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
The opening bell about 60 minutes away. Equities pulling back by 0.4% on the S&P. We're down by 0.8 on the Nasdaq. Some jitters in tech. We can talk about that a little bit later. Danny's going to have some single names for you. But the S&P 500, also some headwinds coming from the bond market. Fixed income yields drifting higher again this morning. 10s at the moment around 462. 30s at around 515, and 2s still comfortably above the policy rate at the Federal Reserve. The 2-year yield around 4.1%. As we count down to that cash open, let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Starting with earnings and apparel, Amer Sports doing very well today, up 3.6%. Their Solomon shoes, they're very popular. You can see them basically going everywhere, and so that supported their earnings along with their brand Arc'teryx. Interestingly, they said that people are buying full-priced items. They're not having to put things on sale, which is helping them against shares moving higher in the pre-market. Now, some of the jitters around tech that you mentioned, a lot of the AI stocks continue to sell off. The chip makers, after this huge run that they've been on, you look at SanDisk down 3%, Seagate down 3.5%, Micron down 2.5%. Part of that is just higher yields, a turn in risk sentiment, but also you had the Seagate CEO saying at that JP Morgan conference that Lisa is at, that they can't meet all of the demand. They don't have enough capacity. It's maybe a good problem to have, but even so, the sector's selling off. But one little piece of evidence that might show that this is something mechanical, this is taking profit and covering your shorts, is what's happening in software. Because while AI has been selling off, the flip side of that are the best performers pre-market in the S&P 500 are software names. ServiceNow, one of the best large cap performers, up 5.3%. Workday, Salesforce, all of them are up around 2%. Again, no specific news tied to them, but maybe just the flip side of the AI sell-off, John.
One to watch going into the opening bow. Danny, thank you. Thank you for the update. Just had to double check that Miller is in the building today before I promote the show. Matt is here. Matthew Miller will be attending his own show at 9 a.m. Eastern Time in about 30 minutes' time alongside Danny Berger. So look out for that. They'll guide you into the opening bow. Let's talk about monetary policy, the future of monetary policy, and the pressure building on some central banks to maybe consider hiking interest rates. Perhaps the ECB will be the first, with 2 special guests. Our good friend Ollie Crook on the ground at the G7. He joins us now for more. Hey, Ollie.
Yeah, that's right, Jonathan. We're here at the G7 finance ministers meeting with central bank governors in Paris at the French finance ministry. The big question in the room, the effect of the war in Iran on inflation, on growth, and we're very lucky to be joined not by 1, but by 2 ECB governing council members, the governor of the Banque de France, François Villeroy de Galhau, and the president of the Deutsche Bundesbank, Joachim Nagel. Thank you both for joining us today. Since you're the host, I'll begin with you, Monsieur de Galhau, and trying to get your assessment first of the conversation in the room among the G7 and what the sort of idea of collective action, what is appropriate at the G7 level to dampen the effect that we've seen from this war?
So first, as you are perhaps aware, this happened to be my last G7 meeting, and I was delighted to welcome my friend Joachim Nagel and all my colleagues from the G7. So I can compare through the last 11 years, and I can frankly say that this Paris G7 was a very good G7. We are in difficult circumstances. You mentioned them, but the discussion was lucid, without any complacency. It was a free discussion at the highest possible level, and it was a confident discussion. And we shared the analysis on global economies, we shared the will to reduce global imbalances, to address the negative consequences of the conflict in the Middle East. And for us central bankers, we are fully determined to bring inflation back to target.
And I'd like to get in, if you could share with us some of your joint analysis of that situation right now. The ECB has given us a framework by which to think about this, the base case, the adverse effect, the severe. I'd like to get both of your perspectives on where we lay on that in terms of the impact of this war.
Maybe before I come to this, I have to congratulate François as well. I think it was an excellent meeting, and you alluded to it. We were, let me say, outspoken in a way. We really recognized this is a delicate situation, and we had an open discussion. And so this was a very fruitful meeting here in Paris. Coming back to your question, where we are, I think this whole conflict started more or less 3 months ago. Now we know that this energy supply shock is more persistent. So we are moving away from our baseline scenario. And so this is, I guess, I believe, a fair description of where we are at the moment.
But does that mean that we are now in an adverse and severe scenario? How are you thinking about it? Because that's the framework the ECB has put out for us to think about.
It is, as always, we will take our decision on data. We will come together in June, and then we will have our decision based on data. But I alluded to it. There is it's a higher probability now that we are now away from that baseline scenario. That means that maybe we have to do something.
And one of the big questions is about the secondary effects and whether or not this inflation is spreading from just the energy, the headline level, to the broader core. What is your analysis of that at the moment?
Can I first insist on the fact that figures are very volatile if you look at financial markets. So we shouldn't focus on data points, but look at the trend. As Joachim just said, as this conflict is lasting for longer, we have to look at more structural, long-term consequences. To give two obvious examples, we discussed financial stability and the bonds market situation. We also have to accelerate our energy diversification and reducing the dependency of most of our countries, starting with Europe, from fossil energy. It's obvious, but let us not limit our response to an emergency answer. On the monetary answer, I think the data will matter more than a precise date. And this is focused on the second round effects.
So for the market's expectations, so they say that there's going to be 2 to 3 rate hikes from the ECB this year, beginning in June. Are you comfortable with that analysis? Do you find that that is a correct interpretation of what we've seen so far?
I guess it's not helpful to speculate about maybe the numbers or when do we what. I think this is not helpful. I think this meeting-to-meeting approach based on the data that we have on that meeting, this is the right way to do it. So we showed our commitment over the last 4 years. We hiked 10 times, we lowered 8 times, and we will show the same commitment when we're coming together for our next meeting.
You think of the French, yeah.
Can I add on markets 2 things? We are not market-driven, we are data-driven, obviously. That said, through markets there is a tightening of financial conditions, and it already plays a role in fighting inflation threats. So we will see, and I think that this is the most important commitment. We showed it in the last 4 years, but European households, European firms can trust us, ECB, Bundesbank, Banque de France, to bring inflation back to target. And this is, believe me, the most important commitment.
And though you're not market-driven necessarily, the market can have bearing on the economy and how things develop. We've seen a move in the bond market recently. How do you interpret that move? You just spoke recently about, obviously, part of it is inflation expectation. You said part of it is political risk. What political risk?
Look, Sarah, first, it's a global phenomenon, and not only a European one, beyond the G7. And there are at least 3 explanations. First is global uncertainty, obviously, and political uncertainty in some jurisdictions. Some question about fiscal policies, and they must remain sound and sustainable. And third, let us be honest, fears of inflation. This is where of our commitment matters most.
And I think just to try to nail you down on this one point, on the question of inflation, do you find that it is currently still segregated to the energy sector? And if it is so, is there a world in which you look through it, this next rate decision, in the sense that it is just at the headline level?
So what I know from inflation and how inflation might develop, it's pretty much dependent on the duration of the shock. And I already said it, I alluded to it, the probability is rising then that we will see more inflation everywhere. And this is something we have to take into consideration, and we will do this in our next meeting.
How much do you think the story on yields is not just about inflation, but also concerns in Europe that we're a bit stretched sort of fiscally? There isn't the firepower, because we look at the sort of fullness of what we've seen in financial markets, growth being dampened, inflation rising, while at the same time equity markets in the United States parabolic, and now yields rising, the bond market catching up. Does that not sort of hold some of the ingredients for sort of untidy unwind in financial markets? Does that concern you?
Well, I think it is not a comfortable situation, this is for sure. I think we, on the monetary policy side, we should be focused on our mandate, and this is price stability. And everyone has to take responsibility here. Is it fiscal? Is it our job? I think it is a delicate situation, but if everyone is taking the respective responsibility, then we can more or less calm markets.
If I can add two things. First, fiscal policy must remain sound. That means that there could be some measures to address the negative consequences for the most vulnerable in our countries. But these measures must be targeted, temporary, and tailored. We said it unanimously in the G7. And can I add another thing, if I compare with the US or some Asian jurisdiction? There is also in this jurisdiction a positive supply shock on artificial intelligence, AI. And it's really of the essence that Europe accelerate on its innovation and on its growth. This is about the Draghi and Letta agenda. We called for it together 18 months ago. And the present situation is not a reason less to focus on structural reform. It's a reason more to accelerate on innovation in Europe.
And I couldn't agree more. There's a lot we can do on the European side. We have to do our homework. Is it the savings and the investment union? Is it the banking union? We have so many things on our plate where we can do a lot to more or less diminish this whole uncertainty.
And in those conversations you were having with finance ministers from the monetary policy perspective, what advice did you give about fiscal policy in terms of not stoking the inflation side of the equation?
Triple T. Can I add that the IMF was around the table, and they have an interesting tracker of the fiscal measures taken so far. I don't say that they are all fully compliant with the Triple T, targeted, temporary, and tailored. But if you look at the magnitude is much more limited than 4 years ago, and this is welcome.
Well, gentlemen, thank you so much for your time. The Governor of the Banque de France and the President of the Deutsche Bundesbank for joining us here at the sidelines of the G7 Finance Ministers and Central Bankers meeting here in Paris.
Ollie, thank you, buddy. Appreciate it. Thanks for all of that. Fantastic conversation on the European Central Bank. Two individuals well aware of the history of hawkish policy mistakes at the ECB. Then it was under Trichet going into the 2008 financial crisis. Also heading into the sovereign debt crisis in the Eurozone as well. Hiking interest rates in response to, guess what? A move in crude, particularly around 2008, and the jitters around the inflation outlook and the inflation mandate. The date's important here. The next meeting is June 11th. The two individuals now were talking about the duration of the shock. There's time here between now and then. I've got no idea where we'll be between now and then, where we'll be on June 11th. Communication's important here. And I would say this is a communication exercise for these central bank governors right now. They want to commit to the idea that they'd be willing to hike interest rates if they need to. And that's important because what it achieves is a tightening of financial conditions, which helps to anchor inflation expectations. And you heard them say that themselves.
Yes. That the markets right now is doing some of the work for them. Right, and you heard that from Nagel. Maybe we have to do something in June. Maybe we have to do things in June. Everyone knows that June is going to be a live meeting, and just those words themselves may help set the bar and anchor, as you say, those financial expectations. It's going to be an interesting time because, to your point, we don't know where we're going to be with energy prices, which is heavily impacting Europe right now, between now and June 11th.
Still a few weeks away, just a few weeks away. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The Sandy fire in Simi Valley, California remains uncontained. California authorities saying fire activity is slowing thanks to calmer winds and higher humidity. 750 firefighters are working to build containment lines while helicopters drop water on hotspots. Meta is cutting jobs and reassigning 7,000 workers to new jobs related to AI. According to an internal memo, the Facebook parent will announce staff cuts later in the week as part of an effort to improve efficiency and offset its investments in AI. In sports, the Mets beating the Washington Nationals in historic fashion. New York becoming the first National League team scored these 10 runs in an extra inning since the 1919 Cincinnati Reds. The Mets topping the Washington Nationals 16-7 in 12 innings. And that is your Bloomberg Brief. John.
Ivani, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Looking forward to earnings from Nvidia tomorrow after the closing bound. Numbers from Target as well through the week. Plus, of course, we'll hear from Walmart later on this week on Thursday. In just a moment, we'll catch up with Jay Goldberg of Seaport. The lone sell on Nvidia heading into a monster earnings report tomorrow afternoon. That conversation just around the corner.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There's two sectors that lead the equity market. One is energy, the other is tech. In those periods when energy lead and commodities lead, you build overcapacity. That lowers the overall price. Investors chase duration, which is growth stories, tech, and the rest of it. But eventually you run out of energy, run out of commodity capacity, and that's where we are today.
Jeff Curry of Abex Markets. Great to catch up with the legend of the commodity market a little bit earlier on this morning, breaking down on what he thinks is going to happen here. We've seen the bust a few times, haven't we? Saw the bust in mining, post the China boom, saw the bust in shale about 10 years ago, middle of the last decade or so, and that's led to a long period of this sector, those sectors being starved of capex, and Jeff thinks you need much higher prices ultimately to get that investment to come back in.
Unloved, and politics also at play. How many times have we been warned about peak oil? Also, remember, as the Biden administration talked about stranded assets when it comes to the oil space. Obviously, that's not happening now. But what's so interesting, and Jeff is basically saying we're just living off of these inventories, is when is it finally going to bleed through prices? What he is talking about in terms of the concerns of the physical market.
Jeff's talked about the revenge of the old economy. Check out the full interview on Bloomberg.com and, of course, on the Bloomberg terminal. Here's the price action for you. Going into the opening bow, the cash open just around the corner, about 41 minutes away. We've got equities down by 1/3% on the S&P 500. On the NASDAQ, we're down by 0.5. Some problems with chips and memory stocks. These are the names that have run up aggressively since the March 30th low, the end of March, and that low up by something like 70% on the chip players going into Thursday, Friday, and the problems we experienced going into the weekend. We've got some negative follow-through on the NASDAQ. We're down by 0.6. In the bond market, yields high once again, notable. 10s at 462, up by 3 or 4 basis points at the front end, and on 10s, on 30s up by 3 to 515. That's the story in the bond market. Here's the story for the week ahead and the next couple of days. Wednesday, earnings from Nvidia and Target, plus in the mix. In the middle of that, you'll get some Fed minutes. Look out for that. Let's see if there's any more hawkish dissent within the minutes. Just some hawkish pushback to that easing bias of the Federal Reserve. On Thursday, results from Walmart, another round of jobless claims, PMI data in the mix as well. On Friday, main event, Kevin Walsh steps up to the plate, sworn in as Fed chair.
That's going to be interesting. First time at the White House since Alan Greenspan in the late 1980s. It's going to be really an interesting moment for the President of the United States because he has been jawboning Jay Powell. He wants lower interest rates. But just this week, he told Fortune magazine, basically resigning to the fact that it might take longer due to the fact that energy prices are higher, and saying we're going to have to see where the figures are when this war is over. And right now, Jonathan, we're in paralysis with the conflict in Iran.
That's the story for Friday. Let's talk about the big story out tomorrow. Nvidia earnings out after the close tomorrow afternoon. Jay Goldberg of Seaport with the loan sale rating and a street low price target on the chip maker. He writes, we think the semis market is going to be choppy in the near term. Nvidia remains constrained by high expectations and serious supply constraints. Jay joins us now for more. Jay, welcome to the program. What are you expecting tomorrow afternoon?
I think Nvidia will print a good number, but not a great number, and it'll be, it'll be good. People will be, won't be running for the hills, but I do think people won't see anything that will meaningfully alter the story or their outlook on Nvidia. The stock has been sort of underperforming the sector all year long. I think that will continue.
Jay, I would just love to get your read on what's going on with China. I was with the president on the trip. Obviously, Jensen Huang was a last-minute addition, picked up at the refueling stop. Do you think that this summit is going to be the breakthrough for Nvidia to be able to sell those chips into the Chinese market?
So I think there has been some progress.
It's up by some 65% over that period, Jay. What would it take for you to change your mind on this name?
So I've always positioned this call as an underperform. Like, I've never told anyone to go out and short Nvidia. That's obviously dangerous. But I do think Nvidia has grown so big and become so dominant that it's hard for it to sort of beat that, right? And we've seen that play out this year, or even longer, even late last year, where it's just underperformed the sector. We've seen a lot of these stocks run 50, 100% even in some cases this year, a lot of their peers and their competitors. And Nvidia just can't run like that. They're a good company, they have good products, but they're supply constrained. They're sold out for the year, and once you're sold out, how do you beat expectations, right? We all have a pretty good beat on what their supply chain looks like, and the limited scope to raise prices. Adding China to the mix will help a little bit, but in the grand scheme of things, there's not much upside to expectations here possible for them anytime this year.
Jay, with that in mind, is that why you think AMD might be the better opportunity in the sector?
Yeah, I think AMD is becoming a serious competitor to NVIDIA. Their upcoming product, the MI450, which is launching later this year into next year, is on paper very competitive with what NVIDIA is going to be offering. I think it's the first time we've been able to say that about AMD. They've always been close, but now they're fully competitive. And we have customers who can't get enough NVIDIA products, and so they're turning to alternatives. NVIDIA is effectively leaving a lot of money on the table, and that's opened the door for everybody else. And AMD is top of that list.
Jay, appreciate the clarity on that. That's important. Jay Goldberg there of Seaport. AMD, the preference here versus, say, NVIDIA, and that sell is not an outright sell, it's just an underperform within the sector. I think getting clarity on that is important when people see that lone sell call on that particular name.
And as you said, he's had that sell call for months, and the stock has just gone up double digits and absolutely carrying basically the entire equity market. But his point is, we know what the supply chain is, we know what their outlook is, and if they have no more chips to sell, then where's going to be the upside when it comes to this name?
At one point, we are up 20% in 7 days through Thursday last week, which is something close to, that's $900 billion plus, close to $1 trillion of market cap on that name.
I was shocked that the market just moved on the mere fact that he joined the president on the refuel stop to China to go on this trip to Beijing. But I guess the market viewed that as potentially this is an opening for that market for the H200s. NVIDIA was talking about at one point a few months ago, $50 billion they can get from China. And you heard there from Jay, he doesn't think it can even crack $1 billion.
That's the main event tomorrow afternoon, earnings from NVIDIA. Right now, as we count you down to the opening bell, about 35 minutes away. Equity futures still negative here and down by 1/3 of 1% on the S&P 500, down across the board, driven by moves in chips and memory stocks. That's going to be a feature of the story going into the cash open. The bond market's not helping out this morning. Yields are up across the curve. 2s are up by 4 basis points, close to 4.1%. 10s are up 3 or 4 basis points, north of 460, and 30s at levels we haven't seen in a couple of decades. You've got to go back to 2007 to see a 30-year at 515. 515 this morning and up by 3 basis points to the long end of the curve. Crude, stable, negative by 0.5 of 1% on WTI. Brent crude around 110, but the tension and the blockade continues, and that's going to keep those numbers up there. Coming up tomorrow, Keith Lerner of Truist, Monica Guerra of Morgan Stanley, Angelo Zeno of CFRA, and David Kelly of JP Morgan Asset Management. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox. That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, You're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Futures down 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, futures fall as yields flirt with 2007 highs and chip stocks extend declines.
From Meta to Standard Chartered, the AI push is reshaping workforces across industries.
And Home Depot's sales fall short as high borrowing costs curb consumer spending.
A down day, as you pointed out, but it's really the chip makers having another really bad run to start this morning. Let me show you what's happening in the pre-market session, because Micron and SanDisk are both down by 1.9%, almost 3% for SanDisk. A couple things going on, just higher yields pressuring everything in tech. And the winners, you also had the Seagate CEO saying that they can't meet all the demand that they have. But Matt, I would point to ServiceNow, that the software stocks are having a really, really good morning. In fact, most of them have been up for 3 consecutive days. So maybe this is all just a little bit of repositioning. You sell some of your winners, you cover your shorts. At least that's what some of the market action indicates.
Right, and get ready for NVIDIA.
That's true. Get close to the ground and just see what happens with NVIDIA.
Yeah. CoreWeave is moving as well. So you can see some of the NeoCloud stocks are getting hit after competition from Google, which agreed to create its own NeoCloud business, so to speak, with Blackstone. Meta is moving 7,000 jobs to AI roles as it restructures. Of course, that's separate from the 8,000 jobs it's taking out. And a check on NVIDIA ahead of tomorrow's earnings. Remember, that's after the bell tomorrow. So we have 2 sessions between us and NVIDIA, but you just heard on surveillance concerns that they're supply constrained and you don't really see any purchases coming out of China, so maybe they won't be able to beat and raise as analysts anticipate them doing.
It's the big event tomorrow and the last of the big earnings. Before all that, Bloomberg spoke with NVIDIA CEO Jensen Huang and Dell CEO Michael Dell about the growth rate of AI at the Dell World Conference.
We're going to be building this out for a decade, maybe more, because after this, digital agents will be physical agents.
Then we go to the physical AI. We haven't even started that. I mean, you saw some examples of that, you know, in the keynote, but that is a way bigger market, and it will require all sorts of new infrastructure and capabilities.
We're going to, for the very first time, bring IT to the world's 90 trillion other industry. And so there's a giant industry ahead of us to build towards. Now, meanwhile, the supply chain is more than doubling every year. I mean, it's probably quadrupling every year, but we'll still have a hard time keeping up with the build-out for at least a decade.
Bloomberg Tech co-host Ed Ludlow conducted that interview and joins us now. Ed, I guess it's the right kind of problem to have, the fact that you can't keep up with demand and capacity constrained.
Yeah, and you guys set it up really well for the print after Market Wednesday, right? That for quite a while, the street has had this beat and raise expectation for NVIDIA. But, you know, Jensen Huang couldn't be any clearer, right? That they are supply constrained. Demand is massively outpacing their ability to supply. And I tried to get a sense of how severe that is. The bottleneck is still memory chips, principally. And I guess the warning that he gave there is that even in a world where supply chain is doubling or quadrupling on an annual basis, it is still behind the pace of demand growth, which is like a nice position to be in ahead of earnings. How the market interprets it and swallows it in the moment, who knows? But China, still the big overhang on NVIDIA right now.
I was just showing, and by the way, we're going to obviously focus on NVIDIA throughout the program. You're going to on your program at 11, and then tomorrow it'll be like NVIDIA all day until the earnings come out. Then we'll do NVIDIA all day the next day with the reaction. I want to talk about the NeoCloud fight here, because we just showed shares of CoreWeave. They're getting hit today because Blackstone and Google are creating what, their own kind of neocloud business with Google chips?
Literally a neocloud that runs on Google TPUs. The neoclouds that already exist largely rely on NVIDIA GPUs. And it's as simple as that. So Blackstone brings $5 billion. There's a debt component where they fund this $25 billion of investment to try and bring 500 megawatts online. But neocloud is just a fancy term for a data center that is very specific for AI workloads. And what Google and Blackstone are doing is saying, hey, there's a really great market. There's a lot of interest in using the TPU technology. We can go out and compete with the likes of CoreWeave, which, as you're showing, down almost 5% in the pre-market. And given the performance of the TPU relative to all the other AI chips that are out there, the market's clearly taking this seriously as a threat to those existing neoclouds that have largely NVIDIA-based architectures.
All right, Ed, very much looking forward to your coverage and looking forward to chatting with you after we get those earnings as well. Bloomberg Tech co-host Ed Ludlow after his exclusive interview there with Jensen Huang and Michael Dell. Staying now with AI, Standard Chartered Bank plans to eliminate around 8,000 jobs by 2030 in an AI push, with the CEO saying the company is replacing, quote, lower value human capital with the investment capital we're putting in. Let's discuss the AI jobs market, or the jobs market and its the effect of AI with Bloomberg editor Tom Metcalf. And Tom, first off, it's a pretty harsh way to describe your workforce. Is he going to get pushback for this?
Yeah, it's really fascinating to see that word, and it's probably getting more attention than the actual substance of the 8,000 job cuts, because, as you say, what is the message out there? And obviously, there's probably some nuance there. You might be referring to, a certain cut of the workforce. But if I was at Standard Chartered, that'd be my main takeaway. And I'm sure there's plenty of memes out there already. But I do think, that sort of semantics is starting to kind of emerge more strongly across Wall Street. So we saw Goldman have similarly kind of, blunt language on that front. And it's just a reminder of how much this job market has completely flipped on its head since sort of the post-pandemic period, where really now the sort of, the power sits now with the employers.
And is there any degree, I guess, which, I was listening to this interview with Peter Orszag of Lazard, basically saying that this time last year, what AI could do for banks, there's so many hallucinations, so many errors, but now the thing is really, really good. Tom, do we have any tangible evidence of not just this lip service of, we're hiring less people, we're firing people, we're going to switch to AI, and things like S1s completely being written by AI, or is any of this actually ongoing yet?
Yeah, no, I think it is, and you've got firms across the whole spectrum in terms of deployment, but there's plenty of banks out there that are transforming their workflows. I think the biggest point is right now where we are is still at a stage where you do want, at least for most of the data that banks are deploying out to clients and stuff, you want that human kind of eyeball on it, just because the sort of the potential risks of getting it wrong is still too high. It's not reliable enough yet. But that's probably the most interesting thing about today is, for me, Standard Chartered's the first bank out there to really give quite an explicit, hard target on this sort of thing, rather than just say, hey, we're going to sort of expect to see kind of a move towards more technical staff and less kind of routine mechanical back office staff. And I think that's the fascinating thing about this technology is, we're not talking in years and years, we're talking months, sometimes even weeks in terms of big changes. So certainly everyone I speak to, it's kind of, the thought in terms of how to run your organization. But right now, I would say Standard Chartered definitely being the boldest in terms of how they're going about it.
All right, Tom, thank you very much. That's Bloomberg's Tom Metcalf. Elsewhere in earnings, Home Depot reported this morning sales missed as muted housing demand and higher borrowing costs limit consumer spending. Bloomberg's Matthew Griffin joins us now. I guess it's one of the sore spots in consumer, low income and anything related to housing right now.
Yes, and Home Depot's report underscores that these pressures just aren't letting up. So you look at comparable sales. This is a key growth metric for the home improvement retailer. Growth there was 0.6% year over year. Wall Street analysts were looking for 0.9%. And the problems, again, are the same ones that have faced Home Depot for several quarters. Interest rates are high, and so are housing prices. This means consumers don't want to undertake big remodelings that might require financing. They aren't buying new homes and undertaking the projects that go along with that. And so expectations were low coming into this report. Again, this has been a problem for a while, but it seems like investors were still disappointed here. Shares now down about 1.5% in the pre-market.
Matthew, I filled up my Dodge Challenger Scat Pack wide body yesterday with gas at $6.38 a gallon. It was over $110. Is that going to affect the outlook for Home Depot in this quarter?
It absolutely could. It seems like it hasn't affected results so far. So the company's CFO said consumers aren't changing their spending behavior, and also that it's unclear so far how much they're going to have to raise prices. That being said, if you look at the effects of the war, consumer sentiment falling, high gas prices have a lot to do with that, and mortgage rates rising. I mean, that just adds to sort of the perfect storm of problems for a company like this. And again, it seems like investors don't think they're going to catch a break anytime soon. Shares down already about 21% over the last 12 months.
All right, Matthew, thanks so much for joining us. Matthew Griven there covers Home Depot for us on the print side. Check on markets right now. We're looking at futures that are lower. Not a huge drop, right? 0.5% lower on futures. We closed yesterday at 74.01, so just 100 points under the all-time high, if you lock that in your memory, of 75.01 last week. We do see the 10-year yield continuing to push higher, and the higher it goes, you're more likely to see the drop get bigger in equities. So right now, 464, 465 if you round up on the 10-year, and I think investors are paying even closer attention to the long end, right? And we got over, I think, 516 on the 30-year. Yeah. Brent crude right now at 110.44, so it's actually off $1.66, but the relationship has been the higher you get in crude, that drives yields higher and that hits stocks. Well, finally, it's starting to hit stocks a little bit harder.
And now that 30-year yield is at the highs for the year. Some of the other single-name stocks that are on our radar this morning, StubHub is surging on a Guggenheim upgrade to buy as its 2026 numbers look strong. Shares up more than 5.5%.
So gas prices not hurting high-end ticket buyers. Amer, they really
it's like America.
I know, but they just need to change it a little bit. Amer Sports raised its full-year guidance. It's a serious company, right, with Salomon and Wilson. Demand for shoes is jumping, and that's helping the company in the pre-market up. Shares up.
Arc'teryx, is that how you pronounce it? Arc'teryx.
Arc'teryx, yeah.
I feel like the finance bros like to wear their vests.
Yeah, it was very trendy for a while.
Is it not anymore?
Stad. I'm not sure lately. I haven't been to Switzerland for a while.
Elsewhere, DeFi platform Hyperliquid is surging. The SEC is said to ready plans for trading crypto versions of stocks. So there's your 24-hour stock trading getting ready for you.
Coming up, President Trump says he called off news strikes that he had planned on Iran after Gulf allies pushed for more time for diplomacy. That's next. This is Bloomberg Open Interest.
Are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1, 2, 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, 2, same way, 5, and 6. So this is 1 through 6.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Let's get to high interest. Look at what's making headlines around the world after attacking billionaire second homeowners and clashing with Wall Street executives. New York City Mayor Zoran Mamdani is meeting privately with top finance leaders, including J.P. Morgan's Jamie Dimon and Goldman Sachs's David Solomon. The talks come as his tax proposals face backlash from billionaires and real estate leaders, whom those other two guys know pretty well. Long Island Railroad trains are set to restart today after New York Transit officials and union leaders reached a tentative deal ending an historic strike. Limited service resumes at noon on 4 major branches with full system service expected by 4 p.m. New York Governor Kathy Hochul says the agreement avoids new taxes or fare hikes after nearly 300,000 commuters were stranded, some of them probably fairly happily. The New York metro area now ranks ahead of Miami and Houston for the most homes vulnerable to hurricane winds. A property analytics report says that over 3 million homes in the region face moderate or greater risk, amounting to nearly $1.93 trillion in reconstruction costs if we did those reconstructions. Experts warn the Northeast lower storm preparedness makes rare hurricanes even more dangerous for our residents. Danny?
That's not great. Anyway, let's turn to one of our top stories this morning. President Trump pausing a planned strike on Iran, saying Gulf allies wanted more time to pursue diplomacy. In a Truth Social post, Trump also warned that warning Iran that more military action could follow if no deal is reached.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
Joining us now is Bloomberg Washington correspondent Tyler Kendall. Tyler, the president saying they're putting off any planned strikes, maybe forever, maybe temporarily. What do we know about the thinking behind this?
Well, Danny, at this point, as you mentioned, the president says that escalation still very much remains on the table. He went on in that post on Truth Social to say that he has told his national security team to be ready at, quote, a moment's notice for large-scale strikes. At this point, we haven't gotten any further details from the White House when it comes to these plans, though President Trump has long threatened that we could see renewed military action, though he's yet to take that step yet, as he maintains that a diplomatic solution is still a viable option. I will point out that our analysts at Bloomberg Economics say that it is becoming increasingly likely that the White House could revert to short and intense strikes in a bid to change the gridlock and the status quo, amid reporting that President Trump has been advised in recent weeks that limited strikes could help pressure Iran to reach a deal, because at this point, the latest is that both sides are rejecting the freshest counter proposals from each one of them, right? We have Iran really maintaining that they don't want to discuss any curbs around their nuclear program, while the U.S. says that its naval blockade isn't going anywhere until a deal is reached. In fact, we got an update just yesterday from CENTCOM confirming that so far the U.S. has redirected 85 ships in the U.S.'s attempts to secure the Strait of Hormuz.
Hey, I want to ask about the fund that I guess President Trump's lawyers have set up with the Department of Justice, $1.8 billion in taxpayer money that will go to people like the January 6th attackers, whom the president pardoned. How does this administration justify that when so many Americans are struggling with high gas prices, struggling to pay for child care, struggling to pay for medical care?
Well, this is a point of criticism that we are hearing raised when it comes to this fund. I liked how the Wall Street Journal put it this morning, saying that it was big on money and symbolism, but so far it's pretty small on specifics, Matt. So we're still waiting for more information on exactly how this fund is going to work, but it is part of President Trump's settlement with the IRS over a $10 billion lawsuit linked to the leaking of his 2019 of the leaking of his tax returns back in 2019. You'll recall this was a big data breach that happened and included many wealthy Americans, not just President Trump, but also Elon Musk, Jeff Bezos, people like that. At the end of the day, so far what we've heard from the Attorney General is that this is set up to be the anti-weaponization fund, to formalize a process to address the claims of those that have suffered alleged weaponization. It is set to end just a month before President Trump is set to leave office in 2028. We'll have to see where it goes from here, but the criticism is coming particularly from Democrats who are alleging that this is a slush fund. We got this statement yesterday from House Democrats saying in part, quote, "This is pure fraud and highway robbery." At this point, we should say an agreement. Under this agreement, President Trump would not receive any money directly, but the mechanics appear most likely to benefit those allies of his.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall back from her trip to Beijing and reporting live from Washington, D.C. Coming up, Jay Hatfield explains why he thinks the S&P 500 could, in the best scenario bull case, hit 8850 this year. That would be a 30% gain from the close in 2025. This is Bloomberg Open Interest.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
To the minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Our next guest says that the S&P 500 could top 8,850 if the 10-year yields fall and earnings stay elevated. Infrastructure Capital's Jay Hatfield does note that for this bullish call to play out, they would need 10-year rates nearing 4%, and I'm so pleased to say that Jay joins us now. So 8850 bullish case. Is 8,000 still your base case, John, for the Jay, for the S&P 500?
It is, and you know it's critical. I just booted it up on my terminal to keep watching 2027 estimates. So when we did our target, they were at 350. They're now at 385, so they're up 11%. So we've kept, for the upside target, 23 times. But to justify that, if you do a DCF, you really need rates to be about 375 to 4. You know, because there's an inverse 10-year rates. There's an inverse relationship between multiples and rates. But what's great about that is even if the strait remains closed and rates are elevated, you can still justify a 21 times multiple. So 8,000 in a way is our downside target, and that's all driven, of course, by this huge AI boom and the associated increase in EPS estimates.
By the way, Jay, I'm just looking. Shout out to my buddy Tommy. Just sent me a message. 30-year yield just moved above the high in 2023, highest since 2007. So the 30-year Treasury at 518 essentially. It used to be that like we said 5% will bring the buyers in, but now it's like either we have a much higher yield, or you get a Middle East de-escalation, or you get evidence that inflation's cracking. Like, what brings yields back down?
Well, actually, what's interesting, as you know, we follow MIPR, so that's the future Fed funds rate. There's a very reliable relationship that's about 100 over that. And the 10-year, we focus on the 10-year because it drives the 30-year mortgage, has actually outperformed that. So it's really only about 80 basis points over. So there's been flows maybe from overseas, safe haven. But so the 10 years outperformed what you would have expected given this huge bearishness in the Fed funds futures market. So the Fed fund futures market is assuming an increase, which we think is ridiculous, but true. So the 10 years actually pretty well behaved, but the bad news is it could trade off into the 4.85% range. That obviously put pressure on the stock market.
And your target, I mean, you need rates to be 4, and we're going like, we're getting towards 1% in the other direction.
Right. Or to get to 21 times, you'd need about 450. So if we sell off to 5, that could be a problem. So we do really need the strait to be reopened to probably resume the rally that occurred in April.
All right, you're going to stick with us because we're going to talk more about this. I will say that in the past, when you've come on with really bullish targets, we've thought, wow, Jay might be crazy. And then they keep hitting. So that's why we keep having you back on. You've been right. Not just that you're smart, and also you have great data. Jay Hatfield's going to stick with us throughout the opening bell. We are looking at futures that continue to move lower as yields move higher. So right now, S&P futures down 0.6%. But remember, we still closed at 7,400 yesterday. The opening bell on the other side of this break.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Dani Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at equity index futures that are lower and continuing to fall further as rates climb. We just saw the U.S. 30-year yield rise to the highest level since 2007, which, you know, when I first heard that stat, I thought, okay, that was almost 20 years ago, but it wasn't that long ago. The point is that was before the great financial crisis. We haven't had rates that high since then, and there's a generation or two of traders who've never seen this before. So S&P futures, NASDAQ futures down, and the tech companies getting hit even harder. We have a decidedly untech company ringing the opening bell at the New York Stock Exchange, Kava. This is the Mediterranean
slop bowl.
So I wasn't going to say that. I still haven't tried it, but I'm sure it's delicious.
It. I love a slop bowl, not gonna lie.
Well, and their stock, I mean, you know, I look at a 5-year period, that's my default.
Sure.
It's up 260% in 5 years.
That's pretty good. I feel like it hasn't been doing well.
No, it hasn't been doing much. It's been down and flat, but over 5 years, pretty damn good. Here we have MKS ringing the opening bell at the NASDAQ market site, and they provide a whole bunch of gauges and valves and capacitors and stuff that I don't understand. Jay's kid, who just graduated in electrical engineering from Penn State, he knows.
I'm sure he does.
But it's like they have gear to make semiconductors. Is it Penn State or Penn? Penn. Sorry. I guess that would be an insult.
Yes, it would.
Right?
Both wonderful schools. Slightly different schools, though.
In any case, they make the stuff for semiconductors, so they're up 85% year to date.
Wow.
Yeah.
Again, it's all these random companies that you've never heard of that are big AI trades like Boilermakers, MKS, or whatever they were. I'm looking at companies that are decidedly tied to the AI trade. Chip makers are down today, as they have been over the past 2 trading sessions. Micron and SanDisk down 0.5% for Micron. SanDisk is down 1.5%. That's not as bad as we saw pre-market, to be fair. But what is sticking is, for whatever reason, software companies are on a huge tear right now. They've been up for the three consecutive sessions. Today makes it 4th. ServiceNow up 3.5%. No clear catalyst, maybe just some short covering after this big run-up you've seen in the AI stocks, Matt.
All right, it's a little bit of a rotation there. Obviously, the semiconductors have had their day. Let's talk about CoreWeave moving after competition from Google, which agreed to create its own AI cloud business with Blackstone. So you see CoreWeave to the downside, off 4% in the cash trade. Meta moving 7,000 jobs to AI roles. So I'm not talking about firings here, although they are going to fire thousands and thousands of people. Anyway, the stock not reacting much, down 0.6%. NVIDIA, obviously, we just want to look at it ahead of the earnings, which are tomorrow after the closing bell. So we have 2 more sessions between us and NVIDIA, the all-important NVIDIA earnings. Right now, it's pretty flat. Joining us, or coming back to us right now, is Infrastructure Capital CEO and CIO Jay Hatfield. And Jay, let me just ask you, as you've been to so many graduations lately, congratulations on that. What do you make of all of this AI taking our jobs news? Because it does seem to be happening, right? And is it a concern for the economy? Because yesterday, Veronica Clark on Surveillance said she thinks the Fed could cut rates 3 times this year because the jobs numbers will look so bad this summer.
We don't agree with that. The key driver of jobs is investment. And obviously, you have tremendous investment coming from the hyperscalers. There's going to be a lot of job churn. You know, if you mention AI at a graduation, you get booed. So it is making it harder. My son does not have a job coming out of Penn. And that's because these huge companies are laying off people. But that's not the overall job market. I mean, we all obsess about it because it's our kids or friends. But the big job market is all those jobs building these hyper scaling situations, building power plants, building chip plants. So that's really the key driver.
He's an electrical engineering graduate. He should be doing just that.
Yes, he'll be fine, but it is creating a churn and dislocation, and that's why you should not mention AI in your graduation speech.
Well, I mean, I've made this argument to Matt before, this idea that, yes, it creates jobs because you need to build these data centers, but they're temporary jobs. Once they're built, you need essentially, on average, I think it's about 50 people running the place. It's just, you know, some HVAC men and women, and if you put the same amount of money in the pharmaceutical industry, for example, you'd be creating 1,500 jobs per data center. So it feels like maybe here and the now we're okay, but long term, is this a very different labor market we're going to need to contend with?
Well, there's going to be tremendous reallocation among job categories. But if you look historically, the only thing that's caused unemployment is a severe contraction in investment. So as long as the investment boom continues, there will be growth in jobs, and the market will clear. So obviously software engineers are going to be less needed, maybe hardware engineers more needed, other job categories. So there's going to have to be retraining. We have a very dynamic job market in the US. Think we're not Europe. And so people will adjust and the market will clear.
By the way, this idea that we're going to keep spending and going to keep building out, I understand the thesis. It makes complete sense considering that we are so far under the capacity for compute, for energy, you name it, that we need. But don't these hyperscalers and all the big companies have every incentive to find efficiencies? Is this not how this ultimately ends, that the scarcity economics gets flipped because we figure out some way to bend time and space?
Well, I think the productivity is spectacular for investment. And if you really just look at Silicon Valley, you get big layoffs from the big companies, and guess what? It creates startups. So there's always new jobs, market's dynamic. If technology created unemployment, then we would have mass unemployment because of the steam engine being developed. So those are all irrational fears, but it is not great for graduates right now, and you do have to monitor the job market and be dynamic.
By the way, your calls have been so spot on over the last few years when there have been a lot of fears, rational or irrational, right? A lot of them, you know, politically influenced. If you have TDS, right, you wouldn't have thought that this market is going to climb so far so fast. How do you do such a sober analysis of these markets when you have things like, you know, ridiculous tariffs or maybe a botched invasion of a Middle Eastern country leading to the closure of the Strait of Hormuz? Like, how do you separate that stuff?
Well, you have to look at economic history. So everybody who's on television implies that recessions are created because the consumer stumbles, but that's not the history. Recessions are created from the investment side, and that's why we're bullish on the economy. Is if you look at first quarter GDP, construction and housing in a pretty significant recession, but the tech business is booming like it's never happened before, up 15%. That's why even if the strait remains closed, we're projecting 2.5%. But you have to be laser focused on the things that matter: money supply, oil prices, and investment. If you just focus on that, you won't make these bad calls like, oh, the consumer is going to roll over because of student loans. And you'll recognize when we are going to have recession, you know, if the Fed raises rates, we don't have a tech boom, and housing crashes, we're going to have recession. That's 13 out of 14 recessions are created by that dynamic.
All right, Jay, thank you so much for joining us. Great to have you in studio. Infrastructure Capital CEO and CIO, Jay Hatfield. Let's get a check on your equity market because we're still down, but I just want to mention there is some very clear dip buying going on in the AI names, the chip makers, because before Micron was one of the worst performers in the S&P 500. Look at where it sits now, up 2.5%. It's helping to lift the index up by 2 points, as is Apple this morning. NVIDIA also turning around after earnings, before we'll get their earnings tomorrow. AMD, Microsoft, and then I pointed this out before. All of these software names are oddly having a really good day. Salesforce, ServiceNow, Intuit, all up at least 2%. Though we are still still down because you have a lot of these big mega cap stocks down. Amazon, Alphabet, Broadcom, Tesla, Meta, those are down. So a lot of the Mag 7. Home Depot falls after its earnings with a weak housing sector weighing on their results. If you look at the indexes, the only one that's doing better is Infotech. And that's because of, again, and utilities now, because you have twofold. You have some of these chip makers turning around, and the best performer in the S&P 500 is ServiceNow this morning. So software names doing well. Utilities, real estate, energy, those not doing as poorly. At the bottom of the pile, you have materials and consumer discretionary. Matt.
All right, interesting moves there in this market as we look at the 10-year yield eclipsing 465, the 30-year yield up over 517. Coming up, Jensen Huang expects Chinese authorities to eventually allow the import of AI chips from the U.S. More from our exclusive interview with him and Michael Dell next. This is Bloomberg Open Interest.
We are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel and energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with a debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Just over 10 minutes into your trading day, let's look at the top calls, what the sell side is saying this morning. First up, CFRA, they are cutting Citigroup and Bank of America, saying that the Iran conflict could hit consumer spending and loan growth. CFRA says Citi's big run and strong first quarter make future upside harder. At the same time, Bank of America faces risks across lending, commercial real estate, and consumer activity as costs rise. The entirety of the banking sector is off this morning, but not by huge amounts. Next up, Guggenheim has upgraded StubHub to a buy, saying expectations for this year are too low, and even small wins in direct ticket issuance or advertising could drive upside. The firm also says that worries around regulation are starting to fade. Shares up a nice 5.7%. Finally, analysts are positive on Amer Sports. Oh, you're right, Matt. That is a tough name.
It's tough.
Amer Sports. They raised full-year guidance on strong demand for Salomon and Arc'teryx brands, Citi highlighting a sharp outdoor margin rebound. Evercore called it the strongest earnings delivery in the sector this season. I get it's supposed to be America and like Amerisport, it doesn't work.
If they said Amerisports.
Oh, Amerisports, that is what it should be.
You know, if they just add an I.
Yeah, Amerisports, that's way better.
In the middle. In any case, I doubt they're going to change it anytime soon. And it has, as we said, some really fascinating and sought-after brands. NVIDIA CEO Jensen Huang told Bloomberg that China will eventually open its AI market to U.S. chips in order to sustain growth. A little bit of wish casting there. He spoke with Bloomberg's Ed Ludlow alongside the CEO of Dell, Michael Dell, at the Dell World Conference in Las Vegas.
The president wants America to win everywhere. Right. The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and to explain very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jesse, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200. Right. I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place. But I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
Let's discuss with Bloomberg senior technology editor Mike Shepard in D.C. And Mike, this has been fascinating to follow because first the U.S. said China can't buy any of our chips on national security grounds. Then the Trump administration said if we get like a 25% cut, we'll allow sales of certain chips. Then it seems like in the meeting with Xi last week, they decided to allow those certain chips again, which still confuses me. And the whole time China is saying, we're not buying them. So how does this end up?
Well, that is a great question, Matt, because heading into this meeting, one of the big unanswered issues was whether China would actually start allowing the imports of H200 chips that President Donald Trump had cleared at the end of last year. And early this year, the Commerce Department had even issued licenses for. And yet on the Chinese side, while there are signals of possible demand, authorities there remain wary of allowing those chips in. And there are two reasons. One is obviously, and it echoes the concerns here about Chinese technology, they are worried about security. Could this be some sort of backdoor for American technology to perhaps even spy on China? But more broadly, they are concerned about trying to protect their own domestic chip-making industry. And Matt, we're talking about companies like Huawei, like Cambricon, like SMIC, which have their own chip ambitions. But then on the other hand, you also have AI hyperscalers in China, like Baidu, like Alibaba, that also would be eyeing compute power, just like the AI companies here in the U.S. are trying to get as much as they can, as quickly as they can, and they don't really care as much about where it comes from. And that is what Jensen is getting at during this interview. He is saying that, look, the market demand on the AI hyperscaler side in China will be so strong that it will simply drive the market to allowing more of his company's chips in. And Matt, this is an important question for NVIDIA. Jensen Huang has previously identified it as a $50 billion opportunity for NVIDIA in China. And we'll be hearing more about it, no doubt, tomorrow after the earnings.
Well, speaking of the crunch around compute, Mike, it's a problem that everybody is throwing money at, including Alphabet and Blackstone, and a new deal that was announced yesterday. It's having an impact. It's selling CoreWeave. Some of the neoclouds are selling off. What exactly does their partnership look like? What is it looking to solve?
Well, the partnership between Alphabet and Blackstone, they are really looking to accelerate this build-out. They are seeing the need for compute, and they are seeing an opportunity. And also, when you think about the two teaming up here, this is a question of scale. Blackstone is one of the biggest investors already in this space when it comes to data centers. And, of course, Alphabet is one of the biggest kids on the block. And they, as a longtime cloud computing provider, also have a little bit of a legacy edge. And of course, their DeepMind and Google AI technology is driving a lot of this. So in a lot of ways, this is a match that looked to be written in the stars, Danny, and then we will look to see more about how this develops. And remember, they are trying to do this investment in the face of growing skepticism that you were talking about in the last blog about job impact and also about what data centers are going to mean when it comes to cost of living here. There is a tension here in the U.S. about the impact overall of the AI rollout.
Hey, Shep, thank you so much for joining us. That is Bloomberg's Michael Shepard. Coming up on the show, G7 finance chiefs pledge not to overdo any fiscal aid as the Iran war raises growth and inflation risks to the global economy. We're going to get the latest from Paris. That's coming up next. You're watching Bloomberg Open Interest.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Treasury Secretary Scott Bessent is calling on G7 nations to increase sanction pressure on Iran. They are currently meeting in Paris, where Bloomberg chief European correspondent Oliver Crook is there and joins us now. Oliver, I mean, it's a precarious situation that the G7 finds itself in, where budgets are tight, deficits are high, and yet there's this pressure from Iran and higher energy prices.
Yeah, I mean, that's a very uncomfortable equation before a lot of these central bank governors and finance ministers who are all gathered here in Paris at the French finance ministry, and that's really been at the center of the discussions. I think at the end of the day, it's very difficult for everybody, even the most sort of sophisticated economists, central bank governors and finance ministers, to really know what to make of it, because they just don't know how long this war is going to last. But I've just caught up with the president of the Bundesbank, ECB Governing Council member, saying that, listen, we're now 3 months into this war. It's very clear that this is something that is here to stay, and that is something that we're going to need to factor into the rate path ahead of us, and really indicating to us what I think the market is already priced in, that it's very likely that you're going to have to get a rate hike here from the Europeans. But Danny, you point to something else. It seems that there are all these conversations happening. There are these two wars happening, oil elevated to $100 a barrel, you have fiscal space completely constrained, and it seems now all of a sudden the bond market has woken up to this fact, and you're seeing it represented across yields across the G7, where you're seeing the highest yields you've seen basically since the financial crisis, and in some cases since the late 1990s. And meanwhile, you have equity markets in the United States completely parabolic. And I asked the central bank governors, you know, what do you make of this situation? And all they were able to say is that it actually is quite uncomfortable.
What are they prepared to do about it, Oliver? You know, there's been talk about the potential for G7 for concerted intervention, right? Which may make sense if you have the highest long rates in some cases 30 years. So have you heard talk on the edges of that conference about the potential for a concerted intervention here?
I think we're not there yet, Matt. What I think, though, is very interesting is that you're talking about the G7, which is a format that was really originally defined by the G6. And this was something that was rolled out in the 1970s. And one of the things it was rolled out to do was to deal with the global oil shock from the 1970s, right, in collective action at the G7 level. And that is basically some of the sort of theory behind the architecture of foreign policy and the sort of American-led system that has really led the system for those 50 years. But that system is now over with the Trump administration. Right? So there is not very clear appetite to act at the collective level at the G7. For the French who were hosting this meeting, they went to great lengths to try to sort of frame all of these discussions in a way that they could get a communique at the end that the United States sort of signed off on. But it's not clear that there is appetite for that kind of coordinated actions. That being said, there have been a little bit of conversations at the margins here. No one is ready to do this yet, but I spoke to the French finance minister who said really one of the things they could do at the G7 level, and they're not ready to do so again, is to release potentially oil reserves, but that's not really actively in the conversation, though they did do that at the beginning of the crisis.
All right, Oliver, thanks very much. Oliver Crook, they are coming to us live from Paris at the G7 meeting of finance ministers. Coming up in the next hour, Raquel Oden from HSBC talks about fund managers boosting stock allocations to the highest levels that we've seen in years. And the CEO of Williams talks energy infrastructure as the Strait of Hormuz remains closed. Plus, Zach Brown from McLaren joins us at the desk as his drivers and engineers make great improvements in F1.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt. It seems to me if they
if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
ABC News. I'm Sherry Preston. As Attorney General Todd Blanche appears before a Senate Appropriations Subcommittee, there are continued questions about the legality of the fund that's been set up to help those the Trump administration says were unfairly targeted by the Biden administration. The ABC national correspondent Stephen Portnoy with more from Washington.
Under the arrangements made public by the Justice Department, the $1.8 billion settlement fund will be controlled by a 5-member board appointed by the Attorney General, with one of the members recommended by congressional leaders. The members can be removed by the president for any reason. Their decisions will be final, with no appeals allowed. The disbursement of taxpayer money is to be kept confidential, with the names of recipients provided only to the Attorney General.
Treasury Department's top lawyer resigned hours after the announcement of the fund was set up as a stipulation of the president dropping his $10 billion lawsuit against the IRS over leaked tax documents. The investigation goes on into those believed to have shot and killed 3 people at the Islamic Center of San Diego on Monday.
Sources tell ABC News that investigators are looking at those 2 teenagers, Kane Clark and Caleb Vasquez, as the suspects in this shooting. Police said after they got that warning call from one of their mothers, they were searching all over San Diego. They sent officers to a mall, even to the high school of one of the suspects. They were still searching for that vehicle when they got the call about shots fired here at the Islamic Center.
ABC's Trevor Ault in San Diego. Health officials around the world are monitoring the Ebola outbreak in Central Africa. ABC's Faith Abube is at the CBC.
The rare variant of the virus is suspected to have killed at least 131 people so far, and doctors are monitoring more than 513 suspected cases in Congo. A few others also reported in neighboring Uganda.
An American doctor working in the Republic of the Congo testing positive, but there have been no cases on U.S. soil. Oil trading internationally at $110 a barrel, and the Dow is down 91 points. This is ABC News. In the land of oil, the sun breaks through.
Electricity generated by solar farms, some spreading thousands of acres, is expected to surpass coal for the first time this year within the power grid that covers most of Texas. Natural gas remains the dominant power plant fuel, but solar's share has increased from 4% to 12% since 2021. Considering the Trump administration's new restrictions on wind farms, solar may soon catch up to wind as a force behind Texas electricity. Jim Ryan, ABC News, Dallas.
A mega utility merger is being proposed that would combine NextEra Energy and Dominion Energy. Both companies have customers from Florida up through Virginia, many of them seeing their rates jump as a result of new AI data centers. Here's ABC's Sophie Flay.
President Trump recently got tech companies to pledge to pay for infrastructure upgrades to protect customers. Democratic Senator Adam Schiff claims that doesn't go far enough. He's proposing a new bill.
What the bill would do is it would say to data centers, bring your own energy and make sure that when there are changes in the grid that are necessary, that you pay for those changes.
NextEra says the scale and efficiencies brought by its merger with Dominion will result in more affordable electricity for our customers in the long run.
Others are questioning that claim. A new survey by Lending Tree says 39% of Americans find owning a car unattainable when you take into account loan payments, insurance costs, and the rising price of gasoline. Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube. We're streaming live on Bloomberg.com as well. Coming up, we're going to check in with Tyler Kendall, Bloomberg Washington correspondent, get the latest news reporting out of the Middle East. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, to discuss her outlook for the markets. We're going to talk about the bond market. That is the story today. Caroline Hyde, BTech co-anchor, we'll get her thoughts on some of the leading stories in technology. I saw the Meta moving 7,000 workers into AI roles ahead of job cuts, so we'll get the latest there. Brendan Greeley, author of the book, The Almighty Dollar, 500 Years of the World's Most Powerful Money. And he's a contributing editor to the Financial Times. So join us here in studio to talk about that. Drew Redding, Bloomberg Intelligence home building analyst, give us the latest on Home Depot. They reported some earnings. So it's Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence program. Let's kick it all off with John Tucker, any Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by Eisner Amper. Most advisors tell you what happened. Eisner Amper tells you what to do about it. Assurance, tax, outsourcing, and advisory services built for businesses that can't afford to guess. EisnerAmper.com. A headline's crossing the Bloomberg right now. It's a red headline. That means it's important. NATO to consider Hormuz deployment if Strait not open by July. So let me go right to Brent, the international benchmark for oil. It's down 1.7%, still well above 110.18 a barrel. So as soon as we flush that out, we'll bring you more details if anything crosses. I also want to start with the yields near a 20-year high. And Paul, you mentioned this earlier, the John Authors column. He pointed out that the yield on the 10-year Treasury bond now exceeds the earnings yield in the S&P 500 to an extent that we haven't seen since the end of the dot-com bust.
Really?
So, you know, put that in your pipe and smoke it. Stocks right now, they are lower, but they seem somewhat immune to the rise in yields. The 2-year up 5 basis points, 10-year up 6 basis points, 464. The long bond 4 basis points higher, 516. The Dow right now down 140 points. S&P 500 45 points lower. The Nasdaq Composite Index down 257, and the Philadelphia Semiconductor Index, that is down right now 2.5%. Amanda Agati at PNC Bank, she says stocks, they can still push higher.
The underlying fundamentals and earnings season for Q1 just incredibly strong. Still, in our opinion, has a lot of legs left in this rally.
And Home Depot, do that real quick. We're going to take a deeper dive in just a second. Missing sales expectations. Lower housing demand, high borrowing costs, that all adds up to bad news. Home Depot down 0.75% right now. I guess this is all the rage, but Intercontinental Exchange, you know, they own the New York Stock Exchange, adding futures contracts for computing power. You'll recall that in Chicago, the CME did the same thing for compute futures contracts last week. Cost of running AI technology rises, so you have to, I guess you have to hedge against price swings. So this is a pricing mechanism and also something of a risk management tool for them. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Keeping cool. Scarlett and Paul.
Went to the beach yesterday. Could not stay on the beach. It was so windy.
Oh, yeah, that happens.
So you didn't even dip your toe into the water?
Yesterday, no. Today, I'm going to give it another shot. But I went in Sunday. But, I mean, yesterday was hot at the house. Go to the beach. Winds just whipping off the ocean.
Yeah.
So, anyway, we'll see how it goes today.
Yeah, so we have, you know, it's really hot in the metropolitan area. And then for Memorial Day weekend, it's going to be really cold.
Yeah, exactly. That's how we do it here in the Northeast. John Tucker, thank you so much. Appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Market Drivers today is brought to you by IBKR. Trade, election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest on your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Let's take a look at what's happening in the marketplace today. Stocks on the move. We do that with Matthew Griffin. Matthew, what are you looking at today?
Well, the first one I've had on my screen this morning is Home Depot. It is an important read on the U.S. consumer right now, and investors not taking it as a positive one. That stock ticker HD, now down about 0.9%. And if you look at comparable sales, that's a key growth metric for them. Growth there was just 0.6%. Analysts wanted 0.9%. And it's problems that have dogged Home Depot for a while. Interest rates are high. Housing prices are high. That means consumers, they don't want to undertake big remodelings that they'd have to finance. They don't want to buy new homes that they would then, you know, do home improvement work on. They're still painting, they're still gardening, but that's not nearly as lucrative. And although the company isn't seeing a big hit from the Iran war yet, it is easy to imagine that's going to show up at one point in results. And so you've got a pretty muted investor sentiment here. Shares down about 14% now year to date.
Yeah, so here's a counter narrative to the U.S. economy is doing fine. Consumers are, spending as they were. The high gas prices, the high borrowing costs, it's certainly starting to affect how people spend, and we're seeing that show up in some of these consumer companies. Let's talk about Micron, which has been such a superstar earlier this year.
Yes, well, Scarlett, Micron now extending declines into a fourth session. Shares down about 2.5% now. That's ticker MU. And there doesn't seem to be a key catalyst here. Investors are just retreating from risk, and they're retreating from these semiconductor stocks that are up so ferociously this year. Of course, these memory names have been some of the leaders in the advance, and Dan O'Regan, he's the managing director of equity trading at Mizuho. He said earlier it's basically just an unwinding of momentum going on here. Of course, Micron's still up 132% year to date, so that rally has not collapsed, but there are maybe some cracks showing.
All right. Okay, ServiceNow.
Well, ServiceNow, that's ticker NOW, may just be the opposite trade here. They are up about 4.5% and in a fourth session of gains. And these semiconductor software trades have really been opposites this year. Traders very optimistic until recently about demand for semiconductors due to AI, at the same time worried that AI will eat software companies' lunch. And so you see maybe some money rotating out of semis, and where does it go? It goes into these names where there are fears of AI disruption. So the AI trade may be taking a bit of a step back today. I was actually looking earlier, the correlation between software and semiconductor stocks in the S&P 500, though, still stands at the lowest since 1994 right now. So they really have, they're still opposites to an extent.
All right, Matthew, thanks so much. Appreciate that. Matthew Griffin, equities reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Let's get right down to Washington, D.C. Tyler Kendall, Washington correspondent for Bloomberg News. She's down there in D.C. Tyler, a lot of news coming out of your neck of the woods again here. It looks like most recently it was just NATO maybe trying to get involved a little bit here with the Strait of Hormuz. What do we know about that?
Well, Paul, this would be significant. A senior official with the military alliance telling Bloomberg News that NATO is discussing the possibility of helping secure ships' safe passage through the Strait of Hormuz. We should say that this has support from several members of the alliance, but at this point, not full unanimous support that would be necessary in order for NATO to deploy military assets. But it comes as so far the alliance has been wary at best of President Trump's calls to have allies help secure the Strait of Hormuz. We've often heard that many of them want to see a stop in the fighting, a stronger ceasefire in place, because I think it's fair to say at the moment the ceasefire is very tenuous and very fragile. Now, this would be significant, and it's going to put more focus on the annual NATO meeting that's happening in Turkey in July, because President Trump has ramped up his threat since the conflict with Iran has started that he could pull out of the NATO military alliance. So that may be easier said than done. Legislation passed by Congress in 2023 forbids any president from withdrawing from the NATO alliance without 2/3 of support in the Senate. But Paul and Scarlett, we know that it's straining the transatlantic alliance, and there's other things that President Trump could do. For example, he could recall the U.S. ambassador to NATO, or he could cancel American involvement in joint military exercises. So definitely something to watch.
Definitely something to watch. And as you pointed out, NATO had wanted to see an end to the conflict. And if anything, they have insisted that they only really want to be involved in the Strait of Hormuz once fighting has stopped. So the fact that they're now considering any kind of deployment if the strait's not open by July would seem to indicate that they're giving President Trump kind of what he wants, which is NATO stepping in to do more, isn't it?
Yeah, I think that's the right read on this, though. Again, we should caution that no decision has quite been made yet, but it does come as President Trump has been making this outreach to other countries, right? He just came back from his travel to Beijing. Right now, Russian President Vladimir Putin is in Beijing, so there's a lot of heightened focus here when it comes to alliances. So we'll see where it ultimately goes from here, because President Trump has previously fumed about how some members of NATO have rejected his calls when it comes to the Strait of Hormuz. Though, Scarlett, at the moment, the strait does remain effectively shut. Yesterday, we just heard from CENTCOM confirming that nearly 88 ships have been redirected by the U.S. who have tried to transit through the Strait of Hormuz. The U.S. says that its naval blockade isn't going anywhere until a fuller deal is reached with Iran. And at this point, we haven't really gotten indications that we are any closer towards that happening.
Tyler, the news on Wall Street today is the movement in the bond market. We have rates higher yet again today in the bond market here. Is there any sense that the White House and this president is sensitive to what's happening in the financial markets as it relates to perhaps this war in Iran?
That's an interesting question. We've previously seen President Trump be sensitive to the markets, right, Paul? When it comes to the oil market in particular, that we've seen the administration try to keep and tamp down rising fuel costs. Just yesterday, we had the Treasury Department announcing this new license for a temporary allowal to buy purchases of Russian barrels that are already loaded onto tankers and at sea to get more of the oil supply to the global market, because we know that the administration is coming under pressure from the market, but also from consumers and Americans as they head to the polls this week for a slew of primaries in a flurry of states, and affordability and the cost of living remains that top concern. Just yesterday, there was reporting from Iranian state media that the administration could be looking at lifting Iranian sanctions temporarily. Doesn't seem like that's happening. A White House official did dispute that report, but we're going to watch closely, as the president said when he was coming back from Asia, that maybe he would consider lifting sanctions on Chinese oil refiners linked to Iranian crude. So again, something to watch, but very clear that the administration has their eyes on this.
All right, very good. Tyler Kendall, thank you so much. Tyler Kendall, she's a Washington correspondent from Bloomberg News. She's down there in D.C. And again, the story, Scarlett's in the bond market today, just grinding higher. We're going to hopefully get John Authors in the next hour. He's got a good column out about what's happening out there in the bond market. But that's where the angst is. But equity markets are hanging in there.
I know. The contrast is really striking. And at some point, everyone says this is going to spill over into the equity market. But it hasn't yet. Just like the big moves we've seen in the bond market has not really enticed dip buyers either.
Yep, absolutely. So maybe it's the fact that you've got gangbuster earnings that we just reported, and some decent outlooks by corporate America. So we'll see how it plays out, but we'll be on top of it. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News, and with this Bloomberg Business Flash, it's worth recapping that headline we had. NATO discussing the possibility of helping ships pass through the Strait of Hormuz if the waterway isn't reopened by early July. Let's start with Brent crude, the international benchmark. That is down just about 1.1%. Still well above $100 a barrel, 110.78. Also, WTI is down about 0.5%, 108.12 on West Texas Intermediate. The long bond earlier did hit the highest level in almost 2 decades. Right now, the 30-year up just about 7 basis points. It's at 5.19. Then the 10-year will do that quote as well. That's 9 basis points higher at 4.67. And I mean, to oversimplify it, but its mortgage rates take their cue usually from the 10-year, and you know the drill. Higher yields could lift mortgage and corporate lending rates. Right now, in the equity space, 6 of the 11 major industry groups in the S&P 500, they are lower, led lower by materials stocks. And NVIDIA is going to report after the close of regular trading tomorrow. Those shares right now down 1.8%. After the earnings report from Home Depot and the sales miss there, the shares have actually turned around. Home Depot now up 0.3%. And the property analytics firm Cotality says more than 3 million New York metropolitan area homes are vulnerable to hurricane winds. That's actually the most of any region in the country. According to their 2026 hurricane risk report, 3.27 million homes in the area face moderate or greater hurricane wind risk, representing $1.93 trillion in reconstruction
More than
costs.
Florida, more than North Carolina?
Houston and Miami rank second and third at risk. This is according to the number of homes that are exposed to hurricane winds.
Yeah, okay.
There is, I mean, in my view, a simple fix to this. You know, mention you can go to Home Depot, buy hurricane clips.
Hurricane clips?
Yeah, you fix them to the top plate of the roof, to the roof rafters. And
this sounds like it's going to cost me a couple $100.
No, I mean, the clips themselves are like a couple of bucks.
No, but I can't
each.
get on the roof.
We'll get in the attic. You want it under the roof. That's where it goes. And just make sure you use the right nails.
Okay.
That have the shear
Anybody
strength.
needs that?
No,
John, you know where to find them.
I mean, it's a simple fix. And
Nails and roofs.
Yeah.
I mean, that's...
You
don't want me there.
I'll get some people for that. John Tucker, thank you so much. We appreciate that. Scarlet Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And again, as John was just mentioning, we got stocks on the move. We got bonds on the move. The 10-year Treasury up 9 basis points, 4 spots, 68. Ira Jersey, Bloomberg Intelligence out with a note. 30-year Treasury yield risk 5.44% target if key level breaks. So there you go. Margie Patel, she's been through a few cycles. She knows what she's talking about in these markets. Senior portfolio manager at Allspring Global Investment. She's up there in Boston. Margie, what do you make of this bond market here? Treasury yields kind of pushing higher to levels we haven't seen in some time. It seems like the bond market at least has some angst out there.
Yeah, that's true. That's true. But on the other hand, when you look at where inflation is right now, 3 to 3.5 to say 4.7% 10-year, I think isn't really a killer for economic activity.
Yet, if you look at just how the bond market is interpreting events versus the stock market, there's a pretty big divergence. At some point, are the two markets going to start seeing things more in sync, and who's going to give way first?
Well, I think in a way, because we have such an enormous amount of deficit financing to do, like many developed countries do, I think that says to me that interest rates for treasuries might be higher than you'd think compared to, say, the PEs or the dividend yields of stocks. So in other words, you could say, well, stocks look too rich compared to interest rates, but I think interest rates, the appropriate level of interest rates may be a bit higher. What's more important to me, though, is corporate profit margins have been very, very strong, and it shows companies have pricing power, so they have not been adversely affected by inflation, and that to me is a lot more key. Can they keep those profit margins rather than just do treasury rates move up a bit from here? I think their treasuries, are really a trading range rather than on a long trek to much higher levels.
Margie, where are you looking for performance in this market here? Is it some of the tech names that have reasserted their position in the marketplace, their leadership position in the marketplace, or maybe some other areas?
Yeah. Well, I think when you invest in the tech sector, the price you pay to make more than other sectors is you have to ride out these periods of volatility. We've had enormous volatility here, but it isn't because of fundamental bad news from those companies. In fact, we had the Mag 7, except for NVIDIA report, and they all reported really very good earnings, as the rest of corporate America does. So I think that it's more just traders. Also, we've had some IPOs come. We have some more large IPOs come. coming. People need to make room for those. And now you're in a kind of a news vacuum because you have only bad news about what's happening with the price of oil, except for NVIDIA, companies have all reported, so you don't have any new positive news. So I think it's natural that we'd see this sort of short-term trading correction rather than a fundamental revaluation of the tech sector. So I think it's just one of those short-term downturns that just the way the tech market is, the equity market is right now.
Margie, you are a senior portfolio manager. You also head up the capital allocation team at Allspring. What are you doing with your portfolio? How are you making adjustments or perhaps not making any adjustments?
Well, I think that looking at the bond weighting in the portfolio that I manage is really at a low point because I do think, one, in absolute levels of yields are low, spreads are narrow for corporates, and there is a chance we could see rates drift up. When you look at equities, it looks as if equities, the fundamentals actually look terrific. We had this last first quarter, we had 2% GDP growth, but we had S&P revenue growth of 11%, corporate profits 28%, record high EBIT margins. So that says to me we should disregard short-term changes in bond yields that go up and really look at equities as having the better return for the rest of the year. So we still think equities will finish the year at least well into double-digit rates of return. Bonds look really more like mid-single-digit levels for the year. So we think equities are still more attractive, even with a little move up in treasuries.
Margie, thanks so much for joining us. Really appreciate it. Margie Patel, she's a senior portfolio manager, Allspring Global Investments up there in Boston. We're doing that Zoom thing. Looking at the markets here, again, the sell-off in the equity markets. We got yields pushing higher. Let's talk a little technology. We can do that with Caroline Hyde, BTech co-anchor. She joins us live here in our studio. Meta cutting some jobs. I'm trying to read through the story here. My personal opinion is AI is a job destroyer, not a job creator. I'm going to stick with that one until somebody proves me wrong. What's going on at Meta?
Well, interestingly, to prove to the point, the one optimistic note I might on that last view of yours, MIT recognized a few years ago that if you look back over 60 years, I think it's even 40 years, only 60% of the jobs that currently are existing today didn't exist then.
Okay.
So there is hope that we find ingenuity in our lower value human capital. Language matters, folks. Language matters. I'm afraid a CEO who's going to talk out about eradicating jobs, up to 8,000 of them over at Standard Chartered, and calling it lower value human capital, that's going to hurt for the people out there, I've got to say. But by the by, I'm not in PR. I'm in a different type of communications. But the communications that we're getting from Meta is that tomorrow, folks are staying home. If you're working in North America, you sit at home because you're going to learn as to whether you're one of the 10% who are losing your job. That's about 8,000 people. But ahead of that, they're actually reassigning 7,000 people to more AI-focused work. So it's sort of a reassignment of the resources that they've got right now, saying that new jobs are going to be related to AI. So here's your new types of roles that you're going to be seeing more broadly, Paul. You're seeing people perhaps moving from the area of social media where they've lent into, and of course we've known that they've been moving the more hardware-related and augmented virtual reality play, and it's going more into augmented reality glasses, but into more apps and focus on artificial intelligence weaving itself throughout Meta's business model. So the chief people officer is just saying this is going to be a flatter ecosystem. This is going to be smaller teams. They think it's going to be higher value, more enjoyable work. We'll see what the talent think about that.
Yeah, absolutely. And I believe that there's this whole push towards smaller teams anyway across tech land. Everyone's singing the praises of this idea of keeping things really focused and concentrated.
Coinbase said that some teams will just be one person if you're an engineer.
That's not really a team.
I was speaking to a young fellow over the weekend, 29 years old, works in a very big tech company. He manages, I think, a team of like 5 or 6 people. He says his people with AI, now this is in the last 6 months, are much more productive. Not 10% more, not 20% more, 3 times, 5 times, 10 times more productive on some of their output metrics. It's just crazy. It's amazing, he says. And I said, okay, I get it.
Maybe if you're a solo engineer, maybe your team is AI.
And I'm just thinking, as a young investment banker, for the first 3 or 4 years of my job, that can all be done by AI.
Yes, you are very high-value human capital, Paul. Don't tell me that.
But having done that, you know how the process works, too. If you haven't done that before, like, you're not able to go in there.
Make me a high-yield pitch book for company XYZ, credit rating blank, boom. 2 seconds later, it's out.
Then how do you go through it and fact-check and know that it's correct?
Fact-check. Make me a pitch book for a high-yield deal would take me 2 or 3 days. Now it's minutes.
Yeah, well, the formatting will certainly be taken care of by AI. That's the most painful part of those pitch books. Caroline, while we have you, I got to ask you about Google creating an AI cloud business with Blackstone. Is this a joint venture of some sort?
It is, and actually Blackstone's putting in most of the money, $5 billion in equity. You leverage that up, it's going to be $25 billion perhaps. Wow. We're talking 500 megawatts of compute in the next few years. That's, what is it? 1 gigawatt is about 750,000 homes in terms of energy. So this is a lot of compute, but this is as they really focus in on their TPUs. This is their tensor processing unit. This is their chip that has suddenly made their AI so much more powerful and really impressed the market with vertical integration. Now, Google builds cloud. They build data centers, but that's expensive. It's nice to get a partner on side to be able to do that heavy lifting for you, not have to put it on your balance sheet as they're expanding out their Google Cloud offering. And they're setting up basically a new neo cloud. So watch the shares, the likes of CoreWeave, of Nebius, of these other neo clouds out there, because it's getting competitive out there, folks.
But Alphabet, are they turning to Blackstone because they need Blackstone as a funding source, or what? I mean, it's a cool deal for Blackstone. I'm wondering why Alphabet's doing it.
Yeah, I think it is the money side of things. Like Alphabet's already announced that they're going to be, what is it, all told, these 4 players, whether it's Amazon, Alphabet, Meta, Microsoft, are spending up to $750 billion, $725 billion, $750 billion, let's call it, in 2026. Yes, people have actually applauded Sundar Pichai's decision to up its capital expenditure plans, but it's still a lot of money. It's still a lot of debt that they've got to issue. And so it's nice to know that perhaps the financing of even greater expansion is being taken on by some other players. This is just managing to scale even further how much their TPUs and their chips are doing the work. I mean, I have to say, it's a big move ahead of NVIDIA's numbers tomorrow, because just think, all these other neoclouds, they use NVIDIA GPUs.
Yeah, this is definitely a play for NVIDIA's market, or at least carving up a little piece out of that market. Caroline, thank you so much. Caroline Hyde is co-anchor of B-Tech, which airs every weekday at 11 a.m. on Bloomberg Television. Be sure to catch her and Ed Ludlow then. I continue to kind of marvel at the move higher in yields, because this has been going on since Friday. Friday was really kind of the breaking point, and since then it's been inching higher, and in this case accelerating here with the 10-year yield now up 9 basis points at 4.67%. Paul, you were talking about the 30-year yield and how a lot of people are pointing out 5.5% could be within reach now.
Yep, absolutely, and that's not what people had on their bingo card to start the year. That's for sure. So rates moving higher. Today, at least, we've got the stock market moving lower with the S&P down 60 points, 0.8%. This is Bloomberg.
right, we are listening in to President Trump taking questions. He is at the White House ballroom construction site. Let's listen in.
You're talking about Cuba? Well, we're going to see. Look, Cuba's calling us. They need help. Look, Cuba is a failed nation. Cuba needs help, and we'll do that. Just hold them, though. It's like an exercise game. Give that to me. I'll hold it. It's so beautiful. See, I look so thin. They'll say, oh, he's gotten so thin because I'm holding this. You don't have to look at my waist. You can look at this. You saw enough of my waist along with President Xi.
Are you confident that you can reach a diplomatic deal
with Cuba? I think so. Yeah, I think so. I am very prone toward the Cuban Americans. They've been incredible people. Many of them have lost family members. They've been very badly hurt themselves. They've been in prison. They've come to this country and they've been very successful. The Cuban American people in Miami, I mean, they are amazing people. Most of them are in Miami, in Florida, but mostly in Miami. I'm very, very prone to helping them. I mean, I think I got 97% of that vote. I want to help them. Now, they have family members in Cuba. They've been treated very, very badly. They've been treated extremely badly, and we're going to get that solved. That's not going to be hard for us to solve.
You can do that without changing the regime.
Well, I don't know about changing the regime. I could do that, whether you change the regime or not. You know, it's been a rough regime. They've killed a lot of people, but it's a country that really needs help. It has nothing. They can't turn on the lights. They can't eat. We don't want to see that.
Mr. President, how much notice did the Gulf nations have? How much notice did the Gulf nations have that you were going to do these strikes before they actually called?
They called me over the last 2 days to say they made a lot of progress in it because we have them negotiating with us, and primarily Saudi Arabia, Qatar, UAE, Kuwait, a little bit, and Bahrain, and some of the others. And we have them negotiating with them. We're all working together. It's like a team. And Israel, of course, and Israel's been a great partner. And so we are negotiating together. I got a call from numerous of these people. They know the people in Iran. Don't forget, when you talk about regime change, I think it's the ultimate regime change because the first level and the second level are no longer with us. They're someplace, but they're no longer with us. So we have real regime change. But I got a call yesterday, sir, could you wait? We think we're close to a deal. And that's okay. Now, I've heard it before with these people, and they change their mind. I made deals with them, no nuclear. We immediately get the nuclear dust. And they said, you're the only one can get it because the bombers did such an unbelievable job that the mountain literally collapsed on top of it. They said us, and they thought China would be the only two countries that could even get it. But I think it's important to get it, maybe psychologically more than anything else.
Mr. President, today is known. How long did they know that you were planning the Gulf nations?
They knew I was getting ready to attack. I didn't tell them. I never tell anybody when.
You're in constant contact with
I never tell anybody when, but they knew that we were very close. I would say I was an hour away from making the decision to go today. And we would probably not be talking about a beautiful ballroom today. We'd be talking about that. And no, I had made the decision. So they called up. They had heard I made the decision. They said, sir, could you give us a couple of more days? Because we think they're being reasonable.
Mr. President, today's for Iran to come.
Well, I mean, I'm saying 2 or 3 days, maybe Friday, Saturday, Sunday, something, maybe early next week, a limited period of time. Because we can't let them have a nuclear weapon. If they had a nuclear weapon, they would start with Israel. They would blow it up, and they would blow it up fast. But they'd blow it up, and I'll tell you what, they go after Saudi Arabia, they go after Kuwait, they go after UAE, they go after Qatar, I think they go after the entire Middle East, and it would be a whole different negotiation. It would be nuclear holocaust. And there's no question in my mind that they'd use it. There's no question. And I deal with these people. They're extremely radicalized. These are not people like when I deal with you. You're a very nice guy. These are people that are seriously radicalized. They would use it. The only question, would it be the first minute, the first hour, or the first day?
How many pause a few times? Has there come a point where
I'm not doing this politically. I'm just, look, everyone tells me it's unpopular, but I think it's very popular. When they hear that it's having to do with nuclear weapons, weapons that could take out Los Angeles, could take out major cities very quick. When they hear that, you know, when they're explaining, I'll tell you what, when we explain it to people, I don't really have enough time to explain to people. I'm too busy getting it done. When they understand, I think it's frankly very popular, but whether it's popular or not popular, I have to do it. Because I'm not going to let the world be blown up on my watch. It's not going to happen.
Mr. President, today is the primary with Thomas Massey and your endorsed candidate. Yeah. Do you think your candidate can beat him? And what are you seeing?
Yeah, Thomas Massey's a terrible congressman. He's been a terrible congressman from day one. Dealing with him is just horrible. I don't think he's a Republican. I think he's actually a Democrat. He's not a libertarian. You know, sometimes they say he's really a Democrat. He votes against us all the time. He voted against the border wall. He voted against men playing in women's sports. He voted against transgender for everybody, the mutilization of your children. He voted against, again, open borders. We have the best border we've ever had right now. Nobody's coming in. I mean, a report just came out. In the last 11 months, literally nobody has been allowed into our country illegally. We're taking people legally. They go through a process. But nobody's come into our country. But we've taken out hundreds of thousands of people. We had 11,888 murders. Many of these murders allowed into our country from prisons. They were in prisons. Many of these people killed more than 50% killed more than one person. This was gross malfeasance. This was on behalf of the Biden administration. I don't know Biden because I don't think he knew he was alive. But Kamala was the border czar. She never called, not one time, she never called the Border Patrol. She never called ICE. She never called law enforcement. She never went to the border. Think of it. I used to call every single day. And that's recently. Now I call less. We have nobody coming through. We had caravans coming through with tens of thousands of people pouring into our country. We had no idea who they were. We would have been, I'll tell you what, our country would have been destroyed. If they won this election, our country would have been, we have now the hottest country anywhere in the world. If they had won the election, our country would have been destroyed. Our country was a dead country 2 years ago, and now we have really the hottest country in the world. And this is the ballroom, and it's going to be something incredible. You see the quality of it, and they go right, those columns go right into the roof. And on top of the roof, we're going to have the greatest drone empire that you've ever seen, and it's going to protect Washington. Thank you all very much. We have a little breakfast for you.
Really?
Yeah. Where is your breakfast? I'd have it. Where is it? It's right over there. We have a little bit of a breakfast for you. I figured it'd be nice to you for a change.
All right, the president taking questions and giving answers. At the construction site of the White House ballroom, he did make some comments about Iran, saying that the Mideast countries have asked for a few more days before the U.S. Would presumably attack Iran again, and so he's waiting on Iran for a limited period of time. We'll keep you posted if there are any further headlines. Meantime, we want to continue on with Bloomberg Intelligence, and we have a great guest right now. Let's talk about currencies, because people conflate a currency with the country that issues it, right? Like the US dollar equals the US and vice versa. But if you look at the history of the dollar, it tells us otherwise. Our friend Brendan Grilly has devoted years to studying this and based his PhD dissertation on it as well. He joins us now. And full disclosure, Brendan used to work at Bloomberg as a reporter for Business Week and as an anchor on Bloomberg Television, hosting Surveillance with Tom Keene and myself. So welcome back, Brendan.
Thank you. It's so great to be here. I have one correction to make. Unfortunately, when I arrived at school, they told me your book, your popular trade press book about the history of the dollar, cannot be your dissertation. So I have a completely different dissertation.
Oh my gosh.
It's too approachable.
Wow. Okay.
Yes.
Yeah. No, you didn't need it to be much more obscure in your dissertation.
Absolutely.
Well, let's talk about your book then. It's called The Almighty Dollar, and about 500 years of the world's most powerful money. The U.S. is about to celebrate its 250th anniversary this July, but how does the history of the dollar go back 500 years?
So I had to figure out how to write about the dollar. I had to figure out where to start. So I thought I would start in 1971. Nixon closes the gold window, and then I sort of like keep pulling that thread, and I end up in 1913 with the Fed, and then you end up with what I've been thinking of as the 1776 problem, which is that we learn in school to assume that countries have monetary sovereignty, that they have control over their own currencies. The problem with that is when you get to 1776, the United States declares political sovereignty, but it chooses as its currency a Spanish coin made of Mexican silver with a German name.
I didn't know that.
And so we can talk through like where that came from and how we got there. But for me, the most important part of this story is that at its founding, the United States did not have control over the dollar. It was very clear when you look at the correspondence from the founding fathers what they thought a dollar was. They saw it as a silver coin. Alexander Hamilton called this coin the ancient dollar. And I wanted to actually title the book The Ancient Dollar, and my editor was like, do you intend to sell any books? So, and you know, Thomas Jefferson said it's important when we choose a currency to choose one that the people are already familiar with. So I think of monetary sovereignty now, sort of after doing the work on this book, as something that has to be won with a lot of work, very slowly over time, and it's constantly in danger of eroding. So the story of the dollar is not the story of America. It's not the story of the Federal Reserve. It's not the story of the United States Treasury. It has its own history. So I ended up you know, literally at the bottom of a Czech silver mine, looking at 500-year-old chisel marks to understand sort of the origins of this currency that is much older and much powerful than much more powerful.
So when did the dollar that we know of, when did that come into existence, really?
Define what we know of.
Okay, I don't know. When did
what we use now?
The U.S. dollar.
Well, okay, so this silver coin, I'll give you like a brief potted history. I think we can do this in like one radio minute.
Okay.
Which is that there was this silver mine in a place called Joachimsthal in Bohemia. They produced only very high quality large silver coins. Those were very useful for trade. Those coins became known as Joachimsthaler, from Joachimsthal, and that got shortened to Thaler, and then in Dutch dollar, and then in English it became dollar.
Okay.
This is all in the 16th century, right? Okay. So early in the 1600s, Shakespeare used the word dollar in his plays. In the Scottish play and in The Tempest, there are mentions of the dollar. So it was clear that that was a coin that was familiar in English well before the founding of the United States. So when you actually get to the Constitution and what we think of as the actual United States, not just the colonies, there was about a 60-year period to take this silver coin and turn it into what we think of now as a dollar, which is bank money.
Okay.
So what we think of now as a dollar sits on the ledger of a bank, of a commercial bank. It's a bank deposit or a bank note that's printed by the Fed. But increasingly, nobody uses cash. So we're really just talking about bank deposits. So the United States had to win sovereignty over that very slowly. And there's this long history of panics in the 19th and early 20th centuries, and after each panic, there's new regulation. So Panic of 1837 introduces comptrollers of the currency at the state level. It introduces reserve requirements. You have to hold silver in the bank. 1861, or 1862, there's new legislation during the Civil War, introduces backing banknotes with treasuries, right? We had to figure that out.
Right.
1907, we have the Federal Reserve, which provides cash in an emergency. 1932, after that bank panic, we finally get national deposit insurance. That's huge. No other country, no other currency zone nearly the size of ours has unified deposit insurance. Only America has that. And so to answer your question, I think it was by 1932 that we had stable, regulated banks.
Gotcha.
Okay, so regulation was key here, and making a lot of mistakes and kind of addressing those mistakes was key in how the dollar system grew up. Where does that leave us now when we talk about things like stable coins or cryptocurrency? How do you think about the dollar's role in a decentralized financial system where regulation is less robust, if even there?
For me, the key to thinking about crypto is that it's not new. It's not that novel. I think of crypto as finances of the past never happened. When you look at the various kinds of crypto, there's Bitcoin. That's basically a commodity. We know how that fits into the financial system. It's a commodity. You think about most coins they're essentially equities. Stable coins, to your point, are a really interesting case because, as you know, they're pegged 1-to-1 to the dollar. But to me, it just looks like a bank. So right now we have decentralized money. Commercial banks, when they make a loan, when you take out a mortgage, they are not getting that money from somewhere else. They're marking that up on their balance sheet, brand new deposits for you. a stablecoin provider has the same fiduciary responsibility as a bank. They've got, when you deposit, they've got to buy assets. Those assets have to have meaning. We have to know that they have the assets they say they have. Every time I hear like somebody in crypto say, you know, we've got the first private decentralized money, my answer is, my dude, you just invented a bank. We know how those work.
Except they're not regulated like a bank.
That's exactly right. And so what I worry about, to my point earlier about monetary sovereignty, it's won slowly and painfully over time, and it's constantly in danger of being eroded. And what I see when I look at stable coins is these are bank dollars that are slowly slipping out of the regulatory control that we built up over the course of a century. Like, we know how finance works. We know how banks blow up. And I know that the Bloomberg audience right now are shaking their fists in anger at the radio. I do think that like the basic bulwark of FDIC, comptroller, Federal Reserve that we built up to protect banks needs to be extended full force to stablecoins. And I think if you did that, they'd lose a lot of their appeal because it's no fun running a bank because it's very well regulated for obvious reasons.
Big money versus small money. What is that?
Well, there's this sort of theory of coins, you know, physical coins, that points out that small coins are much more, actual coins, jingle.
Okay.
Yeah, that actually, that points out that small coins are much more expensive per unit of value to produce because each coin had to be hammered out. It's an industrial process. I've seen this.
That's why we're not printing or minting the penny anymore.
Yeah, absolutely right. Like money is a product. Somebody's got to produce it. Money doesn't happen by magic. And so the big coins are cheaper per unit of cost to produce. And what we found sort of historically is that mints, almost all mints were privately run, would much rather make the big coins. So you have this constant demand for small coins to settle small retail transactions, right? These are not, it's not as if the small coins are units of the big coin. They're completely different economies. So when we look at the economies of, you know, Renaissance Italy, Florence, Genoa, Venice, they all had a big silver coin for international trade and small coins, and the exchange rate fluctuates between the two of them because the small coins are for local purchases and you've got to manage inflation in a slightly different way than you do with a big coin. So I think that's still true now. Banks are like mints. They produce our money. Banks, for the exact same reasons, would rather deal with big loans, big deposits, big transfers than small loans, small deposits, small transfers. And so I think we've replicated that system with banks. And when you look at the problems with banking in America, or rather the challenges of getting people into the financial system, it's the exact same problem. Banks don't want to handle small depositors. They don't want to make small business loans because the back office costs are higher. This is a problem that would be very familiar to a mint.
I want to switch gears and talk a little bit about currencies used in commodities and in international systems. We talk a lot about this petrodollar because oil, which we talk about constantly given how much it's risen, is priced in US dollars and how other central banks are kind of beholden to the US because everything is priced in dollars and how they want commodities to be priced in other currencies, for instance. Is that doable given where we sit? Is this something that the US controls or is it all way beyond our control?
I think, so I've been splitting hairs on this one. I think it is within our control but beyond our regulation. And what I mean by that is when we think of the offshore dollar system, what we think of as the euro dollar system, this is just foreign banks producing their own dollars, manufacturing their own dollars using new loans denominated in dollars. Okay, so the Fed doesn't have any oversight. The Treasury, the comptroller, we can't look at what's happening. But the Fed does step in, as we know, 2008, 2020, with these swap lines with foreign central banks. To me, that says the U.S. dollar is unique in that since the 60s, we've been willing to tolerate in the United States some level of offshore activity. It's very useful to the United States to have these offshore dollars. And in return, we provide this service. Is it sustainable? It seems to be so far, when we look at measures of eurodollar growth, of offshore dollar growth, that line is still going up and to the right. There are 14 trillion eurodollars, offshore dollars. There are 19 trillion domestic dollars. They're comparable in scale, and they're still growing. So offshore banks seem to think it's sustainable.
All right, Brendan, great stuff. Thanks for coming in. We appreciate it. Brendan Greeley, he is author of this book, folks, The Almighty Dollar, 500 Years of the World's Most Powerful Money. It's about money, so immediately it's in my wheelhouse, so I'm going to take a read of this one. So appreciate that joining us here in
We want the book signed, by the way.
Oh yeah, absolutely. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Pressed Metal. Stay tuned for the latest market news and industry research. Next hour, Bloomberg Intelligence starts in just moments. S&P down 50.7 tenths of 1%. The NASDAQ down 280. That's 1.1%. Bond market's moving higher, folks. 10-year Treasury yields up 8 basis points, 4.67. 30-year, 5.18. How about that?
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Tuesday morning. This is Bloomberg Intelligence from the Bloomberg Interactive Broker Studio in Midtown Manhattan. Paul Sweeney, Scarlett Fu, and John Tucker here with you to take you through the second hour of Bloomberg Intelligence. We have a bond sell-off underway. It's a continuation of the sell-off that we got on Friday, and this time it is dragging equities lower. So we're going to get into all of that throughout the hour, but we're also going to check in with Drew Redding. He's our senior housing analyst to talk about Home Depot's results. Certainly consumers worried about inflation and high borrowing costs are definitely having an impact on Home Depot's results. We're also going to check in with Michael Halen. He is our senior restaurant and food service analyst on restaurant spending and how that looks in this higher inflation environment. James Morrow, founder and CIO at Calodyne Capital Management, will join us to talk about private credit. That's an area that's certainly taken a hit. And Riley Griffin, our tech reporter, will join us on Meta's $200 billion data center and how it's rising from the bayou. Bayou?
Bayou. Yep.
Okay. Why'd you
Bayou. Bayou.
You know, sometimes I just got to double check.
I thought they were talking about Beowulf, the poem.
Bayou. Okay, got it. Let's go over to John Tucker, who's going to correct my pronunciation on something else for Bloomberg Business Flash.
No, I won't. Anyway, let's start with stocks, and I'm not talking about Bill Clinton's former cat. The Philadelphia Stock Exchange Semiconductor Index shedding right now, 2%, just about. Yeah, this is a three-day rout, and it's close to a correction, down almost 9% since the peak. The tech-heavy NASDAQ, as a result of that, that is lower right now. The NASDAQ is down 1.2%, shedding 290 points. S&P 500, 54 points lower. That's down 0.75%. And the Dow Jones Industrial Average down 208 points right now. That is down 0.4%. And you mentioned this, Scarlett, certainly isn't helping. Treasury yields, they continue to surge with a benchmark 10-year yield 8 basis points higher, 4.66. The long bond up 5 basis points, and that is at 4.17. Meantime, Cameron Dawson at New Edge Wealth says, you know what, the backdrop does remain positive for equity investors.
I think what's fascinating is that even if you remove tech from the revenue growth number, that ex-tech revenue growth for the quarter was still 9%, which is extraordinary in this environment. And we are in a very robust nominal GDP environment.
Investors waiting tomorrow after the close, get the numbers from NVIDIA. They open their books for investors. Right now, those shares ahead of that, down 0.5%. And Google shares, they are down 1.8%. Google agreeing to create an AI cloud business with Blackstone. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. And back to Paul and Bayou Scarlett.
All right, here's my Bayou story. The one and only time I found myself on the Bayou, I found myself in a duck blind at 4 a.m. waiting for some ducks to fly by so we could shoot them out of the sky. Why was I doing that? Because I was trying to get some investment banking business out of this company, and that was the way. I would go further than my competitors. That's it. And we got it, by the way. We got the mandate to the company.
I would expect nothing less from Paul.
Exactly.
Paul's investment banking tales never fail to surprise.
Duck blind at 4 in the morning somewhere in Louisiana. That's kind of how I roll.
That sounds about right.
Yeah, so it worked. All right, very good, John Tucker. Thank you so much. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on the internet thing here. Let's take a look at some stocks on the move today. We can do that with Vildana Heinrich, cross-asset reporter for Bloomberg News. Vildana, what are you looking at today?
Well, I'm thinking of the famous Bayou song that nobody's even mentioning,
What's
right?
that?
Down by the Bayou?
Oh,
No?
down by. Oh, yeah.
Creedence.
Yeah.
Oh,
Very
that's
good.
a band that John knows.
Since you bring it up, there's a famous recording studio, or at least there was, The Stones recorded there.
Muscle Shoals.
Allman Brothers. Dwayne Allman started there. They were called the Swampers in the studio.
Yep.
Amazing studio. Anyway,
I'm just a terrible singer, so I wasn't going to sing any part of that. But I'm looking at shares of Home Depot, which we were just talking about. That's ticker HD. Shares are actually flat right now, but it is a big item in the news today after the company's key sales, one of its key sales gauges missed expectations in the latest quarter, and that's given some of the muted housing demand that we've been seeing, high borrowing costs. All of that is sort of limiting consumer spending on improvement projects. That key gauge is sales at locations open at least a year, which was 0.6% during the 3 months that ended May 3rd, according to the company, and that was below what analysts had been expecting. So just another way to be looking at how consumers are feeling in this economy.
Well, let's stay with that theme and look at how consumers are regarding their spending on wellness and sports and activity. You have another company that really showcases that.
I was hoping that you would try to pronounce this one because I'm going to be mispronouncing. Is it Amer Sports?
I think it's Amer.
Yes.
Amer?
Amer? Okay.
Oh, see, there's no
We're all
consensus.
having issues today. Yeah, like America. Amer. Okay, ticker AS.
Thank you.
At least have
okay,
the
good ticker.
Shares up as much as 8% today after it raised its full year guidance, and first quarter results beat estimates, and that's helped by demand for Salomon shoes. So I ended up, did I mispronounce that one?
Solomon, those are the ski boots I wear, Solomon.
I've not heard of this brand, which is why this company was interesting to me because
do you ski or snowboard?
No.
No.
Okay, all right, okay, that explains it.
But they have hiking shoes, it looked as well. I looked it up and I did not recognize the shoes, but
they're kind of old school ski company.
I see. So all of you are
Or ski
fans
brand.
of these shoes.
Paul Sweeney is like, what? It's been around for a while.
school.
Okay, very good. Yep.
Oh,
Yeah, old
what she meant to say is old.
Yep.
Yeah.
All right, so what did they do? They had some numbers out.
Yes, and now they're expecting revenue to go 20% to 22% this year, up from an earlier forecast of 16 to 18%.
Okay, one more.
One more, that's shares of hyperliquid strategies. This one is a little bit closer to my home turf, covering cryptocurrencies. That's ticker PURR. Shares are up some 12%, as much as 12% today after a Bloomberg report that the Securities and Exchange Commission is said to be readying some plans for trading crypto versions of stocks.
Tokenized stock trading.
That's right. And so this is a big report. It led the New York Times Deal Book section today. We just have, an inkling that regulators are interested in this and looking at this.
All right, so DeFi platforms like Hyperliquid would certainly benefit. Vildana, thank you as always. Vildana Hyrik, she's our team leader for crypto, for cross-asset coverage, right? And crypto. There you go. Promotion. Thank you, Vildana. And for more conversations like this, be sure to subscribe to our Stock Movers Reports, where we offer 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, Vildana mentioned Home Depot, so let's get a deeper read on what's going on there and check in with Drew Redding, our U.S. home building analyst, to recap Home Depot's results. And I mean, Drew, this company is just, no matter what, tethered to rising borrowing costs and consumer sentiment. And both of those are kind of working against it right now.
Yeah, so it was a relatively neutral quarter for Home Depot. I think the theme is really stability. They mentioned that during the call that demand is relatively in line with where it was a year ago. They did have a slight miss on same-store sales. But I think what investors will latch on to and get a little bit of comfort with is the fact that they maintained their full-year same-store sales guide. Now, when they initially came out with that, it was calling for growth of 0 to 2%. So I do think that they left themselves with a little bit of wiggle room to see how the rest of the year plays out. But to your point, we mentioned stability. That is the case, but what the company is missing is kind of that next catalyst, and it's really housing that continues to remain frozen. Due to elevated rates, we're back up near 6.7%, and that's after getting to a 5 handle earlier in the year. And then, as you mentioned, consumer confidence. We've heard this pretty much across the housing ecosystem, and it's that consumers are worried about the outlook for the economy, the outlook for employment, and they're just pausing on these big purchasing decisions.
What's your world, Drew, your world of home building and all that kind of adjacent stuff? Let's assume rates are higher for longer. How does your world adapt? I mean, it just seems like if I'm a buyer, I'm a seller, at some point I gotta throw in the towel and say, hey, it's been a number of years here. This seems to be the new world here in real estate.
Yeah, it does seem like the level of demand that we're at right now is kind of a floor. We've been bouncing along a 4 million unit annualized rate in the housing market for a couple of years now. The new home market has been relatively stable for a couple of years now. So, there is a certain level of churn that's going to happen regardless of where rates are. Things happen, people get married, they have kids, they need to move. But to your point, I mean, there's still 70% of mortgage holders out there with a rate at 5% or below. So without any forced selling activity, there's not a lot of urgency in the market. Now, from the home builders' perspective, what this means is that they're going to continue to have to lean on incentives. That story's been well documented now that they've been very aggressive in their use of mortgage rate buydowns to kind of make the math work a little bit better for their buyers. Coming into the year, I think there was some hope that, rates were going to come down. They'd be able to take their foot off the gas pedal a little bit. But it looks like at least over the next couple of quarters, they're going to have to continue to offer those concessions to move inventory.
All right, good stuff, Drew. Thank you so much. Drew Redding is our home building analyst here at Bloomberg Intelligence, giving us a read on Home Depot and the home building industry as a whole. Of course, very, very dependent on rates and where rates are. And right now, Paul, rates are higher. They've been going higher since last Friday, but actually, if you take a step back, even long before then, It's just that Friday, it looked like it was everything moving in concert with bond yields in the UK, Japan, and Europe all moving higher. So, of course, we needed to bring in John Authers. He is one of our Bloomberg Opinion contributors. He's also an editor at large, some kind of senior editor title here,
Something
right?
like that.
Something like that. John Authers is in studio with us right now. And John, what surprises you the most about what we've seen in this march higher in bond yields, not just in the U.S., but around the world?
I guess what surprises me is that it finally happens, because I have spent the last 20 years of my professional life dealing with people who have been worried about this precise event happening. And there is still something slightly unreal when it actually does. There is little obvious reason that it has happened now, down to these last few days, other than it would be way oversimplifying to say that this is all down to the Strait of Hormuz situation, but plainly that's the trigger, that's the catalyst at the moment. So you could argue last week you saw December Brent get above $90, 93, 94. It's as high as it's been. So the oil market is telling the rest of the world, we are braced for this to be a longer interruption, for this to be a shock to supply that goes on longer. And that's what matters most to inflation dynamics. That maybe maybe that was the trigger last week, was disappointment around Beijing, the Beijing summit, and no pressure on Iran from China to reopen the straits. But I find that very strange, in that I didn't know anybody before the event who had any great hopes for it. So that's the most. There's nothing at all surprising that this would happen, because the logic for it to happen has been in place for years, if not decades.
And I love.
There's no clear explanation why this week. Why
Although I love you quote in your note here a gentleman from Barclays, Ajay is his first name.
Raja Diakshar or something.
I'll go with that. But he basically says, hey, it's simple and uncomfortable, the reason here. The developed world has too much debt, too little fiscal discipline, and no political appetite for fixing either. If there's a trigger, it has to be the Iran war and the resulting shock to the oil supply. That makes some sense to me, at least.
Yes. But the Iran war has been going on for more than 2 months now. But yes, that's it in a nutshell. Bill Gross, the bond investor, used to talk about the British gilts market being built on a bed of nitroglycerin, and Britain has a specifically bigger problem. It's an island economy. It's particularly open, particularly prone to importing inflation because it does more trade. But basically, it's anything that applies to the UK is only slightly worse than it will be for the rest of the developed world. That's been true of the world that we're sitting on nitroglycerin. Sorry.
So, John, one thing that we keep puzzling over, we do see equities weaker today, but for the most part, stocks have been on a tear, right?
Yes.
I mean, they're still near record territories. And as you've noted, the 10-year yield now exceeds the S&P 500 earnings yield by the most since 2002.
Yes.
At some point, something's got to give, no?
I would think so. Lots of my readers kindly point out to me that I often tend to be too bearish, which is true.
Occupational hazard.
Yeah, it is an occupational hazard. It is very hard to justify the extreme degree of enthusiasm in stock markets, given what bond yields are doing. If you go back to the model that Alan Greenspan, it became known as the Fed model because Alan Greenspan appeared to be using it in the 1990s when he was giving testimony that you compare the earnings yields, the inverse of the PE on stocks to the 10-year bond yields to get an idea of where valuations should be. Then bonds have been a support for stocks ever since the GFC by a very big margin, and that has been totally removed now. And that's not necessarily a bad thing, but it's amazing that there is as great an enthusiasm for stocks as there is. Now, you spend a lot of time, obviously we all should be spending a lot of time talking about AI. There is this other very big positive shock coming from AI, but I do find it hard to believe, and it worries me, that in the minds of equity investors, it so completely floods out the warning they're being given by the bond market to rein in their horns.
What do you? I've got about 30 seconds left here. What do you make of just the AI and the spending associated with it, and the impact on our economy? If you strip out AI, would we really notice it?
Would we
like in the economic growth data?
Yes.
So it's been a big contributor.
The capex that is being spent on this is a very, very real, very significant deal. That is, actual money is being spent and being invested and employing people. There is no question about that. The great concern I have, having lived through .com, is that at the moment we are pricing all the hyperscalers, all the chip makers on the assumption that they will be the winner. And Amazon, it turns out you could have bought it right at the very top of the mania and you would have been fined 25 years later because Amazon was the winner. All the others would have lost you money. Some of the Magnificent Seven are going to lose. Some people are going to lose money out of this big time because they can't all win. And I don't think because they are borrowing and spending in the way that they are at the moment, somebody is going to be in a lot of trouble in a few years, logically. And there is no concern at the moment to work out who that is or to take evasive action.
It sounds like FOMO to me.
Yes.
Yes.
All right, John Authors, thank you so much. And of course, be sure to check out John Authors' columns on the Bloomberg Terminal. You can all check it out at NIB Opinion Go. John Authors with us as we look at yields moving higher. The 30-year at 5.17%, the 10-year at 4.66%.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Major stock averages, they are lower. A gauge of semiconductor shares extending its three-day round. And then you have Treasury yields. They continue to rise. NVIDIA's results, they're due after the close of regular trading tomorrow, and that's going to help set the tone for stocks. Investors are going to be looking for reassurance. The AI story is alive and well. Right now, the tech-heavy NASDAQ is down 281 points. That's a decline of 1%. S&P 500, 53 points lower. That's down 0.7%. And the Dow Jones Industrial Average is down 216 points, a decline of 0.4%. The benchmark 10-year yield is up 8 basis points, 467 right now. The 30-year, the long bond, 5 basis points higher. We're at 517. Home Depot's business taken a hit by elevated interest rates and housing prices. They sparked a pullback in home purchases and big projects. Instead of extensive remodels, folks, looks like are tackling smaller projects, at least according to the retailer. Sales last quarter missing expectations, but the earnings did top estimates. As a result of that, shares of Home Depot right now, they were up just about 0.3%. We have big changes coming to Facebook. The parent there, Meta, the tech giant, planning to cut 10% of workers tomorrow. That's about 8,000 people. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Here's what our next guest says. U.S. restaurant spending looks vulnerable as a 52% jump in gasoline prices and higher fertilizer and food costs tied to the Iran war siphon discretionary dollars. Not good for the restaurant business. Michael Halen, he's our senior restaurant analyst for Bloomberg Intelligence. He joins us here. Mike, how do you think about this? I mean, people are spending a lot more for gas and some other stuff, and I'm guessing that comes out of their discretionary spending, which would include restaurants. What are you seeing?
Yeah, it sure does. And restaurants are typically the first place that people cut back. So, I was on this show months ago. We were kind of bullish coming into the year about the first half because restaurants had suffered through 2 straight years of tough comps. Casual dining had a really rough 2024, quick service a difficult 2025, and people were ready to get back to restaurants. And we kind of saw it in the first quarter, even though there was some bad weather. People were taking their 11% higher tax refunds and spending them at restaurants, right? But now with gas prices up 53%, our outlook has changed mightily. And it's for the reason you stated, right? People, especially in middle America, have pretty tight fixed budgets, right? And if they're spending 50% more on gasoline, that's going to come out of, other spending, and restaurants typically see it first.
Restaurants typically see it first, and we've already gotten some indication of this. You mentioned weather as one of the culprits. We saw Shake Shack, for instance, in its latest earnings report, say that its first quarter revenue missed estimates due to pressures, including weather, as well as rising beef costs. So that's another headache for these restaurant companies. Yet some restaurants will inevitably fare better than others. When you look through your coverage universe, which kinds of companies are better prepared to withstand this difficult period?
Well, we have been seeing a trade down to cheaper options, right? But then it's also going to depend on a case-by-case basis. So first we'll talk about, the lower price chains. Taco Bell is an absolute machine. They are doing a phenomenal job with their marketing calendar, always have, and they're going to do even more LTOs this year than they have last year, and that should continue to drive traffic and same-store sales. Burger King, they seem to be benefiting from struggles out of Wendy's and Jack in the Box. They've improved their operations and the food quality. They made some, taken some share from McDonald's on some of the stuff they did around the CEO's kind of weak bite of the big arch. You know, and they've done some kind of marketing around that with you know, Tom Curtis, who heads Burger King. You know, so those are chains we think can benefit from a trade down. You know, and there's some other chains like Kava and Starbucks that just have some things, good things going for them. You know, Kava, we came into the year saying same-store sales estimates were way too low. You know, if you look at last year in a vacuum, they actually had a very good year. And you know, the data we're seeing shows that 1Q is off to a great start. And Brian Nichols done a great job at Starbucks, improving the operations, now working on improving the food and beverages. And we think they can continue this pretty strong momentum we've seen over the last 2 quarters.
Yeah, my Starbucks at Route 35 in Walt Township, they do a great job for me every Saturday and Sunday, so shout out to them. Michael Halen, thanks so much for joining us. He's a senior restaurant and food service analyst at Bloomberg Intelligence. Let's get back to these markets. They are moving. We have stocks down. We have yields up. Boy, if it weren't for this war in Iran, one of the key driving issues, I think, for this market would be private credit and how systemic is the risk for private credit for the greater fixed income business, maybe the greater capital markets. James Morrow joins us here. He's the founder and CIO of Callodine Capital Management, joining us live here in our Bloomberg Interactive Broker Studio. Jim, thanks so much for joining us here. Talk to us about private credit. Is the risk there systemic to our capital markets, to our fixed income markets, or is it like a lot of people tell us, it's a one-off type of thing, don't worry about it. It's more of a liquidity issue than a credit quality issue?
Yeah, thanks, Paul. Certainly, our view would be that it's not systemic, that the size of the problem relative to the size of the capital markets and credit markets looks pretty manageable. We don't see a macro-driven downturn in credit. If you look across credit markets today more broadly, things are pretty healthy. Stocks are healthy. The economy is relatively healthy. And so really what people have been concerned about is a pretty isolated pocket of the direct lending or private credit market associated with software loans. And that, when you go through the math and try to quantify, it looks very manageable. So it wouldn't look systemic from our perspective.
So this concern about the software debt that's out there, and there's a wall of maturity coming due as well in the next couple of years. How far along that process do you think we are? If this were a baseball game, are we in the 3rd inning? Are we in the 6th inning?
Yeah, I think we're probably in the 6th or 7th inning of identifying the problem, but the maturities, as you point out, are going to stretch out over the next 3 or 4 years. And so the actual absorption of losses by credit markets, by direct lenders, will take some time to play out. So if you try to quantify the full amount, you have to remember that those losses probably happen over multiple years. Therefore, it looks like the underlying funds can absorb those losses pretty comfortably.
So is it worth going out there and trying to find some opportunities in private credit, or how do you think about that as an asset class these days?
Yeah, I mean, certainly new vintage loans, so current loans being made, you're starting to see some spread widening occur within the private credit markets. And I think if we go back to 6 months ago, there was a view that the front end of the yield curve would come down, that there was a Fed rate cut cycle. That doesn't look as likely right now. So the base rate looks like it'll be higher going forward maybe than we viewed 6 months ago. And so all of that points to new vintage loans being attractive places to put new capital from our perspective. And you're seeing the credit markets function pretty comfortably right now.
Yep.
So if there's an opportunity to buy private loans at a discount because there's some stress in the market, what are you guys doing?
Yeah, I think you want to evaluate each underlying credit as opposed to buying large baskets of loan. And certainly, if you want to look at areas of the market to avoid, software would be at the top of the list.
Sure.
Right? So those loans, if you look in the market, are trading at much wider discounts. But to the extent, if you look at private credit, there's concern about credit specific to software. Then there's concern about liquidity as it's associated with non-traded BDCs and other things where you're seeing these redemption cycles. And then there's concerns about marks. Are the marks correctly? And so I think, as a credit investor, you're going to want to go look at those underlying lones, underwrite those yourselves, and mark them accordingly.
Other than private credit, where are you guys at Callodine? Where do you guys see value these days?
Yeah, I mean, what's interesting is in the equity market, you've seen a great bifurcation within the equity market. You have everything associated with AI and the momentum around AI and the infrastructure build. So think tech, semiconductors in particular, industrials, materials, even parts of utilities. And then there's everything else, and that's where we see value in the market. Certainly no one's playing defense right now, so the call option premium and defensive stocks that are high yielding as well looks particularly attractive. So think pharma, staples, REITs, parts of utilities look really attractive if you're trying to measure your downside risk in this equity market.
Is there any part within tech that looks attractive?
Not really. It's probably early to look at some of the software names, which are pretty bombed out. Certainly part of IT services you could start to look at, but more broadly, looking, if you're associated with the AI build out at all, you've got a lot of optimism built into your valuations right now.
So what is the AI play for you guys these days? Because I think for all of us, when we saw that NVIDIA guide, 3 years ago now, I guess when they had that huge guide higher, we're like, oh, I guess AI is a thing, number one, but I'll just invest where everybody's spending money, like the chips and things like that. Now it seems like the market's trying to discern winners and losers a little more.
Yeah, I think if you look at sectors that have high, labor input, or particularly high educated labor input, areas like pharmaceuticals, for example, they could be massive productivity beneficiaries from AI spend, and yet no one's sort of thinking of them as AI plays. If you go back to 2000 and the start of the internet, there was always focus on the picks and shovels and the build out, but it turned out with the benefit of hindsight that the benefits of productivity dissipated across the whole economy. And so I think, again, places where it's not priced in are the more attractive ones right now.
I'm curious what you see when you look at what's happening in the bond market too. We are in the middle of this global bond sell-off, and by most accounts, it's been fairly orderly. But a lot of people are now talking about the 30-year yield approaching 5.5%. We're talking about multi-decade highs for the long bond, whether you're talking about the U.S., the U.K., Japan. It kind of is global in scope. John Authors calls it a slow-motion car wreck. What does this mean for private credit specifically? What does it mean for I want to say equities, but so far it hasn't meant a whole lot for equities. So let's start with private credit.
Yeah, equities are certainly ignoring the discount rate mechanism. For private credit specifically, to the extent the economy slows down, you could have certainly more systemic or macro-driven weakness in credit markets. We haven't seen that yet. Nominal growth is strong, associated with the higher inflation rates, and in general, inflation is pretty good for debtors and less good for creditors. And so you have that base rate phenomenon. But we would think that the risk is really in the equity markets in and around valuation, and particularly when equity markets are being driven by the largest capital program in the history of humankind, the cost of that capital should be relevant at the end of the day.
Fair enough. When we talk about private credit, there's a lot of private credit managers, alternative asset managers out there. Are there too many? I mean, do we need to see consolidation here?
No, I don't think there's too many. I mean, if you look at the history of the active management industry, if you look at the mutual fund space, certainly you saw consolidation over time. You could see it in the alts space again. But, our base view would be that alternative markets, private credit in particular, will be much bigger in 5 or 10 years than it is today. And so this is sort of a speed bump, not a change in the secular growth rate or the secular long-term opportunity in that sector. But certainly the bigger platforms have advantages and could look to consolidate some of the smaller players.
Jim, thanks so much for joining us. Appreciate it. Jim Morrow, founder, CIO at Caladyne Capital Management, also a fellow alum of the Chase Manhattan Bank. So we know credit, folks. We went through the credit training program, so we know balance sheet when we see one. Looking at the markets here, S&P down 55 points, 0.75%. The NASDAQ's off 290. That's 1.1%. And it's all about the bond market. We got the 10-year Treasury yield up 8.5 basis points, 4.67 on your 10-year. 30 years, 5.18%. We've been on.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So you have investor concern over accelerating inflation. That has fueled a sell-off across global debt markets. A 30-year yield earlier did reach a level last seen on the eve of the global financial crisis back in 2007. These higher yields and a sell-off in the chip maker stocks, that's weighing on markets today. Next up, we're going to get NVIDIA's results. That comes after the close of regular trading tomorrow. In the meantime, Christopher Hodge at Natixis sees inflation slowing, but for all the wrong reasons.
I do think that the weaker consumer is going to put lower pressure on products where consumers have a choice whether or not to spend. So I think some of the bleed through from headline inflation to core is going to be offset by the lower consumer demand.
Right now, 7 of the 11 major index groups in the S&P 500 are lower. You have material stocks. They are the biggest drag right now. Healthcare, that is the best performing individual sector in the S&P 500. S&P 500, 50 points lower. That is down 0.7%, 73.52 on the index. The Dow down 203 points, and the NASDAQ Composite Index 266 points lower. That is down 1%. Long bond 5 basis points higher, 517. The benchmark 10-year 8 basis points higher. That is at 467. Brent crude down 1.4%, 110.56 a barrel. You know, during the great financial crisis, cities to get money, they were selling just about anything, including leases on parking meters.
Didn't Chicago do that?
Chicago. That's where I'm going with
this. Look at that.
Mayor Daley, second or third generation Daley, in 2008, he sold the lease on the meters for $1.15 billion to a Morgan Stanley-led group. Now, the same group has reached a deal to sell the lease of the parking meters to Stone's Peak of New York. Don't know the price. It's a 75-year lease. It expires actually in 2084. They raised parking fees across the city. They jumped from $3 an hour to $7 currently at some of the meters downtown, more than twice the rate of inflation. That's
$7 an hour to park on the street. Is that right?
Yeah.
Yeah.
So it's not covered, and wow, that's a lot.
No. Then you pay a toll charge to get into the congestion pricing.
Then you have to fix your window after it gets broke. No, that's not true. But anyway, yeah, that's what happens.
Do they ever suspend parking rules or anything? I mean, if it snows?
I don't know. Anybody in Chicago, would you please inform us as to what's going on? But anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, John Tucker, for that business flash. We do have some breaking news. Apple's new hardware boss is shaking up the oversight of product design. This matters, of course, because Apple is first and foremost a hardware company. Johnny Strauji, I don't know how to pronounce his name, but he's the chief hardware officer over at Apple. He's reorganizing the hardware development, shifting oversight of key functions such as product design. It's all part of an effort to speed up work on future devices. Of course, this gentleman was elevated to this new role after John Turnus, who was the longtime hardware executive, was tapped to become CEO on September 1st. So
very good. And
for anyone keeping tabs on the personnel leadership there, that's the latest on
Mark
Apple.
Gurman, yeah, he's the Bloomberg News reporter all over Apple.
The Apple Whisperer.
He is the Apple Whisperer. All right, you know how much we love these big take stories on the Bloomberg terminal. They're really, really compelling stories. The reporters take a ton of time, a ton of resources to get to the really big details. And this one's a good one, particularly if you're a fan of this AI story and all the money that's being spent. Meta's doing a data center down in Louisiana, like 200, I know it's just going to be a big thing, $200 billion, something crazy down there. And our next guest has an awesome story on this. Riley Griffin, tech reporter for Bloomberg News. Of course, she peaked when she graduated from Duke University. Riley, thanks so much for joining us here. Talk to us about Mark Zuckerberg and Meta. They're building this huge facility down in Louisiana. Talk to us about that.
Yeah, I mean, the scale of this facility is truly unfathomable, Paul. I spent weeks going to and from Richland Parish, Louisiana. That's in the northeast corner of the state. It's the Delta region, and it's one that has long faced economic hardship. Farming right now in the U.S. is a difficult task, particularly if you're farming cotton, as this region does. And Meta is planting a $200 billion data center there. What that looks like is nearly 4,000 acres. President Donald Trump has said it will be Manhattan-sized. They are building 10 new natural gas plants just for this data center alone. That's about the energy consumption of New York City on a winter day. Wow. And one of the largest private capital deals ever assembled is funding its development. And that's all before we get to the $200 billion. So it's just a massive, massive project in a very small farming community, which makes for tensions and growing pains. But also, unlike a lot of American cities and suburbs that are pushing back against data centers, this is a community that is cautiously optimistic that it will prove to be an economic lifeline.
So tell us a little bit more about what people told you when you went down to Louisiana and checked in with the locals there, those who would be directly affected by this.
Yeah. Before I went to Richland Parish, I didn't realize how much of an agriculture story this would be. I spent time with more than 100 people in the region, and again hearing just how hard it has been to grow cotton, corn, soybean. It really landed with me. These are folks who are losing hundreds of dollars on every acre that they plant. Subsidies aren't making up half of that. There are a lot of bankruptcies. Small farms don't even exist anymore. And, as one person, Dustin Morris, who runs a soybean and corn farm in the parish, told me, the promise of the land has been broken. For a lot of folks, they've held land in their family for generations. They don't even know how long back they've been in the parish, and they're just unable to break even right now. So enter Meta. After years of that, a lot of people are trying to get in on the land rush. For now, one family has been the primary beneficiary, but it is a textbook boomtown. 7,500 workers have descended on a community of just 20,000. That comes with its own challenges, but folks are optimistic that Meta long-term will provide some of the economic opportunity that has been lost over the last century.
And what I think we're all learning, Riley, about the data centers is what is one of the gating issues is access to power. Do they have access to power down in rural Louisiana?
Well, Louisiana is an oil and gas state. So Entergy Louisiana, the utility that is working with Meta on this, has told Meta, use all you want, we'll make more. They are saying that energy won't be the constraint, and they're going to build these 10 new natural gas plants really to serve this one data center. 6 of those are going to be in Richland Parish, just to put that in perspective. So I think Meta has really benefited from picking a place where regulatory hurdles to getting that kind of, fossil fuel generation has been a real boon. And we're seeing that across the board, right? With these mega data centers, hyperscalers, companies like Meta, they're not looking to Northern Virginia anymore. They're looking to the South. They're looking to rural regions where land is abundant. They can get lots of energy, and there are politicians who are willing to clear the red tape. And that's a big part of this story, is thinking about Louisiana politicians at the national level, at the local level, at the state level, who really heard Meta and its demands and said, we will do everything it takes. As one person said, we will move heaven and earth to make this happen for you.
Wow, that is some pretty strong stance there. What surprised you the most, Riley, as you were doing the reporting for this, in terms of, I know the scale was something that, kind of blows all our minds, but what took you by surprise?
Yeah, I again, coming back to the state of American agriculture, that's not a sector I've actually covered. I've spent many years covering healthcare, and now I cover tech, but to learn more about ag. It feels like you can't tell this story about rural Louisiana without telling a story of agriculture. So that really stuck with me. And just thinking about the long-term questions. This is a story at its beginning. The data center isn't opening until 2028, so more to come.
All right, Riley, excellent reporting. Really appreciate it. It was a great story. Folks, you can check that out on the Bloomberg terminal. You can go to bloomberg.com/big take to get Riley's story and all the other great big take stories. Riley Griffin, tech reporter, Bloomberg News, proud Duke alum. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker studio in New York City. We are streaming live on YouTube, streaming live on Bloomberg.com as well. Here's a cool lead I like. Our next story. For years, there was only one way for mom and pop investors to buy into Elon Musk's vision. That would be shares of Tesla. Now, that's about to change, and it might be a serious risk for Tesla investors. Jordan Fitzgerald joins us here, equities reporter for Bloomberg News. Jordan, so SpaceX, we think it's going to file for its IPO tomorrow. That'll be huge because everybody's really interested in it. But is it a risk for Tesla shares? Would you think some people might sell Tesla to buy SpaceX or something like that?
Yeah, so from what I've been talking to investors about, it does seem like there is somewhat of a risk there. Tesla for years has been a incredibly expensive stock. It currently trades around 200 times 12-month forward earnings. Wow. And a lot of that has always come from the fact that people really, really believe in Elon Musk's ability to change the world. He's done seemingly impossible things before, and people bet that he's going to be able to do it again. Tesla trades often more like a call option than a stock. And now that SpaceX is coming to market, that special sauce that Tesla had, which is the unique access point into Elon Musk's mind, is being diluted a little bit. Nobody's expecting Tesla to go to zero by any means, but it's certainly becoming a little bit less special now that we have SpaceX.
That's an issue. I hadn't thought about it. I'd thought about it just because, you know, I have another way to invest in Elon. But now if you think about Tesla, the stock, as you were just mentioning it, it doesn't trade like an auto stock. And whatever that Elon Musk premium is, and it's substantial, as you mentioned, the valuation, well, now I can get that somewhere else now.
Yeah,
So
and Tesla has, you know, been criticized for having certain problems for a long time. Its car sales are not performing the way people necessarily want them to, and it's made all of these promises about humanoid robots and robo-taxis, but they're not yet at the market generating profit for the company. Whereas SpaceX, you know, has fewer of those problems. Tesla also operates in several crowded fields. There are other people making cars, there are other people making EVs, there are other people making robots, there are other people trying to make autonomous vehicles. Whereas what SpaceX does is a little more specialized. There are fewer competitors. And so when SpaceX comes to market, there is, you know, a certain theory that you can get into that Elon ecosystem without any of the problems dragging on Tesla.
Is there any talk out there that maybe Elon, just for ease of life, would roll all this stuff up onto one? Maybe SpaceX goes out and merges with Tesla just to get all his companies under one umbrella?
That's the big question. A lot of investors think that's certainly what makes sense. If your value proposition, to a large extent for both of these companies, is Elon Musk, then it kind of makes sense to unify them. It's a rare case where the sum of the parts is greater than each individual. But you know, Elon has a lot more companies than just Tesla and SpaceX. Who knows what's going to happen with Neuralink, with Boring Co. Certainly the ties are intensifying, at least between Tesla and SpaceX, with TerraFab and with sending data centers to space. But at the end of the day, there's also a legal question here. How much will the US government allow them to merge? How much will shareholders be interested in this? Because if things do go the way some are expecting and SpaceX becomes a bit more of a valuable stock than Tesla, then a merger or acquisition of Tesla by SpaceX could dilute some of the shareholder value of SpaceX. So it really depends on what the appetite there is from Elon Musk and from other stakeholders.
And I've seen you reporting, and I'm not sure I ever knew this, but retail investors, they own about 40% of Tesla shares. So you have to vie for their attention as well.
That is according to an estimate from BNP Paribas
Okay.
As of about a month ago. But yeah, retail interest in Tesla is huge. It's always been huge. And these retail investors have largely been into Elon for a long time. They've put their life savings there in many cases, and they've made a lot of money. And so they're not exactly expected to be exiting the ecosystem anytime soon. But at the end of the day, you know, your average person only has so much capital to invest, and it is expected to lead to some splitting of that capital. Like I said, it's not going to be everyone completely exits Tesla and rushes into SpaceX, but on the fringes, we're gonna start to probably see some of those retail investors allocate some money away from Tesla and rotate it into newly founded SpaceX.
Well, I see you spoke with one of the analysts out there in Wall Street. I think is one of the smartest ones, Nick Kolas at Data Trek Research. Is Tesla in the S&P 500?
Tesla is in the S&P 500.
Is in the S&P 500.
And so regardless of, you know, what individual company investors are going to do, it's always going to have some of that index investment allocated into it. And like I said, on the fringes, you might see some people take their like 2% investment in each of the, you know, Mag 7 S&P 500 companies and scale it back and allocate a little bit more into SpaceX as their non-index investment. That's something Nick Kolas did tell me, but you know, Tesla's not going anywhere anytime soon. It just, like I said, might lose some of its sheen.
Interesting. And you quote Nick Kolas in here, and Nick quote says, for Tesla, it has been a 90-10 future to present value for as long as I've looked at it. And Nick was formerly an auto analyst. The vast majority of that company's valuation is based on future hope, not current reality. So it'll be interesting to see. And again, we're going to have SpaceX reportedly going to file as early as tomorrow, maybe even get a deal price sometime in mid-June. That's kind of the timetable that's out there. So very interesting to see how that plays out for SpaceX and for Tesla. Jordan, thanks so much for joining us. Jordan Fitzgerald, equities reporter for Bloomberg News. So some interesting stories there. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. S&P off 55 points. The Nasdaq's off 300 points. That's 1.1%. Yields higher today. That's the story. Up 8 basis points on your 10-year, 4.66%. Top stories, global news coming up right now.
From ABC News, I'm Wayne Cabot. Acting Attorney General Todd Blanche is being grilled on Capitol Hill on what critics call an illegal slush fund. He's sidestepping every direct question so far from Democrats in the Senate about whether January 6th rioters should be compensated by taxpayers for being prosecuted. Democratic Senator Chris Coons pointing out at the hearing today that the way it's written, payouts could be confidential. ABC's Stephen Portnoy with more about the fine print.
Under the arrangements made public by the Justice Department, the $1.8 billion settlement fund will be controlled by a 5-member board appointed by the Attorney General, with one of the members recommended by congressional leaders. The members can be removed by the president for any reason. Their decisions will be final, with no appeals allowed. The disbursement of taxpayer money is to be kept confidential, with the names of recipients provided only to the Attorney General.
The mother of one of the 2 teenage shooters at a San Diego mosque called police 2 hours earlier to say that her son was suicidal and had taken weapons from the house. The 17 and 18-year-old were found dead in a car after the attack that killed a security guard and 2 adults. Today's primary day in election in Georgia, and there's been record-breaking turnout so far in the early voting. Over 1 million ballots cast so far. Georgia, one of 6 states holding primaries today that could give us some clues as to the mood of the nation. A disease whose victims bleed out and die has no cure, no vaccine, and as it spreads, it's going fast through Central Africa. ABC's Faith Abube.
The rare variant of the virus is suspected to have killed at least 131 people so far, and doctors are monitoring more than 513 suspected cases in Congo. A few others also reported in neighboring Uganda.
An American doctor in Congo got it and is getting cared now in Germany. Russian President Putin wheels down in China now for 2 days of meetings with President Xi. You're listening to ABC News. Car ownership is more of a dream than reality for a growing number of Americans. Here's ABC's Sherry Preston.
More Americans say owning a car is a luxury they just cannot afford. A new study by LendingTree finds nearly 4 in 10 Americans, 39%, are being priced out of car ownership. The problem is the rising cost of cars. New cars average just under $50,000 in the sticker price. Car insurance costs have surged 37% in the past 5 years, and that doesn't even take into account the price of gas.
According to LendingTree, many Americans with active auto loans are spending 15% of their income on car-related expenses. Solar panels are cropping up all across vast stretches of the Lone Star State.
Electricity generated by solar farms, some spreading thousands of acres, is expected to surpass coal for the first time this year within the power grid that covers most of Texas. Natural gas remains the dominant power plant fuel, but solar's share has increased from 4% to 12% since 2021. Considering the Trump administration's new restrictions on wind farms, solar may soon catch up to wind as a force behind Texas electricity. Jim Ryan, ABC News, Dallas.
Relief today for hundreds of thousands of commuters in New York City and Long Island. Negotiators for the MTA and the union leaders have a deal to end the Long Island Railroad strike that shut down the nation's busiest commuter rail system. The main issues, pay and health care costs. Train should start running about now. Wayne Cabot, ABC News.
Live from Atlanta, Georgia, this is Balance of Power with Joe Matthew and Kaylee Lines.
Primary day is here. Welcome to a special edition of Balance of Power, live from Atlanta, Georgia, where polls are open right now. I'm Joe Matthew alongside Kaylee Lines here on the campus of Georgia Tech here in beautiful Midtown. Kaylee, Georgia is one of a half dozen states holding primaries today with a lot on the line for both parties and for President Trump with a series of endorsements that we're following today.
Yeah, well, he has endorsed in many races. He also is actively running a campaign against a certain primary contender in Kentucky, the incumbent Congressman Tom Massey, facing a Trump-backed challenger, of course, part of the president's revenge tour, if you will, this midterm cycle. So the outcome of that race could be crucial in terms of determining the president's lasting sway over the base of the Republican Party. All that said, outside of Kentucky, here in Georgia, it's not just one race we're watching. It is several at the state level and, of course, federal offices,
We've got some big ones here, including 2 state Supreme Court seats getting a lot of attention with a potential effort to redraw congressional districts here in Georgia. By the end of the day, or presumably into the wee hours, we will figure out who's going to be running against John Ossoff, which Republican, and of course we've got a wide open field in the gubernatorial contest. But Kaylee, we've got also a looming endorsement in the Senate race in Texas that could come before this hour is out, according to the president.
Yeah, he suggested he could finally, at long last, make an endorsement in that race between 12:30 and 1 o'clock today. Will it be John Cornyn, the incumbent senator from Texas, or will it be Texas Attorney General Ken Paxton? No one knows, and this has been a long time coming, which is why, of course, in the first place, that this race went to a runoff. Speaking of runoffs in that Georgia Republican Senate primary and the gubernatorial race as well, those races could very well head to runoffs as these fields are crowded.
It's most likely. Maybe we'll be back here in a couple of weeks. We're going to talk to Bloomberg's Washington correspondent Tyler Kendall about all of this, including some emerging headlines that have to do with the war in Iran. And we'll also be keeping tabs on the markets throughout the next 2 hours here in Atlanta.
Yeah, the bond market especially, with the 30-year yield at the highest since 2007. So let's get a check on that and everything else as we turn to Charlie Pellet, who's in New York. Hey, Charlie.
Hi, thank you very much, Kaylee and Joe. Right now, the 30-year, 5.18%. Putting it all in context, 10-year, 4.67%, with the 2-year right now, 4.12% in terms of equities. The crowded chipmaker trade continues to unravel, dragging down stocks. The S&P retreating further from its previous record, down now at 73.49, down 53 points on the S&P, a drop of 0.7%. Dow Industrials down 280 now, decline there of 0.6%. Nasdaq down 286, drop there of 1.1%. And the SOX, the Philadelphia Semiconductor Stock Index, down now by 0.7%. Again, that 30-year bears repeating, 5.18%. Spot gold down $65 the ounce, just above 4,500 now, down 1.4%. West Texas intermediate crude oil turning around, up 0.1%, 108.80 a barrel. Barrel of Brent closing in on $111, hovering right around that level, down today by 1%. So bottom line here, Brent oil is trading lower, this after President Trump said he had called off a strike on Iran following an appeal by Persian Gulf allies. Henrietta Trey's is Director of Economic Policy Research at Veda Partners, and on Surveillance this morning, she explained why the president is holding off.
The Gulf is closed, the Strait is closed, and inflation continues to seep across the entire economy into wholesale data, into PPI data, and the Strait is the problem. So escalating and further incapacitating energy refiners in the entire region is only going to exacerbate the problem. So the president doesn't have a good choice here.
Henrietta Trey's of Vader Partners interviewed this morning on surveillance. By the way, you can hear more of the conversation on the Surveillance podcast. You can download that wherever you get your podcasts. Chip stocks hit hard again today. The closely watched gauge of semiconductor shares, the SOX, extending a 3-day rout. Right now, we do have the SOX trading lower. It is down today by just about 0.6%. Among some of the names that make up that index, NVIDIA, which reports tomorrow, down 0.6%. Texas Instruments up 0.1%. Micron Technology up 2.4%. Advanced Micro Devices and Intel also trading lower. Again, recapping, stocks are declining. S&P down 0.7%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet checking on the markets on this Tuesday. Thank you so much. Of course, it's not just any Tuesday. It is Primary Tuesday across a number of states across the country, including here in Georgia, where we are coming to you live here on Bloomberg. Of course, we'll be speaking with many voices well-versed in politics and business in this state over the next 2 hours. And of course, we're finding that as voters head to the polls today, in the conversations we've had thus far, Joe, a lot of it does come back to the ongoing war in Iran and the impact it is having economically here at home via higher gas prices, diesel prices, other concerns. And it doesn't necessarily seem that on that particular issue, things are looking up. After President Trump called off planned strikes for today, at least he said that they were planned for today, he's now suggesting could resume in 2 to 3 days, tail end of this week, if there's no deal.
Yeah, 2 to 3 days, he mentioned to reporters on a tour of the construction site that will be the ballroom, assuming that this gets done. President said a lot of things, and now we're hearing that NATO may be chipping in to help reopen the strait. But you're right, Kaylee, whether we're talking about the price of gas, whether that's diesel or crude in triple digits, food prices are something we've heard a lot about here since we've been on the ground talking with campaign operatives, just getting a sense of what voters are saying. And that price of gasoline, just at about $4 a gallon, almost to the penny here in the state of Georgia, of course about 4.5 nationally, is something you just can't hide from. So as we talk about, the local elections here in Georgia, it's going to be pretty hard to avoid what's happening in Iran. And Tyler will, of course, help us tie all that together.
Indeed. So let's go to her now. Our Washington correspondent, Tyler Kendall, is with us. So, Tyler, if we could just begin with what the president is saying today on Iran after calling off strikes that were planned for today. He's now suggesting maybe Friday, Saturday, Sunday, early next week, these could resume. Do we have a firm understanding of what it is that will make the president ultimately decide whether or not to go forward?
Well, Kaylee, President Trump has maintained that he is unhappy with the latest counter proposal from Iran. We actually heard the same thing from the Iranian side of things as well yesterday, too. Both sides rejecting the freshest responses from each other. As you outlined, President Trump says that there will only be a limited amount of time to get Iran to the negotiating table as he calls off what he says were planned attacks slated for today at the urging of regional allies like Qatar, the UAE, Saudi Arabia, these countries that have been the target of Iranian retaliation since this conflict began. The thing is, we haven't really gotten any firmer details from the White House regarding what these plans have looked like or will look like, though President Trump has often threatened that military action is still on the table, even as he has said that a diplomatic solution would still be viable here. There has been reporting that in recent weeks, President Trump has been advised that perhaps more limited strikes on Iran could help break the status quo, because at this moment, it's really been gridlock. Yesterday, we heard Iranian officials, including Iran's foreign minister, underscore that the country doesn't want to discuss curbs on its nuclear program, something that President Trump says is mandatory in order for a deal to be reached. Last week, it appeared that we were perhaps inching closer to some sort of agreement that could be phased in. First, there would be a reopening of the Strait of Hormuz, and then we could see some talking about what those curbs on Iran's nuclear program would look like. But at the moment, there hasn't really been any updates about that phased plan. And so far, Joe and Kaylee, the U.S. says that it's not going to let up its leverage when it comes to the blockade in the Strait of Hormuz. CENTCOM gave another update earlier today saying that it has so far redirected 88 commercial vessels in its bid to try to secure the Strait of Hormuz.
Tyler, what do we know about NATO here, considering the idea of escorting ships through the strait? This is something that Donald Trump has been calling for since day one of Iran closing the strait. Why now, and what do we know about it?
the why now question is a really important one, as our reporting indicates that this potential coalition probably wouldn't be launched until July, which is going to put a lot of heightened scrutiny on the annual NATO summit that is happening the first week of July in Turkey. As you mentioned, this is something that our NATO allies have really been wary of when it comes to President Trump's demands for assistance to help secure the Strait of Hormuz. A person familiar with the matter does outline to Bloomberg News that not all NATO member states are on board with this, and you would need a unanimous consent among them in order to see a coalition deployed. But it is significant since so far our allies have maintained that they don't want to deploy military assets or assets to help secure the strait until there is a stronger ceasefire in place, until the fighting has stopped. And as you both well know, it probably doesn't even need to be repeated at this moment. The ceasefire is highly tenuous. It is very fragile. But President Trump has threatened our allies, including pulling out of NATO. Perhaps easier said than done. That would require congressional action, but he hasn't been shy about trying to take some other action regarding our NATO allies when it comes to threats in terms of troops or American joint military involvement.
Well, Tyler, the president also hasn't been shy in sharing what he hopes is the outcome today in a certain primary in Kentucky as he looks for the ouster of the incumbent Republican Tom Massey. He on True Social today called him the worst and most unreliable Republican congressman in the history of our country. He said, Kentucky, get this loser out of politics in today's election. What will it mean for the president if Massey is indeed ousted? Or perhaps what if he ends up sticking around?
Well, Kaylee, this is really seen as one of the big races tonight that is a key test for President Trump's grip on his Republican base as we head forward to November. Just for context here, as of now, this is the most expensive House primary race in U.S. history so far. $33 million have been spent. And as you well know, Republican Congressman Thomas Massey is a libertarian. He is considered, though, to be relatively conservative, but he has long been a thorn in the side of President Trump's when it comes to multiple issues, namely the release of the Epstein files, but also the conflict in Iran, also some of the president's signature legislative achievements. I remember being on Capitol Hill last summer and talking with the congressman about how he opposed and voted against the One Big Beautiful Bill over concerns when it comes to government spending levels. And now we should say most Trump-backed candidates so far have been winning their Republican primaries. Looks at what just happened over the weekend with Senator Bill Cassidy, a Republican in Louisiana, who failed to get President Trump's endorsement amid a long-standing feud. So again, one to watch. We'll see where it goes.
Well, there'll be a lot of scorekeeping, I'm sure, by tomorrow. Tyler, we've got only a minute. Tell us about Texas. He said to reporters, maybe a half hour from now, he's going to make an endorsement in this Senate race after all this time?
Right. It's so significant that this is coming now. President Trump saying that perhaps he's going to release this decision because voting started yesterday in Texas. The runoff is next Tuesday. Of course, we're seeing a race between John Cornyn, who's been in the Senate since 2002, and then Attorney General Ken Paxton, who has perhaps more of that MAGA base behind him. Our reporting had indicated last month that President Trump was very close to throwing his endorsement behind Cornyn after he did so well in, or better than expected, rather, in the primary, though ultimately it appeared that perhaps the administration was a little bit wary about his polling numbers. But Joe and Kaylee, the important part here is that so much money has been flooded into this race against the two Republicans because President Trump hasn't weighed in, which means that they haven't been campaigning against the Democrat in this race.
We've got a scenario kind of like that here in Georgia, as a matter of fact. Tyler, thank you so much. Great to have Tyler Kendall from our Washington Bureau. We are live in Atlanta, Georgia. Primary day and much more straight ahead alongside Kaylee Lines. I'm Joe Matthew. This is Balance of Power, only on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ, all in the red. This is Wall Street's chipmaker trade unravels. The SOX right now is down by 0.4%. Dow, S&P, NASDAQ, all in the red. S&P 500 index at 73.54, drop there of 0.7%. Dow Industrials down 223, a decline there of 0.4%, while the NASDAQ Composite Index trading lower by 274 points, down now by 1%. All of this with the VIX holding right above 18, the 10-year 4.66%, the 2-year 4.12%, and the 30-year currently yielding 5.18%. We've got West Texas Intermediate crude higher, little changed, 108.80 a barrel, up 0.1%. Barrel of Brent down $1 now. It is still above $111 a barrel, down by 1%. New York Governor Kathy Hochul says Long Island Railroad service is back, and in a statement on X, she also says full service will be resumed by 4 p.m., just in time for the Knicks tonight, and of course, the ride home this afternoon. The Dow, the S&P, NASDAQ recapping here, all trading lower. S&P down right now by just about 0.6%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet tracking the markets for us. Thank you so much. I'm Kaylee Lyons alongside Joe Matthew, live in Atlanta, Georgia, where it is primary day today. It's primary day in a number of states across the country, but obviously there are many themes that bring them all together, including the state of the economy, which will be on the mind of voters as they head to the polls in all these states today. And of course, one of the most present obvious signs of economic pressure in the form of higher prices. It's coming still at the gas pump. It is a little bit lower here in Georgia, Joe, than the national average, but still with prices like this, we've heard consistently since arriving here in Atlanta that is a major focus for voters, and frankly, it's one that doesn't look like it has any sign of improving in the near term, so long as the Strait of Hormuz remains closed. Maybe not NATO is going to look to get involved in that in July, but that's still 2 months out. The midterms
you can't remove these two stories, that's for sure. It's top of mind for voters here in Atlanta, throughout the state of Georgia, all 6 states that are voting today. You're right, though, $3.99 on average here in Georgia is better than most in the country, as a matter of fact. We're up $4.53 nationally today, according to AAA. Crude oil is pretty flat, I guess, based on what the president said yesterday, averting another potential strike, as he was suggesting. But look, this is feeding through the core, as we've talked about a lot, and it's making food costs higher as well. So this is obviously something that is going to factor into what many see as local issues, but they're national ones, and they bring us right back to the Middle East. Breck Heidelberg is managing director at FTI Consulting and specializes in risk management, joining us now here at our set in Atlanta. Breck, it's great to have you as part of our conversation. Thanks for being with us today on Bloomberg. Do you see that in the way that we're characterizing it? People might not even know that connection to the Strait of Hormuz exists, but the pressures, the cost pressures from this war are driving decisions in local races here in Georgia.
I'd say that's spot on. I think definitely that was the case about not really making the connection of the Strait of Hormuz and gas prices a year ago. But I think now, it's one of those buzzwords everybody's familiar with. It's during COVID, nobody had really talked about a pandemic. Now people couldn't even see or find the Strait of Hormuz on a map. But I'd say nowadays it's changing. I think in Georgia, especially in Atlanta, that's definitely the case in this election. Issues that were not traditionally part of the primary season or top of mind for normal voters, companies, people who work in companies. This is really kind of top of mind right now. And you nailed it with the gas issue. I think that's kind of where this all comes to a head. Seeing gas prices, not just for cars and trucks, but also airfare. Especially now, the primary season hits right at summer travel season, and you mentioned gas prices. But if you check your flights, everything's a lot more expensive now than it was, at spring break and before that. Now it's only going to go up as we start to see the kind of trickles through the economy.
Well, yeah, and that's if there's jet fuel to fuel those planes to have higher ticket prices on said planes. So do you see, from your lens, having worked at the State Department, as any reason for optimism that this is a situation that might improve materially soon? Because it seems like every week Joe and I are having the same conversation. There is no deal. The president wants a deal. He's going to hold off on talks in the pursuit of a deal. But when's the deal actually going to come?
Well, it depends on what kind of deal you want, I think. I mean, and that's the whole problem here is that, both sides have, things that they want. There's criteria that are in their core national interests, and it's hard. It's something that's normally not a short-term thing you do. It takes years. The previous rounds of negotiations took several years, almost a decade. I started a career working under the George W. Bush administration, all the way through the end of the Obama era in a nonpartisan role. But so you see the behind-the-scenes machinations of how these things work. It takes a lot of time, political capital, diplomatic energy to sustain these, and there's a reason why it took so long just to get an interim agreement before. So it's really tough.
Well, now we're looking at a 2 or 3 day timeline, according to the president talking with reporters. 2 or 3 days, we could be striking Iran again. Does that hasten a deal or push it further away?
I mean, I guess there's a lot of things. These are complicated where it doesn't fit neatly in, especially in political season, like a talking point.
Yeah.
These are long, historic issues between the United States and Iran, go back decades. And, they're talking about issues now that took years to get to this point and then are going to take normally years to resolve. So, in the short span, you don't know. I mean, anything is possible. There's always room for, a deal, or at least pushing the status quo to I think everybody just wants to avert further, military action and further, catastrophe in the region and come back to some phase of normal. But what that is, the normal is not going to be the normal there was before the conflict. I think that's one thing people agree on. Like, what comes next is going to be very different than what happened before.
Well, and when we consider what a deal could ultimately look like, presumably Iran is going to want some material sanctions relief, and I know that that's the space that that you focus on. What could that look like in practice? Is it going to unlock global markets for Iranian products? I just wonder how we should expect that to unfold, assuming it happens.
Well, I mean, I think it depends on what that looks like. The devil's going to be in the details, but I mean, none of these things are things that can be resolved overnight, and the market's going to react. Especially when you're dealing in oil prices and energy. These are long-term contracts. It takes a long time for the impacts to be felt. And there may be some short-term impact in Iran, in Iran's economy, if they have access to frozen funds, which most of the, from what I've seen, that's been a lot of the negotiations around. This is Iran's money frozen in accounts. They get it back, and what do they do with it? That's not necessarily going to help the global economy. It might help Iran's economy, help them recover after the conflict, which in theory, the faster they can rebuild, damaged infrastructure, the better that'd be for the oil and gas industry.
Well, so give us the corporate view on this. You've worked with some major corporations in managing risk around certain projects, including Microsoft. How do you make investment decisions right now in such an uncertain environment, or do you start betting on that new normal that you suggested? If we're not going back to where we were, how do you plan for where we're going?
I think you have to bet on the uncertainty continuing. It's one of those things where uncertainty is now certain. It's kind of how you have to look at it. So you can't really expect things to be predictable.
It's job security for you, right?
I guess it's one of those things where in government you wanted to be out of a job if you did your job right. All right, we don't need any non-proliferation specialists anymore. That'd be great. We don't have to worry about these things. But I mean, planning is key. But companies are trying to figure out how do we plan for this situation, and what's next. I think that's what's the next phase of this is really doing more long-term thinking. And but the interesting piece of this is where these conversations are having. Traditionally, like geopolitical risk conversations, these are like grand strategy held at the White House and in capitals and then at the boardroom. Now people in operational level are talking about these issues because now the people who are responsible for moving things overseas or importing things are now impacted. Things used to be the decisions the CEO would make would then kind of trickle down below. Now you're seeing things trickle up to the board because the people who are trying to export chips, like we can't move our stuff to build our projects. Like how do we do that? So now these conversations are happening across the board. And you're also seeing it locally too. People who don't normally care about geopolitical issues are now like really engaged in these issues. So and I think Atlanta is kind of the microcosm of that, of what's happening, in the United States and also globally, where we're home to a lot of multinational companies, either American headquarters or the U.S. headquarters for foreign firms. And so the rubber really hits the road here. You're seeing a lot of conversations at all levels of companies trying to figure out what to do next.
You mentioned exporting chips a moment ago, and obviously we're fresh off President Trump's trip to Beijing. Jensen Huang, the NVIDIA CEO, is along for the ride. We know the U.S. has greenlit the export of H200 chips if China will allow countries to buy them. I wonder what you make of that decision and the entire conversation around exporting these advanced chips specifically to a strategic adversary and competitor.
Well, I'll leave the political aspect of that for some of your other guests, but in terms of the operational aspect, I think it is more uncertainty, I think, in terms of, for export controls are generally well understood. And they are well understood by a certain segment of the industries that are really impacted by this. But now, in the last few years, there's, with the start of the trade wars and tariffs and now export controls and other adjacent policies and regulations, there's a lot more industries and companies that are impacted by this. So we've never had to deal with this. Chips have always been regulated somehow, but not to this extent. So I think there's more now just uncertainty of like, oh wait, what can we do? Like, where can we export these? And that, from the business planning perspective, is very hard because you have to plan ahead, knowing we need to buy these amount of chips from certain companies that make them and try to sell them to build our data centers or sell them to your resellers. That's really hard if you don't know what the final rules are going to be.
Hey, Breck, we just got a seismic post from President Trump, so pardon the interruption here. I can't get over this, Kaylee. He has made an endorsement, as we told you would happen, in the Texas Senate primary, and he did not choose the incumbent.
No.
Ken Paxton, the Attorney General, gets the support of Donald Trump. This is remarkable. To consider this moment when John Cornyn could have been the majority leader in the Senate a couple of years ago, this could mean a very decisive end to this primary.
Yeah, the president saying John Cornyn is a good man and I worked well with him, but he was, quote, not supportive of me when times are tough. He says Ken is a true MAGA warrior who has always delivered for Texas and will continue to do so in the United States Senate. Of course, that is assuming that Paxton can win against the Democrat in this race, James Tallarico. And the prevailing wisdom among most political strategists we've spoken with is it would be easier for Tallarico to defeat Ken Paxton than John Cornyn in a general. It is a testament to how different primary politics can be to general election
Where
politics.
the establishment candidate might have more appeal broadly in a general election. Donald Trump does go on to talk about Cornyn. He says he's a good man and I worked well with him, but he was not supportive of me when times were tough. And despite having the most successful economy in the history of our country during my first term, and he goes on to list a series of achievements considered many to be legendary, John was very late in backing me in what turned out to be an historic run for the Republican nomination and then the presidency itself. Donald Trump backing Ken Paxton today in a breaking story here on the terminal.
Yeah, and I will be looking closely at the reaction from Senate leadership, including the Majority Leader, John Thune, perhaps Tim Scott, who chairs the NRSC, knowing that they, the establishment in Washington, if you will, wanted John Cornyn ultimately to win this race. They have poured immense resources already into this primary, trying to ensure that happens, running attack ads against Paxton. It looks like a lot of that money may have just gone to waste. Of course, that is why so many in the establishment were encouraging President Trump to step in and make an endorsement sooner than this. He's waited some time, remembering this runoff voting is already underway, and of course it is final as of next week.
In all caps, Ken Paxton will never let you down! Exclamation point. Donald Trump on Truth Social turning away from the establishment candidate, the incumbent John Cornyn, longtime senior senator in Texas. I'm sure this is not considered good news by his camp. James Tallarico might like this headline, though, Kaylee, as you mentioned. We'll have to invite him back to the program. I hope we can invite Breck Heidelberg back to the program as well. Breck, FTI Consulting on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. President Trump has endorsed Texas Attorney General Ken Paxton in the state's Republican Senate primary. Trump cast incumbent Senator John Cornyn as insufficiently supportive of his agenda, saying, quote, "He was not supportive of me when times were tough." We'll have more coming up right here on Bloomberg Balance of Power. And in the New York metro area, specifically Long Island, Governor Hochul says LIRR service will be back in full operation by 4 p.m. Wall Street time. Stocks are being hit again today by a chipmaker rout. We've got the Dow, the S&P, NASDAQ all in the red. The S&P down 32 right now at 73.70, a drop there of 0.4%. NASDAQ lower now by 0.3%. Right now we have got NASDAQ, the NASDAQ 100 index down 0.4. And to be sure, the NASDAQ Composite Index down 0.7. The Dow is down by 0.3%. The SOX, the Philadelphia Semiconductor Stock Index, actually turning around now, higher by 0.7%. We do have the 10-year 4.66%, the 2-year 4.12%, and the 30-year 5.17%. Gold down 1.3%, 45.07 the ounce, while West Texas Intermediate crude lower a little, changed 108.61 a barrel, down under 0.1%. Barrel of Brent just above $111, down now by 1%. Kevin Warsh will be sworn in Friday as Fed chair during a ceremony at the White House with President Trump administering the oath. The president told the Washington Examiner he will let Warsh decide what to do with interest rates. Joe Livornia is chief economist Americas at SMBC Nikko Securities America, and on surveillance this morning, he was asked about the Fed under Warsh.
Kevin Warsh will do a great job. I'm very confident of that. However, I don't see how Kevin's going to make a plausible case for rate cuts. Yeah. It's just not there. And if the market continues to price tightening, maybe he just pushes back against the committee that's certainly becoming, at least on from the president's, more hawkish. Maybe he pushes back a bit, gets it more center, and then kind of hope for the best. Things maybe unfold in a positive way in the back half of the year.
Joe Livornia of SMBC Nikko Securities America interviewed on surveillance. 8,000 job cuts at London-based Standard Charters, with CEO Bill Winters warning that a push into AI will replace, quote, lower value human capital with technology. Shares of the bank right now down by 2.9%. Recapping, S&P down 0.4%. We've got the 30-year yielding 5.17%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet. We'll be back with more on the markets coming up at the top of the hour, 1 p.m. Eastern Time, as we welcome our global television audience to the conversation and keep the train rolling here on primary day. We're going to expect a lot of breaking news this evening with 6 states going to the polls. Right here in Atlanta, Georgia, we've set up camp for a couple of days here to watch specifically a series of races here, including the Senate primary that will likely lead to a runoff. But there's a whole other Senate primary that we're talking about suddenly, thanks to Donald Trump. Kaylee, the headline on the terminal says it all. It's a jaw dropper. Trump backs Paxton over incumbent Cornyn in Texas Senate primary. This is an earth shaker in the Lone Star State.
Yeah, and it's an endorsement that has been long awaited and is coming quite late. Early voting has already started in the runoff between these two gentlemen in Texas. That runoff, of course, taking place next Tuesday, May 26th. But President Trump encouraging voters to go for Paxton over Cornyn, calling Ken Paxton a MAGA warrior, talking about how, in the president's mind at least, he is someone who will pursue the passage of the SAVE Act if elected to the Senate, as well as the ending of the filibuster. He calls, in his True Social post, Senator John Cornyn a good man, but saying that he wasn't always there for him when times were tough, keeping in mind, of course, that it is John Cornyn, the incumbent, who Republican leadership in Washington, in the Senate, were hoping would ultimately be victorious in this primary, as they see him as standing the best chance against the Democratic challenger, James Tallarico.
The man who could have been majority leader in an incredible turn in his political fortunes with the president weighing in. He's got a couple of other endorsements that we're going to be tracking in the states voting tonight, Kaylee, but in the next week or so, this is going to have a seismic impact on the Senate runoff in Texas.
Yeah, so let's get a little bit more on this now as we turn to our colleague Tyler Kendall, our Washington correspondent, who is in our D.C. studio. So, Tyler, when we consider how long it took the president to make this endorsement, do we have an understanding of why now and why this choice?
Well,
Well, Kaylee, President Trump did tell reporters earlier at the White House that part of why he wanted to lend his support at this moment is just because what you mentioned, that early voting had already started yesterday ahead of next Tuesday's runoff race. And President Trump told the reporters just then that he had long wanted to make this endorsement, but had so far held off, considering these two candidates were polling very close together when it came to the primary election back in March. It is considered, though, to be highly significant as Ken Paxton clinches this endorsement. And you read some of President Trump's statement out on Truth Social there, but I also wanted to highlight how in one of the first lines he called Paxton, quote, extremely loyal, going on to indicate that John Cornyn, while, as you mentioned, is a, quote, good man, he talks about how Cornyn was delayed, in his words, to endorsing him for the Republican nomination in 2024. I pulled it back up. Cornyn's nomination came after Governor Ron DeSantis dropped out of the race, and it was only between President Trump and Nikki Haley. And in President Trump's view, this is something that he has held on to when it comes to his disagreements with the senator who has held this seat since 2002. Now, when we're talking about just how remarkable this is coming at this point in time, it's important to highlight that so much money has been funneled into this race, 80% of which has actually come from Cornyn's camp in terms of attack ads and defending ads. But that means that all of this money is instead going to the two Republican candidates instead of towards the Democratic candidate, James Tallarico. Now, while still a long shot bid, Democrats haven't won a statewide office in Texas since 1994. This does risk momentum for Republicans because so much focus has been between Paxton versus Cornyn instead of a Republican versus a Democrat.
Can't get over this one, Tyler. We'll pull you back in when the next one breaks. Thanks for jumping back on with us. Tyler Kendall, our Washington correspondent, with a breaking story, courtesy Truth Social. And we want to extend our conversation with a Republican strategist who's with us here at our desk in Atlanta, Georgia. Stephen Lawson is principal in Denton's Regulatory Public Policy and Government Affairs Practice. And as I mentioned, a GOP strategist. It's great to see you, sir. Welcome to our conversation today. We thought we'd be talking Georgia politics, and we will, but I'm just curious, your first blush reaction to this one, the president deciding that loyalty is what matters most. How does that collide with electability?
Yeah, I mean, that's always the rub, right? I think you're seeing Donald Trump trying to play kingmaker in Texas as he has in other states. We've seen this unfold in Indiana. We saw it late last week in Louisiana. And so I think you're seeing the president continue to push the boundaries on that and really try to make his endorsement go a long way.
Well, and we have a mixed track record for President Trump when it comes to these endorsements and primaries, specifically. Take here in Georgia and Herschel Walker. And I wonder if you think the president may be misguided in terms of his primary selections with general election dynamics in mind in November. Is Ken Paxton the more dangerous choice?
Yeah, potentially. I mean, I think John Cornyn probably had the stronger case to make in a general election. And, you know, that's always the rub. How candidates fare in a primary versus that general election. And I think we are ground zero here in Georgia for that dynamic, as you mentioned, with Herschel Walker. Also, the president endorsing David Perdue against Brian Kemp in 2022. And so we have have an independent streak here in Georgia. It'll be interesting to see how that plays out today and in the weeks ahead.
Before we move on to some of these races in Georgia, should we assume that John Cornyn is down and out? I mean, he's going to be on the ballot. He's got a lot of supporters and he's got a lot of money.
He does, yeah. No, I think this is a huge test for Donald Trump. We've seen him be successful in the previous weeks, but Texas is a different dynamic. John Cornyn has a tremendous amount of goodwill and name ID there, but that race is in neck and neck, and I think it's going to be a photo finish for sure.
Well, we'll all be looking for the outcome of this one next Tuesday. We may have to wait longer for an outcome in another runoff here in Georgia because he has not decided to endorse in this Senate primary either. You have two Republican congressmen, Mike Collins, Buddy Carter, and Derek Dooley, who has been endorsed by the governor. Brian Kemp, the president, has not weighed in on this one. Is he causing this to go to a runoff and more money to be spent Republican on Republican instead of shifting their focus to running against the incumbent Jon Ossoff?
Yeah, this has been a protracted primary that has gone on for well over a year at this point. You mentioned, obviously, Congressman Mike Collins. He's been seen as the front runner in this race for well over a year, followed by Congressman Buddy Carter. Derek Dooley, who the governor has endorsed, has been surging of late. There is some thought that he is going to make it into second place after tonight. And then what does that runoff dynamic look like? Does the the president decide to engage. If it is Mike Collins and Derek Dooley, that sets up for another Kemp versus Trump showdown potentially with the implications big as ever.
Well, Clash of the Titans. Why is the governor putting so much of his capital behind Dooley? He could have ended this himself.
He could have. He was obviously, everyone wanted Brian Kemp to run. He's had a tremendous record here in Georgia as our governor. I think his decision to go all in on Derek Dooley has left some questions with people in Republican circles here. But again, this is someone who has the strongest record of any Republican here. He has the strongest favorability and job approval ratings of any Republican here. And, look, underestimate Brian Kemp at your own peril. But I think this is going to be a really steep hill for Derek Dooley to climb.
Well, how steep is the hill to defeat Jon Ossoff, whoever wins this primary? Because going into this midterm cycle, Ossoff obviously was characterized, and perhaps you still think rightly so, as the most vulnerable incumbent Democrat. Given national politics and the economy and approval of the president's handling of the economy where it is, do you still think that he stands a real chance of losing his seat?
I do, but I think Republicans have made it more difficult with this protracted primary. Regardless of who wins, either tonight and in 4 weeks, is going to be at a significant resource disadvantage. You have a very popular incumbent senator in Jon Ossoff, who is going to stockpile resources and have the cash advantage. But at the same time, we are a battleground state. He has taken a number of very vulnerable votes that I think are not going to sit well in a general election environment. But is that enough in the environment that we're in to keep him from getting reelected? I don't know. You may have another runoff in November, as crazy as that is.
Yeah, well, and gosh, I guess, does this go to a runoff on the gubernatorial race as well? Obviously, this is an open contest, and we do have an endorsement here from Donald Trump and Lieutenant Governor Burt Jones. How much does that mean here in Georgia?
It does mean a lot, but that's another race that's neck and neck. Obviously, you have billionaire outsider Rick Jackson, who has come into this race and completely up into this race.
Big bucks.
In most polls, he's spent well over $100 million. In most polls, he is the front runner right now. I expect after tonight, I think it's going to be a close 1-2 finish between Rick Jackson and Burt Jones, and then it's going to be 4 weeks of a knockdown drag out to see who wins. But I think that is another instance where Donald Trump's endorsement carries power, but what are the limits to that? I think he's testing it here in Georgia.
Well, and when we consider who they could be against, Keisha Lance Bottoms, of course, the former mayor of this city where you are joining us from, is seen as the front runner on the Democratic side. She actually was able to secure the first post-presidency endorsement from former President Biden. Obviously, Georgia has had statewide Republican leadership for some time, even as we saw 2 Democratic senators sent to Georgia in recent years. What would it mean if we were to see a gubernatorial flip in this state?
It would mean the environment is very, very bad for Republicans nationally, and that has trickled down here in Georgia. Obviously, we are a battleground state. I think we are still a center-right state on most days, but we saw this dynamic play out in 2022 when you had 200,000 voters vote for Brian Kemp and Raphael Warnock. That is the segment of the electorate here that is going to determine who wins in November, and that is the segment of the electorate that I think is going to be paying attention to how the national environment looks the most.
Looks like redistricting is about to land on your doorstep here, joining the ranks of many states around the country. Knowing that would be for the next cycle, there's still a lot of focus being paid to the Supreme Court seats that are up right now as well. Because of that issue, I've heard more about those 2 seats than any other since we've been here. What do you expect to happen? Are they flippable?
They are flippable, and I do expect, I think the Democrat challengers to those seats probably have the upper hand right now. They've had tons of national Democrat money pour in to what would otherwise be very sleepy judicial races.
Right.
I think the Democrat...
Barack Obama involved in this.
Correct.
Harris, Holder.
Lots of national figures. I think their game plan was, let's try to sneak up on these races and see if we can flip them. I think given early voting turnout, they are on track to potentially do that. There was a ruling yesterday from the Judicial Qualifying Commission that potentially there may be some questions about ethics violations there in those races, barring them from doing things that they can't do. So that'll be a really interesting wrinkle to unfold. If they were to win, will they then be seated, or will this be a problem for them?
We just have 30 seconds left, but what is the one thing Republicans need to have changed between now, the primary, and the general in November if they want to improve their odds?
Yeah, I think that we've got to stay focused. I think we've got to be united here in Georgia. I think that starts with Donald Trump and Brian Kemp getting on the same page. I think that's critical to our success. But we've got to continue to talk about kitchen table issues, and we've got to focus. There's a great record here in Georgia, despite what's going on nationally, of Republicans being able to deliver that. I think that's what we've got to focus on.
We appreciate you joining us. Republican strategist Stephen Lawson here live with us in Atlanta, Georgia, and our coverage from Georgia on this primary day continues here on Balance of Power.
From Atlanta, Georgia, this is Balance of Power with Joe Matthew and Kaylee Lines.
It's primary day and the polls are open in 6 states, including this one. We've joined you live from Atlanta, Georgia on a special edition of Balance of Power here on Bloomberg TV and radio alongside Kaylee Lines. I'm Joe Matthew, 7 to 7 East Coast time here in Georgia, Kaylee. We're going to be counting votes later this evening. and also tracking Donald Trump's endorsements in a couple of races, including one that just broke, not here, but in Texas.
Yeah, in the Republican primary, which has gone to a runoff scheduled for next Tuesday, President Trump is backing the Attorney General Ken Paxton over the incumbent Republican Senator John Cornyn, a man who could have been the Senate Majority Leader at one point, was seen as a contender for that. He has been backed by Senate leadership and the Senate electoral arm, as they see him as the best chance in retaining Texas as a red seat and defeating the Democratic contender James Tallarico. But Ken Paxton, who President Trump in his True Social post described as a MAGA warrior, is, I guess, the one who ultimately passed the loyalty test.
That's for sure. MAGA trumping the establishment today, as it were, and that could be the case as well in Kentucky. A similar scenario where the president is trying to primary a Republican by the name of Tom Massey, who he refers to as the worst member of Congress in the history of America. It has become the most expensive House race in American history, and just one of the races we'll be tracking tonight.
Yep, more than $30 million spent.
Stunning.
And again, to underscore it, just in the primary. This is where we are in American politics, and we follow it for you here on Bloomberg, just as we follow other things for you as well. There's developments when it comes to Iran, as the president warns that he could strike within 2 to 3 days if no deal is seen. So we will keep tabs on that for you, as we always also keep tabs on financial markets, because quite the moves we're seeing in the bond market today in particular. So for that, we check in with Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee. Indeed, the 30-year right now at 5.17%. The 30-year hitting the highest since 2007. Equities selling off. The Dow, the S&P, NASDAQ, all in the red. The SOX, however, the Philadelphia Stock Exchange's semiconductor index, has turned around. It is higher now by 0.8%, but still losses for the equity market. S&P 500 index down 23, well off session lows, down 0.3%. Dow Industrials down 128, a drop there of 0.3%. NASDAQ down 131 for the NASDAQ Composite Index, a decline there of 0.5%. The 10-year 4.65%, with the 2-year 4.11%, and the 30-year 5.17%. Gold at $45.07 the ounce. Spot gold down 1.3%. West Texas Intermediate crude flat on the day, 108.67 a barrel. Brent 110.72, and again should emphasize the SOX turning around from earlier losses, up now by 0.9%. Among some of the many semiconductor names that make up that index, NVIDIA, which reports tomorrow, higher now by 0.4%. Texas Instruments up 0.7%. Micron up by 5.2%. Advanced Micro Devices does remain lower, a little change, down under 0.1%, and Intel up by 2.3%. Recapping, S&P 500 index down 0.3%. The 30-year 5.17%. The 10-year 4.65%. West Texas Intermediate crude 108.67 a barrel. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet in New York, thank you so much. I'm Caitlin Lyons alongside Joe Matthew here in Georgia, where if you're watching or listening to us from the Peach State, happy primary day to you. Happy primary day to those in Alabama, Kentucky, Pennsylvania, Oregon, and Idaho as well. It is 6 states that are heading to the polls to choose the candidates they'd like to send to November's general election. But it is a 7th state that we actually have our focus on at this hour, thanks in part to President Trump, who has at long last decided to make an endorsement in the Texas Republican primary, not the backing of an incumbent Republican Senator John Cornyn. Instead, the president has thrown his force behind the Attorney General Ken Paxton.
Pretty remarkable, as we add another endorsement to the list, and this one is a bit of a jaw-dropper, Kaylee. Joining us as we broadcast live from the campus of Georgia Tech here with the sounds of the aviary behind us, we turn to a voice of authority here inside Bloomberg. When it comes to elections, we talked to Greg Giroux, Bloomberg Government Senior Elections Reporter. And Greg, I don't know if you saw this one coming. The president decided to go with Ken Paxton. Is it over for John Cornyn?
Certainly a shot in the arm for Ken Paxton. I wasn't sure if this endorsement was ever going to come, because President Trump weeks ago had teased an endorsement in the Texas race, and it never came. So I'm a little bit, I guess, surprised by maybe the late timing of this. It does underscore the White House's confidence that Paxton is probably going to win the runoff. Trump does not take a whole lot of risks when he makes endorsements. But it also underscores, I think, a confidence among the Trump White House that Paxton can hold the seat in November against a determined Democratic opponent and state rep James Tallarico, who's very well funded. Democrats have not won a Senate race in Texas since 1988, and I think the Trump White House is betting that Paxton can continue that streak.
Well, so I guess when we consider streaks here, Greg, I wonder if President Trump is feeling like he's on a bit of a streak himself after successfully leading a push against state senators in the state of Indiana who wouldn't go along with redistricting, seeing pretty much all of them that he wanted out ousted from their seats in their primary. Then, of course, Senator Bill Cassidy in Louisiana this past weekend. He's hoping for the same today in Kentucky, pushing hard for the ouster of Congressman Tom Massey, who has made it onto the enemies list on this retribution tour, if you will. Greg, what will it mean for the president if he is victorious in Massey not being victorious today?
That'd be certainly a big win for the president if he can oust Massey, who I think is a tougher opponent than the Indiana Republican senators who defied him on redistricting earlier this month, or Senator Bill Cassidy, who made himself immediately vulnerable by voting more than 5 years ago to convict President Trump on his second impeachment trial. That's something that Thomas Massey never did. He didn't vote to impeach him or convict him. However, Massey did earn the enmity of the White House by clashing with the president on fiscal policy, on foreign war powers, but probably most conspicuously on transparency related to the release of the files related to Jeffrey Epstein. And Massey's been very, very vocal about that. I think what makes Massey a little bit more difficult to unseat is also he has a very unique political personality in that district. He's represented for over a dozen years, and I think I don't know what's going to happen tonight, but I think Massey's definitely a tough out, even with all of the big spending against him. We've seen more than $32 million spent in advertising this primary, which is more than any House primary in history, according to Ad Impact. Pretty extraordinary.
What do you make of the Senate primary here in Georgia, Greg? The governor could have shut this whole thing down, they say, if he had actually run himself, but he decided to make an endorsement in this case in Derek Dooley, and it looks like this could go to a runoff. Is that the best thing that's happened to Jon Ossoff so far?
Yeah, I mean, the longer that the Georgia Republicans draw this election out, the better for Senator Ossoff, who is the only Democratic senator seeking re-election in the state that Trump carried in 2024. Ossoff, who's unopposed in the primary, never was going to face serious intra-party opposition, can keep building his campaign war chest, which is over $32 million right now as the Republicans continue to spend. We have basically three main candidates in that primary: Congressman Mike Collins, Congressman Buddy Carter of southeastern Georgia, then Derek Dooley, as you mentioned, backed by Governor Kemp. The last ad I saw from Carter attacked Dooley, which makes me believe maybe Mike Collins is in first place, and that Buddy Carter, is trying to catch Derek Dooley for that second spot in what looks to be a likely runoff election in about a month.
All right, Greg Giroux, Bloomberg's very finest, covering races across the country for us. Thank you so much. But of course, it's races here in Georgia that we are focused on today, and the issues that are shaping them, many of which, Joe, of course, come back to the economy, economic conditions here for the consumer and for businesses that operate here. And that's the conversation we want to get to next. As I'm pleased to say, joining us on our set here in Atlanta, again, broadcasting from Georgia Tech's campus, is Katie Kirkpatrick, Metro Atlanta Chamber's CEO. Katie, thank you for being with us.
I'm happy to be here.
On Bloomberg TV and radio. It's great to be in Atlanta. Just, can you give us your sense of what you are hearing, especially from businesses, as to the environment they are currently experiencing here in Atlanta? What are the headwinds? What are the tailwinds?
Yeah, so what's really interesting about Atlanta, that we've been on a 30-year growth streak since we hosted the 1996 Olympics. And so we continue to grow above the national average. We have 70% of Fortune 500 companies have a presence right here in Metro Atlanta. And we're sitting right here in Georgia Tech, which is an incredible asset when you're thinking about recruiting talent. So when you think about your customers, your access to the global economy, when you think about attracting talent, those are the things that businesses really are thinking about that are headquartered or have locations here. So it is a great spot right now for businesses that are here in Atlanta. And I am quite bullish on the growth that we're going to see post-World Cup, which we will be hosting in 27 days.
You connected the dots there nicely, from Olympics to World Cup, and that's a big deal for you, right? It's not just the economic stimulus that comes with such a massive event, but the halo effect. You're still talking about the Olympics this many years later.
Absolutely. We will be celebrating the 30th anniversary of the 1996 this July, right in the heart of the 8 matches that we will be hosting here. And we have seen the halo effect. We have had double-digit growth for more than 30 years here, right here in the Metro Atlanta region, which represents 6.2 million people and growing. And so the investment, the number of jobs created here in that 30 years, we're looking forward to seeing that type of continued growth post-World Cup. And we're looking to welcome the world.
Well, it certainly is exciting. Of course, the attention of the world isn't always on things that are as festive and positive as massive sporting events like that. When we consider the wider geopolitical climate and an ongoing conflict in the Middle East that, of course, has stifled global energy supplies, how is that feeding through to businesses here? Decision-making strategies that they have to pursue and costs that they are facing?
I hear from our business leaders here that they're quite familiar with uncertainty. If you look over the last 6 years, what each CEO has had to deal with, from a pandemic to a labor shortage to inflation to fuel costs, as we're seeing right now due to geopolitical impacts, they just stay the course. I'm hearing from them that they're just focused on their strategic imperatives, their strategic plan. Certainly, these challenges that are created from the world, from either wars or from tariffs or those types of things, they have to take in stride. But at the end of the day, they're focused on their employees, their customers, how they're delivering on their basic value to those that buy their products and their customers, that right now they control what they can control, and then they just keep moving forward.
We'll talk more about their employees and their customers. You're paying about $4 a gallon, it looks like, in Georgia, which is quite a bit below the national average. At a certain point, though, we see a corrosive impact, and then the conversation about the K-shaped economy comes into effect. This obviously disadvantages the people who are most vulnerable. What are you hearing from your members about consumer spending and sentiment?
Yeah, look, you mentioned the K-shaped economy, and so you certainly, as we see with our markets, we see that those that are on the upper end certainly are less impacted by any kind of value proposition in the marketplace. But we do see on the bottom of that curve, we are seeing stress in the market, and we're hearing from small businesses that these costs are not going to be sustainable in order to either keep them in business or keep them in that scaling mode. And so what we're hypersensitive to is how do we build certainty and business certainty in this state to support that continued growth, especially for our small and medium-sized businesses. And in fact, you can look at our governor when you're talking about the fuel prices. We think $4 is high because we're not used to having $4 gasoline here. But he recently suspended the gas tax in the state of Georgia, recognizing that many in our community needed a break. So we have to give him a lot of applause for making that decision.
Well, and I'm also curious how, as businesses are facing higher costs when it comes to inputs as well as labor, how you're hearing them think about deploying artificial intelligence to maybe find greater efficiencies and higher productivity.
That is the question of the day, right? Is how each business can adopt AI depending on what industry segment that you are on. And so I think we're still at the beginning of that AI revolution. It took us 100 years to do the Industrial Revolution. It took us about 30 years to adopt the internet. We're at about year 5 on AI, if you look at the progress there. And my understanding is that many businesses, small businesses, actually have a higher uptake on AI. And I think that's largely because they're using the more simplistic models. When you get into the larger businesses, they are deploying AI, but what I am hearing is that is not at the diminutive or the cuts in jobs. They're looking at it for productivity and efficiency gains and still waiting to see what that next iteration of AI is. You all know that ChatGPT and Claude seem to release a new update every day, it seems like.
Right.
And so if you're building models and thinking about AI in your workplace, you really have to be cognizant of the change that's coming ahead.
You can't have AI without data centers, and I know that's a big growth opportunity and a big debate here, as it is in many states around the country with the competition for water, for power, and other resources. Would you entertain the idea of a data center moratorium if that managed its way onto the ballot, or is there a more nuanced approach to this that the chamber might take?
So I think what's important is to understand the way Georgia has operated over the last couple of decades, which is providing the business certainty. What's important here is you have to look at the investments that have already been made.
Okay.
Our energy supply is abundant and reliable and secure. So on the energy side, we feel really good. On the water side, we've been planning for decades to make sure that we have a reliable and safe water supply here. So what it really boils down to is what that local community is willing to accept in their community. Does it meet the value of the community? Does it meet what their citizens want in their community? It's really important that we think about the role that AI data centers play in economic productivity. And if the U.S. is going to continue to grow and hopefully get to a higher growth rate for our GDP, we're going to have to embrace technology like artificial intelligence and the data centers that we are constructing here.
You mentioned a moment ago how we continue to see new iterations, smarter iterations of these AI models, so much so that some of them actually seem quite frightening, whether you're looking at Anthropic's Mythos that says it can find cyber vulnerabilities, something that is of great concern. How are you hearing from businesses about them trying to insulate themselves against some of those kinds of risks?
Well, the nice thing about Georgia businesses is we're right here in the center of Georgia Tech, which does both creating new models for AI computing, but they're also deeply investing in cybersecurity. So the two go hand in hand. So companies are looking not only about what those large language models are that could support them, but they're also thinking about how to protect their intellectual property, how to protect their data that they collect on a daily basis. And by the way, that's nothing new. Businesses have been in the cybersecurity space for a long period of time, but they go hand in hand. It's not an or, it's an and.
Is the chamber, are you prepared for a new governor? This is a big transition for the state.
Of course. We seem to get one every 8 years.
Yes, you sure do.
And so we are a nonpartisan entity that works with whomever is elected, both at the city or the state level. Our issues don't change depending on who our leadership is. We want a strong business climate that provides certainty for business to grow. We want an educated workforce, and we want connectivity to the world. And so whoever is elected, we will carry that message to them.
Fantastic. Katie Kirkpatrick, the Metro Atlanta Chamber. She's the CEO, and we appreciate you bringing us into your world here. It's great to be on the ground in Atlanta and here at Georgia Tech.
Thank you so much.
Absolutely. Alongside Kaylee Lyons, I'm Joe Matthew, and this is a special edition of Balance of Power, live in Atlanta, Georgia, where voting is underway right now and will be for several more hours before we start counting votes, knowing, Kaylee, that there was an early vote here that set a record in Georgia.
Yes,
1 million people, up 15% from what we saw the year earlier, or the cycle earlier, I should say. And so we're going to be tracking a series of primaries here and in 5 other states. I should also mention Texas. If you're just joining us, President Trump has made an endorsement. He chose the Attorney General Ken Paxton over the incumbent Senator John Cornyn.
Yep, absolutely incredible. And that's, of course, a runoff that we're following next Tuesday, keeping in mind that many of the races here today, whether it's the Senate or gubernatorial, could head to runoffs themselves in June. So it's a lot that we'll continue to follow for you live from Atlanta here on Bloomberg TV and radio.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Developing story with bankers preparing to sell $49 billion of debt to back Paramount Skydance's takeover of Warner Brothers Discovery in one of the most highly anticipated financing deals of the year. Now, sources tell Bloomberg a pre-marketing process is expected to launch as soon as the next couple of weeks. Right now, looking at Paramount Skydance shares, they are down by 0.1%. Warner Brothers Discovery, WBD on the ticker, up now by about 0.3%. We do have the NASDAQ 100 index turning around higher now by under 0.1%. S&P well off session lows, down now by just 9 points, down 0.1%. The latest bout of weakness in bonds is lifting yields to multi-year highs, and that is reducing the appetite for stocks. Dow Industrials down 108 right now, down 0.2%. The S&P, as I mentioned, down 0.1%. NASDAQ down 0.2%, but the NASDAQ 100 index higher now by 0.1%. The SOX has also turned around. The Philadelphia Stock Exchange's semiconductor index now higher by 1.8%. All of this with a 10-year at 4.65%, the 2-year 4.10%, and the 30-year 5.16%. Gold down 1.3%, 45.07 the ounce. West Texas Intermediate crude little changed, 108.62 a barrel. Brent 110.85, down now by 1%. Doug Ostrover, the billionaire co-founder of Blue Owl Capital, is unloading his stake in the NFL's Washington Commanders. Sources tell Bloomberg Ostrover's selling his stake back to the Josh Harris-led ownership group. Recapping, S&P down 8 points now, down 0.1% with a 30-year 5.17%. Balance of power continues now. And back we go to Atlanta. Once again, your hosts, Joe Matthew and Kaylee Lyons.
Sassy or anything. All right, Charlie Pellet, thank you so much. We are indeed live in Atlanta today, as it is primary day in Georgia, as well as in 5 other states across the country that we are following. But it is a race in Texas that has our attention at this hour, as President Trump, of course, within the last hour, has chosen to endorse Republican Attorney General Ken Paxton over the incumbent Republican Senator John Cornyn in the Republican runoff for that Senate seat, which is, of course, scheduled for next Tuesday, although voting has already begun. And we have just gotten a response to that from the incumbent John Cornyn, who has taken to Twitter, Joe, to say the following. He talks about how he has voted and worked closely with President Trump through both of his presidential terms, voted with him more than 99% of the time. He says, and this is the words of the senator, he has consistently called me a friend in this race. It is now time for Republican voters to decide if they want a strong nominee to help GOP candidates down ballot and defeat Tallarico in November, or a weak nominee who jeopardizes everything we care about. He ends his statement with, I trust the Republican voters of Texas.
So he's running.
Yeah, not dropping out.
Exactly, yes, I joke, of course, and this comes after the president said specifically in his lengthy post on Truth Social, John Cornyn is a good man and I worked well with him, but he was not supportive of me when times were tough, despite having the most successful economy in history. This seems to be a loyalty play for the president, but it might not be a good general election play, as the conventional wisdom, duly noted here already, is that Cornyn would have been a more formidable opponent for James Tallarico, who must be pleased to some extent, Kaylee, with this news.
Yeah, and incredible that Cornyn's statement calls out Tallarico specifically, alluding to that kind of dynamic. And when we consider the dynamics overall, it is, of course, against a national climate that right now, based on history and economic reality, does not seem to favor Republicans, in part, of course, due to higher gas prices emanating from the war in Iran and the closure of the Strait of Hormuz.
Yeah, that's right. Tyler Kendall has been tracking all of this in Washington, and we just want to get an update now from our Washington correspondent with important news from the White House. Tyler, this, of course, is not the only endorsement. This is a breaker right now, but the president's got a series of endorsements that we'll be tracking throughout the evening. How important is this one?
When it comes to Ken Paxton's endorsement, Joe?
Yeah.
I mean, it's going to be a critical one, and it's just remarkable considering how long it took President Trump to make it, considering that we know nearly $26 million have been spent by Republicans when it comes to this race, but that money has gone for Republican versus Republican attack ads instead of Republican versus Democratic attack ads. This is going to be a test of President Trump's endorsement and appeal to the MAGA base as we head into November. President Trump so far has had a pretty solid track record when it comes to his endorsement style. But the question is, will that result in tangible results for Republicans when they are up against Democrats? Because as you both were mentioning, we know that the cost of living is really at the forefront of the conversation. I don't have to tell you guys that affordability remains the #1 issue. And a new poll out from CNN earlier this week finds that 55% of Republicans say that President Trump's policies have increased their household costs. At the end of the day, though, President Trump is urging patience of the American people, telling them that this will only be a short-term disruption. He was asked earlier today at the White House what potential other items could be on the table to bring down fuel costs. He said there are some other initiatives in the pipeline that he's looking at, as we know that the White House has urged Congress to take up and pass a temporary federal gas tax holiday. We'll see where this ultimately shakes out, though, Joe and Kaylee, because even as the president says that this will be short term, there are big questions here about the timeline, as it appears that we are no closer towards a deal. The president saying earlier he's giving Iran a limited amount of time to come to the table after previously pulling back what he says were planned attacks slated for later today.
All right, Bloomberg's Tyler Kendall live in Washington for us. Thank you so much. And joining us now live in Atlanta at our pseudo studio here at Georgia Tech, where we are broadcasting to you live from Bloomberg TV and Radio, is Paige Alexander, the CEO of the Carter Center. Great to see you. Thank you so much. There's obviously a major legacy that we can discuss of President Jimmy Carter here in Georgia, nationally and globally. But part of what the Carter Center does is elections monitoring around the world and here in the U.S. So on this primary day, I wonder how you are thinking about that work and how you may be engaged in that work here in Georgia as voters head to the polls or are already voting.
Sure. Well, welcome to Hotlanta. I appreciate being here.
It is hot.
Yes. I should talk about nonpartisan election observation, because that's what we do. There are winners and losers in every election, and the voters make that decision. And what we at the Carter Center have done in 128 elections in 40 different countries is to very specifically look at the legal framework surrounding elections. And so we're not doing vote tabulation. We are looking specifically at whether the laws are being followed before Election Day, on Election Day, and afterwards. And so we're doing that here in Atlanta in 3 different counties today.
Do you expect a smooth, a successful election here? And have you had any instances or expect to have any instances where you see ICE at a polling site?
We have not, and I would say that Georgia has the smoothest, safest, most secure elections with the paper ballots. It's been counted and recounted numerous times, and we're not worried about that. I think people have gotten out to vote, and early voting numbers were very high as well.
Yeah.
Well, and we were just hearing this from our colleague Tyler as well about what is on the minds of voters as they make their decisions at the ballot box, and a lot of that has to do with the economy, higher gas prices emanating from the war in Iran. You have deep experience in the Middle East specifically, and I wonder if you see a real prospect of a near-term resolution to this conflict, and if we are able to get to that end stage, if you will, what has to happen next in terms of recovery and a humanitarian response?
Diplomacy takes a lot of time, and dropping bombs is far easier. And I think that as we look at what needs to be addressed now, it's protection of civilians, it's de-escalating. There are conflicts happening all over the world, and they don't get better with times and with bombs. They get better with conversations, and that's why the Carter Center's worked in conflict resolution in many of these conflict areas, because when the sides talk to each other, it depolarizes the system at hand, and that's what needs to happen in this case.
Keep hearing the line, history echoes. We came awfully close to having a hostage situation with 2 downed airmen in Iran a couple of weeks ago. Thank God they were rescued. But I wonder if you see this administration, folks planning this operation, as having learned from the experiences that President Carter had with Iran.
President Carter, just as with elections, he won some and he lost some famously. Yeah. And he had the situation in Iran back in the day. And for the lessons that we learn as a community, as a global community, it's to know who your friends and allies are. And those conversations have to happen. They have to happen directly with our allies. And I think that lesson is still being learned.
Well, when we consider working with allies, obviously there are allies like Ukraine, for example, who have been dealing with a war that Russia instigated for years now. There's obviously a recovery effort that needs to happen there. Our ally Israel has been waging war in Lebanon against Hezbollah. We have seen destruction, let alone to speak of the destruction in Gaza. How is the Carter Center involved in all of these different theaters in the rebuilding that will need to happen?
Well, you're here in Atlanta, which is the global health capital of the United States. I mean, you've got Emory University, the Task Force for Global Health, the Carter Center, CDC. And I think one of the things we have learned is that all of these pieces have to work together. And so although the conflicts are boiling, we also have a global health emergency going on at the same time. And if you do not have these strong organs outside of government that are able to step in, then I think that's when it's like a heart being on bypass. If you take the heart off bypass, if the organs and muscles aren't working. So I consider groups like the Carter Center and others in Atlanta as those muscles and organs.
Just to add to what Kaylee said, you were instrumental in spending a lot of time in helping to rebuild in the Balkans. And I wonder if it's too early, or if it's ever too early to start talking about rebuilding in a place like Ukraine, if not Gaza.
Yeah, so, and the work that we've done, we at the Carter Center do less in infrastructure, but when you look at the permissive environments of allowing us to go in and do mine removal, I have mines removed in Syria so farming can get back to where it is. We have done digital mapping of where those mines are. And so it's never too early, but the important thing is to have the conversations ahead of time. I mean, not to be Pollyannish about it, but at the end of the day, you know, we shouldn't be in a situation where we're reconstructing entire countries.
I want to go back to the global public health issues that you were speaking to a moment ago. We obviously are seeing an Ebola outbreak right now. And I wonder if you think that that is due to some of the policy decisions that this administration has made in pulling back funding, whether it's for global health efforts, USAID, or others.
Right. Well, I think that we've seen the destruction and devastation of the healthcare sector and of foreign aid. We are going to reap the benefits of whatever efficiencies were found by basically not being able to protect our borders. Global health policy is security. And right now, we are lacking that security. We're lacking a pandemic preparedness. We are lacking the ability to make sure that black flies and mosquitoes don't fly across the border and suddenly we have malaria in the south. I mean, these are issues. Global policy and public policy are all part of health security. And so, yes, I think the Lancet Journal said 14.5 million people are going to die by 2030 because of what happened with USAID. Wow. And the same thing's going to happen with Ebola at this point if we're not able to address it because we didn't hear about it in time.
It does seem like something we're going to be talking about a lot more, Kaylee, as this is found to be a strain that is going to be extremely difficult to contain. Paige, it's great to meet you, and we appreciate your joining our conversation today in Atlanta. Paige Alexander, the CEO of the Carter Center, with us here on a special edition of Balance of Power. Primary day in Georgia. Polls are open, and we're going to be talking about all the races in not only Georgia, but the other 5 states throughout the day here on Bloomberg.
Indeed, we will. Thanks for being with us. I'm Kaylee Lines, alongside Joe Matthew, live in Atlanta on Bloomberg TV and radio.
1:40 on Wall Street. We do check markets all day long here at Bloomberg. Dip buyers emerge for semiconductors. We've got the stocks up by 1.6%. The NASDAQ 100 index in the green. The Dow, the S&P, NASDAQ all remain lower. Right now, we got the S&P well off session lows, down 13, 73.90, down by about 0.2%. The Dow down 111 now, down 0.2%. NASDAQ Composite down 73 for NASDAQ, a decline of just under 0.3%. The NASDAQ 100 index up by 11 points, up under 0.1%. The SOX, the Philadelphia Semiconductor Stock Index, is up by 1.6%. The 10-year right now at 4.65%. The 2-year 4.10%, and the 30-year 5.17%. We do have gold down 1.4%, 45.03 the ounce. West Texas Intermediate crude 107.79 a barrel, down 0.8%. Barrel of Brent 110.39 now, lower by 1.5%. After earnings, Home Depot up now by 0.4%. We'll be hearing from Lowe's rival tomorrow. Right now, Lowe's shares unchanged on the day. Recapping, the Dow, the S&P, NASDAQ do remain lower, down 0.2%, but the NASDAQ 100 index up under 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Back we go to Atlanta. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. Atlanta, Georgia is indeed where you find us today here on Bloomberg TV and radio. We are here for the state's primary, one of 6 that is happening across the country today in terms of primary votes. Of course, when we consider some of the races here in Georgia specifically, be it the Republican Senate primary or the gubernatorial race, they very likely could not be decided.
That's right.
Ultimately, in today's vote, they could run into a runoff June 16th, so about a month from now. And of course, one day later, June 17th, is when the incumbent Republican governor, who is not going to be governor for much longer, Brian Kemp, has called a special legislative session here in Georgia to reconsider the state's congressional map, not for this cycle, not for the 2026 midterms, but instead for 2028.
That wave of redistricting is going to go beyond this cycle, which is something that we discussed with Congresswoman Nikema Williams, the Democrat whose district includes about 3/4 of Atlanta, was the former chair of the state Democratic Party, joined us here at Georgia Tech to talk about that redistricting effort. Also, the light that it has shined on 2 open Supreme Court seats. I shouldn't say open, contested Supreme Court seats on the state level here. And of course, her own fortunes. Every member of the delegation is running for re-election. Let's listen.
I've only been in Congress 3 terms, and I've had 3 different districts. And so one of those districts was court ordered because we needed fair representation. And so now our governor has called this special session to say that legislators need to come back on June 17th to redraw the lines. After just 2 years ago, a court order said that our lines were not fair and we needed to make sure that all voices were represented in our democracy here. And so now we're going back, and the governor is saying we don't know what those lines will look like, but what we know is that they're changing. And that only hurts the constituents, the people that I serve. Elected officials should not choose who they represent. The voters should choose who represents them. And I always stand on the side of the people. And so we look at everything going on right now where people are choosing if they can put $20 in their gas tank, not knowing how much it really costs to fill up because they only have a certain amount. Gas prices, groceries, housing costs out of control. And we haven't had a special session to address any of those issues. But lo and behold, when it comes to doing whatever Donald Trump wants to happen, to have these rigged maps, then they have time and speed to get these things done.
3 districts in 3 years. There's got to be some kind of a record, Congresswoman. With that said, I've been really taken since we got here over the weekend by how much talk there is over 2 state Supreme Court seats. I realize the Senate gubernatorial races are getting all the ink, but is it because of the effort to redistrict that these local Supreme Court or statewide Supreme Court seats are so important?
So we've seen so many things go to our state Supreme Court, from things like your First Amendment rights down at the state capitol that I was involved in, from reproductive freedom. We've seen these high-profile cases where women have literally died in Georgia because of decisions that were made by a legislature that were our state Supreme Court decided on. And so now we have an opportunity to have 2 Democratic women representing us on the Georgia Supreme Court. And so this has been a race that used to be on the general election ballot in November. And Republicans in our state changed it to the primary, thinking that that would help them. And so I think we're going to be in for a surprise. So stay tuned till tomorrow night when the polls close.
And staying tuned, we are on this primary day tonight as well. That was our conversation, or part of it, with Democratic Congresswoman Makema Williams, who represents Georgia's 5th District. And as we heard from the Congresswoman, and we have heard in many of our conversations here in Georgia thus far, a lot of voter sentiment, it seems, is being driven by the economic reality that they are facing and pressure from higher prices at the gas pump specifically. And the question we have, and we have it on this network here on Bloomberg TV and radio overall, is how quickly that could filter into the wider economy as we consider consumption decisions being made.
Yeah, and we're seeing that a bit of a bleed into the core in the most recent CPI report. So some of this, based on what we're seeing in the bond market, is inevitable. I mean, interest rates are rising on their own, which is going to make a very difficult set of circumstances for Kevin Warsh as the new chair of the Fed. It also makes for a pretty difficult set of circumstances for retail-facing businesses. The restaurant industry is a huge one, Kaylee. We're in one of the great restaurant towns in the country right now, as we've been attempting to enjoy after hours here, and their input costs are through the roof, and they're dealing with a consumer that's very anxious.
Yeah, and so this is the conversation we want to have here in Atlanta as we turn now to Georgia's Restaurant Association President, Stephanie Fisher, who is here with us on set on Georgia Tech's campus. Stephanie, welcome to Bloomberg TV and radio. And we appreciate you joining us, and we know you're joining us fresh off of a meeting with some executives in the restaurant space. And I wonder what you're hearing from them about the economic environment that they are currently experiencing.
You are right. So welcome. I mean, thank you very much for having me on the show today.
Indeed.
And yes, so I spent the morning with some of our members, restaurant members in the Marietta area. And, you know, honestly, while things are okay, you know, they're definitely getting hit with pressures from just, you know, the conflict in Iran and honestly, it's not so much the cost pressures, but when gas prices go up, they see lesser foot traffic.
Interesting.
And
so there is a direct correlation.
There has been a direct correlation, yeah. And when prices went down just a couple of weeks ago, they definitely saw foot traffic come back up. But when the prices just jumped again, you know, they saw it kind of decrease a little bit.
Makes you think twice about going out.
Yes.
Diesel is, of course, also rising, which makes shipping goods a lot more expensive. This, I'm sure, is hitting home for a lot of your members as well.
It is, and, you know, hopefully this is temporary.
Yeah.
And restaurateurs know, you know, there's maybe some other things that they need to look at on their menu to maybe lessen that impact, look at different vendors, maybe source more locally, and then getting it shipped in.
That's actually fascinating. This helps the local food movement
It does.
because you're paying less to ship. What other kinds of decisions are restaurants making right now, or is there some time? Is there some cushion before you need to start reconsidering costs, labor, et cetera?
You know, since the pandemic, and we hate to say that word anymore, but, you know, honestly, prices have gone up. Everybody has known that. They've gone up for our consumers, and there's a reaching point that we have to make sure that we don't price ourselves out of the market. So I think our restaurateurs understand that they just can't raise prices when they want to. They need to be very strategic about it. So like I mentioned earlier, there's other things that they can do. Can you take some menu items off that maybe are don't have a great margin? Can you look at different vendors? Can you, like I said, you know, maybe source locally and help our Georgia-grown product here in the state of Georgia?
Yeah.
So they don't reach for labor and job cuts first, is what you're saying?
Not if they don't have to. I mean, the labor is definitely better than it was, but they still struggle. They still struggle, and you know, there's certain positions, kitchen, and maybe, you know, managers that are harder to source, and getting qualified candidates through the door is probably their biggest issue. But why don't we look at technology? You know, how can they work with technology to then take that labor and place it somewhere else where it's actually needed?
We're in Midtown, and we're surrounded by snazzy restaurants that have the benefit of tourism traffic and a lot of other factors that smaller neighborhood establishments do not enjoy. But you can't have a city like this without them. Is it more difficult for small restaurant owners to compete with the big guys?
You know, I don't think so.
Yeah.
I think it depends on where you are. Yes, we're in beautiful Midtown.
Right.
You've got downtown, which is definitely growing, getting a revitalization. You've got West Midtown, but you know, there's other areas in the city that definitely are growing. The Georgia 400 corridor. You've got Alpharetta, Roswell, Milton. Then you've got you know, Gwinnett County. So there's a lot of different areas that are definitely growing, whether it's independent or some of the larger restaurant groups.
Well, and what kind of windfall are restaurants of all sizes anticipating with the World Cup coming to town soon?
I think for restaurants being in the downtown area, the midtown area, Buckhead, I definitely think they will see more traffic, probably from people who are coming here to watch the games. I think the restaurants in our surrounding areas and across the state, actually, you know, producing watch parties, and so you'll get the more local group coming into the restaurants that are outside the city limits.
It's a really interesting restaurant market. If you look at the Michelin Guide, you can find everything from sushi to whatever international flavor you're looking for. But this is also Atlanta. Does soul food still resonate? Like, what are the actual genres of cooking that lead the pack in this town when it comes to your business?
You know, honestly, it's a little bit of everything. Our city is so lucky. We are so diverse.
You didn't reach for lemon pepper wings. I thought you were going to.
You can do.
All right.
You can do lemon pepper wings and definitely soul food. I mean, you know, soul cooking it's incorporated into a lot of different areas.
Sure.
You have Buford Highway, which is just outside of the perimeter, and you know, you've got 26 nationalities within a 7-mile radius. So you want it, you can find it in this city.
Well, we enjoyed some soul food last night, some fried chicken,
exactly.
some good mac and cheese.
That's right.
I believe Joe talked about the best collard greens he's ever had in his life.
Mary Mac's Tea Room.
night.
You know where I'm
Yes,
talking about.
I wouldn't expect anything less.
Fantastic.
Well, and I'm looking forward to more good food after the show. But while we still have you, Stephanie, I want to go back to what you are hearing from restaurant owners in terms of policy that they would like to see. We're here on Election Day. There's going to be decisions made about who is leading the state ultimately, at least after Brian Kemp's tenure is over, who will represent them in Washington. What does the industry want from leaders?
You know, I think what they want, and it was funny because we asked that question today, and it's more so on the local level.
Okay.
It is, you know what, permitting. Make it easier. Make it easier for our restaurateurs, any small business. It's not just restaurants. How can we get permitting where, you know what, it's in a timely manner, liquor license, you know, things like that will help our restaurateurs open faster, because if a restaurant opens, that means more money for the city and then for the state, and it, you know, restaurants are the lifeblood of our communities.
Yeah.
So
it doesn't matter the industry. The answer always comes down to red tape, it seems. That's where you're going, right?
Yes. Yeah.
Amazing. With that said, are you getting the response that you want from officials here in Georgia, or are you telling people to go vote today to find someone who does it better?
I always want everyone to vote because it's your civic duty, and you vote for who you think will represent you best.
Yeah.
We have a great relationship down at the state capitol, and you know, our biggest goal when we're down at the state capitol during session is to educate our lawmakers. So depending if a bill gets dropped and you know if it's going to negatively affect you know the restaurant industry, we're there along with our members because they want to hear from our members, right? So to tell the story. To make sure that we educate them on why this would be bad or good.
And finally, in our last minute here, in terms of your membership, do you expect it's a membership that will grow larger or shrink in this kind of economic environment over, say, the next year?
I would say over the next year, I would like to grow and to make sure that our members and our restaurants here in Georgia understand what we bring to the table for them.
Yeah.
And what our goal here is to make sure that we keep the state one of the most profitable states for our restaurants. That's the most important thing, whether that's through policy or whether it's through resources that we can give to our members. So I am hoping that our membership stays where it is or maybe grows, but only time will tell.
We've only got about 30 seconds. No tax on tips? Thumbs up so far? Is this helping your members?
You know what? I just heard that this morning.
You
that
did?
The servers are happy with no tax on tips. So
there you go.
Yeah.
Well, it's great to have you come directly to see us from your meeting with members, and it's great to meet you. Stephanie Fisher is President and CEO of the Georgia Restaurant Association. Maybe we'll have some tips for us for later on. I'm Joe Matthew alongside Kaylee Lyons here in the beautiful city of Atlanta. It's primary day. Voting is underway now, and we'll meet you back here with a lot more on the late edition of Balance of Power. That starts at 5 p.m. Eastern.
Yep, right at the top of the show, we'll be joined by the mayor of Atlanta, Andre Dickens. That's a conversation that you don't want to miss. So we'll see you then. Just a few hours from now, Joe and I are going to go find ourselves some food. Thanks for being with us on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Yes, indeed. Carol Masser, Tim Stenivek, live here at Bloomberg headquarters in New York City. It is Tuesday, May 19th, and
I feel like we're becoming a little bit of a broken record where we see some pressure on equities as a result of rising yields, although we should point out stocks are certainly off their worst levels of the session.
Yeah, off their worst levels of the session, but we're still seeing the S&P down 0.2%, the NASDAQ down 0.4%. On a day where we're seeing yields, Carol, move higher, the 30-year hitting levels last seen in 2007, boosting the odds that the Fed is going to raise interest rates.
Yeah, 519 is as high I've seen on that 30-year today. So, but you see it. And yet, equities off their worst levels, so willing to rebound. So we'll kind of get into why that's happening. Ahead this hour, we're going to get some different reads, in fact, on the macro environment. We are going to talk that higher yield environment, the market anxiety that creates, and how you look at fixed income versus the equity side of things. We're also going to talk kind of a deep dive into real assets.
Yeah, reads on the economy. Real estate with Brett Mufson, president and partner for the vertically integrated real estate and hospitality group Fontainebleau Development. Get an idea on what's happening in Vegas, too.
Yeah, looking forward to that. And then diamonds, even those grown in the lab. Natalie Morrison is the founder of Astria London. So she's working with Sarah Jessica Parker, and they are doing these lab-grown diamonds. So we're going to see
They're
what she
all
has
the
to
rage
say.
with people getting engaged now.
You go into a jewelry store, there's diamonds, there's lab-growns, there's CZ, and then there's something else in between. There's like all these different layers. So
I just want to know, why wasn't this a thing when I got engaged?
I know. So it's very true. Anyway, we're going to talk to her about the demand and what they're working on. First up, though, let's get a check on that trade, because right now in the S&P, kind of an even amount up and down overall in that average. Charlie, take it away.
I will certainly do that. We are off session lows on the S&P 500 index. Dip buyers coming back into chipland this afternoon. Right now, the SOX up 1.4%. But the Dow, the S&P, NASDAQ, all moving lower. S&P right now down 17, 73.85 where we stand, down 0.2%. Dow Industrials down 104. That is a drop of 0.2%. The NASDAQ Composite Index down 93 for NASDAQ, a decline there of 0.4%. I mentioned the Philadelphia Stock Exchange Semiconductor Index. It is up by 1.4%. The 10-year, 4.64%. The 2-year, 4.09%, and the 30-year currently yielding 5.16%. Gold down 1.4%, 45.01 the ounce, while West Texas Intermediate crude oil currently trading 107.70 a barrel, down 0.9%. Barrel of Brent down 1.4% now, 110.47. Bitcoin down $76. Right now, Bitcoin 76,778. Bitcoin down by about 0.1%. Chip stocks have turned around, as I mentioned, by evidence of the SOX up 1.4%. NVIDIA up 0.4%. NVIDIA will be reporting tomorrow after the close of trading. Texas Instruments now up 1.4%. Micron up 5.8%. Advanced Micro Devices up 0.5%. Intel right now up by 3.6%. Bottom line here, stocks lower, semis higher, and the 10-year currently yielding 4.64%, with the 30-year 5.16%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As you just heard from Charlie, we did see Wall Street's crowded shipmaker trade continue to unravel, dragging down stocks on speculation that a surge from this year's lows has gone too far amid war-fueled inflation risks that are boosting bond yields. Although I should point out, we have also seen the SOX go back into positive territory today. So
yeah, it's
we're
up
definitely off our worst.
1.5% now, but at one point today it was extending this 3-day route.
Yeah, I think what's interesting is like investors are looking like this higher rate environment here to stay. What does it mean in terms of valuations, especially for some of those higher flyers, if you will, in the equity trade?
You mean like the index that's up more than 60% this year?
Exactly. Okay. What did I say? All in on the SOX.
Okay.
That's where I wanted to be. No, I did not do that. We've talked about the rising bond yields, how they are creating those problems for an expensive stock market. So let's jump into our market chat today. Great to have back with us Allie McCartney. She's Private Wealth Advisor, Managing Director, Wealth Management with UBS Alignment Partners. They've got just about $1 billion in assets under management here in studio. And joining us on Zoom is our own Michael McKenzie, Bloomberg News rates reporter. And we're going to get to Michael in just a moment. Got to talk about the rates environment. But Allie, I want to start with you. Stocks for a long time always seem to be looking for reasons to rally. I think it's even happening today today, but it does feel like there's some more concern about this higher rate environment sticking around and what it means for valuations. Stocks was down earlier today, more than about 5% since May 11th. How do you see the market environment and then how higher rates play into it?
A lot in that question. So as you said, we've had 7 weeks of rally, right? We've had, it has been everything's rosy to the extent that we've looked through one of the largest geopolitical and energy issues in 20 years. And so I think what's happening now, although market participants seems to still want to ignore the Strait of Hormuz and the conflict or war, the question now has become about global rates policy and inflation and the link there and what does that mean for stocks. So that's what you're seeing, this back and forth. We now have a clear message that the next move in the UK and Europe from a rates perspective is up. We have the U.S. markets predicting that the next rate is up. We think that it's down, but yields are telling a different story. And so this puts a pause in the rosiness after a market that I think has just from a valuation perspective incorporated the extraordinary earnings season.
Why do you think the next move is down, but the market thinks it's up?
So I think that what the market is not understanding or is not taking a look at is the labor market. And our labor market is this no hire, no fire. It's going to give at some point, whether it's from AI, whether it's pockets of high unemployment in geographies or in 20 to 30-year-olds. And I think that as we look at the combination of, first of all, like the fiscal spending that we have in this country that is really almost more than making up for, sadly, the crowding out that's happening from energy gains, and the fact that from a relative perspective, we are energy independent and our GDP is still growing. And what that usually means is, that there's still room, especially for a Fed that has maybe he's gotten a little more hawkish in terms of Warsh has gotten a little more hawkish over the last few weeks in terms of the commentary. But I think the bias of that committee and certainly his bias in the way he tells us he looks at things is down, not up.
And let's not forget, we'll get some insight into Fed commentary and how they feel when we get the minutes from the latest Fed meeting. I believe that's on Wednesday. Hey, Michael, come on in because we do want to get into the rate backdrop, the trouble that might bring for some of the high flyers in the equity trade. You've got a story on the Bloomberg talking about this surge in longer maturity U.S. Treasury yields testing the resolve of global bond investors, torn between the possibility of locking in the rates near the highest levels in decades and the risk of an even greater sell-off. What's your read on this? What are you hearing from the street? Is it any sign of the rates market basically topping out or not yet, or do we not really know? Michael, hang on a second. We've obviously got some audio problems there, and we're going to hopefully get to Michael, an important voice here for us at Bloomberg when it comes to rates. But I mean, you're talking about, what do you think from the Fed minutes? Does it matter what we get from that on Wednesday in terms of insight, or is NVIDIA earnings more important to you?
Yeah, so look, we're 95% through the earnings picture for the first quarter. We're trending at about 17%. We have two of the stocks, Micron and NVIDIA, will be a full third of that 17% earnings, right? So we still have that concentration, but we also have a lot of breadth. AI is in a new inning, in a new phase, and it is a new tailwind that is not just a tailwind to energy and hyperscalers, but to pharma, to healthcare, to financials. And so I think what we're going to have to do is we're going to have to parse from an equity market perspective the legs of the stool or the drivers that are interest rate sensitive, right? How much of our belief in this market and the valuations and the room for upside has to do with simply thinking that interest rates are going to be lower and the discount cost is lower, and how much is true growth, margin, increase in profitability, et cetera. And I think there is still a very important, impactful, and exponentially growing and widening AI story there about innovation and profitability.
All right. We want to bring in Michael. My understanding is everything's working. Michael, I want to ask you about rates. And I'm just, as you guys write, I think you heard me about your story that investors torn between the possibility of rates near their highest levels in decades, and the risk of an even greater sell-off. I mean, do we really know what happens next, or what are you seeing in terms of commentary and trades that maybe say to you things are headed higher from here?
I think, I mean, if you look at what's happened today, we've seen an enormous amount of selling block trades through Treasury futures, and that's really pushed yields to levels that has actually compelled people that bought Treasuries in the last week or two to cut those trades. And that's more of the fast money, algo trading, hedge fund community. If you talk to asset managers, you take the long-only, long-term view, there has been some buying going on, and they've been looking to scale in. But I think in general, the sentiment seems to be no one's really sure. We seem to be in a bit of a vacuum here, a bit of a pocket, because we're not going to get any serious data until the first week of June. We've got a long weekend coming up this weekend with Memorial Day, and the market is trading disorderly. It is, to quote a few people, it does feel a little unhinged, which is not a good sign. I think in general, the market has repriced the Fed. We're now seeing around 35 basis points of rate hikes priced in by the first quarter for next year. We're close to 20 basis points of a hike by the end of this year. A lot is going to rest on how Kevin Warsh and the Fed look at the data in early June, because this could continue to go. And I think some people are talking about that, the market needs to price in at least 50 basis points of hikes, given the inflation situation. And the fact that until the labor market shows signs of weakening materially, this economy is trundling along. It's got a good fiscal tailwind. AI is delivering very strong profit margins across the board for the S&P 500. So at the moment, the real story is that real yields are rising as well, and that tells you the economy is picking up.
Yeah, despite all of this, we have growth. It's sort of phenomenal, right? We have the corporate investor that continues to invest. They see a lot less uncertainty on the tariff front and on the regulatory front. We have the individual investor, which on the low end is certainly starting to cut in more to their savings and use credit cards more. But we have this economy where the top 10% spend 50%, and they've seen outsized gains in their portfolio. So my guess is that if we don't see a cut, as we expect to in the end of the year or now pushed into next year, that we're at neutral for a bit until we can see what happens. But I would be surprised, given the administration, given the bifurcation in the consumption market, and the growth that we're seeing, to see a hike out of this Fed.
Yeah, well, I mean, there's also the politics of it, too.
Yes.
And the fact that if Warsh were to hike and that would be his first move, I think that would be a very different signal than the president actually wants to see. Michael McKenzie, come on back in here, because when we talk about superlatives like the 30-year yield hitting the highest since 2007, people think back to what happened 2007, 2008, 2009. And I'm wondering, I'm not going to ask you why this time is different, but the signal is different. I think it's fair to say the economy is different. It's fair to say, but why are we seeing a similar move?
Well, if you think back to May, June of 2007, corporate credit was very, very tight. People had piled into corporate credit. The CDO machine was in full flight, and Treasury yields were rising, and everyone was focused on, okay, the Treasury market is sending us a signal. We don't know what that is, and ultimately that broke the credit market. And it also broke the housing market, which, as we now know, was in a bubble. And if we look at today, we have very tight corporate credit spreads. We also have a housing market that is not going to be going anywhere with mortgage rates rising the way they're rising at the moment. And we do know that Treasury Secretary Bessent has made getting housing costs down in terms of mortgages a priority. That's not coming to fruition. So I suspect if we stay higher for longer, it is going to put increased pressure on corporate borrowing. It's going to put increased pressure on people taking out loans. Housing is an important driver of the U.S. economy. So we are very much living in very interesting times, because this can go, again, the AI is helping the economy at the moment. But again, how long is the consumer going to stay basically stay in here when mortgage rates are going up, car loan costs will be going up. This is going to be tough to see whether the U.S. consumer can stay, and keep on trucking.
Michael, I'm going to come back to you in a moment because I'm curious when you say interesting, does that mean recession as part of interesting? But Allie, come on in. You're listening to Michael.
Everything he says is right. And that bifurcation between the people consuming in this country is clear and getting more and more exacerbated by the day.
I keep wondering when we're going to pay the piper for this because
For what?
For the bifurcation. We talk about this all the time. It's, for those who are in the market and dealing with asset gains or own a house that's going up.
Things are pretty good.
Things are pretty good. Mm-hmm. And then there's so many people we know where it's not the case.
It is absolutely a tale of two cities.
There's got to be consequences of that.
There have to be consequences. I think the longer term consequences, let's put the social ones, which are meaningful, to the side. But from a fiscal perspective, the consequences are clear that with all of the transfer payments and fiscal spending and intentionality and policy to try to alleviate that, especially ahead of midterm elections, that's just more and more debt, which in a sense complicates this issue. I think that a lot of the things that we've referred to, whether we're talking about the Fed's next move, whether we're talking about waiting for the consumer, whether we're talking about credit markets, I think probably for, as he said, for the next month or so, certainly before potentially a big IPO that is, on the horizon that has some consequences, some of which are known and some of which are going to be unknown for markets and the flow of money. And before we see some data that comes out, before we hear Warsh in his new position, I think that there is going to be, the market is just going to be a little bit volatile, and nobody's going to have a reason to take a lot more risk or a lot less risk unless the geopolitics change.
So then we'll look forward to the next earnings cycle. Hey, Michael, come on in. So I do, interesting, meaning interesting, possibly a recession here, or is that crazy considering all the dynamics you guys just laid out in terms of the U.S. economy?
I think in general, if we are going to get better productivity, an AI boom that pushes up corporate profits, then risk assets will hold in here. I mean, risk assets, it's remarkable how well they're holding in. Again, I'm having flashbacks to the summer of 2007. They held in for a while. Don't forget, in 2007, the stock market didn't hit a record high until October 31 that year. And the Fed had already started cutting rates because Countrywide was being frozen out of the repo market for all of its mortgage book. So there were tremors going on, and obviously we've had issues with private credit this year. We've had some concerns that maybe layoffs are coming through AI.
Right.
But I think, again, this is what investors are having to grapple with. There's just so many moving. And you have the Middle East situation, which is really... again, historically, the U.S. economy goes into recession because of oil shocks.
Well,
we haven't quite had shocks, I guess.
All right. We're going to leave it on that note. Michael McKenzie, Bloomberg News rates reporter. Allie McCartney here in studio, private wealth advisor, managing director, wealth management with UBS Alignment Partners. Guys, thank you so much. We're going to talk some real assets when we come back.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower, the stocks higher. Semiconductor dip buyers step in. The Dow, the S&P, NASDAQ all remain in the red, but we are off session lows. 20-point drop on the S&P right now. It's 73.82, down by about 0.3%. The Dow lower by 110, down 0.2%, while the NASDAQ Composite Index is down 104. For NASDAQ, a drop of 0.4%. The SOX, the Philadelphia Stock Exchange's Semiconductor Index, up now by just about 1%. We've got the 10-year at 4.65%, with a 2-year 4.09%, and right now the 30-year is at 5.16%. Spot gold down 1.5%, $44.98 the ounce, while West Texas Intermediate crude down 0.7%. WTI 107.83 a barrel on WTI. Brent 110.64, down now by 1.4%. Doug Ostrover, the billionaire co-founder of Blue Owl Capital, is unloading his stake in the NFL's Washington Commanders. Sources tell Bloomberg Ostrover is selling his stake back to the Josh Harris-led ownership group. And the Super Bowl will be heading to Nashville for the first time. The game will be played in Nissan Stadium, a new facility scheduled to open for the 2027 season as home of the NFL's Titans. Recapping, S&P 500 index down 0.3%. The SOX higher by 1%, and West Texas Intermediate crude 107.90 a barrel. The 30-year 5.17%. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Hey, last month, Bloomberg out reporting on Las Vegas, noting that business on the Strip has cooled as tourists are deterred by rising costs, including parking, resort fees, and higher prices for food and drinks. But I'm really curious about what our next guest has to say.
Wouldn't that be everywhere?
I know. Well, they decided to, focus on Vegas.
No, but I feel like costs are going up everywhere.
They are. But I am curious to see what our next guest has to say, because they've opened the Fontainebleau Las Vegas, or as you said it, much better than I did.
I did not say it well. That's why you're saying it.
The $3.7 billion property, it opened in late 2023. Let's get to it with Brett Mufson. He is president and partner at the vertically integrated real estate and hospitality group. It is
Fontainebleau Development.
Fontainebleau Development. I want to make sure I said it well. They've been involved in more than 100+ real estate projects and developments worth more than $27 billion in transaction value. And you guys play across the spectrum. Welcome. I warned you that we're in a little bit of a crazy way today. How are you?
I'm doing great. Thanks for having me.
It's good to have you here. You do a lot in Miami. You do a lot in Vegas. Are those the two places where you see the most opportunities? Because you can play everywhere and anywhere, and you do.
We do, yeah. I think, for our investment thesis is kind of investing, thinking about a paradigm shifts in our business. And what I mean by that is Fontainebleau, large-scale luxury resorts kind of span different income streams. So retail, entertainment, groups, leisure. We span kind of the tide of all of it, right? Nightlife.
Wellness, maritime. You guys go everywhere.
We touch it all, yeah. So I think that those two markets clearly have the diversification of consumers that we can address, and we've had a lot of luck doing that in both markets.
What do you make of Carol's opening about the focus on Las Vegas and the softness or the cooling that some people are saying we're seeing as a result of higher fees?
Yeah, I think that, listen, in 2025 was clearly a year of normalization, right, after two record-breaking years in the prior years. So I think...
coming off of COVID?
Coming off of COVID, yeah, it's a normalization, I think, that we've experienced in 25. In 26, though, if you look at just the calendar, it's incredible to see the demand, right? So LVCVA, which is the Las Vegas Convention Center Authority, they've announced that 2026 may be a banner year for meetings and groups. That's huge for our business, right? Consumer spending, yes, it's up, just like you said earlier, across the board. But, there's been a clear bifurcation in the marketplace. It's a K-shaped economy, as a lot of people are talking about. And, we have fortunately built our product purpose-built for that luxury consumer.
So how much pricing power do you have at the higher end?
We're seeing a lot of pricing. I mean, for us, listen, it's a little bit different. We're in our early years of growth. So every year we're growing year over year. The market...
Double digit?
Double digit.
High teens?
Yeah, about 18% in the first quarter. But if you look at our competitors... they have flat growth, even with visitation being flat, right? And so I think that just means that spend is staying pretty consistent. I mean, there's about 23.8 billion of revenue across the Strip in Las Vegas. It's a lot of money, and it's about $6 billion, which is about 36% increase since pre-COVID levels. And so with that, though, you see, there's a clear bifurcation, and we happen to be continuing to grow, and it's the numbers and the proof's in the pudding with the numbers. People are spending more per visit, right? Even with flat visitation across the board.
Brett, you mentioned convention. I mean, we're going to be headed out to something in June.
I think we still have to buy the tickets.
Yeah,
but yeah, we're going.
And then yesterday
well, I
we
hope
talked.
You're staying with us.
Dude, I don't even know if we have our tickets. Listen, there's a lot that we have to figure out today.
But we were talking to a colleague who was out at Dell World, which was in Vegas. Like, how much of your business, like you guys, rise and fall based on convention activity?
Yeah, it's about 50% of our business.
Okay.
Wow.
And by the way, that spans also in Miami as well. I mean, that's our bread and butter.
So when that's your business, do you find that individuals are paying or companies are paying?
So it's the wallets for a convention spender are, if not better than, depending on the group.
Yeah.
Right. So it all depends on the quality of that group. But if you get the right quality, which is where you work on your patterns and finding the right groups, then yes, it could be better than a.
Well, the reason I ask is this is like we're hearing more and more about people going on. It's called bleisure, I think. It's like business / leisure. So they go somewhere for work, but then they stay a few extra days because they like where they are, and it turns into sort of a mini vacation. And is that a big opportunity for you?
Yeah, absolutely. I mean, we listen. At the end of the day, it's as you know, we're in a screen economy, right? And so our thesis around all of this, and this goes to groups where people need to meet to make deals, for example, right? They can't do it behind a screen. Or if it's a nightlife, which is an experiential experience, right? So people are enjoying that, or just food and beverage and getting in front of people and being, human.
How big
right?
of
I think that's a big deal in today's environment.
How big of a driver is in Las Vegas, at least for you at Fountain Blue, is the Sphere and people coming to see stuff at the Sphere?
We've seen a major uptick in our customers actually. Combining they're visiting us because of the Sphere.
Yeah.
There's no doubt.
You talk to, I've talked to so many people. We've been out there since the Sphere was there.
We kind of keep hoping for a work event so we can actually go.
I don't know. How much do you like fish, Carol?
Yeah, exactly.
Big fish head over here, so maybe, I think they're done.
We tend to do a 24-hour trip when it comes to Vegas. When you look at real estate generally, though, before I get into like areas and stuff, the rate environment, how is that making certain projects more attractive, or are you holding off in hopes that it changes maybe in the next few months?
I think it's a double-edged sword, right?
Yeah.
I think new projects are very difficult to get built. Interest rates don't make that easier. But on the other side of it, we were very fortunate to own an asset that we got built in a market that had zero supply in 15 years.
Yeah.
So that's helpful, right? Barriers to entry are higher for us. But yes, there's no doubt, there's no hiding it that rates are higher than they have been in the past, and I think that's kind of fed through the food chain, so to speak, and that's why you're seeing consumer pricing kind of matching that, right, and offsetting that for owners and operators.
Brett, is it making you guys say, let's just hold off on this project, let's just kind of wait and see where the dust settles, or no? Are you still saying we want to do this? The market looks good, the opportunity looks good. Let's do it.
We play in a premium luxury customer space. And so when you're in that space in a K-shaped environment, which we are in, which I think is going to have, no stopping in the foreseeable future, we think that you can still build to that customer, but it's not without challenges.
Where else do you go to build?
Well, historically we've been in Miami. We have two large-scale hotels there. The Fountain Blue, obviously, in Miami Beach, and then we have Turnberry Isle Resort and Club, which is in Aventura. And then we also have a hotel in Nashville, actually, the Hilton Nashville, which is right in the center, right in
Everybody
downtown.
loves Nashville, man.
It's a great city.
But what about expanding beyond where you already have a presence?
Yeah.
What are the markets that are attractive to you right now?
Well, our pipeline is actually pretty robust. We're looking to expand the Fountain Blue brand across the globe. And no better place to kind of launch it than moving it from Miami after 70 years of history, moving to Las Vegas. And so that was our second entree, and we plan to expand our presence in Las Vegas and then beyond. So we're looking at markets like the Middle East and Dubai. We look at Asia markets, and across the country.
Does the war in the Middle East make you think differently about that as a region?
Makes you take a pause, but at the same time, I think that it's a short-term, situation that they're in, and there's a lot of growth going to happen there, and we're believers in that long term.
Apart from those international markets, what about additional U.S. markets?
Any market for us that has the ability to capture large-scale resort product, which is unique, right? So we need to be in the markets that have enormous group demand, that have an appetite for nightlife, right? Big food and beverage presence. Our skill set is in the lifestyle and luxury resort, but in large scale where you have meetings taking place as well. It's very
New York.
unique. There you go. New York could be on our horizon. I was here for 15 years, so that would be a dream.
Is it on the horizon?
Not yet, but hopefully.
Well, we talked about coming in, just all the different things you guys do: hospitality, residential, commercial, aviation, gaming, culinary, maritime, and more. Wellness, too. I mean, is the growth area really hospitality? Is that where you guys get the most bang for your buck, or
It's across the board. Vegas is a diversified demand, environment.
Yeah.
So is all of our resorts, for that matter, just given the diversity of what we do. But Vegas in particular, they did an incredible job making it the entertainment city of the world, right? The capital of the world. So for us,
it's gone through so many iterations. Remember when it was supposed to be like, bring your family, it's for the family, and then it's kind of gone back.
There's still a lot of families.
But you can still do it all. But you really can. We have the Sphere is another example of it reinventing itself. Allegiant Stadium does incredible events with the Raiders. VGK has an enormous fan base locally, right? You can't forget that the town has really gone from a gaming town to an entertainment business and infrastructure.
Is Florida getting crowded?
Florida, absolutely. There's been a massive amount of growth.
Yeah. Is it less opportunities?
No, in fact, I actually think there's an enormous amount of demand, and the future is bright for Miami, especially South Florida, and I could go on and talk about all the different firms that are moving down there and moving their offices from New York, and we've been the beneficiary of that in the hospitality space.
Anything out there give you pause right now?
Great question. No, I think, listen, the only thing that gives you a pause, at the end of the day, the consumer is hurting.
Yeah.
Right? And we all see that. So, as you invest, we invest at the high end, so we're luxury and fortunate, we're, lucky and fortunate to have that. But
well, what is the typical profile of your customer?
Our customer spends about 2 trips a year coming in and out of Vegas. They got about $150,000 of net worth. On average, right? We're talking about averages, not the aspirational.
Yeah.
So we're very focused on the data and having oil prices where they are and other things. Travel's down, right? Visitation's down, but at the same time, you hear the Delta CEO talking about how 60% of its revenues are coming from the premium cabins. That's our business.
Love those premium cabins. I'm just going to put it out there. Who does it? Who does it? No, you talk to the airlines, right? They just keep expanding.
And the companies are the ones paying, so there's a high willingness to pay on that part.
Brett, this was great. Come back.
No, I appreciate you guys having me.
Yeah.
Fun chat. Appreciate it.
Brett Muffson, he's president partner at Fountain Blue Development, joining us right here in studio. When we come back, we talked about real estate, a hard asset. We've got another one. We're going to talk diamonds, those grown in a lab. We've got the founder of Astria London. That's next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks lower, and the latest bout of weakness in bonds is lifting yields to multi-year highs. S&P right now down 28, a drop there of 0.4%. Dow Industrials down 177, down 0.4. NASDAQ down now by 0.5%. But on an down day for much of the market, we're seeing an up day for the SOX, the Philadelphia Stock Exchange's semiconductor index. Dip buyers coming in. The SOX now up by 0.8%. The 10-year at 4.66% with the 2-year, 4.11%. The 30-year, 5.17% right now. Multi-year highs. We have got spot gold at 4,500 even the ounce, down 1.5%. West Texas Intermediate crude 107.77 a barrel, down 0.8%. Barrel of Brent just above 111 right now, down by about 0.6%. Bitcoin meanwhile down 0.1%, back at 76,750 on Bitcoin. 8,000 job cuts at London-based Standard Chartered, with CEO Bill Winters warning that a push into AI will replace, quote, lower value human capital with technology. ADRs of Standard Chartered, they're down 2.7%. I mentioned oil selling off today. WTI again down 0.8%. Oil majors are higher. ExxonMobil up 1.3%. Chevron now up by 1.4%. ConocoPhillips up by 0.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Tim Stanovic, live here at Bloomberg headquarters in New York City. The global lab-grown diamond market valued between $26 and $30 billion. We've reported this across Bloomberg. The synthetic segment now accounts for over 50% of all engagement rings. Surging volume and falling prices have severely disrupted the $80 billion traditional diamond industry. And I got to say, you walk into any jewelry store. I have a jewelry store that my mom went to, we grew up with, and it's like mined diamonds, real diamonds, I guess you should say, synthetic diamonds right next to it, and then you've got like CZs and some other things. But it's just amazing, the category, when you go into a jewelry store.
I wonder if Natalie Morrison is going to take issue with the word real that you used just
I know.
now.
That's why I hesitated.
She is the founder of Astria London. The brand, by the way, counts Sarah Jessica Parker as its global creative director. Natalie, welcome. Make the point for us, though, this sort of distinction or no distinction between a lab-grown diamond and a diamond that's mined in the quote-unquote traditional way. Is there a difference?
No. There is zero difference. Chemically, optically, structurally, it's a seed of carbon who all grows under the ground and take billions of years to get up to the surface, and a lot of money and deforestation and time to extract, versus putting it in a microwave. But it's a seed of carbon.
But if I take
baby at the end.
If I take one lab-grown and one mined diamond to my friend Brian's dad in Midtown, who's been doing this for 40 years, can he tell the difference between the two?
No, because there is none. There's no gemologist in the world who can see the difference between a lab and a mined diamond. Do you know, I often made a really bad analogy, but it's a little bit like IVF versus an IVF baby. I've got 4 of them. Trust me, they're all the same.
Well said, well said.
All right.
I thought early on when they started doing lab-grown diamonds that there were limitations in size. But tell me, is that not the case? Can you do anything in terms of size, shape? You can do anything.
The more technology advance, the less any constraints we will have. But there is no limits in anything, in color, size, quality. I actually believe today that the quality of lab-grown diamond are superior, especially on the very high end of the diamond market that we are in, that we can find in the mine.
Do you make them like, I think about, what is it, the 4 C's or whatever? Like, do you just make, what's grown in the lab, are they all just the top of the tier, if you will, in terms? No. So you do make different,
That's correct. So any diamonds come from the level of money, investment, quality of the reactors we have, technology behind it. So no diamonds are the same, whether it's a mine or whether it's a lab.
So what is the technology?
So there is 2 types of technology in order to make them. So as I said earlier on, it's a seed of carbon.
Yeah.
So basically, the carbon is the strongest material in the world, right? And which you put in a reactor, and we basically replicate what happened under the ground in those reactors with 2 methods called CVD and HPHT.
So pressure.
One is the pressure intensity, one is replicated through the heat.
Okay.
And by doing that, within 4 to 6 weeks, the diamond is formed.
4 to 6 weeks. How much energy does it take?
Okay, so that's an interesting question, because the biggest challenge at the moment is one, the resale value, and one, the sustainability, which are the main question. Because it's no more a secret that a diamond is a diamond, whether it comes from a lab or a mine. So now the two challenges in terms of education we face. Coming to energy, obviously it takes less energy in a reactor than under the ground. So the reality is it takes a fifth less approximately in a reactor than under the ground. However, it's not 100% sustainable yet. I actually don't believe it. However, it's improving every day with technology, with renewable energy, with using, so today we only use recycled gold. So everything is improving all the time. We don't use water. There's no deforestation. There's no human traffic problems. So there's no many problems that we can talk of.
I know, though, before we got going, we talked about the impact, certainly, on the economies that have depended on mining. And I guess it's safe to say that, I don't know, is that the downside of all of this, you know?
Yeah,
in
sub-Saharan
terms of,
Africa, like Botswana, for example. Jen Jabasaja was here talking to us about that just a few months ago.
Exactly. Like, so there is that downside.
Yeah, it's correct. It's correct that the Botswana economy has relied for years and years on the mine industry. But actually, the world is evolving through technology, and I think countries need to adapt. I think we do need to help those countries. So Australia, for example, give a percentage of their income for giving education to kids in Africa. And I think a lot of companies should do and help anyway, in general, in the corporate world. However, the mine industry, if you look at it today, also have given a lot of the percentage of their mining result to De Beers. And I think today they are potentially buying out De Beers or a part of it. So maybe it's not a bad thing for anyone. The world needs to diversify, and the economy of each country needs to diversify.
I want to talk a little bit about what took so long technologically for us to get here, because, I mean, you know, it was almost like I got engaged a decade ago at this point, and this wasn't even a thing. Like lab-grown diamonds were not even part of the conversation. I talked to young people today, and it's like...
For your wife-to-be, or just, were they around?
So the lab-grown diamond have been around since after the war in 1950. They were actually made
But they weren't really...
It was not prevalent.
Yeah. So out of the diamond market, lab-grown diamond was 1% of the market in 2015.
Yeah, that's...
20,
okay, fair.
Yeah, 5% of the market in 2021, 40% last year. 70% of the engagement ring of the US today are lab-grown diamond. And The Economist is expecting it to be 75% by 2030. I actually think it will go faster than that.
Yeah, so you're illustrating my point perfectly. Why was it such hockey stick growth, and why did for so many years was it under the radar?
Well, the reality is the mine industry has been dominating the industry, the diamond industry, for 100 years, and have done an amazing exercise of marketing with De Beers. First of all, telling us that the diamond is rare. Diamonds are not rare. The reality is there is enough diamonds in the world so that 8 billion people can each have half a carat each, and you will still be having hundreds of thousands of them being hidden somewhere. So the reality is the diamond is not rare, but they've done a beautiful marketing exercise in order to promote it that way.
Why are diamonds still, though, then so expensive? Like, if so many people are choosing for engagement rings to do lab-grown diamonds.
I mean, the lab-grown diamonds that I've seen have not been expensive relative to
because what's the cost?
A mined diamond.
What's the cost differential? Like percentage?
The difference of price is the difference. I'm out.
You're good.
Oh, you're good. You're doing
okay. So the difference of price is approximately 70% between a lab-grown diamond and a mined diamond.
70% cheap, less expensive.
Cheaper.
Yeah.
Lab-grown diamonds are cheaper by 70%. First, it costs less to make them. You don't have to extract everything from the planet. You don't have to. But you know, the real question today is actually the resale value. The biggest, I will say, problems between lab and mine diamond is they should work together. They should work together instead of fighting. Yeah. The biggest critics that mine diamond gives to lab-grown diamond is, oh, there is no resale value. And I always said, yes, obviously, you may have no resale value, but there is a resale value to everything. So let me give you an example.
Just got about 25 seconds.
If you get 2 carats of lab-grown diamond today, you will probably, in D color, which is a high-end what we do, it probably will be $6,000. The same equivalent in mine will be $60,000. By the time you leave the shop, you've already lost $30,000.
Yeah.
So personally, even if I lose everything, I know what I want to buy.
I'm just going to take this and just like show it to my husband at home. Natalie, thank you so much. Natalie Morrison, she's the founder of Astria London. We'll get you back soon. When we come back, we talk stocks on the move.